around 26,250 thereabouts, and lows were maintained around that 26,100 odd mark itself. The Nifty Bank's inability to cross past and close above the 20-day moving average is something that has the bulls slightly worried. So this is something that we will monitor very closely as we move towards the trading session. The advanced decline ratio as well. We started with 1,700 stocks in the green and ended with 1,700 stocks in the red. So that would, keep portfolios feel more red than green, and that is another trend that we will monitor as we move towards the end of the year. The cash market flows, as you pointed out, the FI is selling about 1,700 crores in the cash market, but remember the gross volumes from the FIIs were about 52% lower than what we've seen in December, and December by and large is lower than what we see in the the full part of the year. And trade on thin volumes likely to continue today as well, and that means that there could be high impact costs, big moves on very low volumes. FIIs and index futures too. While the short covering continues, they bought about 1,000 crores. On Wednesday's trading session, they unwound a few longs as well. So while, the net contracts, the shorts reduced to 1.29 lakh from 1.58 lakh, the long exposure still stands at around 12%. So any sustained move above that 26,300 thereabouts could lead to a further short covering up move. All of that rests on whether the Nifty holds on to the 20-day moving average or not, and all data indicates that it will perhaps hold that 26,100 to 26,000 sort of mark, and that's what the option writers are playing for as well. 26,000 put, a fair amount of writing. 26,100 put, an equal amount of writing on that one as well, and then you've seen some writing at the 26,200 call and the 26,250 call. What does all of this action mean? Well, option writers are expecting the Nifty range to be between 26,000 at the lower end to 26,300 at the upper end. The key to track now, in absence of big institutional volumes coming in from the FIs, are the mid and small caps. They've been underperforming. Can we see a relative outperformance on the mid and small caps? And typically, on thin trade, you have a lot of these high beta names like PSUs, rail and defense stocks. They keep buzzing a lot more. We saw glimpses of that on Wednesday. Does that continue today as well or not? And all the way to the end of the year, because of NAV propping and low volume up moves that we see on all these high beta names, is something that I'll be tracking very, very closely.
Thank you very much for that. And I think the biggest disappointment of 2025 was the lack of the US-India trade deal, despite the early start at the beginning of the year. But there has been a significant development, positive diplomatic development as we go into the new year. So India's ambassador to the United States, Vinay Quatra, has met US envoy to India, Sergio Gore, at Mar-a-Lago to discuss strengthening bilateral ties. The talks have focused on expanding trade relations and the future of the India-US partnership. Sharing details on social media, Quatra said the discussions covered shared goals on trade as well as Gore's priorities as he prepares to take charge as the US ambassador to India. The meeting comes as New Delhi and Washington continue efforts to boost cooperation across trade, investment, strategic sectors, and evolving global challenges. So while we wait for the India-US trade deal, the efforts are underway to boost cooperation between India and Washington. So generally, a positive sign for bilateral conversations. But on the tariff issue, we have Stephen Okun, the CEO of APAC Advisor, who told CNBC that US midterms are likely to push President Donald Trump to lower tariffs and that a trade deal with India and China will happen in early 2026. Listen in.
He is going to get pressure from the Republicans in the House as well. And so is India going to win the midterms for the administration? Of course not. Yeah. But it's just every little bit that's going to count. And sure, if you look at the textiles and the things that people buy every day, clothing that they buy every day, that's going to be a difference. China's going to be, of course, the biggest difference of all. And that's where I think you look to see the biggest trade deal, not a reset, but you are going to likely see a trade deal between the U.S. and China and between the U.S. and India in 2026. And I think sooner in the year, because you have to let that run through pricing to get that help in the midterms.
Right, interesting commentary coming in. Let's get in, Prashant Baroda, portfolio manager at Allspring Global Investments on the show. Prashant, season's greetings to you. A holiday thin session, holiday thin period as well, but not short of any news. What do you make of the lack of clarity on India-US trade deal? I mean, it's like waiting for Godot.
Yeah, we've been waiting whole year, right? So I think from US and India perspective, right now it's not at the front stage because US is working on something on Russia and Ukraine. And my sense is if that Russia and Ukraine happens, whether it's first quarter or second quarter deal happens, automatically tariffs will go down from 50 to 25 for us. And then it comes to then maybe they'll work and get to closer to 20. So my sense is that India is probably going to be a beneficiary of the headlines on any Russia and Ukraine deal.
Got that. Prashant, hi. Morning. Rima here. So record highs for the US markets. It's the third consecutive year of gains for the S&P 500. So when you are starting off a new year, 2026, with these gains in the backyard, what will typically happen? Because in the past, if there is a prolonged bull run, then the gains will continue. Markets stay resilient. But if we are closer to the top end after 3 years of a good run, then you do see some mean reversion, some profit booking correction set in. So what, according to you, is going to be, do you think the S&P 500, for instance, will have a positive close in 2026? Will we see some more gains?
Yeah, I think you have to take into mind 2026 is also election year, midterm elections in the US. And the US economy is tied a lot to how, equities and global markets are doing. So I continue to see kind of sustained earnings growth, and maybe we're looking at the 20s being sort of the roaring 20s post the 22 correction. So I do see sustained growth. And I think the catalyst for a lot of these AI names will be whether OpenAI can raise $80 to $100 billion in the first half of next year. And if that happens, I do see continued sustained performance.
Right. What are your thoughts on emerging markets at large? Because increasingly the clamor for emerging markets, particularly the non-Indian ones, is increasing because people are looking at alternatives, and China offers decent value, also AI play. At the same time, a lot of money is moving from India to China. Do you think that will continue into 2026?
China, I think, will continue to do well. I think India will also do well. So in the last few years, it's been like in 2024, India had a great year, and 2023 as well, where China was suffering. It kind of reversed a bit in 2025. I see them growing in lockstep from here on. I think a lot of the frothiness in Indian valuations is coming off, and the government has done good reforms with GST implementation. So I think autos sales will continue to do well from that perspective. So the Indian economy will do well and grow at its own speed. And I think China and Korea will also benefit from the AI trade along with Taiwan as well. So emerging market as a whole looks very good going into next year.
What is your weightage of India in the emerging market All Springs portfolio? In fact, if you could give us the weightage of all the emerging markets.
Yeah, we're slightly overweight in India versus the benchmark. So we've, the Indian market has moved from 2024 to 2025 into from buy at any price to buy at reasonable valuations as well. So we've been overweight sectors which have very reasonable valuations and where we sort of see earnings growth trajectory. We are overweight in the financial space as well in India. And when it comes to the overall EM, we're slightly underweight China, but we don't have any exposure to financials in China. But we are overweight the AI sector within China, and we are overweight Taiwan, Korea as well.
Taiwan and Korea.
Taiwan, we are slightly underweight because the biggest weight, we are overweight TSMC, but we are underweight some other sectors within Taiwan. But Korea, we are definitely overweight. We see the memory plays continuing to do well. And actually, the interesting point today is I heard some news that Apple, which used to go in and just dictate, at what price they'll buy with all these manufacturers, is seeing a lot of pushback given this AI boom, and it's affecting a lot of prices on that front too. So I see continued momentum in a lot of these memory plays going into next year.
All right. And do you have any projections on how you expect earnings to compound in India over the next few years? Because, that's the one missing piece in our puzzle.
Yes. And I think...
Go ahead.
Can you hear me?
Yeah. Go ahead.
Yeah. So from our perspective, India, I think, should continue to compound. Some sectors will compound at decent kind of mid-teens growth rate, and other sectors such as IT and, sort of globally exposed pharma names are still a little challenging within India. So I think if you continue to stay in sort of companies that continue to compound at sort of higher teen rate, you'll get that valuation fill up as well. But we continue to be underweight sort of Indian IT and Indian globally exposed pharma players for now.
Would you look to increase your weightage further on India? Because you've sounded positive, and you have been positive on India over the last couple of months when we've been interacting. I understand that the metric for investment has changed. As you said, buy at any level, any valuation, to buy at a reasonable level and valuation. But from here on, you're slightly overweight India versus the benchmark. Would you look to further increase it?
Yes, I think it is actually what has happened over the last years. Our India portfolio has done really well versus the benchmark. So, some of the names have done much better than the overall benchmark. So we see continued kind of momentum in a lot of these names, and we continue to kind of benefit from them. And we'll take advantage of sort of valuation premium that if some of the names get to rotate into other names which are more subdued, but where we see earnings trajectory maybe on an 18-month perspective. So I think India is going to be a very selective market. You can't buy the entire index. You have to kind of play in pockets, whether it's financials or autos, where you see sort of earnings growth trajectory.
All right, financials and autos, that's what you like, and you stay away from global-facing names. Thanks a lot, Prashant, for joining in and giving us your outlook for 2026, your view on India and the whole host of other global markets as well, playing China via the AI and TSMC theme. Wish you good luck, your team a very happy new year as well, and season's greetings once again.
Same to both of you as well.
All right, Prashant. See you again in 2026. But let's tell you, until then, what are the interactions that are lined up on the show today? Coming up at 8:35, the management of SJS Enterprises to discuss the company's new tech license and supply agreement with a Hong Kong-based company. 9 a.m., Praveen Sahai joins in for an outlook on the consumer durable space. At 9:20, Mihir Vora of Trust Mutual Fund be our market master for the day. Following that, we have the management of Hoodco. Will be chatting with us at 9:45 on their second half of FY26 outlook. And towards the end of the show, we will be speaking with HDFC Bank's Sakshi Gupta and Union Bank of India's Kanika Pasricha on the India macroeconomic outlook. Stay tuned. Right, we take a short break, but before we do that, we will talk about all the specific stocks. We'll get to that in just a bit in our special Top 10 segment. We're looking at VIP Industries, KNR Constructions, Adani End, Ola Electric, Vikran Engineering, all of them on our radar on the back of positive news flow. on the back of negative news flow may perhaps be Castrol India, IEX, Coforge, IndusInd Bank and Strides Pharma. Welcome back. You're watching us here on Bazaar Morning Call on CNBC TV18. On this Boxing Day, the GIFT Nifty indicates that there might be a slight punch to the bull. 62 points on the way down. Let's see whether we open closer to the 20-day moving average and see some support out there or not. But a lot of individual stocks on our radar, and our team is here with us on the stocks that will be in the news this morning. First up, we have Castrol. A big move is what we saw on Friday. And post-market close, there were details on the open offer that came by. Sonal joins in.
Good morning, Manglam. Well, we might not see the same reaction today because finally we have the open offer price. First, the details. There is an open offer from Motion JV Co, Stone Peak and CPP Investment Board to acquire 26% stake in the Castrol India listed entity. They will be buying 25.71 crore shares at 194.04 rupees a share. This price is just at 2.5% premium to what we saw as Wednesday's closing market price. So looks like the reaction won't be as positive as we saw in Wednesday's trading session. Now, interestingly, if we talk about Stone Peak, which will be acquiring 65% stake in Castrol Global, that company has delisted all the recent acquisitions which it made. In 2025, it was Air Transport Services Group. In 2024, it was Acumen Inc. In 2022, it was TK LNG Partners. All of them after acquisition were delisted. So we'll watch out for details for Castrol India as well. For now, the offer price or the open offer price is just at 2.5% premium. So expect a muted reaction to Castrol India stock today.
Indeed, and it's not that the stock has done phenomenally well. In 2025, stock is down 4%, and now the premium also is not very significant. Thank you for explaining that. But VIP?
VIP, a big move is what we saw on Wednesday's trading session, and that continues even now, because now the street is betting on the completion of this deal and perhaps a turnaround coming in. Over the last 5 years, the stock has done virtually nothing. If you discount the 12% gain that we've seen on Wednesday's trading session, then the stock is virtually flat. 5 years ago, it was close to around 350 rupees, now at 408 rupees. Most of the gains seen on Wednesday. Promoters, have sold to multiples, and the deal is complete. Now the promoters own 20%, but 32% has been transferred. Multiples PE bought 2.65 crore shares. Samvibhag Securities, which is basically an entity of Akash Bansali, bought another 1 crore shares, both of them at the price of 388 rupees. Who were the sellers? The promoters. Piramal Vibhuti Investments at around 145 lakh shares, or 1.45 crore shares. And we had DGP Securities, which sold another 1.4 crore shares at 388 rupees. The key to track now, multiples growth turnaround plan for the company. What is it that they do? How much do they invest? And can they withstand the competition? And, the kind of growth runway that Safari has gotten much ahead of VIP.
Got that? So that's the stock you should have on your radar. IEX is another. Vivek is here to tell us more.
Well, that's right. So IEX, expect the stock to be under a bit of pressure today. Economic Times has reported that, market regulator CERC is actually evaluating a revision in transaction fees charged by power exchanges in India. CERC is actually considering a lower uniform fee of rupees 1.5 paise per kilowatt hour on each side, that is both the buying and selling side, for most of the transactions. Remember, currently the exchanges charge 2 paise per kilowatt hour on each side. So from 4 paise per kilowatt hour for a transaction, it could drop down possibly to 3 paise per kilowatt hour. Not only that, for longer duration contracts, they're actually looking to further reduce the fees to 1.25 paise per kilowatt hour. Discussions are currently at a preliminary stage. No final decision has been taken yet. We've reached out to IEX, awaiting a response from them. But prima facie, if this does fructify, it could be negative as far as IEX is concerned.
All right, negative as far as IEX is concerned, down about 2% on Wednesday as well. But Rima, Coforge, the big fundraise news that may perhaps come during market hours today itself.
It may not. 5:30 p.m. is the analyst call. So the Coforge announcement will come prior to that. Now, the stock has been under pressure ever since the company intimated the board that they will meet today for a fundraise announcement. In the last 3 days, stock is down 7%. The news, board meet today to consider a fundraise via a pref or a QIP. Analysts meet 5:30 p.m. Now, what the street fears is that this fundraise is going to be likely for an acquisition. The last fundraise happened in May of 2024, where the company raised money via a QIP to fund the Cigniti acquisition. After that, they did some acquisitions, but they were smaller in size. They were tuck-in acquisitions, which did not require incremental fundraise. What does a fundraise mean for Coforge? 1, equity dilution, and 2, a risk to cash flow discipline. Because in the past, compared to peers, the street was concerned that companies' free cash flow generation was not at par. Free cash flow to PAT, it was not at par. So the stock, the street didn't like that. And then the company course corrected. So is there going to be a risk to the FCF, free cash flow generation, and the conversion? So that's the risk, which is why the street is worried. But again, we'll wait for the details. All
right. So that's about Coforge. Vivek, monetization for KNR construction, that's positive?
Well, absolutely. Monetization, largely along expected lines, given most of the companies that do go ahead and develop HAM projects are now looking at monetizing them because these are yield construction assets and they try and sell it to InvITs. Along similar lines, KNR Construction has executed an SPA, a share purchase agreement with Indus Infra Trust to sell 100% shareholding in 4 of the HAM projects. Both equity as well as debt will be sold to the buyer. Now, what is positive about this particular deal? KNR will receive close to 1,543 crore rupees, which includes 145 crore of surplus cash. The equity investment in the HAM projects that KNR had done was just around 567 crore. So this pegs the valuation at close to 2.7 times price to book, favorable when you're comparing it to past transactions in the same space, which have actually been under 2 times price to book. So positive in terms of valuation. The stock has been pricing it recently as well. A deal is expected to be completed by 30th September. And also remember, Indus Infra Trust 2, the publicly listed InvIT as far as this particular deal is concerned. KNR Construction, positive, but it'll be interesting to see whether post the deal also the stock manages to move higher.
All right. Thanks a lot for that, Vivek. Let's get in Ria with all the other stocks which are making the news this morning. Ria.
Well, good morning, Manglam. Let's start off with IndusInd Bank. This stock is expected to open in the red today. They have received a letter from the SFIO, which is the Serious Fraud Investigation Office, on the 23rd of December for an investigation. The company is seeking relevant relevant information regarding excuse me, an ongoing probe in the company. Now matters relating to the accounting of internal derivatives trade, certain unsubstantiated balances in other accounts as well as other liabilities were reported to the SFIO on the 2nd of June of this year. And now an investigation has been launched for accounting lapses in the derivatives portfolio, which has a financial implication of roughly 1,960 crores to the bank. So the stock is expected to open in the red on the back of this. Moving on to Adani Enterprises, though, positive news flow for this one. The Navi Mumbai International Airport has commenced operations with arrival and departure of its first scheduled passenger flights, and with day one seeing around 48 flights connecting 9 domestic destinations. Now, in terms of the capacity in its initial phase, the airport will be able to handle roughly 20 million passengers and 0.5 million metric ton of cargo per annum. And at its peak capacity, they will be able to handle 90 million passengers and 3.2 million metric ton of cargo per annum. For Ola Electric, positive news flow on this one as well. They have received a sanction order for rupees 367 crore PLI auto scheme incentive payment for FY25. And the last stock which will be in focus is Strides Pharma. The US FDA has issued Form 483 with 4 observations at the company's facility in the US for an investigation that was conducted in the month of December.
Thank you very much for that. Back to Vivek on Vikrant Engineering. Vivek, another order win?
Well, the slew of order wins for Vikrant Engineering to close of the year is quite strong. Over 2,000 crores worth of order received on 23rd. Yesterday, too, the company has given an update to the exchanges. They have received a large 450 crore order from NTPC Renewable Energy Project. This is for a 400 megawatt solar power project in Chitrakoot in the state of Uttar Pradesh. End of Q2 order book was 4,000 crore, a little over 4,000 crore. Now with these two orders, almost 6,500 crore. So strong going, good going as far as Vikrant is concerned.
Thank you very much for that. And also keep your eye on defense names, because the Defense Acquisition Council will be holding a meeting today. And this will be the last one for 2025. Will we get any sort of announcements, MOUs, kind of deals or, order wins? So defense stocks should be on your radar. Let's do a quick recap then of the top stocks. Stocks with positive news flow are VIP, KNR Construction, Adani Enterprises, Ola Electric, Vikrant Engineering. Stocks with negative news flow are Castrol India, REX, Coforge, IndusInd Bank and Strides Pharma. Get into a break. On the other side, we'll invite the management of SJS Enterprises on the back of their new deal wins and partnerships. Stay tuned. Welcome back. Let's invite SGS Enterprises, the first management on the show today. Now, this is a company which makes decorative parts for automobiles and consumer appliances. So, for instance, they make 3D badges, the aluminum badges that you see for branding on vehicles, the stickers on cars, which are called exterior decals. Now, recently, the company signed a technology license and supply agreement with Hong Kong-based BOE Varitronics for a period of 5 years to manufacture automotive display systems for four-wheelers within India. Sanjay Thapar, Executive Director, Group CEO at SGS Enterprises, is now with us on the show. Good morning, Sanjay. I'm Rima, and season's greetings to you and everyone at the company.
Good morning, Rima. Same to you and everyone at the studio.
Thank you for joining in. Now, this automotive smart display market is growing very rapidly. In all our cars, we have larger screens, infotainments, digital cockpits, etc. So is this a new vertical for you? Can you explain this partnership that you have with Varitronics? What will be the expected revenue, by when, and how much do you have to share with Varitronics for this technology license?
SGS is, as you know, aesthetics, a decorative aesthetics company, and we've expanded into cockpit components. So we used to make clusters, and these clusters are now becoming digital across the auto chain. And what we have, what we see for the future really is that these modern vehicles have digital cockpits. And with this TLA, what we are doing is bringing one of the world's largest display manufacturers, which is BOE. And we are joining hand with them. SGS is a leading player in the automotive aesthetic components. And we will locally produce these displays for a more resilient supply chain for the end customer. So that's what we bring, world-class technology, localized in India, which will reduce imports and will add to the import substitution.
Can't hear you
think,
very well,
the audio's,
Sanjay. I think we need to try.
Yeah, the audio is getting muffled a little bit. Maybe you want to speak up a little? You want to try speaking up?
Let me try again.
Yes, go ahead.
So what we will do here is localize these advanced displays that BOE supplies. So BOE is one of the largest manufacturers of display systems in the world. And SGS has very strong, deep relationship with customers and local manufacturing experience. So both these combined would deliver to Indian customers advanced display technologies at localized in India, which will help with import substitution. Currently, most of the displays get imported into India, and we hope to be one of the early starters in this business in India.
Two-part question here. What is the kind of revenue that comes in from the Indian markets from this particular product? What are the realizations here? How do you plan to expand it? Would you reduce costs for all the Indian players here? And what's the kind of money that you have to share with those guys? So one is on the opportunity size, and the second is, the money that you will be sharing with them.
This is a technology license agreement, so not a joint venture. So we will not share any money with them. So we will get know-how, we will produce. The investment is done by SGS currently. As we go along, I would imagine that this would fructify or change into a JV. So at the moment, it is purely SGS investment, supported very strongly by BOE, who will send their technicians, engineers to help develop that capability here. As you know, these modern vehicles are now becoming more and more about a digital experience on the cockpit. So you have the display system, you have the touch functionality, and the user experience, in fact, is defined by the display. So we hope to bring that next level of enhanced user experience to customers in India through this collaboration.
Sanjay, when will you start manufacturing these advanced display systems, locally in India? Is it FY27, FY28? How many units, or what will be the overall production and therefore the revenues that you will generate?
So the plant is ready. We have a leased facility which is available. Equipment is on order. We should, by FY27, we should have the plant and equipment ready, and FY28 is when we will see revenues coming out of this. The automotive center stack display system market currently is estimated to be about 1,500 crores, which could grow up to 5,000, 6,000 crores by FY 2030. So we have, it's too early to say what revenues will come out of this, but we are in that direction where we will hope to be one of the early beneficiaries of localization in India.
What about margins? Because you've enjoyed margins of 27, 28%. Will this be higher margins?
To begin with, the components will be imported and we'll assemble them. But our plans are to localize the cover glass and the backlight unit with the support of BOE, and that should help improve margins. Directionally, we look at high margin businesses, and as we go along, we understand this business better. We will try and enhance this to be directionally in that margin bracket that we normally operate. But this would not, this is a very high value item. So I don't imagine that this would be at that same margin that we currently earn, but gradually we will get there. We have quite a strong track record in terms of enhancing margins to operational efficiencies, and we hope to bring that to this venture as well.
Okay, just one more question. You said FY28 revenues will materialize. Can you give us an indication of what could be the revenues in FY28, FY29? Do you have any early orders that you've signed with? And what will be the total production at your end?
We will build capacity to, in the first phase, we build capacity to make 200,000 displays a year. And I will not be able to share with you details of the customers that we are engaging with, but we are in advanced stage of negotiation with key customers in India.
All right. And since we have you with us, beyond the autos, I remember two growth drivers for you. One, you said that you are looking at building your presence in the consumer space, which accounts for about 20% of your revenues right now. And the other one was exports, which you currently about a tenth of your revenue. You expect it to grow much faster than your overall business. Where are you on both those counts, and what are your updated targets for the same?
We are performing well. So last 2 quarters, we won some very significant businesses across the world, Latin America, North America, Europe. We started supplies last quarter to these customers. These are very large wins. So even in the consumer business, we won businesses for a very key client in North America, where we are the sole suppliers for an overlay that we supply, which is a human machine interface part that goes on washing machines. Automotive nameplates are a big business for us. So these large acquisitions that I said, we own the branding for a very large brand, a North American brand across the world. And we hope to repeat that with others. So in terms of guidance, what I've guided is FY28 of our consolidated revenue, I imagine 40 to 15% coming from exports.
Okay. Any new customers that you've added? Because I remember when you added Hero MotoCorp, there was a big jump in your revenues. And when you added Nissan in your exports, there was a surge in the exports. So in Q3, since we've not spoken to you since then, any new customers you've signed on or likely to in Q3, Q4?
This is daily life at SJS. So we keep winning new programs from same customers. We already have a very large portfolio of customers. We supply to many of them already. So we keep growing that, wait for the Q3 results for us to announce any new customers, but largely it is mining the same customers for more programs because these are large mega accounts. And I think we are just at the tip of the iceberg. There's huge runway for growth.
Yeah, there is huge runway for growth. If you could give us a sense on, what your current order book is right now.
We don't guide.
From the end of, the last quarter to now, how many orders have you won? What's the updated number here?
We don't announce order book because these are aesthetic decorative parts. So fundamentally, there's a design modification that happens. But as I said, we won large businesses from Stellantis, from Nissan, from Whirlpool, and that continues to grow. So the order book is robust. We had announced 300 crores orders to be executed over the next 6 to 7 years from one customer. Another customer is about 50 crores revenue pool, and another customer is about 30 crores. So these are these 2-3 big that we've announced so far. And as I said, we are working on more business.
You said in the first phase, getting back to the partnership with BOE, the TLA, the Technology License Agreement with BOE, in the first phase, your capacity will be 200,000 displays per year.
That's right.
And that will be ready by FY28. You should be ready
Yes.
with this. And when do you foresee the second phase of capacity expansion coming on stream? And for all this, what will be the total capex that you've outlined?
So currently, we've allocated 60 crores for this first phase of investment. And beyond that, as business develops, we will put in more money. As you are aware, SDS is a completely debt-free company. Internal cash accruals are what we look at when we expand. So we hope to continue that with internal accruals. So CapEx is not the issue. Based on revenue visibility, order wins, we will add capacity as we go along.
You had told us that you plan to double your revenue in 3 to 4 years. Now, with this incremental revenue stream coming on board in FY28, is there any change to that target?
No, this is a part of that plan. So what we said to double our revenue, so we are opening up new verticals to increase our TAM, and that's the way we go.
Great conversation, Sanjay, for joining in. That's SJS Enterprises.
All right, with that, what we'll do is take a short break, wish Sanjay and his team a very happy 2026. On the other side, Technical Trades with Sudeep Shah and Mitesh Thakkar. Stay with us.
Welcome back. Let's now go across to Hormuz for the big delivery movers that we had on 24th, which stood out for the kind of volumes and price action.
Good morning, Rima, and some interesting names in this list in the broader markets, even though the market breadth turned awry by the close of the session. JBM Auto is one such name. It was the biggest single day gain and volumes that the stock had seen in the last 3 months, and Wednesday's volumes were the total of the last 64 sessions put together for JBM Auto, with over 3.5 crore shares being traded. The 20-day average is just under 4 lakh shares, and out of those 3.5 crore shares, only 14.5 lakh shares were marked for delivery. So delivery volumes remained disappointing, even though the 20-day average is is only 75,000 shares. Now, Wednesday's turnover, which was close to 2,300 crore, is almost the same as the company's free float market cap, and the stock is down almost 25% from its 52-week high, which is close to around 850 rupees. Now, Prime Focus has been one stock that has been on the upswing over the last month or so. There's a fifth straight day of gains. The stock has declined only in 3 out of the 18 trading sessions we have had in December so far. Look at the volumes as well. Although the stock has kept moving higher, the volumes over the last 3 days have been on the decline, and only 75 lakh shares were traded, which is below the 20-day average of 95 lakh shares. And out of those 75 lakh shares, 26 lakh shares were marked for delivery, the 20-day average of around 14 lakh shares. But the last 1 month has seen the stock gain over 44% in value and is trading at record high levels. And lastly, KNR Constructions is a stock that has been beaten down all through this year. There's a fourth straight day of gains on Wednesday. It's up 20% in these last 4 trading sessions. And today as well, the stock remains in focus, mind you. Wednesday's volumes were the highest in 3 months. Over 1.5 crore shares were traded, the 20-day average of just over 13 lakh shares. And out of those 1.5 crore shares that were traded, 20 lakh shares were marked for delivery, the 20-day average of around 5.5 lakh shares. The stock down 50% in 2025, and it is turning out to be the worst year that it has had since its listing back in 2008. It would look to reverse that trend in the last few trading sessions of the year.
Take that point, Hormaz. Thank you so much for putting all those stocks on our radar. JBM Auto, I remember on December 22nd, the exchanges wrote to them asking them for whether there was a reason for the big spurt in volumes as well. The company said no, it was largely market driven, and turns out that on Wednesday as well, there was a fair amount of trade, the biggest single day gain and volume in the last 3 months. And KNR Constructions, that's a stock that we probably discussed with Siddharth Khemka of Motilal Oswal Financial Services, joining us now. Sid, good morning. It's Boxing Day, so, before a weekend and after a holiday, so sandwiched. And the street expects low volume, high moves to continue on a lot of these smaller names, largely in absence of big institutions trading with huge volumes today. So, individual stocks, let's start with KNR Constructions itself. The stock over the last 4 trading sessions has gained about 20%. And now we have the news that the company has gone ahead and decided to monetize some of their road assets worth nearly 1,500 crore rupees. How much of that do you think is in the price?
Hi, good morning, Mangalam. First of all, season's greeting to you, Rima, and the entire viewers of CNBC. I think, as you rightly said, some stock-specific action we'll see, otherwise a lackluster market until the start of 2026. I think this is something especially for KNR, I think this is a positive development which is expected to receive about 1,543 crores. The monetization of 4 assets, I think definitely this is something which the market was not factoring in, and with the upcoming budget, there is some hope that after last 2 years of dismal capex, there could be some acceleration in capex, given that the government has done a lot to boost consumption, including the GST rate cuts. So if you look at some of the defense, railway stocks that are in momentum, and I think even infra stocks like KNR could do well, we definitely have a positive view on KNR with a target price of 190.
All right, you have a positive view on KNR with a target price of 190. What are your thoughts on Castrol? Do you track that one? Because, the acquirer has made an open offer, and there is history of the acquirer actually going ahead and delisting all the companies that it's gone ahead and acquired in the past. Do you have a view on Castrol post the happenings of Wednesday rather?
Yes. Yeah, Mangalam. So if you look at the parent company, Castrol has been on a lookout for a stake sale for a couple of months now, and I think that was in the news. The open offer is the first step that they have to mandatorily do in the Indian markets, which they have done, which is closer to the CMP. In respect to the core business, I think a change in management that could lead to more strategic thought process going forward, bring in more focus towards the new age businesses, the EV-based focused businesses. I think overall we believe that that could be a big positive. And if any delisting thing happens, I think that could be at a much significant premium, given that the stock has been under pressure for quite some time. It's a cash-rich business in India, high dividend yield. So the valuation could be much higher if the company goes for a delisting. But for now, I think the first step is to do the mandatory 26% open offer. I think long term, this is a strong brand. We are confident of the company ability to maintain its profitability and the newer management steering the company towards the newer business segment. So we remain positive. Again, in terms of valuation, we have a target price of 260, which is almost 40% upside from current levels.
All right. And as a house, you all have been positive on VIP as well. I remember a note coming by earlier in September. Post this deal, which completed on Wednesday, where the promoters sold their 32% stake to multiples, with them holding 20% right now. Do you believe that a turnaround is underway? And what are the things that multiples has to get right for your bet to fall in place?
So yeah, I think multiple things in way for multiples as well. I think that is again because of the lack of succession planning. They were looking out to sell out, and I think there is a lot of the market share loss in the recent past to some of the newer D2C brands. That has been a key concern. I think they would look at a refreshed strategy anchored around augmenting the supply chain efficiency. There has to be a strong focus on secondary sales, divesting some of the low profitability brands, and also look at closing some of the loss-making EBOs. I think that is something, a lot of things on hand for multiples. In terms of the legacy brand, a very strong brand recall, so that should be a big positive for multiples going forward. And we are optimistic about the long-term growth story in the overall luggage industry. Travel has been on the boom, and I think VIP with a new management in seat that could steer to a strong growth going forward.
What about Coforge? Would you have a view on Coforge? The board meets today. Stock has been a bit of an underperformer after a record run in the prior 2-3 years. There is some news report. Money Control is reporting that Coforge is looking to buy a company called Encora, which is led by an Indian person. The CEO of Encora is Anand Birje, who was previously the president and a founding member of HCL Technology. And the transaction size is supposed to be $1 billion. So that's a large one to digest if it comes through.
So yeah, if you look at purely in terms of the acquisition announced, I think that's a big acquisition. And for
if it comes through, because we don't have the details, this is what, oh, there you have it. We have it now. Sources say, sources to CNBC-TV18, Coforge in talks to acquire Encora at a transaction valued at $2 billion. Encora is currently owned by private equity firm Advent International. So this is, I think, a big transaction, $2 billion.
Big transaction indeed. What we'll do is we'll take this short break, come back, get you details, and perhaps get in, our correspondent who's breaking this story as well to give us some more details on what he or she is picking up. That's about, Coforge and Encora likely to be bought for about $2 billion. Take a short break, come back pre-opening, and also with us will be Praveen Sahai of PL Capital for his perspective on India's consumer durable sector. We'll also connect with Sudeep Shah and Mitesh Thakkar for technical trades.
Welcome back. This is Bazaar Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Pre-opening rates will come in just a bit. Before that, let's get in some technical ideas. Sudeep Shah, Head of Technical and Derivative Research at SBI Securities, and Mitesh Thakkar joining in to help with some ideas. Good morning, gentlemen. Mitesh, it looks like it's going to be a slightly softish start, but markets have been consolidating within this range. Are you sensing any breakout? What would be the Nifty Bank trade?
Yeah. Good morning. So, a breakout may not happen immediately, but what is good is that there is no breakdown happening. You look at the markets for the last about 2.5 months. We got a low at about 24,600 and then have rallied to about all-time highs of 26,200, even made a fresh high on an intraday basis. And the markets are kind of consolidating. So consolidating just around the previous highs is not a negative sign unless until there's a clear sign of a breakdown. And therefore, I believe that eventually there is a stronger chance of us breaking beyond 26,380, 400 and heading higher. But till then, the markets are still consolidating. So buying on the index, if somebody's taking a fresh position for a good risk reward ratio, should be closer to about 25,800.
All right. Sudeep, your index calls?
Good morning. See, what we feel is that markets in the next couple of days may be in a range between 25,900 and 26,300, 26,350, this 300, 350 point range. But yes, by and large, overall, from a positional perspective, we feel that till this 25,800, 25,900 zone is guarded, we may see eventually we may see a upside up to 26,500 and beyond. So positionally, the view is very strong. From the next couple of days, since we are just into this holiday mood, I feel the markets may be in a range between 25,950, 25,980 and 26,250, 300 thereabouts on the upside.
All right. Mitesh, your stock picks?
Morning, Mangalam. I have 2 buys and 2 sells today. A buy on Nuvama, which made a fresh swing high by around 7,600. I think the closing was 76.15. So buy around 7,600 with a stop just below 7,500 and a target of 7,800 is what I recommend. Similarly, Dalmia Bharat Cements is a buy. Let it cross 2115, that's the pivot. So above that, buy with a stop at about 2084 for targets of 2175. On the selling side is Adani Enterprises with a stop at 2246. And I would look at a short-term target of around 2170. And sell on Axis Bank with a stop at 1242 for targets of 1195.
Right, a long on Nuvama Wealth and a short on Axis Bank and Adani. And Sudeep, do you have a long short mix or you're veering towards one side of trade?
One side of trade, Mangalam. 2 buys. One is 361 VAM Limited, Wealth Asset Management. Here we've seen a breakout, a symmetrical triangle breakout on the weekly charts, as well as the stock is closed at its highest level post July 2025. So what we feel is that this breakout could continue and fructify on the upside. 1170 is the stop loss that we are putting at, and the targets on the upside that we feel here could come is 1250, 1270 levels. So 361 is a buy. The second stock is CSB Bank. Now, we have seen all these mid-sized private banks moving and giving good returns in the last several weeks. And now one more bank, CSB Bank, has broken out of its consolidation. We feel here the stock is well poised to make a move up to 445, 450 levels in the coming few weeks. On the downside, one can keep a stop loss at 407.
All right, we take that point. Thanks a lot, gentlemen, for stopping by. We'll get back to you at 9:10 for your calls there, and thereafter, once the market opens as well. Meanwhile, just before we get to the news, the bottom of your screen, and speak to Praveen Sahai, just watch out for the quick commerce space this morning. Why do I say that? Because our colleague is finding out that Zepto will perhaps file its $750 million to $800 million IPO in December itself, most likely today. And their order volume and net sales value have grown over the last 6 months by about 45%. And they will have the largest cash position of any new age company going public post this IPO. Remember, they have about $1 billion of cash. And this would be interesting at a time when Swiggy has recently raised about $1.5 billion itself. And Zomato sits on nearly $2 billion of cash themselves. Interestingly, we also have a note coming in from CLSA on the quick commerce space. They're saying for the week ended 15th December, Zepto saw the highest week-over-week increase of 1.2 million, followed by Blinkit at around 0.4 million and JioMart as well. These are user additions. Swiggy, Instamart and Big Basket each added about 0.3 million users week on week, and Blinkit saw about 1 million at 0.6 downloads for the week versus Swiggy and Instamart at around 1 million and 0.5 million at Zepto itself. Within food delivery, Zomato's weekly average users week on week was slightly weak, while Swiggy saw a 1.3 million increase. All of the beauty players saw a minor decline in weekly average users, and within e-commerce, it was Flipkart which saw a decline of 4.2 million users week on week. Meesho was flat, and Amazon saw a minor uptick of 2.4 million users. But Zepto week on week was doing extremely well. Quick commerce on our radar. Let's move on from quick commerce to consumer durables. Now we're joined by Praveen Sahai, who's the research analyst at PL Capital. Praveen, winter's been slightly harsh in many parts of the country, but not as harsh as what the projections were. What does that do to the inventory lying with a lot of these retail sales players, and as a result of which, your call on the consumer discretionary durable space?
Yeah, hi, Manglam. Thank you for having me. On the RAC especially, the seasonal product, if you ask me, definitely the inventory is at the higher level, 65 days, or you can call it a 3 million around, and which is a quite a higher on the, throughout the season, like from the summer, bad summer, and then second quarter, and now we are in third quarter, and still with a higher inventory. Definitely, that's one of the concern we are carrying right now for the next season. The second also concerning part what we are looking at is the RM price inflation, or with the B norm change, there would be a further increase in the cost. So how to pass on those? So definitely the concern is still prevail. This quarter is expected to be a muted. There is no much of a relief from the GST cut in terms of the volume. But more I am worrying on the margin front, because if they will not able to pass on the RM price inflation or the BE norm, then that will be a big problem for the margin front, especially for the RSC players. And the second thing on the so far the winter has been quite normal, not very harsh. Then we have to look at like how the Jan and the Fab, whether it's extended or not, like of rainy season. If that will not, then definitely like of usually we see chronology when there is a harsh rainy season, harsh winter, then after there is a harsh summer or the extended summer. So that is another concern we are carrying with actually right now. So far, however, if I look at sequentially, there would be some improvement in the the inventory, or the slight improvement you can say in the secondary sales, but not a material to impact the numbers. Numbers is expected to be very soft for the Q3.
And there was recently an analyst initiation coming in on LG Electronics as well. Not sure whether you cover that or not, but the note was on the sell side saying that perhaps they are losing market share to a lot of the listed larger players too. If you could give us a sense on your one view on LG Electronics, and secondly, your pecking order and target prices on the consumer durable space.
Yeah, we have a coverage on the LG, and also as you asked about our top pick, definitely the LG is one of them. And in the consumer durable, why we like the LG is a diversified throughout the consumer durable segment. One, second thing is if you look at in all the large white goods, they are almost the market leader. They have very good penetration in the premium portfolio. And regarding the market share, definitely they are protecting their premium market share, which is a more good for the margin front or the profitability front. So that's why we are liking that. And even their penetration throughout the B2B and the AMC businesses, which they wanted to grow up very faster from here, is expected to drive the numbers as well in the coming years. So, and also if I look at a 9-10% CAGR in the earning, That stock is even cheaper than the Havels right now. At the same offer like Voltas trading at 36 time FY28 earning. On that front also, it's looking better off.
All right, so LG continues to remain your top picks. You're not too worried about the market share loss because at the premium end, which is not margin accretive, they are continuing to hold their market share. Praveen, thank you so much for joining in. Wish you and your team very happy New Year and season's greetings as well. With that, let's get to the important story that our colleague Rachna just broke, which is that Coforge is in advanced talks to acquire a stake in Encora, a $2 billion deal. Rachna joins in with more details. Rachna.
Sources tell us that Coforge is in advanced talks to acquire a majority stake in Encora in a transaction that's pegged at around $2 billion. Now, the deal would mark a potential exit for private equity major Advent International, which currently holds a majority stake in the company. Now, to put this in context, Advent entered Encora in 2021, acquiring the company from Warburg Pincus at a valuation of about $1.5 billion. Now, Warburg had bagged Encora during its earlier phase of expansion, helping build scale in offshore delivery and deepen its US enterprise client base before selling out to Advent as the company transitioned into a more mature digital engineering platform. Now, Encora operates squarely in the digital engineering and product development space. Its core strengths lie in cloud-native application development, data engineering platform, modernization and enterprise software services with a strong concentration of clients in North America. Over the last few years, under Advent's ownership, Encora expanded both organically and through acquisitions, positioning itself as a high-growth engineering-led alternative to traditional IT outsourcing firms. For Coforge, this would be a transformational transaction. The company has historically been a mid-sized IT services player with strength in BFSI and travel tech, but limited exposure to deep product engineering. Encora would significantly shift that mix is what we're picking up from our sources. Now, as of March 2025, Coforge reported a net cash flow of around 474 crore rupees, cash and reserves of roughly 6,000 crore rupees. That balance sheet does provide flexibility, but clearly not enough to fund a $2 billion deal outright. As a result, Coforge's board is expected to consider a fundraise, potentially combining debt and equity to support this acquisition.
Thank you very much for that. Transformational indeed, but a very ambitious one. Coforge's top line itself was $1.5 billion in FY25. That said, it's been growing rapidly. Last year, FY25, the company's revenue growth was in excess of 30%, building on the 13-14% growth that it had in the prior years. So that's Coforge for you. We'll wait by to see how the street reacts to digesting a large acquisition by Coforge. Mitesh is now back with us for a 9:10 call.
See, I'll go with a sell on Axis Bank for targets of around 11.95.
All right, sell on Axis Bank. Sudeep, you have a call? All right, okay, so sell on Axis Bank. Let's do a quick recap of the top stocks that we covered earlier this morning before we, wait for market opening. In the positive arena, we're looking at VIP Industries and KNR Constructions. Alongside that, stocks in focus would be Adani Ent, Ola Electric, Vikran Engineering, and Castrol India, IEX, Coforge, along with IndusInd Bank and Strides Pharma. So a bunch of stocks which are likely to be on our radar. GIFT Nifty last indicated a 60-point downtick at the open, and the pre-open has settled largely flattish, so which is more of an outperformance as compared to what the GIFT Nifty was suggesting. So we have a couple of seconds to go before we look at trade. In pre-open, a couple of stocks that are doing well. Lenskart is one which is up, settled slightly higher. There is a brokerage note that is coming on Lenskart as well. Avendis has initiated coverage, largely positive on that one. Vikran Engineering, which saw about a 7% gain on Wednesday's trading session, has won another order of 450 crores. So let's see how that stock pans out. And finally, we'll watch out for how KNR Constructions also does after a 7% gain that we saw on Wednesday, and then after the news of them having monetized assets worth 1,500 crores. And now in pre-open, it is up around 8.5% too. So 3 seconds to go for the market to open. As we look at it, the Nifty is open. There goes the opening bell, and it is a slightly reddish start, but nothing as lower as what the GIFT Nifty was indicating. And the Sensex too has opened about 0.2% lower, with the Nifty Bank around 59,112 mark. Remember, for the Nifty Bank, closing above that 59,300 mark, or the 20-day moving average, will be extremely crucial to track. The heat map comes up for you. The advanced decline, at least at the opening, is fairly split right down the middle, and that's exactly what the heat map is telling. More red than green, actually. Adani Ent and ICICI Bank, not much changed. In the gainers list, you do have Trent, which was among the gainers on Wednesday's trading session as well. And prior to that too, we saw some bit of fund buying supply getting over on that counter. BEL doing well. A lot of these defense and PSU names likely to do better as we move towards low volume trade. But Eternal is lower. Among the top losers on the Nifty, Wipro, Bharti Enterprise, Bharti Airtel and ITC along with HCL Tech, Titan, all of them marginally in the red. So heat map, more decliners on the Nifty than the frontliners. Rima.
Well, mid-cap index opens mildly lower, but a flattish bias. Negative advanced decline ratio in favor of the stocks declining, but the gap is not large. About 1,000 stocks advancing for 1,300 stocks in the red. Vikran Engineering is clearly a big mover today. Large volume stock opens out with a gain of about 5%, taking its weekly rally to about 14% on the back of order wins. Ola Electric is having a positive start to trade on the back of getting in some PLI benefits in excess of 300 crores. Hindustan Copper has been one of the big movers of this year, 82% rally as we speak on the back of the rise in silver prices. So Hindustan Copper continues to do well, as are many of the ETFs, whether it's Tata Silver ETF, HDFC ETF, Nippon India Silver ETF, gains of close to about 4.5%. Castrol India is now inching towards the open offer price. So Castrol India opens out with a gain of about 2%. You've got strength coming in Lenskart. IEX is a drag. IEX has slipped about 3.5%. Some concerns on the regulatory front, but it's reports-based as of now. VIP is struggling, 3% lower in opening trade. And Zepto, looking to file those confidential papers for the IPO, looking to raise some more money, is putting pressure on Swiggy and Eternal. So, that is a pocket where you are seeing weakness today. Swiggy down by nearly 2% and Eternal is the top Nifty loser right now. Eternal is the top Nifty loser. BEL is also seeing some buying interest. I think there is a Bloomberg report about a potential MOU between BEL and Astra Micro. So that's got the street a tad bit excited. The mid-cap index has managed to inch back into the green, but very, very flat as we speak. Pretty much unchanged now on the key indices.
Pretty much unchanged, and that's exactly what the expectation was. The stock in the morning, though, on the downside has to be IEX. The reports are suggesting that the CERC will evaluate revision in transaction fees charged by power exchanges. So there have been a lot of regulatory overhangs on IEX in the past as well. Now the stock down almost 3.5%. And with the copper prices being at record high, along with silver being at record high, Hind Zinc, Hind Copper seems like the obvious beneficiaries here, and we've seen that up move in the past as well. Bharat Dynamics is not BEL is not the only defense stock which is doing well. Bharat Dynamics is the other one, and then we have seen some traction build in a lot of these defense PSUs and rail stocks as well. So Mazagon Dock is doing well. We've seen some traction in IRFC, Titagarh Rail Systems. All these stocks doing fairly well. Solar Industries is the other one from the defense pack. So it's largely defense and rail along with PSUs which are seeing a spike. Ola Electric opened fairly well in the green, currently has given up a wee bit from its highs. Castrol continues to surge. So after an 8% up move on Wednesday, that settled with just about 2% in terms of gains. Castrol is up around 3.5% right now, and VIP is seeing a vociferous amount of profit booking. Greenply Industries has seen a lot of volume uptake this morning. Volumes are nearly 30-35% of what we see on a daily basis in just the first take. And Greenply Industries, not Greenplanel, Greenply comes up for you, sitting with a gain of 5.5% at the open itself. So a large part of these moves could also be on high impact because of thinner volumes. So any more volumes than what one sees usually would lead to a disproportionate amount of price change, as we are seeing thinly traded moves. The Nifty has recovered from the lows. Mid-cap index now up around 0.1%. With that, what we'll do is welcome our market master for the day in our studios. Mihir Vora, the Chief Investment Officer at Trust Mutual Fund, joins in now. Mihir, as always, a pleasure speaking with you. And we're looking at 2025 as the lost year for a lot of the larger names, a lot of the mid-caps, broader markets as well. We just about managed to hold resilient this year. And even if you account for, the decline that we've seen in the rupee, then we're negative, severe underperformance. So let's start with your open big question for 2026. What are your key aspirations, hopes, and what do you think will really outperform in 2026? Where should one put their money?
Morning, Mangalam. Thanks for having me, and season's greetings to you and all your viewers. 2025, as you said, you can say it's a lost year, but I'd say that it's a lost year after many years of outperformance. So, the whole concept of mean reversion probably worked out this year. And while we did see a sharp correction in some of the mid-cap names and the small-cap names, we are seeing in the last few weeks a bit of a bounce back also. So I don't think all is lost. We also must understand that 2025 had a high base of expectations as well as valuations to start from. So to that extent, we have done actually quite well in spite of the Sindoor episode, in spite of the worst of the tariffs that we saw from the US, and that still is not resolved. So many headwinds in terms of valuations as well as fundamentals, weakening currency, etc. So the fact that we are still at this level as far as the Nifty is concerned is actually a positive, I would say, considering where we started from. The good thing now as we enter 2026 is that the base of expectations has been reset. We've seen a price correction in the broader market. We've, of course, seen a time correction in the overall market. And with the currency being where it is, I think a small trigger like the trade deal happening can actually lead to the Indian outperformance in 2026. So I think expectations is everything in the market. Right now, expectations are low. Domestic flows are, healthy. FII flows have been significantly negative. If FII flows turn positive, I think we are in for a good 26. So I don't think the ask is very high from 26.
What would it take for the FII flows to turn positive, and where are you on the earnings expectations?
So earnings expectations, I think is cyclical. Typically what I've seen is that as the market moves, the earnings expectations also keep moving. So as of now, we are talking about single digit earnings growth, high single digits for the large caps and a little higher for the mid and small caps. So I think that expectation continues. From the FII point of view, I think the big trigger will be stabilization of the currency and the trade deal happening, because that I think in FII's mind, the high tariffs that India is facing puts it a notch under China. See, till 2020, early 25 or end of 24, China was a no-no. In the sense, it was very skeptical. People didn't want to trust China. It was almost untouchable, and we've seen that 20-year underperformance of China in the equities markets. But the DeepSeek moment actually, coincided with extreme valuation, and when people wanted to reallocate, they started reallocating to China. So I think a decent amount of money went to China and emerging markets. India actually got left out. So I think this is the year, 2026 will be the year when India can catch up if the trade deal happens. And I think it's only a question of time. India and US can't afford not to have a deal, whether it's in a few weeks or a few months, I don't know. But it will happen, and that will be a significant trigger.
Okay. Mihir, on mid-cap IT, I mean, the favorites were a Coforge and Persistent. And now we're getting reports about a very large deal by Coforge. I mean, Coforge's market cap is $6.5 billion. And I don't know if you caught what Rachna was telling us, that they're looking to buy a mid-cap AI sort of a company called Encora, which is backed by Advent for $2 billion. So it's a transformational, it pushes it up in the big league. But it's a big deal to digest also, and will involve a lot of fundraise because it doesn't have too much cash on its books. So keeping that in context, if it comes through, how will the market read it? As a investment, as a CIO, when such news breaks, how do you analyze it?
So, typically, obviously, while I can't comment on individual stocks, but it's always about, what capabilities are you acquiring and what's the valuation at which you are acquiring. So if there's a good balance of capabilities and valuations, then I think the market should treat it positively. But if the management or the promoters are doing something just for the top line and just to show growth, then probably the markets will be a bit more skeptical. So I would wait for that framework to pan out before we take a call.
Right. Where do you stand on the rail, PSU, defense themes of the previous years, which came undone all of last year? Now, from the peak, they're down, 25, 30, some even 40%. But over the last few trading sessions, they've begun to see some traction. Would you ascribe any sort of value to the traction that we've seen, or do you think this is just year-end radical random moves that are taking place?
A bit of both, I would say. First of all, as you rightly mentioned, the sector did underperform quite significantly. Stocks down 40 to 60% in some cases, so they're bouncing off that correction. But I also know that the DAC is meeting. They are trying to push through orders, and once those meetings are done, then we'll see the orders flow in. So, with a correction, the market always looks a bit ahead. So now the hope after this correction is building up that the order flow will start again in these sectors.
So which is the sector you're most bullish on? If you had to play for one thematic sector for next year, as a, invest in a thematic mutual fund, which one would it be?
Thematically, I would say equally biased towards the capex theme and the financials theme. Within financials, I would say that so far we've been more bullish on the capital markets and all those players. But the way banking sector has underperformed, especially the private sector banks last year and even before that, they offer a good balance of valuations and growth. We are seeing green shoots in credit pickup. That was the only missing link in the banking system. So with credit growth touching say 12 to 13%, I think private sector banks, the banking index or banking thematic fund can do well. We continue to remain positive on the capital markets theme. Second is, as you rightly mentioned, the defense theme. For example, there is a case for these stocks to do better after the correction that we've seen in the last 1 year.
Where do you stand on the consumption space? The reason why I ask you is because, over the last 12 months or so, there have been a lot of nudges by the government to push consumption. And now, as we speak, 6, 7 months, 8 months down the line, green shoots have started to appear. And once that happens, it really bolsters growth. These stocks have been underperformed, especially on the staples side. Do you believe that, staples is ripe for a comeback, or maybe still back the new age growth companies which are even at a higher valuation?
Absolutely. The latter, I would say. Staples for us is now a mature sector. Of course, there will be pockets of excellence. Stock picking is always possible. But the vast majority of the staples sector is mature with single-digit kind of growth, which really does not excite us given the valuations that they're trading at. On the other hand, the new age companies, which are B2C or even D2C kind of companies, they do offer a longer runway of growth. And in our investment framework, the length of the runway of growth is very important, which is where the new age companies fit in.
Despite the valuations, you believe that the growth runway?
We believe that the runway is long enough for those valuations to be justified.
And where do you stand on the travel and tourism space, hospitality? It's seen a decent rally. I mean, it's not an undiscovered theme now, but there is still a long growth runway there.
Absolutely, especially on the online players, for example. Even hotels, for example, they've corrected. In the past few months, even hotel sector has stabilized or time corrected, I would say. So hotels, airlines have corrected. So in general, the travel pack, in spite of good news, has corrected. So it's not, the consolidation, I would say, is done. Time consolidation and price consolidation, and next year looks good for that sector.
So did you buy Indigo in the peak of the crisis when the prices were a lot?
I can't comment on individual, but I would say that we do have exposure to this sector.
All right.
Fully invested as of now?
We got about 5% cash, which is plus or minus.
Which is normal.
Which is normal, yeah.
Got that. And incremental cash will go in. If, as you keep getting these SIP monies, financials is one.
Financials, anyway, we are positive on, so we already have enough exposure. We probably have increased exposure in the last few weeks to some of the indirect or direct metals plays.
Okay.
Because, the precious metal place does seem to be, much stronger than expected. And I've been bullish on precious metals in any case. So that's where, given the rally in gold and silver, precious metal plays as well as some of the gold financing.
Gold financing.
Yeah, absolutely.
The brokerage notes that have come this morning, among the many initiating coverages that we've seen on Lenskart, the recent one, this one comes in from Avendas. They've initiated coverage with a buy rating. They have a target price of 490. Remember, the issue price of the company was closer to 411, and the stock has been doing well, 461 right now. They're saying that the disruption in eyewear retail through manufacturing to consumer model, M2C, is very important because it solves for a key category challenge and core business challenge as well. Leverages proprietary technology to enhance operational agility, replicating its India playbook to scale globally and expand into international markets as well, such as Japan, Singapore, Thailand and UAE. Over the holiday, we got another update coming in, them buying some stake in a Korean company as well. They expect the consolidated revenue of the company to grow between 21% compound and expand margins at by about 550 basis points. So they're positive on the stock, they're positive on the sector, they're positive on the theme. and they have a target price of 490 rupees. I remember us having a conversation about these new age companies, the ones that came with IPOs, Indian businesses looking to scale the Indian playbook to neighboring countries as well. In that, where does a company like this fit in your overall scheme of things?
Absolutely. Indian companies are looking global. For example, some of the other online companies also, whether it's in ticketing or facilitating of bookings, etc., those companies are no longer Indian companies. They are, expanding globally. So once you have that core skill set of either the core software engine or the core platform, or in certain cases even manufacturing platform, there is no reason why we should not go abroad. And I think the companies are doing the right thing.
Any contra view for next year, which the street is perhaps getting wrong, reading wrong?
As of now, everything is contra in the sense that sentiment is so low. People are not really bullish on any one thing in a big way. But
financials is fairly a consensus.
That's what I said. So it's not that contra anymore, in the sense. Which is the sector which has underperformed the maximum? I would say sectors like FMCG, some of the pharma names are, have underperformed. The generic pharmas, for example, they've been the worst hit in the last year, severe underperformance. So some of those pockets of value can emerge, I would say.
We were speaking to another market expert as well, and their contra view was that 2026 might not be the year of gold and silver. With the kind of massive rally that we've seen in the past, 2024 was great. People believe that maybe 2025 will not be that year. But 2025 was even better for both gold and silver and even platinum.
Correct.
2026, what happens? Does this outperformance continue? Or maybe even if they don't perform as well as they did in 2025 because of the base effect, etc., do we see correction or do we see just stabilization?
So it may be a bit front-ended given the momentum that is built up in the last few weeks. The gains may be front-ended and then you might see a period of consolidation or correction. But structurally the story, as far as, the fundamental story of inflation hedge, asset diversification, that continues. You see, remember in 24-25, it was the central banks which accumulated gold and silver. We really haven't seen the speculators come in.
Right.
So this might be the year where the retail actually might also jump in, the Bitcoin holders and all those guys.
Right. So you're calling a hold on gold as against a short or a long?
No, absolutely not a short for sure. As I said, the asset allocation to gold as far as international institutions are concerned is still very low. And it's only in the last 1 year or 2 years that central banks have seriously started accumulating gold, and that can last for a while.
And central bank are generally price insensitive. So if they want to accumulate to hold a certain amount, they're not really going to care about the price right now. And it just feels like the geopolitical tensions are no longer episodic. They're constant. Like even today, there was this Trump, US attacking Nigeria. So in that sense, gold is a safe haven, seems to be working. But yeah.
It's not only central banks, just to, it's not only central banks, even global institutions, pension funds, endowments, they have very little allocation to these asset classes.
Right. So
now silver has become the third largest asset class, fourth largest asset class in the world.
Even family offices in India are buying a lot of gold and silver this year.
As against, just families which were buying a lot of gold and silver. But I wanted your thoughts on old economy. Now, you've spoken about new economy, growth runway, all of that. Old economy, is there any value unlocking potential? Because Coal India, they've announced the unlocking of value in some of their subsidiaries. The stock has done well, in the sense that this month it's up 8%. But obviously, it's not performed like some of these high flyers. So do you think at some point some money would go back, names like Coal India, etc.?
We always see a rotation to value once in a while, but from our investment style point of view, they don't make structural buys for us, So while we may dabble in them once in a while, there'll never be core holdings in our portfolio because that's not in our investment philosophy. There are other styles of investing which, of course, would love to have those kind of dividend yields, etc., but not in our framework.
Debt is one of those forgotten asset classes over the last couple of years at least, because equities, yes, the retail sentiment has increased, a lot of the allocation has increased to equities as well. And with the outperformance of gold over the last couple of years, like Nima mentioned, a lot of these family offices which would earlier deploy that capital into debt is now coming back to gold, etc. Do you think at some point debt becomes an attractive asset class as well? With the open market operations, the government looking to reduce the yields?
Certainly, Indian debt, yes, not international debt.
Yeah, Indian debt.
Yeah, Indian debt, of course, because I think this year has seen the worst of the currency, the worst of the liquidity issues, etc. And now the government and the central bank are turning dovish. So that makes a good setup. And with inflation being under control at 3 to 4%, I think we are in for a good setup for debt. So part of the asset allocation should go to debt also.
So 100 rupee investment in 2026, how would you allocate it between gold, silver, debt and equities?
Equities, of course, would be more than 50%, with the balance 20 to 25% in debt and the balance in gold and silver.
Wow, that's quite a bit to gold and silver. Thank you very much, Mihir, for joining in. That's the word coming in from Trust Mutual Fund. We will get to Vivek now because IEX is still struggling in trade. Vivek joins in with more. Vivek.
Well, that's right. As far as the regulatory concerns are there for IEX, first it was market coupling, expected to get implemented in Jan, after which, now you're seeing a fresh concern. Economic Times has reported that CERC is now evaluating a revision as far as transaction fees are concerned. This is across all of the power exchanges in India. Remember, CERC is now evaluating or considering a lower unified fee of close to 1.5 paise per kilowatt hour per side for trading segments. So currently, both buying and selling will cost, transactors close to 3 paise per kilowatt hour versus the current 4 paise per kilowatt hour. So almost a 25% cut as far as transaction fees are concerned. Now, in case this particular development is implemented, this will mean a material cut as far as earnings as well as the top line for IEX is concerned. Now, along with that, longer duration contracts such as term ahead market, they are considering a cut that could be even further of close to 1.25 paise per kilowatt hour. We've reached out to IEX, so far they have not yet commented on the development, but it's still a developing story and the final decision will lie in the hands of CERC.
All right, a final decision lies in the hands of CERC, as of now down about 2.5%. But Castrol is definitely one of those stocks where, we've seen some traction after an up move that we saw on Wednesday, which resulted in the stock ending at the lower end of trade after seeing that big immediate spike. But the news of the open offer has the street a lot more excited, up nearly 4% this morning. And a consortium of Stone Peak Motion JV Co. and CPP Investment Board has launched an open offer to acquire 26% stake in the company. This follows BP's announcement that it will sell 65% stake in Castrol's global entity to Stone Peak. Sonal joins in with the details of that one once again. Sonal.
Castrol continues to be the big story. Let's address the news first because now there's an open offer which has come by from Motion JV Co. Stone Peak CPP Investment Board. They plan to acquire 26% stake in the company at 194.04 rupees a share. Now remember, if we compare it versus Wednesday's closing price, this is just a 2.5% premium. So the street was expecting maybe a little more, and that has come in as a disappointment. Now let's talk about who are the big holders in this particular stock. The institutional holders where FII is at 10.3%, Government of Singapore holds 1.33%, in DIIs the mutual funds hold around 14.95%, but LIC owns a big chunk, 10%. So the open offer, when it actually comes by, LIC could be a key deciding factor as to what happens with the open offer when it starts for the stock. Other than that, now remember, Stone Peak is the one which has acquired around 65% stake in the global entity. This company has a history of delisting all the acquisitions. For instance, in 2025, it delisted Air Transport Services Group. In 2024, it delisted Acumen Inc. In 2022, it delisted TK LNG Partners after acquiring all these companies. So what happens with Castrol Limited, that's the India one, is key to watch from here on. Now, just to give you a brief of what happened on Wednesday, British Petroleum or BP agreed to sell 65% stake that it has in Castrol Global, that is Castrol Limited, to Stone Peak at an enterprise value of $10 billion. The total consideration here was $6 billion, which included deferred dividend payments, and also it will be used to reduce the net debt of BP going forward. Will they only sell 65%? No. Following a 2-year lock-in period, they also have an option to sell the remaining 35% stake in the company. So that will be very, very important to watch. The transaction is expected to complete by end of 2026, subject to some approvals, and a significant proportion of Castrol JV minority interests relate to the shareholders of the publicly listed Castrol India Limited. So all the decisions, and once the transaction is completed, what happens with Castrol India Limited is the key to watch, because the open offer will start only after this process or this transaction gets completed. Kotak has an ad rating on the stock with a fair value of 210. They expect the stock to be range bound till the time open offer process is over, and open offer will trigger, as I earlier mentioned, only when the global transaction is over. They say transaction will take place at a promoter level, of course. There's nothing happening beneath, so it will not impact the operating performance of the stock or the company in this short to medium term. Now let's talk about some more numbers, because BP holds stake in Castrol since 2000, and the Indian listed entity has been listed on stock exchanges in 1982, and in last 20 years the stock is up 7.3 times. In last 10 years the revenue CAGR has been just 5%, profit CAGR has been just 7%. So stock or the company hasn't done much in terms of revenue and profit growth in last couple of years, but their dividend payout has been quite strong. If you look at the numbers, it has been anywhere between 66% to as much as 139% in 2024 itself. It follows a calendar year. So their shareholder return in terms of dividend payout has been quite strong. What about Stonepeak, the company that has actually acquired that 65% stake? It is an alternative investment firm with asset under management of around $80 billion. They have a lot of investments in renewable or clean energy or the energy space overall. Something like Lestari Cooling Energy, Madison Energy Investments, Ørsted, which is a European company. There's North Star Renewable Power, Peak Energy. So some of the portfolio companies are largely in the energy space. So it'll be interesting to watch out for whether they buy the remaining 35% stake. Most importantly, whether they go ahead and delist Castrol India, because that is something that they've done with the previous acquisitions that the company has made.
Thank you for explaining that so well. Get into a break. On the other side, we'll be joined by Sanjay Kulshrestha of Hutco to talk about their 2026 outlook. Stay tuned. Welcome back. Hutco is the next management on the show now. The stock is down about 9% in 2025. Now, this is a PSU, a Navratna company, which provides finance for housing and urban infrastructure projects across India. As I said, the stock has been a bit subdued this year, down 9%. But it's on the back of two fantastic years. In 2024, Hutco's share price was up 85%. In 2023, it was up nearly 140, 150%. And the big tailwind was the PMAY scheme, and then there was just generally positive sentiment and re-rating seen in PSUs. Sanjay Kulshreshtha, CMD of Hutco, is now joining in. And the three focal points that we want to talk about: one, will the rate cut push the net interest margins higher? Two, is the company on track to achieve 450 crore of recoveries in H2? And will the AUM exceed 1.6 lakh crore as was earlier guided this year? Thank you very much, sir, for joining in. This is Rima here. Season's greetings to you. But first, let's just begin with getting a sense on how Q3 has been. Can you tell us about the trends that you witnessed this quarter in terms of sanctions, disbursements? Now, H1, we had disbursements breaching 25,000 crore. Is it fair to assume disbursements will comfortably cross 50,000 crore mark as guided?
Yeah, thank you so much and good morning. You are right that we are following the path of the growth, and we had planned that by 2026, our AUM will become 1.5 lakh crores, and we are very well on the track in terms of the sanctions, disbursement and NIMs and the spreads. And the way markets are supporting us, the states are supporting us, which is backed by the robust Government of India policies towards the infrastructure creation for Viksit Bharat. So definitely we are on the track, and initially in the start of the year, we had already given the guidance that we will be achieving around 50,000 crores of the disbursement, and we are very well on that track.
All right, you are very well on track for that. If you could give us a sense on the disbursements that happened in the third quarter, the outlook that you have for the entire year for AUM growth, and also the spreads.
So we are targeting a growth of 25% around CAGR, and the way the sectors are emerging, the states are coming with the sense of the Viksit state, and we are working in all the states, and all the states are coming up with large infrastructure projects. Because if you see, we need to create our new cities, we need to upgrade our cities, and the way the investments are required, it has been estimated around 70 to 80 lakh crores of the investment is required in between 21 to 36. So this is a 15 years kind of window on which we need to upgrade our cities, and we are well on the track. And the way Government of India has came up with a lot of programs, starting from the PMAY or Jal Jeevan Mission or Urban Challenge Fund, which is recently in the last budget which was announced, to upgrade our cities, and we need to upgrade our cities to the global standards. At the same time, we are working with the transitions or mobility or metro. So there is lot of potential, lot of tailwinds, lot of planning, lot of legislative and the policy support other than the capital supports from the Government of India, and company is moving ahead on that.
Just to clarify on the AUM bit, you said 1.5 lakh crores by the end of this year, right?
Sure.
But that's lower than 1.6 lakhs that you had earlier guided for. So is there a bit of a shortfall there?
No, there will not be any shortfall. I am talking about the targets which had been given around 2 years back. We will be surpassing this 1.5 lakh crores, and around 1.6 will be the practical number that we will be achieving.
So you said one of the big tailwinds was the PMAY scheme. Now, PMAY 1 was a success. PMAY 2 was launched about a year back. But when we spoke to you post Q2, you said on account of state level delays, there was no disbursement, no sanctions happening under PMAY 2 scheme. So can you give us an update on that? When do you think you will start disbursing loans under PMAY 2?
So it is a good thing that states are not requiring a counterpart funding, and they are financially sustainable and supporting the PMAY program. At the same time, because presently they have that kind of FRBM limits available with them, and they are supporting their own project, which is 40% contribution. That is a counterpart requirement by the states. But we are very hopeful because the state require a lot of funds. The way they are planning their infrastructure, they need a lot of funds, maybe in PMAY or Amrit or Jal Jeevan Mission or road networks or new cities. So I'm very well sure that but our target of 3 lakh crores by 2030 was apart from the PMAY.
Got that. So you're saying that the reason we've not seen any sanctions or disbursements under PMAY2 up until now is not because, there are some execution issues with PMAY2, but rather the states have adequate funding with themselves, which is why they do not need the assistance of a company like HUDCO. So, when last... Sorry, go ahead.
In Q3, we had sanctioned one PMAY project. This is the good news.
Okay. How much was it, sir, in Q3?
Around 5,000 crores.
5,000. And in Q4, do you think it'll pick up? I mean, is just Q3 the start?
The initiative of Government of India has already picked up. So we will be the beneficiary maybe in Q4 or years to come. But if you see, housing is not alone. Housing is connected with the roads, drains, roads. So everything is connected and we are beneficiary of these kind of infrastructure finance.
Okay. So just to close this point about PMAY2, so last year you said that you were hopeful of disbursements of 1 lakh crore on account of this in 4 to 5 years. Now 1 year has gone and we've only seen 5,000 crore of disbursements. Do you think this 1 lakh crore target could be missed because of the reasons you...
It was not a target. It was not a target for the company. It was a support to the states without compromising on our larger perspective of AUM of 3 lakh crores. So we are very hopeful that states will be requiring. But other than that, we have a lot of programs, lot of projects which are sanctioned for the states.
Got that.
All right. And what is your target on the ROA as well as NIMs? You had expected a 10 basis points improvement in the third quarter, further improvement. Has that happened? And by the end of this year, can you do that 2.2% guided ROA?
Yeah, if you see, the company believes in the bankable, sustainable and viable kind of infrastructure across the country. And I am very sure that ROA will be plus 2%, 2.1, 2.15 kind of things. And at the same time, we will not be compromising on our NIMs. Our NIMs will remain plus 3% and our spreads will remain plus 2%. And for that, we are taking a lot of measures, starting from the treasury management to internal improvement, reducing the cost of compliances, cost of funds. So all these measures have been taken.
Okay. So how does the recent rate cut by the Reserve Bank of India change your cost of funds and your expected NIMs and spreads?
Yeah, the repo has just been reduced and we are very hopeful that the bond price will also start coming down the way RBI is continuously supporting the markets through the infusion. And at the same time, bank loan had been reduced immediately by 25 basis points. And we had planned strategically that a lot of loans we had taken from the banks. You may have seen our balance sheet in Q2. And they are all repriced less than 25%. And we had also been more competitive by this reduction of repo rates.
So what is your cost of funds expected to be? And therefore, is there a change to the NIM guidance of 3.3%?
I think 3.3 is it's a good figure to achieve. And since we are supporting the state government, we will slightly reduce the rate of interest for the states to support them in their projects.
So cost of funds comes down and the interest rate for you.
All right. Yeah. Since you're in a mood to give us all these numbers and outlook, etc., you've always been fairly candid and clear on your growth path. Mr. Kulshrestha, if we consider that you will cross that 1.6 lakh crore AUM by the end of this year and this 20-25% sort of sustained growth stays, then obviously your 3 lakh crore AUM target by FY30 also has to be scaled back, right? You think you can get to that number by FY28, FY29 itself? That's one. And secondly, if you could give us a sense on your mix as well. You wanted urban infra to be about 75% of the AUM. Is that target likely? Where are we right now on that?
Yeah, it is likely because the way the potential in the urban infrastructure is there, I think we are right on the track. And if you see other than infrastructure, we are only doing the counterpart requirement of the states under PMAY. So most of the loan portfolio will comprise of the urban infrastructure only.
Okay.
And what 3 lakh crore AUM?
Regarding 3 lakh crores AUM, you are right on the number. We have to revisit these numbers maybe in 2027 FY. We had not started revisiting because we have to see the sustenance of our ratios also, like debt equity or capital. All these things needs to be seen. Then only I think the more vital commitments can be made on the numbers.
How much by way of recoveries are you expecting in Q3 and Q4?
We are committed to become a net zero NPA company, and we are taking all sort of efforts to have that kind of number. And in Q2, we had already achieved 0.07% of the NPA, which is, I think, nearing zero only. And because if you see, there are a lot of projects which are into, say, NCLT or DRT, and we are very hopeful. Maybe in Q4, a lot of projects will be maybe resolved, and we will be getting around 200 to 300 crores kind of money out of these projects. But at the same time, we are very, very aggressive towards the resolution of all the proceedings. At the same time, we had revised our one-time settlement policies also, because these loans are way back sanctioned more than 20 years or 30 years. So we want to capitalize all these things so that the energy and the force can be given to the actual business that we are doing.
So net NPA zero by Q4 FY26?
Maybe H1 of 2027.
Got that. Thank you very much, Kulshetra, for joining in. Pleasure interacting with you, and look forward to more conversations. Season's greetings and a very happy new year to you.
Happy New Year. Thank you so much.
All right, moving on now to the luggage industry. That's in focus following multiples PE-led acquisition of VIP Industries. A note from Elara Capital suggests that the industry is entering a sustained recovery cycle, and the brokerage is optimistic on the prospect of listed players. Mangalam has moved over to the big wall with the details.
Well, VIP Industries was definitely the stock on our radar all of Wednesday and now as we speak, as well as the much spoken about and much discussed transaction with multiples has completed, where the promoters have transferred 32% of their 52% equity to multiples, and the last tranche of that transaction was completed on Wednesday itself. Now, if you look at the luggage industry, VIP, which was once the hallmark, going forward, there are brokerage notes which came by earlier this month itself. Elara, for one, believes that this industry is entering a sustained recovery cycle. It is a quasi-play to the travel and tourism industry for the country as well, likely to grow at a 12% CAGR and be nearly a 36,000 crore industry by FY28. And that's not all. The branded penetration, which stands at around 54%, because of the changes in GST and increased consumer preferences, likely to go to about 60% as well. So far, the industry, has been led by functionality-led demand, fueling both affordable and premium segments, hard luggage, designer luggage, and luggage, which has now become more of a form of expression rather than just a utility, is leading the industry to move towards high competition. Back in the day, this industry was, led by a lot of these large players, the likes of VIP, Samsonite and Safari, and then digital native brands, private labels, D2C entrants, all of them have begun to expand aggressively. So the industry, which was earlier in oligopoly, has now moved towards perfect competition. However, there's a catch here. D2C players are constrained by offline reach and high customer acquisition costs, so profitability might be a little difficult for them, and that makes Safari and VIP Industries a well-placed bet to benefit from all of these moves in the industry, and that's exactly what Elara expects as well. But if you look at the last 5 years sales CAGR, VIP has grown at just 5% and Safari has grown at 21% sales CAGR over the last 5 years. And that's not all. 5 years ago, the market cap of Safari was 1/4 of VIP, and now it's double of VIP, because VIP has done virtually nothing for investors over the last 5 years. Safari's earnings per share has compounded at around 35% as well, and VIP Industries, on the other hand, while the revenues did not grow, the losses expanded. FY25 losses were 69 crores. First half of this year, a kitchen sinking, first half, where they've made losses of almost 156 crores. So what now from here on? Elara believes that the company is in repair and stabilization mode. Post multiples acquisition, there'll be sharper governance and focus. Obviously, improvement in margins, increased market share and execution is something on which the recovery for VIP hinges. Turnaround trajectory offers a re-rating potential for the stock after it having done nothing for the last 5 years. Risk reward is now favorable. They have a target price of 430 on the stock, valuing it at 26 times FY28 earnings. But remember, all of that has key risks. The key risks: intensifying competition, sharp rise in input price, and failure in identifying change in demand. So those are a bunch of things that we'll be watching out for India's luggage industry. Will it actually take off just the way the travel and tourism industry has taken off?
Well, thank you for explaining that so beautifully. We'll see whether 2026 is the year for luggage makers. But at least the day, 26th of December, is not too much for the markets. Markets are pretty much unchanged, very quiet, range-bound session of consolidation in a holiday-thin trade. Siddharth Rai Mangla of Stockbox Technologies is now with us on the show. Siddharth, good morning. Thank you for joining in. How are you approaching trade? Is there any trades, any stocks that you are advocating?
Hi, Rima. Good morning, and thank you for having me on the show, first of all. And also, seasons and New Year's greetings to you people as well. So, see, Rima, if we talk about Nifty, there are two things. First of all, the overall structure in Nifty, Rima, is still looking good. At least as long as we are above 26,000, 25,900, that important support range, the positional view in Nifty should stay bullish. But having said that, just like you said, this is kind of a holiday period for the market. So the volumes in Nifty are lower than usual, which is why we're not getting any clear momentum opportunities in the index. So if somebody has an existing long position in the index, they can definitely keep on holding on to them with stop losses around 25,950, 25,900 in that range. If somebody wants to take a fresh long position, we must be waiting for a while and at least wait for the index to go back about 26,150, that around today's high. So if once Nifty goes back about 26,150, then the momentum will also be on our side. So then a fresh long position in Nifty can be taken. So the structure in Nifty is good, but as of now, it's much better to sit on the sidelines.
All right, much better to sit on the sidelines, perhaps play it via stocks. Then what are the individual stocks that you're backing right now, Siddharth?
Yeah, sure. Hi, Manglam. See, two stocks, both of these we have to buy. The first one is NBCC. See, today's movement in this counter is absolutely very amazing. So, the stock has made an open low just where the stock opened today. Started running absolutely from those levels, and again a big breakout is also being given. So NBCC can be bought right now. The spot is around 120.5. We can buy it here. The stop loss will be 119, and our targets being the first target 124 and the second target 126. The second stock is Mazgaon Dock. See, there's been a very strong turnaround in this counter for the past 6-7 sessions, and now in today's sessions there is again a very strong breakout as well. So Mazgaon Dock can also be bought. It's trading up around 2610. It's a good thing that the stock has also sustained about 2600. So it can be bought at these levels. The stop loss will be at 2580. And our targets being the first target 2680 and the second target 2700.
Okay. Thank you very much for that. We will slip into a break on that note. On the other side, Lata will focus on what's in store for the Indian economy in 2026. Stay tuned.
Fly Emirates, fly better.
Welcome back. Now, the markets, well, largely around that 26,100 mark for the frontline index, the Nifty and the mid-caps jostling for any sort of levels right now or direction. But 2025, as that draws to a close, what's in store for the economy in 2026? Lata Venkatesh here with the key indicators for the economy and an exclusive CNBC TV18 poll on what economists expect in the new year.
The RBI Governor Malhotra recently described India's economy as being in a Goldilocks scenario, where growth is coming in higher than the long-term trend and inflation is lower than the long-term average. For 2026, economists polled by CNBC TV18 expect this Goldilocks scenario to continue, albeit with lesser intensity than in 2025. Our poll shows the economy is expected to grow by 6.8% over 7.5% this year. But this is the average. 50% of the economists had forecasts above 7% for next year, while 50% stood at just 6.5%. The 7% club see growth from rising consumption due to GST and income tax cuts and falling interest rates, and green shoots in capex in sectors like power and real estate. The 6.5% GDP club disagree with the private capex upcycle assumption. They see consumption as good, but not good enough to trigger massive capex. They also see growth slowing due to a weaker pace of government capex and still subdued private capex due to the global uncertainty. Respondents also see India's nominal GDP, that is, output calculated at current prices without adjusting for price rise, at 9.7% next year, far better than the 8.3% this year. But here again, 50% see nominal GDP below 9.5%, which is, compared to previous decade of India's nominal GDP average at over 11%. Now, coming to CPI inflation. The poll sees it rise to 4% next year from the unusually low 1.9% this year. Here again, it's a divided house, with 50% expecting a continued benign 3.8% CPI, while the other half see CPI between 4 and 4.5%. All economists expect consumption to grow better than investment, with public capex slowing and private capex still diffident. The government is expected to reduce its fiscal deficit to 4.3% from 4.4%, in keeping with the long-term promise to lower deficit. But with the presentation of the 16th Finance Commission report, government may start targeting overall debt to GDP rather than fiscal deficit. There will be pressure to bring it down, that is, debt to GDP down towards 80% from around 84% currently. However, of maximum interest is how much money will the centre and states plan to raise via bonds and state development loans. Our poll said this number would be at least 30 trillion rupees, up nearly 8.5% from this year's 27.7 trillion. Demand for government bonds may be much less next year than this asking amount. Hence, most people expect RBI to continue to buy bonds via OMOs or open market operations. Yet, the 10-year yield is seen slightly higher next year than this year. That is, the cost of capital is not falling. Now, the bigger talking point is India's external account. Like this year, the current account deficit will be modest next year as well at 1.06% of GDP. Now, current account refers to imports, exports, remittances, and monthly transfers by Indians living abroad to their families here. Now, here the deficit has lately fallen because of very good services exports, the GCC exports. The worry has been the capital account, with FPIs, that's foreign funds, shipping out $15 billion in 2024 and $17 billion in 2025, making the overall balance of payments negative at $5 billion last year and likely $22 billion this year. India cannot continuously keeping shipping out dollars from our reserves kitty. Our poll says next year the outflows trend will end and we will see an inflow of $7 to $8 billion. Again, this is the average. Many economists see a $20 billion inflow, but some others say continued outflows or a very measly 1 billion inflow. It is these continuous outflows by FPIs and foreign direct investment that pressured the Indian rupee in 2025, making it depreciate nearly 6% versus the dollar. A poll says economists expect the rupee to end the current year at 90.4 and lose just a nominal 2% next year, that's FY27, to end at 92 rupees per dollar. Finally, here come the googlies. Most of the numbers won't hold if the trade deal is not signed with the US sometime in 2026. In any case, the numbers will need to be tweaked as early in February, when the Ministry of Statistics will reveal a new GDP and CPI series with a fresh base of 2022 and 2024. So all numbers will need to be recast.
All right, Lata, thank you very much for that. On that note, we will slip into a very short break, but we will continue and take forward what Lata had to say, what's in store for the Indian economy in 2026 with HDFC Bank, Sakshi Gupta and Union Bank of India's Kanika Pasricha. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. As 2025 draws to a close, what's in store for the Indian economy in 2026? To decode this, we're joined by Sakshi Gupta, Vice President and Senior Economist at HDFC Bank, and Kanika Pasricha, Chief Economic Advisor to Union Bank of India. Ladies, good to see you. No holidays for you all, clearly. The men are away?
Hi, good morning. Yes, I think no holidays for economists right now,
No
right?
holiday.
Too much happening in the economy.
Well, good to see you. Very good to see you, and season's greetings to all of you. So, you know, the narrative going into 2026 is that of macro resilience. I mean, the headline GDP growth of 8% plus is, you know, takes your breath away. Plus, we've got this ultra low benign inflation of 0.2, 0.3%. So let's begin with what the RBI action is going to be in such a scenario, because we've already had 125 basis points of rate cut. The view seems to be that the policy from here on will become supportive and not stimulative. Maybe at best, we get one more rate cut. The timing could be undecided. So I would like both of you to share your views on what we should expect from the RBI, in terms of a monetary policy going into 2026. Sakshi?
Yeah, hi. Look, from the RBI monetary policy perspective, as you rightly said, I mean, inflation is expected to, kind of remain very comfortable even going into 2026. So from a policy perspective, yes, they have space to perhaps deliver another rate cut. Now, the question is whether they will do that or not. I think if the current growth momentum kind of continues, I see a low probability of the RBI cutting rates again in the February policy or going below 25 throughout 2026. So on rates, we are pretty much at the bottom and we could see the RBI remaining on hold. But I think what is more critical over the next 3 or 4 months at least is going to be how the RBI manages and balances what's happening on the rupee front combined with, what they do on liquidity because, they have come in and announced further OMOs and the FX swaps. But I don't think that the liquidity problem is behind us. For effective transmission to continue in the money market and, broadly into financial markets and the real economy, I think liquidity support is something that the market will watch out for. And I think the RBI will have to do a lot more on that front.
Okay, so the focus will be on liquidity transmission rather than headline cuts. We could be closer to the bottom end of RBI's rate cutting cycle. Kanika, you want to weigh in?
Yeah, so actually, yes, season's greetings. See, I think the RBI will behave the way the Fed is doing as well. That incremental rate cuts, we see one more rate cut to complete the cycle. Timing of last rate cut, usually difficult to call. It may be Feb or April. But 5% is what we see as a terminal rate. That's one. Second, globally as well, it's the cost of capital that matters, and liquidity measures are more important rather than just policy rate cuts to drive the same. RBI has already given a bazooka this week of close to 3 lakh crores, 2 lakh crores additional OMOs, plus $110 billion of FX swap. Given there are many moving parts in the puzzle here, it may be further, dollar sales by RBI to protect the rupee in a volatile environment. It may be RBI GSEC redemption in January. So they can be, and in case the FPI flows return or not to India, especially in equity starting Jan, we may need another repeat of at least 1 lakh crore of liquidity injection between Feb and March as well. That's on close watch. Going forward in FY27, of course, BOP may switch from negative to positive, a minus surplus of $5 to $10 billion, but still RBI support via liquidity, durable liquidity injection of at least close to 2 to 3 lakh crores may be needed, even in FY27 is our view. Thanks.
All right. If you could, detail the growth for next year, your projections, and break it down in terms of how much comes in from capex, how much comes in from consumption, how much comes in from international trade, and what would the government spending look like for the GDP growth to continue? So you could weigh in on that, along with, the reduced GDP deflator. That has been a bit of a concern, despite higher, real GDP growth coming in. The nominal GDP hasn't grown as well. And that really correlates to corporate earnings. So if you could give us a sense on your projections for that for 2026. Kanika, starting with you.
Okay, so thanks, Mangalam. See, first and foremost, let's first look at the nominal GDP numbers. That's been a bigger source of problem, right? And leading to the gap between real and nominal GDP, given the GDP deflator has been low and propping up the statistical level of real GDP, so to say. So nominal GDP this year we see around 8.5%. Next year, we see it normalizing back to 9.5 to 10%. However, real GDP, we see falling, but I would say still normalizing instead of saying falling, from 7.5 to a range of 6.5 to 7%. Now, in terms of the real growth drivers and the levels, see in this 6.5 to 7% range, it's part of the long-term range for real GDP growth over the last few decades, I would say, at least 1 to 2 decades. From that perspective, upper end of the range, which is 7% likely, and consumption expected to be a bigger driver of growth compared to capex. Now, why consumption? Because of the lagged impact of a variety of measures already undertaken by the government and RBI. Government has done income tax rate cuts. There's been GST rate cuts. That's been a propeller. While on the from the RBI monetary policy perspective, rate cuts, liquidity likely to have a delayed impact on consumption basket within GDP. From capex perspective, as we move into FY27, with fiscal consolidation likely to remain on the agenda, even though the pace may slow in our view, contribution of government to capex may slow down. Broad-based private capex recovery still is not likely given the uncertain environment, but emerging sectors may stay may hold on to the baton for private capex recovery, be it AI, data centers, semiconductors, renewables, etc. Thanks.
All right. And Sakshi, your call on the same?
Right. So look, in terms of nominal GDP growth this year, we are at close to about 8.3%. Next year, as the inflation cycle turns, and in terms of just base effects being very low, I think inflation numbers will start edging towards 4% or higher in the second half of the year. I think that will also lift nominal GDP growth. So we are expecting about 10.1% nominal GDP growth for FY27, which is a slightly better scenario for earnings growth or credit growth, given their very high correlation with nominal GDP. In terms of real growth, we have a range of 6.7 to 6.9 for real GDP growth for FY27 compared to 7.3 this year. I think that in terms of drivers of growth, of course, we think that consumption this year, I mean, we have seen slightly better, performance on the consumer side. I think next year you could see some broad basing where it's not just rural, but also on the urban consumption side, the impetus might start looking better. In terms of private capital expenditure, I think that given how capacity utilization rates have been improving, and with some support from consumer demand being better, I do expect private capex contribution to growth to be slightly better than what you have, kind of noticed over the last 2 or 3 years. So we are hopeful that there will be in segments that there will be some greater support from that. In terms of the government spending numbers, look, I think that broadly, we at this stage are expecting that government expenditure should be somewhere, the target should be somewhere between 11 to 12 lakh crores. So, not a very big jump from the numbers that they are targeting for this year. So broadly supportive for growth, but it's not the incremental impetus to growth that we have seen from government spending over the last few years. I don't think that that's something that's going to play out. I think one risk that we must talk about to our growth outlook, I think continues to be how our goods exports perform and the outcome of the trade deal. I think that still continues to be an overhang on the growth estimates that we are making for FY27.
That's well put. One final word. Lata was telling us that the expectation is 92 against the dollar by FY27. Your own rupee projections, Sakshi and Kanika. Sakshi, go first.
Right. So that is our projection as well. I think for FY27, we are looking at a range of 90 to 92 against the dollar for the rupee. I think that broadly suggests a relatively more stable rupee. We are also anticipating the balance of payments to turn into a surplus next year. And on the current account, we should be at 1%, 1.1% of GDP. I think the near term continues to be a problem. I think next 2 or 3 months, I think market continues to be influenced by, the lack of or the announcement of a trade deal. So I think that you could see a fair bit of volatility. I think a possibility of that going into the beginning of 2026.
All right. Kanika, your quick word.
So on rupee, frankly, I agree with Sakshi. After a 4.5% depreciation already seen, maybe we end around 90.5, 90.5 March end. Next year, we see rupee at 92, 93. But yes, near-term dip in USD INR likely once the trade deal announcement formally comes out. That will be a positive. Broadly, rupee is behaving as per fundamentals in our view, and may align that we may see the extent of depreciation may come down, but we still see broad depreciation pressure persist in alignment with fundamentals for rupee next
All right,
year as well.
ladies. Thank you so much for joining in and giving us an outlook on the economy for 2026. Wish you, your teams, your families a very happy new year. With that, we wrap up on this edition of Bazaar. Stay tuned. The theme of Chartbusters comes up next.
Indian markets open mixed with Nifty trading around 26,100. Metals lead once again while IT stocks trade with cuts. Mid-caps outperform.
CPPIB, US private equity firm, Stonepeak and Motion JV Co. make an open offer to acquire 26% stake at 194 rupees apiece. A move follows British Petroleum's decision to offload majority stake to Stonepeak. Stock gains of Castrol.
Reports suggest the electricity regulator CERC is deliberating lower transaction fee of 1.5 paisa per kilowatt hour versus the current 2 paisa fee. Shares of IEX trade lower in trade.
Big block deals in VIP industry see promoters complete the planned transfer of stake to a consortium led by multiple PE. Stock trades with cuts.
Coforge trades with cuts as sources tell CNBC-TV18 that the company is set to acquire digital engineering firm Encora for an enterprise value of $2 billion. A board meeting to mull a fundraise is also scheduled for today.
Hello, good morning. You've tuned into Chartbusters, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra as well. Sonal, good morning. While we saw a bit of a dull day coming in on 24th. Today seems like, nothing exciting coming for the markets. 0.2% of decline, below 26,100 levels for the Nifty. So maybe everyone's gone on that holiday and we're not seeing much of a momentum today. But that's something we'll be keeping an eye out on.
Yes, maybe the markets are missing the boys on Chartbusters as well. But for today, as far as the markets are concerned, it's a mid-cap day so far. We are seeing that outperformance coming in 98 points higher on the mid-caps, but they also have come off sharply from the highs of the day. Small-cap index, that's the other big gainer, 0.3% higher there. We do have energy stocks which are doing well. Realty index also contributing a fair bit. Metal index, that continues to be an outperformer, so that is a sector to track as well. We do have losses coming in from financials, consumption and the pharma space. So these are some stocks which are on our radar and we'll keep tracking that for you. For now, let's welcome Somil Mehta of Mirae Asset Sharekhan for a technical check on the markets. Somil, good morning. Thank you so much for joining in. Usually the last week, of course, we see lower activity. The volumes are lower as well. What kind of levels should we watch out for in that case? Will it continue to be very range bound?
Good morning to everyone. It's been a little range bound. We've seen a little bit of correction in the last couple of days. However, the trend still remains positive in the short term, in the medium term, both. Nifty has taken support around the 40 hourly exponential moving average, which is very close to 26, 130, 100 levels. So I think from here, buy on decline should be the strategy and crucial support at 26,000. I don't see this 26,000 breaking on the downside. On the upside, the target would be around 26,350, 340 levels, which is closer to previous swing high, the all-time highs as well. But above that, the most important part is that the medium-term outlook targets looks like 26,700, 800 levels in the next probably a quarter. So buy on decline should be the strategy, and view is positive in the short term, medium term both.
Okay, our view is positive in the short and medium term. Somil, good morning. Thank you so much as always for joining in. What are your top picks right now? What should one keep an eye out on?
In the short term, we've seen good traction in railway stocks. So Erida looks great to me. Erida has just broken out of a inverted head and shoulder pattern. Momentum indicators fresh by RSI is oversold and cutting upwards. A great setup. So stop loss would be 135 and the target would be 155. The second stock is Prestige. Prestige looks great to me, ending diagonal pattern. It has not broken upside yet, but I'm preempting that this pattern will break on the upside, taking support at 200 daily exponential moving average. Great setup. Short-term stop loss would be 1595 and the target would be 1730.
Okay, all right, Somil, thank you so much for joining in. The realty space is doing well and Prestige Estates is one of the bigger names which are doing well in trade. With that, we'll do one thing. We'll slip into a break. When we come back, we'll talk about a lot of stock-specific action that's happening in the broader markets and in the Nifty as well. Stay tuned for that.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back to Chartbusters on CNBC-TV18. Let's just look at the railway stocks as of now. They are all buzzing in trade. Last few trading sessions we have seen them run up. Today also they're managing to hold on to good gains. IRCTC, Ircon, Railtail, Titagar, Jupiter Wagons, all of these buzzing in trade. And this is coming after train fares have been hiked from December 26th. That's today. And this has come in as a notification. There are new ticket prices. So we'll watch out for all these railway stocks. But let's put the spotlight on Coforge as well. Now, sources tell CNBC-TV18 that Coforge is in advanced talks to acquire stake in Encora. Rachna is joining in with us now to give us more details on this one. Good morning, Rachna.
Good morning. Sources tell us that Coforge is in advanced talks to acquire a stake in Encora in a transaction that's pegged at up to $2 billion. Now, the deal would mark a potential exit for private equity major Advent International, which currently holds a majority stake in Encora. To put this in context, Advent entered Encora in 2021, acquiring the company from Warburg Pincus at a valuation of about $1.5 billion. Warburg had backed Encora during its earlier phase of expansion, helping build scale in offshore delivery and deepen its US enterprise client base before selling out to Advent, and now as the company has transitioned into a more mature digital engineering platform. Encora operates squarely in the digital engineering and product development space. Its core strengths lie in cloud-native application development, data engineering platform, and platform modernization and enterprise software services, with a strong concentration of clients in North America. Over the last few years, under Advent's ownership, Encora expanded both organically and through acquisitions, positioning itself as a high-growth engineering-led alternative to traditional IT outsourcing firms. For Coforge, this would be a transformational transaction. The company has historically been a mid-sized IT services player, as we know it, with strength in BFSI and travel tech, but limited exposure to deep product engineering. Encora would significantly shift that mix. As of March 2025, Coforge reported a net cash flow of around 474 crore rupees and cash and reserves of roughly about 600 crore rupees. Now, that balance sheet does provide flexibility, but not enough to fund a $2 billion deal, or a deal that could go up to $2 billion outright. Now, as a result, Coforge's board is expected to consider a fundraise, potentially combining debt and equity to support this acquisition. Back to you.
All right, Rachna, thank you so much for joining us with all those details. The stock, though, has come off from the highs at the day's low as we speak. So we'll watch out for any updates on this one. But this is the update as far as Coforge is concerned. But that's not it. We have a lot of stocks which are on our radar today. Castrol is one of them. We spoke about that big deal of British Petroleum selling 65% stake in the global Castrol company to Stonepeak at an enterprise value of $10 billion. The indication was there would be an open offer for the Indian listed company, that's Castrol India, and now that has come by. The open offer comes from Motion JV Co, Stonepeak and CPP Investment Board. They will buy 26% stake in Castrol India. The price is 194 rupees a share. If we compare it with Wednesday's closing price, it's around 2.5% premium, and that's exactly the price that it's trading at as well. And in terms of the shares, it will be 25.71 crore shares. Why is it important from a perspective of the shareholders? Because now institutional holders, where FIIs are 10.3%, we have Government of Singapore which holds 1.3%, DIIs have 14.95% stake, and LIC has 10% stake out of that. So it will be very important to understand how this open offer goes through, which will happen only after the global transaction is completed. The other important point to note is that Stonepeak has so far delisted all the acquisitions that this particular company has made. It was Air Transport Services in 2025, in 2024 it was Acumen, and in 2022 it was TK LNG Partners. Just to give you a perspective on the transaction, British Petroleum will be selling 65% stake to Stonepeak, and that is not it. After a lock-in of 2 years, they have an option to sell the remaining 35% stake as well. Everything according to the minority, basically the significant proportion of Castrol's JV in the minority will be related to what is happening with Castrol India Limited. So it will be very important to track any updates from here on. Kotak has an ad rating with a fair value of 210 rupees on the share. They expect the stock to be range-bound till the time open offer is completed. It will, of course, trigger only when the global transaction is completed, right? But they do not expect any impact on operational performance because, of course, the transaction is between the promoter entities. So nothing happens to the financials as well. Remember, BP has been holding stake in Castrol since 2000. And in last 10-20 years as well, we've seen the stock go up by 7.4 times. But their revenue and PAT CAGR has been in single digits, so that has been a worry. But dividend payout has been quite strong, ranging between 66% to as high as 139%. For Stone Peak, it is an alternative investment firm with the $80 billion in terms of AUM and largely investments in energy firms, renewable energy, clean energy. Some names will come up for you on the screen, a lot of them in Europe as well. So we'll watch out for more updates on this one. But for now, two important things: what happens with the open offer, and second, whether Castrol will be delisted, because that's what Stone Peak has done so far.
Absolutely. We'll surely keep out on the triggers that you mentioned going forward as well. But let's talk about IEX. That's another stock that's in focus today. It's under pressure as reports suggest that CERC is mulling lower transaction fees. Vivek is now here to tell us more details on this one. Vivek, over to you.
Well, that's right. So, the regulatory overhang as far as IEX refuses to die down, number one is the impending imposition of market coupling. But other than that, ET has raised fresh concerns. ET says that CERC is evaluating a revision in transaction fees charged by power exchanges in India. They have said that CERC is considering a lower uniform fee of 1.5 paise per kilowatt hour per side, which is both buying as well as selling side for most trading segments. Currently, remember, exchanges levy 2 paise per kilowatt hour on each side. So total transaction charges could drop by as high as 25% in case CERC takes these recommendations into account and goes ahead and implements them. For longer duration contracts, the cut could be even steeper. ET reports that fees could be reduced to as low as 1.25 paise per kilowatt hour, and this will mainly be in the term ahead market. We've reached out to IEX, no comment so far, but an important development to track nevertheless, given the fact that this could have a material impact as far as top line is concerned.
Okay, all right. Thank you so much, Vivek, for joining us with all those details. Quickly, let's take a look at SRF as well, because there's an anti-dumping duty which has been levied on R134A, which is a refrigerant which SRF produces. This is on all the imports from China, because China has been dumping this at lower prices, which was not good for the domestic industry. Now, remember, only SRF is impacted because it's the sole producer of R134A in the country. They have a capacity of 20,000 metric tons per annum, and any sort of change in the realizations, the domestic realizations, if it's $1 per kg, it would impact their EBITDA by 2% for FY27. So not such a big impact, because that realization differential has been coming down. So not such a big impact on SRF, but yes, 2% EBITDA positive by FY27, considering that prices remain at current levels. So we'll watch out for that stock as well.
Okay, thanks so much for that, Sonal. But on that note, we're actually going to slip into a very short break. After the break, we'll get you more updates, more stock-specific action. So stay tuned in.
Fly Emirates, fly better.
Welcome back. You're still tuned into Chartbusters. Zepto is set to pre-file its DRHP today under the confidential route. Rachna tells us more on this and what she's picking up. Rachna?
Well, after a delay of nearly a year, Zepto is now set to confidentially file its draft IPO papers. Today, that's on December 26. Now, this is according to people familiar with the matter. The company is targeting a public listing in the July-September quarter of 2026 and plans to raise around 11,000 crore rupees. That's about $1.3 billion. Now, this is through a mix of fresh equity and an offer for sale. But the timing is significant, both for Zepto and for India's fast-maturing quick commerce sector. Let's start with the numbers. Zepto's revenue growth has been sharp. FY25 revenue more than doubled to 11,000 crore from about 4,500 crore rupees in FY24. Losses also widened alongside expansion. Net losses rose to 3,367 crore in FY25 from 1,249 crore rupees a year earlier. Now, the company was last valued at about $7 billion in a private round in October 2025. So, public listing would place Zepto alongside rivals such as Blinkit and Swiggy at a time when investors are far more focused on profitability and execution than growth alone. Ahead of the IPO, key strategic shift has been the effort to Indianize the cap table. In January 2025, Zepto completed a reverse flip, moving its domicile from Singapore back to India, which is pretty standard. But it has worked towards raising domestic ownership largely through secondary share sales. Motilal Oswal's founders bought shares worth roughly $50 million. But that may not have been enough because Zepto continued to attract global capital, including a $450 million round led by US-based pension fund CalPERS in October 2025. Zepto's origins trace back to Y Combinator when the accelerator invested in 2021. That, and with later investors, the company scaled rapidly and became India's first unicorn of 2023, ending a prolonged funding slowdown, if you remember. But scale also brought scrutiny. In late 2025, the Central Consumer Protection Authority fined Zepto for using dark patterns such as drip pricing and basket sneaking. Earlier in 2025, a Maharashtra FDA inspection led to a temporary suspension of a warehouse in Mumbai's Dharavi, but that was an isolated case. As per reports, the company also laid off over 500 employees last year as a part of cost control measures. Despite this, user momentum remains strong. According to data from CLSA, Zepto added 1.2 million weekly active users in the week of December 15, the highest among quick commerce players. That said, Blinkit continues to lead on downloads. How public market investors weigh growth, losses, governance, and competition will ultimately determine how this IPO plays out.
Okay. Rachna, thank you so much for that. Zepto surely will be on the radar going forward as well. But let's talk about tariffs, and the uncertainty over trade deals ensured that volatility was the only constant in global trade in 2025. And for India and Indian businesses, a source of significant heartburn. Abhimanyu Sharma is reporting to us that while the government fought to keep trade on even keel and find new markets, a cheap rupee has been one of the only comforts for exporters, and 2026 is likely to see much of the same unless the government effects a breakthrough. Let's go across and listen in.
2025 started with the prospect of India striking lucrative trade deals with many nations across the world, including the United States. The ongoing Russia-Ukraine war, the Israel-Gaza conflict, sanctions on Russia, along with geopolitical tensions in the Red Sea, pushed up freight costs for exporters. Despite uncertainties, India's total merchandise and services exports in FY25 hit an all-time high of $825.25 billion, a growth of 6.05% year-on-year from FY24's levels. But US President Donald Trump threw a spanner in the works, imposing tariffs on imports based on product and country of origin. In the second week of April, he announced global tariffs with a baseline of 10% across all imports and reciprocal tariffs on some countries, including a 26% tariff on India.
We get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world. You know, everything they made, they'd send it in, pour it into our country. Therefore, it wouldn't be made here, which is a negative. But we would not send in anything because they were charging us 100% tariffs. And
a breather came soon after. Reciprocal tariffs were paused for a period of 90 days, even as talks for a bilateral trade agreement continued. Indian negotiators met with their American counterparts numerous times, even in person, and talk of a trade deal remained a low but steady hum. Then came the big jolt. On the 27th of August, President Trump blamed India for funding the Russian war on Ukraine by continuing to buy Russian oil. He hiked tariffs on India to 50%. India pushed back.
Somebody tells me tomorrow I can't be friends with the European Union, I won't accept that. Or somebody tells me tomorrow I can't work with Kenya, it's not acceptable to me. So I think we are all in it together. The decision whether to buy a particular product from a country is something that the entire world will have to take a call on.
As India and the US continued to engage with each other in a bid to arrive at a mutually agreeable and beneficial trade deal, India managed to conclude negotiations on some significant bilateral free trade agreements. It signed an FTA with the UK in July, though that is yet to come into effect. The government has also facilitated the opening up of a few new markets for Indian exporters, including Switzerland, Norway, Iceland and Liechtenstein, as the FTA with the European Free Trade Association came into effect in October, and the European Union approved imports from 102 fisheries establishments. In December, India and Oman completed negotiations for a comprehensive economic partnership agreement, under which Oman will provide India duty-free access to 98.08% of its tariff lines. This covers 99.38% of what India exports to Oman. More recently, India concluded negotiations for an FTA with New Zealand. While these came later, Indian exports still stood on firm, albeit fragile ground. In the first half of the FY26, India's exports rose 5.86%, led by a 9.34% rise in services exports and a 2.90% rise in merchandise exports. This was driven by electronic goods, engineering goods, drugs and pharmaceuticals, marine products, and rice, with Spain, Hong Kong, China, and the UAE proving to be strong markets. Though India's exports to the US also rose 13% year-on-year in the first half of the financial year, this included a lot of front-loading of exports as traders tried to beat the window before higher tariffs kicked in. But the brunt of higher US tariffs is being felt, especially in the export of labor-intensive areas like textiles and leather, which have a high dependence on the American market. And while talks continue, there is no definitive headway yet.
I have said many times that all agreements, all discussions have many diverse, many different angles. Many dots have to be connected, and we never negotiate deals with deadlines.
To mitigate the hit from US tariff disruptions, the government also looked for other supportive measures. The Export Credit Guarantee Corporation upgraded the country ratings of 24 nations in September, reducing insurance costs and overexposure to markets affected by tariffs, protectionist policies, or restrictive market access. The fall in the rupee's value against the dollar also gave exporters some cushion, as did a mammoth GST rate rationalization exercise that gave producers more traction in the domestic market. The recently announced export promotion mission, which aims to provide exporters with financial incentives in their quest for newer markets, is also designed to help.
भारत के किसान, भारत के मछुआरे, भारत के पशुपालक, उनसे जुड़ी किसी भी अहितकारी नीति के आगे मोदी दीवार बनके खड़ा है.
As 2026 dawns, talks for a trade deal with the US are still underway. Buzz of it being imminent crops up periodically, but as people say, nothing's certain till the dotted line is signed.
Right now, we are engaged with not only negotiating a bilateral trade agreement, which definitely with a country like United States will take a lot of time, because trade agreements are very wide-ranging agreements these days with a lot of issues, not only market access issues, which are negotiated under the umbrella. But at the same time, we are also engaged in a protracted negotiations on a framework trade deal, which will try to address the reciprocal tariff challenge that the Indian exporters today face. So these are two separate parallel negotiations going on.
India is also engaged in negotiations with the 27-member European Union, the Russia-led Eurasian Economic Union, the 5-member Brazil-led Mercosur bloc, Chile, Peru, and Maldives. Terms of reference have also been finalized for trade deals with Israel, Qatar, and the 6-member Gulf Cooperation Council. In addition, an FTA review is underway with the ASEAN bloc, and expanded FTAs are being considered with Australia and the UAE. None of these may materialize overnight. But as each of these fructify over the next 12 months, Indian exporters can expect some relief. The biggest relief, however, will come only when India and the US are able to agree on terms that both leaders find palatable. In New Delhi, this is Abhimanyu Sharma for CNBC TV 18.
Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormaz Fatakia. Looks like a holiday session which is taking place for the market right now. Why do I say that? We come back from a holiday yesterday. There is the weekend tomorrow. Some of the global markets are shut on account of Boxing Day. A lot of them were shut yesterday and had a shortened session day before yesterday as well. So all in all, volumes were less than 50% of what we've seen on a daily basis in December, and that's exactly what's playing out today as well. I mean, so far the volumes have been relatively on the muted side, and the markets also are in that holiday mode. Why do I say that? Once again, the Nifty is in that range, holding just around the 26,100 mark, not going too higher, not falling too much as well. The broader markets as well, if you look at the mid-cap index, at an index level, it's marginally in the green, but dig deeper, look at the advanced decline ratio, and there as well, it hasn't made its mind up right now. Perhaps, again, pausing the snooze button until the start of 2026. Typical of how trade usually pans out, as we move towards the end of this year, that line as flat as can be with the red and green, virtually next to each other, stuck to each other. But amidst all of this, my co-anchor Hormaz has put the spotlight on some top movers for the market. He goes across to that wall. Hormaz, it looks like the typical year-end names doing extremely well, the likes of defense, rail, PSUs.
Well, year-end and year-end party for all of these names. The volumes may be lower, participation may be lower, but the volumes and participation is definitely not lower for these railway stocks. And take a look at the moves in today's session. This is the 5th straight day of gains for them. Now look at RVNL now up 12.5, IRFC is up 8.5, as is RailTel, and RITES 2 has moved up for almost 5%. IRCON is up 8%. So all of these stocks are moving higher for the 5th day in a row. And take a look at the volumes as well at which they have moved. It's not as if the move it's on lower volumes, but RVNL is up. 3 crore shares have been traded. IRFC has nearly 5 crore shares traded. RailTel has nearly a crore, and RITES 2 has had over 25 lakh shares traded. And take a look at the 20-day average as well. Well, significantly above the 20-day average for all of these names will be in these railway stocks, and are trimming these losses that they have made all through the year so far. So railway stocks well and truly in the spotlight for the 5th straight session. Panacea Biotech is the other top mover in today's session. They're almost 14% higher now. It's the biggest single day gain since August of last year. It has gained in 4 out of the last 5 sessions. Volumes today already the highest since September of 23, and close to 60 lakh shares have been traded now on Panacea Biotech. And take a look at the 20-day average, only 19,000 shares. So significantly higher volumes. The stock has moved above its 50 and 100 DMA. The 200 DMA on the upside comes up to levels of 431, but the stock is down almost around 30% from its April peak, which was around 580 rupees. And lastly, MMTC, the top gainer on the Nifty 500, among the top gainers though, 11% higher, slightly off the highs of the day. 6th day of gains, now is up almost 20% in the last 6 sessions. The biggest single day gain that the stock has seen since May. Well over a crore shares have been traded on the stock already. The 20-day average is just 12 lakh shares, and it is nearing very key levels. All the 50, 100 and the 200-day moving average is between 62 and 63. So as of now, it is trading at all of those important levels on the upside. Still down 14% this year, and still down well over 50% from its July 2024 peak, which was at 132 rupees, Mangalam.
All right, we take that point. Thanks a lot for all those, movers, the few that we have today on low volumes, but some with decent volumes as well. But speaking about volumes, speaking about growth, have package and parcel volumes along with, transactions moved higher or not? We have the logistics players joining in. Vineet Agarwal, who's the MD of Transport Corporation of India, now joins us. Typically, the second half of the year, a lot better for this industry than the first half. Vineet, thank you for joining in. Season's greetings. The wonderfully colorful background that you have of the globe. May there be as much color and joy in the world in 2026 as well, and for your shareholders too. The first half of this year, you did about 8% revenues. You expected about 10 to 12% this year because the second half is typically stronger. So let's ask you, you're in the middle of the second half. You're at the end of the third quarter. How have business volumes picked up, and what are your expectations for the remainder of this year?
Hi, Mangalam. Thank you for having me, and season's greeting to you and the team as well. Yes, you're absolutely right. The second half of the year is always better, and things start picking up. Let's do a little bit of short recap. Actually, I was thinking about what happened in the whole calendar year, and we started off with all the tariff disruptions, and not forgetting the Indo-Pak skirmishes that happened. Those were some of the negatives, and really had an impact on the market, also on the local industry as well. And subsequently, then we had a very weak summer, as we recollect. Some of the consumer segments from the beverages or even air conditioners, etc., had a weak summer. Then MSMEs were down as well, and capital goods sector was also had not picked up that much. The silver lining, of course, in the last few months has been the auto sector. With the GST cuts that have happened, that has triggered a really tremendous amount of movement across the country for the finished goods. Simultaneously, we are seeing on the consumer goods with the GST cut also there has been some impact. Volumes have started to move up in this third quarter, as it always does post Diwali. Things still, it was a little soft, but then now things are still picking up. But with the GST cut, I think the most important thing that has happened is the sentiment change. The The fact is that there are consumers that are wanting products. So we are seeing a reproduction, or rather production restarting everywhere, as well as restocking happening. Clearly, the flavor of the day and the flavor of the last few months has been quick commerce. Volumes there has been tremendous. The growth has been tremendous. Addition of new warehouses has been really, really high. And we are seeing this continuing. In terms of the next few months, I think these trends will continue. We definitely see quick commerce adding to volumes for the sector as a whole, driven by consumer trends also. The GST cut will certainly help, and more income on people's hand will also help.
So for a player like you, how does all of this stack up for your own performance? Because in the middle of the year when we spoke, you were looking at 10 to 12% sort of revenue growth. The first half was 8%. That put the onus in the second half for you to at least meet that range. So one, are you on track for that range? And secondly, quick commerce, you have some exposure there, but not as much as, say, some of the quick commerce players themselves. So what's your exposure to quick commerce right now? And how is this likely to pan out in terms of growth for you?
So I talked about quick commerce as a trend. Clearly, it is not a very large contributor to our business. It is a very small percentage. But what will contribute to that 10 to 12% guidance that we have given is essentially the growth in all of the other things as well. Multimodal is growing a lot. We are seeing that rail traffic has increased, and we do container transportation across different modes of transport, whether it is sea or rail and road. And we are seeing that has started to pick up. Warehousing is picking up, and consequence of the quick commerce is warehousing also. So we do a lot of the back-end fulfillment for our customers, for the quick commerce companies or for other customers. And that back-end fulfillment centers, the warehouse centers are growing quite rapidly. So the growth will come from these areas, multimodal, automotive, as well as the back-end fulfillment centers, which are warehouses for quick commerce companies, for e-commerce companies, for even, there are large consumer durable companies that are now looking for larger spaces. I think the trend is shifting towards moving from multiple smaller places to much larger facilities, where the inventory management, where the quality control, as well as the deliveries to all these multiple channels is becoming more precise. So here, larger companies like us, which have the bandwidth of creating infrastructure, as well as delivering the quality, the KPIs that all these customers need, is driving some growth for us as well.
Vineet, morning. Thank you for joining in. Compliments of the season to you and your team as well. Based on the changes that you are noticing right now, and as you just highlighted, how much are you looking to spend the next year, considering the demand that you're witnessing and the change that you're witnessing, part one? And clubbing in another question as well, we are just a month shy from the budget. What are you expecting as an industry from the finance minister this time around?
So capex wise, the last 10 years we did about 1,000 crores of capex. The next 4 years, 3 to 4 years, we are going to do 1,000 crores of capex. The current year we are looking at about 350 to 400 crores. Similar kind of capex, 350, 400 crores. We placed an order for 2 new ships that should come in calendar year next year, end of calendar year next year. And of course, the trucks, the warehouses, etc., those are ongoing investments. We also put in money for 2 new automotive rakes for railway rakes as well. So net, the 1,000 crores is what, and most of it will come from internal accruals versus with very little debt that we plan to take on. In terms of the budget, I think it's very interesting times. I think the infrastructure spend that the government has been doing needs to continue. I have always been saying that we really build for the past. We really need to build for the future. We need to continue investing into infrastructure the way that we have been for the last 2-3 years on the budget. There's never going to be less of that. We are a country where we are trying to catch up on infrastructure. So it will help our sector from a multimodal perspective, the roads, the rails, the railway networks, as well as the connectivity through ports, etc. So more and more on infrastructure is my number one request from the government.
All right, more and more on infrastructure is your request from the government. Just a final question, the last few trading sessions, we've looked at some of the exchange disclosures that have come in. And in that, the promoter entity has been marginally inching up some of their stakes. Could you explain the rationale behind it? Do you believe more in the future of the company? You have some extra cash that you want to deploy back? Or was it just, something that usually happens?
No, we keep looking at trends and we see that, okay, we can invest more into the company and we want to keep doing that. We are fundamentally very, very clear on the growth for the next 10, 15 years, actually. So I think it's always a good time to buy.
All right. Wish you good luck, Vineet, and wish you and your team a very happy new year as well. Take a short break. Come back, focus on the bond market as always with Manisha Gupta.
You want to talk business? Meet me in the Onboard Lounge.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome to Bond Street, and joining us on this episode is Mr. K. Rajaraman. He's chairman at IFSCA. Mr. Rajaraman, hi, thank you so much for joining in. And we've seen bonds set to be mainstream. We've seen strong indications in 2024 and that getting solidifying even in 2025. So when it comes to IFSCA at Gift City, how would you say you're positioning yourself differently from India's domestic bond market, and what does that really mean for the retail bond investors?
Good afternoon to you, and thank you for having me on your program. Let me first of all say that Gift City has the bond ecosystem here is almost like 5 years old since the exchanges have started listing bonds on their exchange. These are largely Indian corporates. I think a large number of Indian corporates, some of the largest ones, as well as mid-sized companies who have listed their bonds in the Indian in the international stock exchanges in Gift City. The NSE IX and the India INX are the two exchanges in Gift City which list these bonds. So if you look at the nature of the market, I think it is a largely institutional market. because the issuers are large corporates and the subscribers, the investors are also large institutional investors from across the world, and typically intermediated by large international banks. So if you look at the nature of the products that are available at the exchanges, they are only the Indian corporate bonds, which means that these are outside the scope of investments of resident investors. I think resident investors cannot invest in a product which originated in India. So the subscribers by definition have to be either institutions in GIFT City or foreign investors or investors such as NRIs or of those kinds. So if you look at the market which I just described, I think in 2024-25, nearly about 57 issuances happened with a total value of nearly $7 billion. The total outstanding bond issuances that have happened here as of date is about $68 billion, out of which about $16 billion are green, social, and sustainable bonds. So this is the nature of the market at this point of time.
I'm just sticking to the retail market here. And in the overall landscape, when it comes to bond and the debt market, how important would you see that playing a role in a longer term? And also when it comes to IFSC, yet again, what additional safeguards, disclosures in place are going to help them understand credit currency and the default risk for that matter?
So, as a regulator, the International Financial Services Centers Authority places great importance in investor protection. And the most important element of investor protection is to ensure that investor gets adequate information for him or her to make informed decisions. So, what we have done is that from April of this year, we have mandated that all the bond issuers should mandatorily rate their bond issuances through registered credit rating agencies in GIFT City. And so some of them are also eligible to avail of international credit rating agencies as an additional rating mechanism from rating agencies who are not located in IFSCA, but located anywhere in international jurisdictions. So we also have mandated that the issuers should also disclose enough information on the use of proceeds, because obviously that gives greater visibility for the investors on how the money is getting used by the issuers. And also, let me also say that the issuers are also mandated to disclose material information to the stock exchanges from time to time. And I think things which are of importance for the investors to know, such as redemption and cancellation of debt securities, details of interest payments, any buyback or put option, etc. Similarly, I think the exchanges are also mandated to disclose any instance of default, so that the investors are immediately aware of these events to enable them to make decisions.
Mr. Rajaraman, while we keep speaking to a lot of domestic issuers and, of course, exchanges, and they have been asking for friendly taxes, that is, and some tax cuts here, is that what you're looking at IFSC as well, tax or regulatory advantages that the Indian retail investor perhaps can look at?
So let me say that the Indian retail investor would be subject to the tax law which obtained in domestic markets. So he would be subject to taxation based on the kind of product he's investing. But if you were to look at a foreign investor who is investing into the bond market in GIFT City, then obviously one of the features of the tax policy that has been put in place by the government of India is a lower rate of withholding tax. I think at 9%, as against 10 or 15 or 20%, which are available on various treaties, depending upon which jurisdiction you are investing from. So this concessional rate of 9% of withholding tax on bonds, on the interest that is payable on the bond issuances, is something which is a very attractive feature for foreign investors and non-resident Indians to use when they invest into the bond opportunities in GIFT City.
I'll wind up this conversation, Mr. Rajaraman, with one final thing. You've already told us on what the future perhaps could look like, and I understand that the bond market development, we have a Niti Aayog report. There's a lot being worked upon in sense of bond markets. In next, let's say, 3 to 5 to 7 years, perhaps, how would you look at IFSC transforming the bond investment experience overall?
So, I mean, I would say that a good bond market where I would recommend that a retail investor should invest is where there is liquidity, I think, and there is transparency in the pricing. So, from that perspective, the size of the bonds which are issued also matters, because generally corporates issue large ticket bonds, I think, which are probably more relevant to institutional investors. So mechanisms such as fractionalization of bonds through either mechanisms like ETFs or using tokenization technology is also something which we are working on. And I expect that these mechanisms will evolve over the next several years. So till such time, I think it would largely remain an institutional-led market.
All right. Mr. Rajaraman, thank you so much for taking time out for us today. Really appreciate that. Thank you.
Thank you. Thank you.
CNBC-TV18 and India Bonds presents Bond Street.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're watching us here on Trading Hour. If you look at the F&O desk and the cues coming in from there, the market's at the lower end of the range, but the range itself has been fairly narrow. Currently, the Nifty is down about 70 points. The Nifty Bank led lower by about 110 points as well. The mid-caps are marginally in the green. The advanced decline tells you that the market's still in snooze mode, and there is no directional move that the street has made its mind up for. The decliners are slightly higher than the advances, but remember, through the course of the day so far, majority, this advanced decline was largely split right down the middle. But amidst all of this, there are three pockets which are doing extremely well, and that tells you that it's a holiday thin trade, and it is not necessarily the FIs driving the market. Why? Because the rail stocks doing well. They started doing well on Wednesday itself, and from there the momentum has built on. The second one are all the PSUs. So we have NBFCs, BHEL, IREDA, all of them doing fairly well. And the third pack are the defense names. Yes, there is some fundamental news. The Defense Acquisition Council likely to finalize on a few more orders or, acquisition of defense, indigenization of products, etc. But, none that suggests the kind of move that we're seeing on a lot of these defense names. The inability of the Nifty Bank to cross past that 20-day moving average and close above that is something that will worry the bulls a little bit. But that worry may be postponed until the next week, where the actual expiry for the Nifty and the NSE indices actually takes place on Tuesday. Until then, the option writers are positioned for a range. What is this range? 26,000 at the lower level to 26,150, 26,200 at the higher level. Why do I say that? Because there's call writing at both 26,100 and put writing at 26,100 as well. So those straddle writers at 26,100 call and put, playing for a premium of almost 120 rupees from that 26,100 mark. You plug that in, then you have 25,980 as an important support, and on the way up you have 26,220 as an important supply zone. So roughly 26,000 to 26,200.
Boy, 26,000, that is one level the bulls would definitely be looking to defend. Mangalam, thank you for that FNO update, but the boy was more for the railway stocks than the range for the Nifty. 6 out of the 10 names on the Nifty 500 are currently railway stocks among the top gainers. And if you take a look at the other movers, apart from the railway names, Hindustan Copper is up another 6% today. It was on Wednesday trading at levels last seen in 2010, and it is building on to those gains now. So another 6% on Hindustan Copper. GMDC is up 5%. And among the smaller financial names, Karur Vysya Bank has made a move higher in today's session, 5% on that stock as well. So a smaller financial name putting its name up in the list of gainers. So at the highest point of the day is Karur Vysya Bank as well. Mehul Kothari of Anand Rathi Shares and Stockbrokers is joining in for a quick chart check. Mehul, good morning. Thank you for joining in. There's this dip that you have seen in the last couple of days. Would you view this as a buying opportunity, or would you stay on the sidelines because the volumes are lower and wait for better levels to get in again?
Morning, Hormuz. Once again, thanks for having me on the show. Well, in our last meeting on Monday, Nifty witnessed a gap up opening where our view was that clear 26,200 needed to be sustained for further upside towards 26,500, while a gap fill towards 26,050 remained a strong possibility. So in line with that view, Nifty has almost tested 26,050 zone today, validating that view. So going ahead, 26,050 to 25,950 zone needs to be closely watched, as this area could act as a potential buying zone. The support now, the major support Hormuz remains somewhere near to 25,800, and as long as this level is not breached, we continue to expect fresh highs in the index. Having said that, we reiterate our view that we have been emphasizing over the past few weeks that it is better to focus on individual stocks rather than the index. Sectors like railways and defense have already seen a massive pullback, and a similar corrective or pullback move may unfold across other broader market stocks in the coming sessions.
Speaking about some of the broader market stocks, one of the bigger beneficiaries of these revised railway tariffs perhaps could be IRCTC. Largely because, the tariffs on premium trains and premium services have been increased, long-distance trains as well. And my sense is a larger part of those long-distance trains would be booked online. And the IRCTC convenience fee that they charge on their internet ticketing business would benefit them more because it's pro rata. And that means that, they would have a better jump in their EBITDA. The stock opened marginally flattish, then kept building onto those gains. And now there's a bit of a bazooka sort of move that we've seen on IRCTC. And in all the other rail stocks that have moved over the last couple of years, despite the correction that we've seen, IRCTC still remains a bit of an underperformer out there. So the increased rail tariffs, could that benefit IRCTC's internet ticketing business or not? Because nearly 80 to 90% of their EBITDA comes in from this internet ticketing business itself. So IRCTC currently higher by about 4.5%. Mehul, do you have a call on IRCTC and any other individual stocks that you recommending right now?
See, Mangalam, IRCTC was a good buy somewhere near to 695, 700 odd level. So one can wait for a dip, or one can keep holding the stock because the potential now has been towards 720 to 730. It can retest that 200 demo which is placed near to 730. So it can go towards that, and then we can review the position, or we can book profits over there, which are the trading bets. But currently it cannot be bought because the risk reward ratio is not favorable. But yes, somewhere near to 700 it can be bought. And from our side, there is one stock which we are liking, that is ITC Hotels. At current market price of somewhere near to 197, the stock has formed a reversal candlestick pattern on the weekly charts, and it appears well positioned for a pullback. So one can consider buying the stock somewhere near to this level with a stop loss of 188 for an upside target of 210.
All right, you like ITC Hotel. One of the hotel stocks which is doing extremely well right now is Leela Palaces and Hotels as well. It's a big gainer right now, a big play on the premiumization business. Among all the other listed players, they have the highest margins, and they believe that, you know, this margin upside would continue on Hotel Leela. So ITC Hotels up around 1.5% right now. Hotel Leela comes up for you up around 4.5% when I last checked. Now holding up with a gain of 4.5% as well. Leela Hotels and Palaces. Speaking about expensive things, Hormaz, may not always be expensive, because Titan is the one which is doing well in today's trading session, and we had an inkling of that on Wednesday, where, you know, there were rumors around Titan having filed a patent for this brand called Beyond, which is a lab-grown diamond foray with the trademark offices. That meant that there might not be an immediate launch, but it was a patent that the company had filed for already, or a trademark that the company had filed for already. Turns out now that they're closer to the launch than anyone imagined. In fact, they've gone ahead and told the exchanges that it's their first lab-grown diamond store in Mumbai that opens as soon as December 29th, and it will be somewhere in Andheri. The erstwhile Carrot Lane store out there has been, you know, repurposed for this. This will be an exclusive retail store, and the brand Beyond basically stands for offering a curated range of lab-grown diamond jewelry, adornment beyond, watches, saris, fragrances, and general lens, sort of eyewear lenses, etc. So it is adornment beyond the other things that they offer, and not necessarily equating this with jewelry. And they plan to add a couple of more stores in Mumbai and Delhi in the immediate near future. Why is this important? Because up until now, all the jewelry players had been saying that, okay, lab-grown diamond is not very important for us. It's not a trend that we're looking at yet. We're just monitoring it. They're observing the lab-grown diamond category closely. This is the first big company foray into lab-grown diamonds, and as an offering coming in from Titan. So this is something that we will monitor very, very closely. In a way, legitimizes the demand and the underlying fundamentals of the lab-grown market. What does it do for their overall business, margins, etc.? That's a question we'll work on later. But the fact that they've gone ahead and opened something like this is good enough. Observing lab-grown demand category closely, the customers are buying lab-grown demands, not at the cost of natural diamonds. And we won't announce our lab-grown plans in public yet, is what the management used to say to us earlier over the last many interviews that we've had with them. But now it is public that they are looking at Beyond.
A sector leader entering a trend, and that a trend that is fast catching up across the country, the lab-grown diamonds trend, and Titan has now announced a foray into that market. So, well, round about the highest point of the day is Titan.
Yeah, you know, and the interesting part is that every large-scale luxury player that we speak to over the last few days, you know, we've realized that the big opportunity that they're looking at is in mass luxury now. So the earlier luxury, done. Mass luxury is where the next billion, where, in terms of people and in terms of business opportunities come by. Zudioization was the word that we had used, because Puneet Chatwal said it's gingerization. Well, Titan go beyondization. Whether that happens or not is something that we'll be tracking. Take a short break, come back on the other side. Devang Mehta joins in from Spark Private Wealth Management on Market Talk.
Fly Emirates, fly better.
Welcome back. So 90 points lower now on the index, heading towards the lowest point of the day, and still holding on to those levels of 26,050 as of now. Devang Mehta from Spark Private Wealth joining in to discuss more on the markets. Devang, good morning. Thank you for joining in. Compliments of the season to you and your team as well. Now, a lot of these railway names are starting to make a mark yet again. The January seasonality before the budget is perking these names up. Of course, a lot of them are beaten down names, but do you find this to be a good entry point as of now? Because the stocks have been beaten down almost 40-50% from their record levels.
Good morning, Hormuz. Thanks for having me on the show, and season's greetings to all of you, you particularly your team and all your viewers. Yes, typically, yes, what we have seen in this type of a market is while the broader markets have been extremely weak in terms of performance, the benchmark indices led by certain companies have done very well. Coming back to your important question about the typical railway stocks or the PSUs or defense stocks which have started to do well. And last, I think 6-7 days, we have seen a bit of recovery even in the fortunes of the broader markets, be it mid caps, be it small caps, and I'm not sort of jumping the gun on those. But what's very important is that a lot of these companies have corrected. Right. Last time on your show, I just dissected the sort of correction that these companies have gone through. As you rightly said, some of these have corrected by 20, 30, 40, 50% as well. So yes, there is a value emerging. I think gone are the days when there was only a railway budget type of trend in this type of businesses. Now, most of these companies, I'll not paint everything with the same brush, but most of these companies are now driven by revenues and earnings as well as order book growth. So my sense that at some point there has to be gravity. 30-40% correction in a lot of these interesting businesses. I'm not naming all this, but looks interesting. And while we talk about the fall in the broader market, the median fall from the 52-week high for companies, 1,510 companies, is roughly around 24%. And a lot of these companies are corrected 30, 40, 50%. So my sense, yes, some of these companies look interesting. Mid and small cap probably in the next 3 months' time should show a bit of complexion change as a lot of FIIs also start coming back to the proceedings. My sense that the broader markets look interesting at this point, but it has to be driven by earnings and cash flows. That's the most important part.
All right, has to be driven by earnings and cash flow. You know, before going to the break, we were just talking about Titan, where Titan has launched its business for lab-grown diamonds under the name Beyond. How do you like the jewelry space right now? What's your call on gold, silver? And maybe is there any particular player that you like in the jewelry space?
I think typically not on the jewelry space, but we have been, Titan has been a portfolio stock since the last 3-4 years. We have generally been positive, and this is one company which probably has done well. It's sort of defied the trend, and it's been one company, if I'm right, it's probably near to very close to the life highs. I think these companies have done all the right kind of the expansion strategy, right from Tanishq brand, which is sort of now synonymous with jewelry. I think other businesses, right from watches to the futuristic businesses. I know a lot of these businesses have not yet shown the color. For example, Tanera, which is into saris and traditional dresses. But yes, lab-grown diamond, which is one big segment which you can't sort of get away with without being into it. I think that's also a right kind of noise, and market sort of is again rewarding it that it's not getting into the old scheme of things and not diversifying or not sort of innovating. So my sense that numbers of these companies, I heard the management commentary a few days back. The word they use is typically growth, right? Which the street likes. And I know that stock has been a bit expensive, but these are companies which probably are portfolio companies, and nobody would sell it with a 1 or 2 quarter divergence in earnings. So yes, we like probably Titan, not recommending the stock, but it's been a portfolio stock. This type of lifestyle expansion companies, aspirational Indian coming up the curve, discretionary consumption are trades which one should probably get into if the horizon is 1.5-2 years.
You know, Devang, there has been a lot of conversation with regards to Coforge and the fundraising that they are doing, the acquisition that they are about to make, a potential acquisition, of course. And there are concerns with regards to dilution, the cash flow generation as well, cash flow conversion cycle at the company. Midcap IT in general, where does Coforge feature in your pecking order?
honestly do not track Coforge as closely, and it's never been a portfolio stock. But to answer your question, one company which we hold for a lot of our clients in the portfolio has been LTTS, L&T Technology Services, which is more of you can say ER&D or a bit of AI or artificial intelligence type of a company which had a bad patch the last couple of years. But I think the management commentary this time has been bullish, and there has been an improvement in numbers. So these are type of companies in this industry where there will be a bit of innovation or something which will come to the fore. We like this type of businesses rather than the usual mid-cap IT.
All right, take that point. Thank you so much for joining in and giving us your views. Wish you and your team a very happy 2026. Take a short break, come back, get you more of the markets on the other side.
You want to talk business? Meet me in the On-Board Lounge.
Well, 2025 was the year rare earths moved from the margins to the center of global power. Their conversation wasn't rare. Export curbs, supply shocks, and manufacturing disruptions turned these minerals into strategic assets and forced countries, including India, to rethink how to secure their supply chain. Really, how the supply chain really works. Shivani Bajaj puts a spotlight on the year that made rare earth magnets really rare, but yet commonplace in discussions.
If there's one lesson global markets learned in 2025, it is this: the country that controls supply chains holds the power. Driving home this lesson were rare earth minerals, a small group of elements that quietly rewrote the rules of geopolitics, manufacturing, and energy security in 2025. The turning point came in April. China tightened exports licensing on rare earth elements. These elements are crucial for a host of manufacturing activities, from EVs to electronics to military equipments to renewable energy to a range of industrial processes. By October, those controls were expanded further to include magnets and even processing technology. But the impact was visible in April itself. Exports slowed, uncertainty crept into supply chains, and global manufacturing, from cars to clean energy, was suddenly left exposed. This wasn't about running out of minerals, it was about who controlled access to them. Now, that's because while rare earths may be a group of 17 critical elements and global production stood at around 196,000 tons in 2025, valued at around $12 to $15 billion, the industries these elements supported were collectively valued at a whopping $7 trillion globally. In number terms, one electric vehicle needs about 1 to 2 kgs of rare earth magnets. One offshore wind turbine can use anywhere between 600 to 2,000 kilograms, and a single fighter jet uses more than 400 kilograms across systems and sensors. So in effect, without rare earths, motors don't run, and modern technology stalls. In addition, there are very few alternatives to rare earths at scale. So China's move was a masterstroke of sorts, and it caught the world flat-footed because China mines around 70% of rare earths globally and controls 85 to 90% of refining and processing and produces over 90% of the world's permanent magnets. This means that even if rare earths are mined outside China, they often still depend on Chinese processing to be useful. All this makes the supply chains extremely fragile and ripe to be weaponized. Factory floors went into chaos. Global EV sales, for instance, took a hit. Magnet shortage led to cost pressures and production risks. In India, Maruti Suzuki cut its EV production target sharply to around 8,000 units from earlier 26,000 units. This disruption was real. For their use in defense manufacturing, rare earths were firmly classified as strategic minerals, and NATO countries started increasing their stockpiles. Adding to the chaos was the market-driven surge in prices of many of these elements. One striking example is the price of yttrium jumped more than 4,000% during the period of supply stress. And so started a global scramble for rare earths, with almost every country and government entering the race. The US and its allies committed billions of dollars to build non-China refining capacity. The European Union, under its Critical Raw Materials Act, set a target to process 40% of its needs domestically. And Japan pushed long-term supply contracts and recycling. As a result, over 300 million tons of rare earth resources have now been identified outside China. Over 146 projects are already under development to extract and make these elements ready for use. But there's also a reality that none of this will happen overnight, or even in a handful of years. India also found itself at a sticky wicket with Chinese weaponizing rare earths. We import nearly 100% of the rare earth magnets, despite being home to about 6% of the global reserves. India's manufacturing push, on which the government has based the big portion of its plans for Viksit Bharat, was suddenly vulnerable. The government responded with a 7,280 crore rupee scheme aimed at building domestic magnet capacity of around 6,000 tons per year. This was aimed at not only reducing its dependence on China for these elements, but also eventually providing the world with an alternative supplier. As 2026 begins, the global race for rare earths is going to get crazier and well more intense. Global demand for rare earth is expected to grow by around 700% by 2040, driven by energy transition, the global semiconductor push, and the drive for defense and space supremacy. With stakes so high, rare earth minerals are no longer just commodities. They're strategic assets, they're global bargaining chips, they're carrots and they're sticks. And in this evolving new world order, those that dominate supply chains can dictate terms. And everyone wants in on that security that it offers. Back to you.
Shivani, thank you for summing that up for us. Rare earths in 2025. Take a short break. More on the markets on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Well, if you look at, this sandwiched session for the market, yesterday was a holiday, now there is a holiday again tomorrow and day after. And then we're counting down to the end of this year. Thin trades, but market's slightly lower right now, closer to the 26,050 mark for the frontline index. A good 70-80 points off today's high and a fair amount away from 26,235, which was Wednesday's high. We'll monitor this even as the mid-cap index continues to hold mildly in the green. Thank you so much for watching Trading Hour. We'll see you on Monday. Until then, it's the team of HTR Halftime Report, which comes up after this short break.
Stock struggle for direction amid thin year-end trading volumes. Nifty Sensex under pressure even as mid-caps hold up. IT, auto and pharma are the laggards while defense and consumer durables gain. Coforge board meets today to mull a fundraise proposal. Sources tell CNBC-TV18 that the company is set to acquire digital engineering firm Encora for an enterprise value of $2 billion. CPPIB, US private equity firm Stonepeak and Motion JV Co. make an open offer to acquire 26% stake at 194 rupees a piece. Move follows British Petroleum's decision to offload majority stake at Stonepeak. Stock gains about 2% of Castrol. Quick commerce company Zepto to file its confidential DRHP today. Sources tell CNBC-TV18 the company is targeting a public listing in July to September quarter of 2026 and plans to raise around 11,000 crore rupees or about $1.3 billion through a mix of fresh equity and an offer for sale. Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. My colleague Sonal Bhutra will be joining us shortly as well. But a day in terms of the market that we're keeping an eye out on, a bit more of a decline that we've seen specifically in the last hour or so. 30-40 points from that 11 o'clock move, we've seen a further decline coming in. As of now, Nifty is at 26,060 levels, down 0.3%. So from the day's high, we've seen a significant decline coming in, right? In the last couple of trading sessions, also the Nifty was in the red. Today, let's look at the broader end of the market. What is the Nifty mid-cap doing? What is the Nifty small-cap doing as well? When you look at the Nifty mid-cap, just managing to hold on to some bit of a gain and seen a bit of a bounce up in the last 15-20 odd minutes. We'll watch out for that. Nifty small-cap strongly holding on to the green side. Advanced decline ratio. That is not that exciting today. Advanced decline ratio is more in the favor of declines versus advances as of now. We saw that crisscross happening somewhere at 11 and then it went away to the red is much higher than what we saw in terms of the number of stocks in the green. So that is what we'll be keeping an eye out on. Nifty Bank also continues to be under pressure. IT also a top leg out there, down almost 0.9%. But we have Vivek who is here to take us through all the stocks that are moving around in today's trading session. A lot of moves are happening because of news flow. Which are the stocks buzzing around? Let's go across to Vivek. Good afternoon, Vivek.
Well, good afternoon. Thank you so much for that, Vinny. I know, like you mentioned, the advanced decline ratio, especially in the broader end of the market, is actually under quite a bit of pressure and mainly in favor of the declines. In terms of individual stocks, well, the number one, as far as the Nifty is concerned, can't look beyond Titan, almost 1.5% higher. The company has blinked and has now forayed into the lab-grown diamond market as well. The railway stocks, they continue to shine this on the back of the fact that, number one, you've seen some pricing action being taken. Along with that, news reports indicate that there could be a very high railway budget this time around. Back of that, all of these stocks, RVNL, RailTel, IRFC, all of them doing very well in the session. The metal pack, most of the names continues to shine higher. Have a look at Hindustan Copper, higher by over 7%. Hindustan Zinc, Nalco, and MDC, all of them up anywhere between 2 to 4%. The other set of stocks doing quite well is one name from the BFSI space. So have a look at Karur Vysya Bank, up almost 6% on decent volumes today. One of the top gainers as far as the broader end of the market is concerned. On the other hand, quite a few laggards as well. Coforge, a large fundraise, is something that the street hasn't liked, has been falling continuously for the last 3 to 4 trading sessions. Sun Pharma, we told you day first day about how there could be some pricing pressure come across as far as Illumia is concerned. Kotak pegs the impact in case it does happen at low double digit. That stock low by over 1.5%. Dixon, this particular stock continues to lag down for continuous sessions, down over 1% today. And lastly, First Cry, the biggest laggard as far as the small cap space is concerned. Again, this particular stock on reasonably high volumes compared to, when you're comparing it to typical trading sessions.
Okay, Vivek, thank you so much for listing out all those stocks. Like Vivek mentioned as well, we have these other names like the railway stocks. Look at the Nifty 500. Most of the names coming in today, if you pick out the list for the top gainers, are the railway names. RVNL up 12%. We are seeing RailTel managing to hold on to very, very strong gains of 7% as well. So in that list, railways surely are topping the charts. And why? Because obviously there are new rates that have come into action. And this is with effect from today. There's a hike in in terms of the railway ticket prices, the new take rates, which is keeping all these railway stocks abuzz. But do not forget, for the full year, these railway names were not doing that well. So it seems like they, at least in the last few trading sessions, they managed to trim down those losses, because now we've seen a bit of an up move. Jupiter Wagons, Titagarh Rail, and all the other names that I mentioned as well are among the movers there. Apart from that, GMDC today is managing to hold on to good gains. Hind Copper also is managing to hold on to very good gains as well. So that is what we'll keep an eye out on. But Sonal is here. Sonal, a day where we mentioned a bit more of a further decline now has come in. Advanced decline ratio not looking too exciting.
It is not. In fact, markets is at the day's low, and we have a lot of stocks which are declining, but a lot of stocks which are in focus on the back of news as well. So let's talk about that one, because Coforge is one of them. Sources tell CNBC-TV18 that Coforge is in advanced stocks to acquire stake in Encora. Rachna is here with more details on the size and everything else as well. Rachna.
Well, sources tell us that Coforge is in advanced talks to acquire a stake in Encora in a transaction pegged at around $2 billion. Now, the deal would mark a potential exit for private equity major Advent International, which currently holds a majority stake in Encora. To put this in context, Advent entered Encora in 2021, acquiring the company from Warburg Pincus at a valuation of about $1.5 billion. Now, Warburg had backed Encora during its earlier phase of expansion, helping build scale in offshore delivery and deepen its used enterprise client base before selling out to Advent as the company transitioned into a more mature digital engineering platform. Encora operates squarely in the digital engineering and product development space. Its core strength lies in cloud-native application development, data engineering platform, modernization, and enterprise software services, with a strong concentration of clients in North America. Over the last few years, under Advent's ownership, Encora expanded both organically and through acquisitions, positioning itself as a high-growth engineering-led alternative to traditional IT outsourcing firms. For Coforge, this would be a transformational transaction. The company has historically been a mid-sized IT services player, as we know it, with strength in BFSI and travel tech, but limited exposure to deep product engineering. Encora would significantly shift that mix. As of March 2025, Coforge reported a net cash flow of around 474 crore rupees, cash and reserves of roughly about 600 crore rupees, and that balance sheet does provide flexibility, but not enough to fund a $2 billion deal outright. As a result, Coforge's board is expected to consider a fundraise, potentially combining debt and equity to support this acquisition.
Rachna, thank you so much for that. But wait up, because quick commerce startup Zepto, that is also seems like it's pre-filing its DRHP today, and that's under the confidential route. Give us more details on this.
That's right. After a delay of nearly a year, Zepto is now set to confidentially file its draft IPO papers. That's on December 26th. Now, this is according to people familiar with the matter. The company is targeting a public listing in the July-September quarter of 2026 and plans to raise about 11,000 crore rupees. That's about $1.3 billion. This will be through a mix of fresh equity and an offer for sale. The timing is significant, though, both for Zepto and for India's fast-maturing quick commerce sector. Let's start with Zepto's numbers. Now, Zepto's revenue growth has been sharp. FY25 revenue was more than doubled at 11,109 crore rupees from 4,498 crore rupees in FY24. Losses, however, widened too alongside expansion. Net losses rose to 3,367 crore rupees in FY25 from 1,249 crore rupees from a year earlier. The company was last valued at about $7 billion in a private round in October 2025. A public listing would place Zepto alongside rivals such as Blinkit and Swiggy at a time when investors are far more focused on profitability and execution than growth alone. Ahead of the IPO, a key strategic shift has been the effort to Indianize the cap table. In January 2025, Zepto completed a reverse flip, moving its domicile from Singapore back to India, which is pretty standard when a company has to go IPO. But since then, it has worked to raise domestic ownership largely through secondary share sales. Motilal Oswal's founders bought shares worth roughly $50 million. But that may not have been enough, because Zepto continued to attract global capital, including a $450 million round led by US-based pension fund CalPERS in October 2025, which defeated its Indianizing effort. Now, Zepto's origins trace back to Y Combinator when the accelerator first invested in 2021. That, with later investors, the company scaled rapidly and became India's first unicorn of 2023, ending a prolonged funding slowdown, if you remember. But scale also brought scrutiny. In late 2025, the Central Consumer Protection Authority fined Zepto for using dark patterns such as drip pricing and basket sneaking. Earlier in 2025, a Maharashtra FDA inspection led to a temporary suspension of a warehouse in Mumbai's Dharavi, but that was an isolated case. Now, as per reports, the company also laid off 500 employees last year as part of cost control measures. Despite this, the user momentum remains strong. According to data from CLSA, Zepto added 1.2 million weekly active users in the week of December 15, the highest among quick commerce players. That said, Blinkit continues to lead on downloads. But how public market investors weigh growth, losses, governance and competition will ultimately determine how this IPO plays out.
Okay, all right. A lot of things to watch out for, especially considering so many players in the listed space as well in the quick commerce market. Thank you, Rachna, for bringing us all those important details. With that, we'll slip into a break. When we come back, we'll focus on a whole host of stocks in our Movers and Shakers segment. Stay tuned for that.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC-TV18. Now, let's talk about all the stocks that are moving around in trade and why. What is the specific reason behind them? First up, let's go across to Vivek. KNR Constructions, that's surging in trade. And this is on the back of the share purchase agreement with Indus Infra Trust. Vivek is here with more details. Back to you, Vivek.
Well, thank you so much for that, Vinny. You know, when you're looking at KNR Construction, a very interesting deal along the lines of what's been transpiring as far as the road space is concerned. Most of the road developers are now bundling the assets and selling it to InvIT. Similar lines, KNR Construction has gone ahead and executed a share purchase agreement with an InvIT, which is Indus Infra Trust, to sell 100% of its shareholding in 4 HAM projects, which is hybrid annuity model projects. So now 100% equity as well as the debt that is part of the subsidiaries or the SPAs of these particular projects. So what does KNR get in return? KNR receives close to 1,543 crore. This also includes close to 140 crore surplus cash. Remember, the equity investment that KNR had done in the 4 projects was close to 567 crore rupees, implying that the valuation multiple that the company has managed to back for these assets is at a very healthy and attractive 2.7 times price to book. When you're comparing, favorable, especially when you're comparing it to past transactions in the sector, which have been hovering around 2 or even less than 2 in most cases. Now, the deal will be completed by 30th of September. And another thing to notice that, remember, even Indus Infra Trust is actually a publicly listed infrastructure investment trust. So, good deal coming in for KNR. Stock has been rallying in anticipation of this particular deal as well.
It is 4% higher in a market which is otherwise looking a little weak and off the highs as well. But that's about KNR Constructions. But we have Titan, which is on our radar, one of the top gainers on Nifty. Mangalam is joining us to tell us the reason here. Mangalam?
Well, it's a sparkling development that has taken place at Titan. And by sparkling, I mean they have announced for the first time their foray into lab-grown diamonds. Yes, the management has been speaking about it in the past, saying that they've been observing this trend, whether they want to get into it or not. They won't announce their plans publicly, etc. Then there were a few murmurs that they've gone ahead and trademarked the brand Beyond for their lab-grown foray, and then the analysts were worried whether trademarking the brand immediately means a launch or not, etc. The company's gone ahead and now set the record straight. Titan will enter the lab-grown jewelry space, and the first store opens as recently or as in the near future as 29th December. So Beyond, from the house of Titan, which is their lab-grown foray, will have their first exclusive retail store in Mumbai on the 29th of December. It will offer a curated range of lab-grown diamond jewelry, will cater to the adornment needs of women in lifestyle categories. And this understandably is one of those repurposed stores from Carrot Lane. So looking at adornment jewelry, a lot more affordable than natural diamonds. So they do not want to, cannibalize the demand that they get for natural diamond jewelry itself. They also plan to add a couple of more stores in Mumbai and Delhi in the immediate near future. Again, this is a seminal moment from the jewelry industry standpoint, because the first time a large-scale, organization has announced its formal foray into the lab-grown diamond space. So the impact of this is something we will monitor over the next few years, not immediately, but this is just an important inflection point.
It definitely is. Thank you so much, Mangalam, for bringing us all those details. Vinny, would you be interested in lab-grown diamonds in that case?
I would be interested in lab-grown diamonds. I mean, that is the one that is affordable right now versus diamonds. But yes, that's an option. I would love diamonds as well. I'm okay with diamonds or lab-grown. I'm okay with both of them as long as someone is giving it to me.
Oh, you can buy it yourself. Why do you have to ask someone to give it to you? But nevertheless, that was in a lighter moment. But SRF is the stock on your, on our radar, because there's an anti-dumping duty which has come by on R134A, which is a major product for the company. It is an ADD for 5 years for imports from China, because dumping was done at an unfairly low price. And this is something which is happening across the chemical value chain. But for this one, it's a 5-year dumping, anti-dumping duty which has come by. Now, do remember, SRF is the sole producer of this particular refrigerant in the country with a capacity of 20,000 metric tons per annum. And analysts estimate that if there is even 1% or $1 improvement in realizations per kg, it would mean a 2% impact on EBITDA for FY27. So minuscule impact, but the fact that the anti-dumping duty has come is something which the street likes. Although whether it converts into a meaningful impact will be seen, because now the realization between domestic prices and global prices has been narrowing. So maybe if they converge, it might not be as beneficial. But for today, basis the prices today, it'll be a 2% impact.
Okay, and are there any other chemical companies?
It's just SRF, it's the sole producer.
Just for us. Okay, so keeping an eye out on SRF. But Dilip Bilkon, let's focus on that as well. Auto win seems like that's the reason for this one. Vivek, over to you.
Well, very surprisingly, last few days of the calendar year of CY25, we've seen a gush of order wins across a whole host of EPC companies. Dilip Bilkon today has announced that it's been declared as the successful bidder for two reasonably large-sized orders. The first order is where the company has emerged as the successful bidder. This is for a transmission asset, and the ordering authority was REC Power Development as well as consultancy. So Dilip Bilkon will now acquire 100% equity of the project SPV and will act as a transmission service provider. The total size of this particular EPC order is close to 1,850 crore. The other order that the company has received is a 3,400 crore order from Adani Road Transport Limited. This particular order is in the state of Bihar, and the ordering authority is Bihar State Road Development Corporation. Total size of the order, like I mentioned, 3,400 crore. Remember, order book at the end of Q2 stood quite healthy at a little over 18,600. So it's an important development for Dilip Bilkon as well. Gives them some more visibility, especially as far as FY27 is concerned.
Okay, all right. Thank you so much for joining us with all those details. So that's our movers and shakers segment. But it's time for a break. When we come back, Rajesh Palvi of Axis Securities will join in with some trading strategies on the other side. Stay tuned for that.
You want to talk business? Meet me in the On-Board Lounge. Welcome back. 83 points lower on the Nifty. We do have some losses coming in the mid-cap space as well as far as the advanced decline ratio is concerned. What's the F&O setup looking like in that case? Mangalam is joining us with more on that. Mangalam.
Well, it is classic holiday thin trade which is playing out right now with the larger indices not doing particularly well. And as we pointed out, the broader markets are doing well, and in that as well, a couple of these high beta names are doing even better. So the market's drifted lower, at least on the front line end of things. So if you look at the Nifty Bank, you have a cut of almost 1/3% on both those indices. Now the 20-day moving average of the Nifty comes into play. The Nifty Bank's inability to cross the 20-day moving average and close above that has led to the street looking at the Nifty's 20-day moving average as an important support. So 26,000 likely to hold on is what the bulls believe for now. But as it happens in holiday thin trade, the mid and small caps are having a good day, at least at the index level. There too, what has happened is if you look at the advanced decline ratio, way more stocks declining than the number of stocks which have been advancing. And this after a fair amount of tug of war between bulls and bears in that period. So those crisscross lines tell you that now the ratio is firmly in favor of the number of stocks which are declining. Amidst all of this, there are a few high beta sectors which are doing well. Again, we pointed the possibility of this out in the morning. We had the likes of defense, rail and PSUs, all of them buzzing fairly well. So amidst all of this, with the expiry next week and holiday thin trade, what is it that the street can expect? Option writers are expecting a range-bound trade to continue. Why do we say that? Because you look at the 26,050 call and the 26,100 call, those call writers are fairly active in trade today, telling you that the Nifty is unlikely to cross past 26,150 with a fair amount of gusto. 26,150 to 26,200, closer to yesterday's high, remains a bit of a supply area. But at the lower level, we do have some support coming in at 26,000 because put writers at 26,050 have still been fairly active, and the premium out there is close to around 50 odd rupees too. So between 26,000 to 26,150 is this narrow range where the market will continue to meander.
Okay, Mangalam, thank you so much for that. Surely we'll be keeping an eye out on those levels. But let's also bring on board Rajesh Palvia, VP Technical and Derivative Research at Axis Securities. Rajesh, good afternoon. Thank you so much, as always, for joining on the show. Nifty has again come around 26,000. Now, if it closes below 26,000, then what are we keeping an eye out on? And if it holds on to 26,000, what are the levels that we should watch out for?
Good afternoon. Yeah, so Nifty is consolidating in range only. 26 is having major put-based concentration, so that may act as a support area. As you pointed out, like if we break below 26,000, yes, some more liquidation we could witness. But looking at the broader market and the kind of recovery in the broader market from the lower level is giving us confidence that, there is a possibility that, Nifty may attempt to give breakout on the higher side. Though call writers are still active at 26,100, 200 strikes, there is no as such, unwinding trades are visible in this two strike price. So any decisive breakout about 26,100 could lead to some short covering action towards the this monthly expiry, and then a rally can extend further. But on the other side, Bank Nifty is still trading below to 20-day moving average, and the major put-based concentration is placed at 59,000 level. So that is important to watch for in next couple of days, whether we able to defend this 59,000 level or not. If it breaks below 59, then some liquidation we can see in this Bank Nifty and banking stocks, which can put some pressure on the Nifty also. So 59,000 is the key level. If it's break, 58,800 would be the next level on the downside. So one needs to play in the range for Nifty. If you get opportunity around 26,000 level, you can buy with a very minor stop loss of 25,950. That's the stop loss you should follow towards this monthly expiry for Nifty. And we believe that, the way the broader market is showing sign of confidence, there could be a possibility of breakout about 26,100 towards the expiry.
Okay, all right, Rajesh, that's about the indices. What about individual names? If you can quickly tell us that.
So Titagarh Wagon from the railway space is looking attractive. The way stock managed to give breakout, we believe that, here we could see more continuity of uptrend. 930 to 940 we are projecting target. On the downside, 890 needs to keep as a stop loss. And another stock is from the cement space, that is Dalmia Bharat. The 6-week consolidation range breakout is already taken place, and the way weekly charts are now shaped up, we believe here we could see more upward momentum towards 2200 to 2220. So Dalmia Bharat is buy with stop loss of 2120.
Okay, thank you so much, Rajesh, for joining us on the show, telling us about the markets as well as individual stock names. But on that note, we're going to actually sip into a very short break. After the break, we're going to be focusing on Castrol India as well as VIP Industries. Stay tuned in.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back to Halftime Report on CNBC-TV18. Nifty at 26,060 levels. We have Astra Micro, where that is also in focus, and this is on the back of some announcement that had come in. In the morning, it was a Bloomberg news flow. Now they've said that they've signed a memorandum of understanding with the BEL, so keep an eye out on this one as well. Astra Micro is holding on to gains of 1.2%. But let's talk about Castrol, right? That's the one that is in focus in the last couple of trading sessions, and obviously we have Sona to take us through all the details about this as well.
It is in focus on the back of the open offer that has been announced now. And remember, we spoke about the acquisition by Stone Peak of BP's stake. Now there's an open offer coming in from CPP Invest. There's Motion JV Co and Stone Peak, which have announced that they will be acquiring 20% stake in Castrol India. That is the Indian listed arm of Global Castrol MNC. The open offer price here is 194 rupees a share, which is exactly where the stock is trading at right now. And And this is after the Wednesday announcement that British Petroleum will sell 65% stake to Stonepeak at $10 billion. Now, remember, it is very important to understand what will happen once the open offer kicks in, because LIC holds around 10% stake in the company. We have FIIs, which have around 14% stake, Government of Singapore, which has around 1.3% stake as well in the company. So all of this will be important to track going forward. Now, in terms of details, the important part also is that Stonepeak has made several acquisitions in the past, and most of them have been delisted. For instance, in 2025, they delisted Air Transport Services Group. In 2024, they delisted Acumen Inc. In 2022, they did it with TK LNG Partners. And the key to watch now will be whether they will delist Castrol from here on or not. On the back of this, Castrol India remains in focus. They also say that the transaction is expected to complete by end of 2026, and British Petroleum also has an option to sell the remaining 35% stake after a 2-year lock-in period. A significant proportion of Castrol JV minority interests will relate to shareholding in the publicly listed Castrol India Limited. Kotak has an ad rating. They say open offer will trigger only when global transaction closes. And remember, transaction has taken place at a promoter level, so it will not impact the operational performance at all. The company has seen single-digit growth in terms of revenue and PAT in the last couple of years, but strong dividend payout, and that's where the stock has been in focus. Stonepeak is an alternative investment firm which has an $80 billion of AUM and has large investments in energy companies, clean energy, renewable energy, and that continues to be its focus. But the key to watch out will be whether Castrol Limited is delisted Indian entity, and what happens with the open offer now that LIC holds 10% stake. That's a majority stake that they have.
Absolutely key to watch out for those triggers there. But let's move on. And the luggage industry is in focus following multiple PE-led acquisition of VIP Industries. A note from Elara Capital actually suggests that the industry is entering a sustained recovery cycle, and the brokerage is optimistic on the prospects of listed players. Mangalam is here to give us those details. Mangalam, back to you on more details on luggage industries.
Well, the luggage industry has been on our radar for the last 6 months or so, ever since the VIP deal with multiples was announced. Thereafter, the previous 2 trading sessions were important because the deal has now been completed. The promoters of VIP have transferred the remaining 26% of the deal, stipulated 32% that they were to sell to multiples at 388 rupees per share on Wednesday, and now the deal is formally concluded. The luggage industry, we have a note coming in from Elara in the earlier part of the month, which they believe is entering a sustained recovery cycle. Why is that? Because, it's a proxy to the travel and hospitality play that we have. At the same time, luggage has become a mode of expression rather than just function. So 12% industry CAGR with an industry size of nearly 36,000 crores by CY 2028 is what Elara expects. And that's not all. In that, the branded penetration would increase as well and would further accelerate because of the GST cuts that have come by. So 54% as of CY24 turns into 60% at a much accelerated pace. So far, the industry was led by 3 players, mainly Samsonite, VIP, as well as Safari. And now functionality-led demand has fueled affordable and premium segments, and the industry has moved away from this oligopoly into high competition because the barriers to entry have come down, and a lot of these D2C digital native brands, private labels, have been expanding aggressively, be it the likes of Mokobara, you have National Miles, or something like Uppercase as well. They're, however, constrained by offline reach and high acquisition cost, and this is where the opportunity for Safari and VIP Industries lies for them to benefit a lot more. Safari obviously has been doing a lot better than VIP. 5 years ago, Safari's market cap was 1/4 of that of VIP, and now it is more than twice of VIP. The share price of VIP compounded at around 2.5% over the last 5 years, and that of Safari compounded by about 54%. VIP sales have been very sluggish, grew by just 5% on a compounded basis. Safari's sales have grown over 21%, implying serious market share gains and them becoming a market leader as well. Their earnings have also compounded over 35%, whereas VIP has been making a lot of losses. In FY25, the net loss was 69 crores, increased to about 156 crores. So that brings the opportunity for multiples to actually turn that around, and that's what Elara is betting on as well. The company is in repair and stabilization mode. Multiples acquisition will actually give it some focus and also governance, sharper governance, What does it have to do from here on? It has to execute well, improve margins and restore market share. But all of this comes at a risk. Turnaround trajectory, while it offers re-rating potential, risk reward is in favor of going long with a target price of almost 430 rupees. But the risks are their inability to grow very fast, competition denting their business a lot more, higher than expected rise in input price causing a bit of compression in their margins, and if they fail to identify new changes in demand scenario, that could take VIP Industries back to square one.
Okay, all right. That's an interesting take on the luggage industries. Thank you so much for joining us with all those details, Mangalam. It's time for a break now. When we come back, we'll focus on India's real estate investment trust segment, the REIT market that is, and how that's growing. Stay tuned for that.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC TV18. Nifty is at 26,030 levels. Keep an eye on that. Down almost 100 points in today's trading session. Day's lowest point for the Nifty 50 as of now. But India's real estate investment trust, that's REIT segment, has gained visibility after its fifth listing in 2025 and a slew of reforms announced. Sonal is here to decode what are the next and what is the next phase of growth for this. Sonal.
One of the notable trends in 2025 is the increased focus on REITs.
This year, India saw its 5th REIT list on the stock exchanges, a small number globally, but a big milestone for a market that only began its REIT journey in 2014. Let's zoom out. The US launched REITs in 1960, Australia in 1971, Japan, Singapore and Hong Kong followed in the early 2000s. Today, while the US boasts 196 listed REITs and a market cap of $1.4 trillion, Japan has around 57, we have Singapore with 39 REITs, Australia has 32 REITs right now worth $126 billion and Hong Kong has 11. Where does India stand? India stands at 5 REITs with a market cap of about $18 billion. REITs are like mutual funds, where the underlying is real estate, where they acquire, own, manage or finance income-generating real estate. In India, this real estate would be offices, malls, warehouses. 5 listed REITs in the country are Embassy Office Parks REIT, Mindspace Business Parks REIT, Brookfield India REIT, Nexus Select Trust REIT and Knowledge Trust REIT. Remember 2024? That's when the holding period for capital gains was cut from 36 months to 12 months, the first major nudge towards REITs. But in 2025, SEBI officially reclassified REITs as equities, aligning India with global practice. This will be applicable from Jan 2026. But why does that really matter? Because it has the potential to unlock institutional money. Mutual funds today have roughly 23,000 crore rupees in REITs, barely a drop in an 80 lakh crore industry. Funds can invest up to 10% of NAV in REITs, but the current allocation doesn't even touch 1%. Most exposure is still sitting inside debt and hybrid categories. Equity funds barely touch 2%. This reclassification is expected to reshape that in 2026 and beyond, improving liquidity and making REITs a mainstream asset class for Indian investors. In fact, there were tax sweeteners too for this asset class. Dividends and rental income from REITs remain exempt in the hands of investors, provided underlying SPVs pay corporate tax. And according to Anirok, if we talk about some more numbers for REITs, Indian REITs delivered distribution yields of 6 to 7%, comfortably above the global benchmark of 4 to 5%. Capital appreciation, because basically that is the rise in prices, stood at 3 to 5%, again higher than international peers. Although vacancy levels, they stayed elevated at 10 to 16%. On the ground, India continued to build. As of October 2025, over 23 million square feet of new Grade A office space was under construction, and Global Capability Centers, or the GCCs, drove 28 to 29% of gross leasing, reinforcing India's position as a global office hub. The market is now projected to cross $30 billion in the coming years, and also a lot of other impact that we'll see because of the regulations. And 2025 also saw early traction in small and medium REITs, introduced last year, allowing fractional ownership of real estate between 50 and 500 crore rupees. CBRE estimates that this space could surpass $75 billion with nearly 500 million square feet of eligible commercial assets across offices, retail and logistics. So now, maybe the question will be, how fast will this market grow, and not if we will see more traction in REITs in India.
Thanks so much for that, Sonal. But on that note, we're going to slip into a very short break. We'll come back, talk about markets and more stock-specific action on the other side.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. There's some fall in the markets. The Nifty is at the day's low. We do have stocks like ICICI Bank, which are at the day's low, Axis Bank, ITC, TCS. A lot of pressure coming in on these banking names, and that's leading to the further fall that we're seeing in markets currently. So watch out for Bank Nifty, because that one is down around 200 points as we speak, leading to the pressure that we're seeing on the Nifty or the benchmark index as well. But let's talk about individual names again. Lupin is in focus on the back of an Avendus cap note. Winnie, what does the note say?
Hi, so in terms of the note that's coming from Avendus, one, the buy price is, it's a buy rating, target price is 2,445 rupees. Now, investors are fearing that FY27, maybe there could be some concerns because of Myra Becron as well as Stovlapton, some erosion coming in on that front, so a reduction in revenue on that front. But what Avendus is highlighting, they are saying that, market is underestimating the pipeline that Lupin has across its inhalation biosimilar complexes and injectable side. So that is an important one in terms of the future pipeline. They think there is more to look at than what an investor is looking right now for Lupin, and it's quite positive there. They said recent approvals have come in that validates the platform's enabling sustained complex generic launches globally as well, not only domestic, globally as well, which is important for them. So this validation as well as the breadth support is superior in terms of earnings growth versus US-focused generic peers. Now, because of all this, they're positive, and that is why the buy rating sustains and continues for Avendus on this one. So look at the stock right now. It opened up in the green, but now, given that the market is also overall seeing a bit of a fall, it's a muted day for Lupin as well.
It is, but that's about a lot of stocks, right? They're opening higher, but closing lower. That's been the case with a lot of mid-caps so far. But as we wrap on this show today, let's get you an important market voice on how the Indian market performed in 2025 and what lies ahead for the market. Mihir Vora, Chief Investment Officer of Trust Mutual Fund, says India did well despite events such as Operation Sindoor, US tariffs and a lot more. Listen into what he had to say.
2025 had a high base of expectations as well as valuations to start from. So to that extent, we have done actually quite well in spite of the Sindoor episode, in spite of the worst of the tariffs that we saw from the US, and that still is not resolved. So many headwinds in terms of valuations as well as fundamentals, weakening currency, etc. So the fact that we are still at this level as far as the Nifty is concerned is actually a positive, I would say, considering where we started from. The good thing now as we enter 2026 is that the base of expectations has been reset. We've seen a price correction in the broader market. We've, of course, seen a time correction in the overall market. The currency being where it is, I think a small trigger like the trade deal happening can actually lead to the Indian outperformance in 2026. So I think expectations is everything in the market. Right now, expectations are low. Domestic flows are, healthy. FII flows have been significantly negative. If FII flows turn positive, I think we are in for a good 26. So I don't think the ask is very high from 26. The DeepSeek moment actually, coincided with extreme valuation. And when people wanted to reallocate, they started reallocating to China. So I think a decent amount of money went to China and emerging markets. India actually got left out. So I think this is the year, 2026 will be the year when India can catch up if the trade deal happens. And I think it's only a question of time. India and US can't afford not to have a deal, whether it's in a few weeks or a few months, I don't know. But it will happen, and that will be a significant trigger. The way banking sector has underperformed, especially the private sector banks last year and even before that, they offer a good balance of valuations and growth. We are seeing green shoots in credit pickup. That was the only missing link in the banking system. So with credit growth touching say 12 to 13%, I think private sector banks, the banking index or the banking thematic fund can do well. Staples for us is now a mature sector. Of course, there will be pockets of excellence. Stock picking is always possible, but the vast majority of the staples sector is mature with single-digit kind of growth, which really does not excite us given the valuations that they are trading at. On the other hand, the new age companies, which are B2C or even D2C kind of companies, they do offer a longer runway of growth.
Stocks are struggling for direction amidst thin year-end trading. Volumes on the Nifty and the Sensex are under pressure even as mid-caps hold up. IT, auto and pharma are the laggards while defense and consumer durables are some gainers.
Coforge board meets today to mull a fundraise proposal. Sources tell CNBC-TV18 that the company is set to acquire digital engineering firm Encora for an enterprise value of $2 billion.
CBPIB, the US private equity firm Stonepeak and Motion JVCO have made an open offer to acquire 24.6% stake in Castrol India at 194 rupees a piece. The move follows British Petroleum's decision to offload a majority stake in its parent company to Stonepeak. The stock is up over 2%.
Quick commerce company Zepto to file its confidential DRHP today. Sources tell CNBC-TV18 the company is targeting a public listing in the July to September quarter of 2026 and plans to raise around 11,000 crore rupees or about $1.3 billion through a mix of fresh equity and an offer for sale.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios on the final Friday of 2025. I'm Hormuz Patakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormuz. I mean, it is the final Friday like you mentioned, and the market's clearly in holiday mood, right? All of those indices hovering around the low point of the day. The mid-cap index managing to stay in that green.
Just about managing to keep its head above water. But yes, the Nifty currently, they're still holding on to some important supports, at least as of now. The 26,000 level is now an important one. The 26,100 was taken out earlier in the day. But that is the important level to watch on the downside for the index. You pull up the Nifty Bank as well. And 59,000 was an important level on the downside for the banking index. Still just about managing to keep it above those levels, so that is going to be an important level to watch on the Nifty Bank as well. So these are of course where the indices lie, at least hovering near the lowest point of the day, but the broader markets are painting a fairly better picture, at least as of now, compared to the benchmark indices.
Absolutely, and all of those indices holding some key levels as you pointed out. But if you take a look at that advanced decline ratio, right, at around 11 o'clock those lines were merging and converging, but now it's firmly in favor of the declines, as you can see on your screen. But some of those stocks that are doing well today are those railway stocks, those companies gaining for the fifth straight session. Let's bring it on your screen for you. Ercon, Railtel, IRFC, all of them surging in trade, 6%, 7%, 8%, all of them doing really well in trade. Those metal stocks continue to shine. Hindustan Copper about 6%, in 8% now in the green. Nalco, Hindustan Zinc, all of them gaining in trade. However, on the downside, it's those IT names that seem to be lagging. They continue to fall. Coforge, HCL Tech, Emphasis, all of them trading in the red.
You know, it is interesting because Coforge is now at the lowest point of the day. It's down over 10% in the last 3 trading sessions ahead of that all-important board meeting to consider a fundraising proposal. And it's a potential acquisition that is in the offing, and the street does not like it because of the fact that there might just end up being some more potential dilution for Coforge, as Rima was also highlighting earlier in the day, earlier in the week, that there is, in case there is an acquisition, there could be, or in case there is an issue of shares as well, that could lead to a potential dilution. They had raised some money last year as well, and now another fundraising plan on the offing. Of course, there is an analyst day later as well, so we keep an eye out on that. And since you mentioned Hindustan Copper, it's up 22% this week. It's now turning out to be the best week that the stock has had since December of last year, maybe even better now, because December of last year it had back-to-back weeks of 20% or more gains. So Hindustan Copper now heading towards levels last seen in 2010. So 8% higher at the highest point of the day is Hindustan Copper. Now, of course, there is the other major talking point all through the year has been tariffs and uncertainties and so on and so forth, right?
Absolutely. That's been the key talking point for this year, right? That's what defined 2025. So tariffs, uncertainty over trade deals ensured that volatility was the only constant in global trade in 2025. And for India and Indian businesses, a source of significant heartburn. Abhimanyu Sharma reports that while the government fought to keep trade on even keel and find new markets, a cheaper rupee has been one of the only comforts for exporters, and 2026 is likely to see much of the same unless the government effects a breakthrough.
2025 started with the prospect of India striking lucrative trade deals with many nations across the world, including the United States. The ongoing Russia-Ukraine war, the Israel-Gaza conflict, sanctions on Russia along with geopolitical tensions in the Red Sea pushed up freight costs for exporters. Despite uncertainties, India's total merchandise and services exports in FY25 hit an all-time high of $825.25 billion, a growth of 6.05% year-on-year from FY24's levels. But US President Donald Trump threw a spanner in the works, imposing tariffs on imports based on product and country of origin. In the second week of April, he announced global tariffs with a baseline of 10% across all imports and reciprocal tariffs on some countries, including a 26% tariff on India.
We get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world. You know, everything they made, they'd send it in, pour it into our country, and therefore it wouldn't be made here, you know, which is a negative. But we would not send in anything because they were charging us 100% tariffs. And
a breather came soon after. Reciprocal tariffs were paused for a period of 90 days, even as talks for a bilateral trade agreement continued. Indian negotiators met with their American counterparts numerous times, even in person, and talk of a trade deal remained a low but steady hum. Then came the big jolt. On the 27th of August, President Trump blamed India for funding the Russian war on Ukraine by continuing to buy Russian oil. He hiked tariffs on India to 50%. India pushed back.
Somebody tells me tomorrow I can't be friends with the European Union, I won't accept that. Or somebody tells me tomorrow I can't work with Kenya, it's not acceptable to me. So I think we are all in it together. The decision whether to buy a particular product from a country is something that the entire world will have to take a call on.
As India and the US continued to engage with each other in a bid to arrive at a mutually agreeable and beneficial trade deal, India managed to conclude negotiations on some significant bilateral free trade agreements. It signed an FTA with the UK in July, though that is yet to come into effect. The government has also facilitated the opening up of a few new markets for Indian exporters, including Switzerland, Norway, Iceland and Liechtenstein, as the FTA with the European Free Trade Association came into effect in October, and the European Union approved imports from 102 fisheries establishments. In December, India and Oman completed negotiations for a comprehensive economic partnership agreement, under which Oman will provide India duty-free access to 98.08% of its tariff lines. This covers 99.38% of what India exports to Oman. More recently, India concluded negotiations for an FTA with New Zealand. While these came later, Indian exports still stood on firm, albeit fragile ground. In the first half of the FY26, India's exports rose 5.86%, led by a 9.34% rise in services exports and a 2.90% rise in merchandise exports. This was driven by electronic goods, engineering goods, drugs and pharmaceuticals, marine products, and rice, with Spain, Hong Kong, China, and the UAE proving to be strong markets. Though India's exports to the US also rose 13% year-on-year in the first half of the financial year, this included a lot of front-loading of exports as traders tried to beat the window before higher tariffs kicked in. But the brunt of higher US tariffs is being felt, especially in the export of labor-intensive areas like textiles and leather, which have a high dependence on the American market. And while talks continue, there is no definitive headway yet.
I've said many times that all agreements, all discussions have many diverse, many different angles, many dots have to be connected, and we never negotiate deals with deadlines.
To mitigate the hit from US tariff disruptions, the government also looked for other supportive measures. The Export Credit Guarantee Corporation upgraded the country ratings of 24 nations in September, reducing insurance costs and overexposure to markets affected by tariffs, protectionist policies, or restrictive market access. The fall in the rupee's value against the dollar also gave exporters some cushion, as did a mammoth GST rate rationalization exercise that gave producers more traction in the domestic market. The recently announced Export Promotion Mission, which aims to provide exporters with financial incentives in their quest for newer markets, is also designed to help.
भारत के किसान, भारत के मछुआरे, भारत के पशुपालक, उनसे जुड़ी किसी भी अहितकारी नीति के आगे मोदी दीवार बन के खड़ा है.
As 2026 dawns, talks for a trade deal with the US are still underway. Buzz of it being imminent crops up periodically, but as people say, nothing's certain till the dotted line is signed.
Right now, we are engaged with not only negotiating a bilateral trade agreement, which definitely with a country like United States will take a lot of time, because trade agreements are very wide-ranging agreements these days with a lot of issues, not only market access issues, which are negotiated under the umbrella. But at the same time, we are also engaged in a protracted negotiations on a framework trade deal, which will try to address the reciprocal tariff challenge that the Indian exporters today face. So these are two separate parallel negotiations going on.
India is also engaged in negotiations with the 27-member European Union, the Russia-led Eurasian Economic Union, the 5-member Brazil-led Mercosur bloc, Chile, Peru, and Maldives. Terms of reference have also been finalized for trade deals with Israel, Qatar, and the 6-member Gulf Cooperation Council. In addition, an FTA review is underway with the ASEAN bloc, and expanded FTAs are being considered with Australia and the UAE. None of these may materialize overnight, but as each of these fructify over the next 12 months, Indian exporters can expect some relief. The biggest relief, however, will come only when India and the US are able to agree on terms that both leaders find palatable. In New Delhi, this is Abhimanyu Sharma for CNBC-TV18.
Well, that was about trade, tariffs, and a whole lot all through the year. Take a short break. More news and updates follow on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still with us on Business Lunch. Moving on to the big story from the corporate world. Sources tell CNBC-TV18 that Coforge is in advanced talks to acquire stake in Encora. That stock, however, is down over 3% in trade. Rachna Dhanrajani is here with more of those details. Rachna?
Right, sources have told us that Coforge is in advanced talks to acquire stake in Encora in a transaction that's pegged at about $2 billion. Now, the deal would mark a potential exit for private equity major Advent International, which currently holds a majority stake in Encora. To put this in context, Advent entered Encora in 2021, acquiring the company from Warburg Pincus at a valuation of about $1.5 billion. Warburg had backed Encora during its earlier phase of expansion, helping build scale in offshore delivery and deepen its US enterprise client base before selling out to Advent as the company transitioned into a more mature digital engineering platform. Now, Encora operates squarely in the digital engineering and product development space. Its core strengths lie in cloud-native application development, data engineering platform modernization, and enterprise software services with a strong concentration of clients in North America. Over the last few years, under Advent's ownership, Encora expanded both organically and through acquisitions, positioning itself as a high-growth engineering-led alternative to traditional IT outsourcing firms. For Coforge, this would be a transformational transaction. The company has historically been a mid-sized IT services player with strength in BFSI and travel tech as we know it, but limited exposure to deep product engineering. Now, Encora would significantly shift that mix. So it's definitely going to be transformational, but also very ambitious because as of March 2025, Coforge reported net cash flow of around 474 crore rupees, cash and reserves of roughly 600 crore rupees. That balance sheet provides flexibility, but not enough to fund a $2 billion deal. Now, as a result, Coforge's board is expected to consider a fundraise, potentially combining debt and equity to support this acquisition.
All right, Rachna, but stay on with us. The other big story that you're tracking for us today is that quick commerce startup Zepto is set to pre-file its DRHP today under the confidential route. Tell us more on that front.
That is correct. After a delay of nearly a year, Zepto is now set to confidentially file its draft IPO papers, that is on December 26. Now, this is according to people familiar with the matter. Now, the company is targeting a public listing in the July-September quarter of 2026 and plans to raise about 11,000 crore rupees, that's about $1.3 billion. This will be through a mix of fresh equity and an offer for sale. But the timing is what is significant here because it's for both Zepto as well as for India's fast-maturing quick commerce sector. But let's start with the numbers first. Zepto's revenue growth has been sharp. FY25 revenue more than doubled to 11,109 crore rupees from 4,498 crore rupees in FY24. Losses also widened alongside expansion. Net losses rose to 3,367 crore rupees in FY25 from 1,249 crore rupees a year earlier. Now, the company was last valued at $7 billion in a private round in October 2025. A public listing would place Zepto alongside rivals such as Blinkit and Swiggy at a time when investors are far more focused on profitability and execution than growth alone. Ahead of the IPO, a key strategic shift has been the effort to Indianize its cap table. In January 2025, Zepto completed a reverse flip, moving its domicile from Singapore back to India, which is pretty standard when a company wants to go IPO in India. But since then, it has worked to raise domestic ownership largely through secondary share sales. Motilal Oswal and its founders bought shares worth roughly $50 million. But that may not have been enough because Zepto continued to attract global capital, including a $450 million round led by US-based pension fund CalPERS in October 2025 and hence defeating its purpose of Indianizing the cap table. But Zepto's origins trace back to Y Combinator when the accelerator invested in 2021. That and with later investors, the company scaled rapidly and became India's first unicorn of 2023, ending a prolonged funding slowdown, if you remember. But scale also brought scrutiny. In late 2025, the Central Consumer Protection Authority fined Zepto for using dark patterns such as drip pricing and basket sneaking. Earlier in 2025, a Maharashtra FDA inspection led to a temporary suspension of a warehouse in Mumbai's Dharavi, but that was an isolated case. Now, as per reports, the company also laid off over 500 employees last year as a part of the cost control measures. Despite this, user momentum remains strong. According to data from CLSA, Zepto added 1.2 million weekly active users in the week of December 15, the highest among quick commerce players. That said, Blinkit continues to lead on downloads. Now, how public market investors weigh growth, losses, governance, and competition will ultimately determine how this IPO plays out, and we will keep a close eye.
Yes, indeed, we will keep a close eye out on that. One of the big IPOs loading for next year. Rachna, thank you for both of those updates. We keep an eye out on the Zepto DRHP when it is filed later in the day, and of course the outcome of the Coforge board meeting as well. For now, Coforge at the lowest point of the day, third straight day of losses. Take a short break. More news and updates on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. As 2025 draws to a close in a few days, CNBC's Monica Petrelli brings you the biggest trends that are expected to shape the way we travel in 2026. Take a look.
Traveling is no longer about the destination or even the journey. These days, travelers say they want one thing, an experience to remember.
So experience-led travel popped post-COVID, and it's been evolving ever since. But this style of travel isn't about checking the boxes or seeing the sights. It's about meaningful trips that let travelers connect with the people and the places they visit.
In 2026, that trend is driving more to seek spots with fewer crowds, especially ones with cooler climates and better prices. Advisors from the luxury operator Virtuoso say 76% of travelers are choosing shoulder season or off-peak trips, while 75% say they want destinations with moderate weather. That means staying cool will be ultra hot in 2026, with Iceland, Antarctica, and Norway topping the company's list of rising destinations. An analysis of more than 100,000 trip requests at the luxury travel company Zacasso shows increased interest in Northern and Eastern Europe, with more skipping the crowded islands of Greece for the culture of Poland, where requests next year are up 230%. In Asia, interest in Thailand is dropping, yet rising in Japan, where hotel searches in secondary cities like Takamatsu and Sapporo are growing faster than major tourism draws like Tokyo and Osaka, according to Agoda. Luxury travelers are seeking even more solitude, pushing five-star operators like Four Seasons and Orient Express to enter the yachting market, while wellness travel is maturing as holidaymakers skip spa packages for science-backed longevity retreats. From K-pop to the FIFA World Cup, sports and music events are set to be huge tourism magnets next year, with countries like Saudi Arabia spending billions to vie for top talent and the tourism dollars they attract.
But research from Hilton shows most people travel for a different reason, simply to rest and recharge.
The mental load of modern life is fueling a rise in decision detox holidays, with more travelers seeking the ease of all-inclusive hotels. Others are hiring high-end travel agents to handle every trip detail in a trend Virtuoso calls the top ultra-luxe experience of 2026. Other travel trends are age-old, but with a twist. More Gen Zs are seeking nature next year, while middle-aged travelers are taking golden gap year trips. However, food is the great unifier, with viral TikTok videos propelling new food and drink experiences at Airbnb. Hotels, in turn, are upping the game to keep travelers and their social spending under one roof.
When you just look at this year, 33 of our hotels were recognized with 43 Michelin keys. We had 4 hotels here in Asia Pacific named amongst the top 50 hotels in the world recently. And then when it comes to food and beverage, 3 of our bars were recognized amongst the top 50 bars.
Underpinning it all is technology that is easing travel's biggest pain points, from biometric processing at airports to AI-powered language translation apps. AI is also ushering in a new era for hotels, which are moving from reacting to guest requests to predicting what they'll want next. Surveys show rising travel costs and economic uncertainty are causing some to pull back their 2026 plans. But January could still be the biggest booking month on record as travelers close out 2025 and look forward to the year ahead. For CNBC, I'm Monica Petrelli.
And with that, it is a wrap on this edition of Business Lunch. From Hormaz and me, goodbye and many thanks for watching. Midcap Radar coming up next.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Continues to be a down day so far. The Nifty is at the 26,049 mark. The mid-caps, though the benchmark index is doing well, there are more declining stocks than advancing today.
That's right. Good afternoon, Sonal. The advanced decline ratio is muted and in favor of the declines, given the fact that mid-cap index actually is trading with a slight positive bias. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks struggle for direction amid thin year-end trading volumes. Nifty Sensex under pressure even as mid-caps hold up. IT, auto and pharma are the laggards, while defense and consumer durables gain.
KRNR Constructions shares rally as the company signed share purchase agreement with Indus Infra Trust to sell its 100% stake in 4 road SPVs for 1,543 crore rupees, including 1,398 crore rupees as sale consideration.
Canada Pension Plan Investment Board, US private equity firm Stonepeak and Motion JV company make an open offer to acquire 26% stake at 119 rupees apiece in Castrol India. The move follows British Petroleum's decision to offload majority stake to Stonepeak. Castrol stock gains about 2%.
Dilip Bilcon shares surge almost 4% in trade as the company gets LOA for EPC project worth 3,400 crore rupees from Adani Road Transport. The company has also announced that it was declared as the lowest bidder for a project worth 1,850 crore rupees from Karnataka government earlier this morning.
Reports suggest the electricity regulator CERC is deliberating lower transaction fee of 1.5 paise per kilowatt hour versus the current 2 paise fee. Shares of IX are trading lower.
All right, those are the top headlines. We'll discuss some of the stocks in greater detail as well. But the headline remains that while the mid-cap index is doing well, we have far more declining stocks versus the advancing stocks as we speak. If we talk about the sectoral movers right now, metals continue to take the lead, followed by some of these CPSE names, while there is some profit booking coming in from IT, pharma and auto index. So these defensive names not doing so well in trade today. Again, as we pointed out earlier, lower volumes, end of the year, so not much activity happening on a benchmark level.
That's right, and very few equity markets worldwide are actually trading today or actually even open today. Boxing Day, as they call it, not too much volume activity happening, especially as far as the broader end of the markets are concerned. Cash volumes quite thin. But this is our special segment, Mid-Cap Movers. Hormaz is standing by the wall. He spotted some of the stocks that have decent volume and are also seeing significant price action.
You know, there's been a lot of traction in these railway companies now. It's the 5th straight day that these stocks have gained, and how. And you take a look at RVNL, IRCON, IRFC, all of them trading with very, very healthy gains. RVNL holding on to gains of 12%, IRFC is up 9%, RailTel's up 7%, IRCON's up 7%. So a lot of these railway stocks continuing to punch higher after being beaten down all through the year, at least down 40 to 50% from their record high levels. Now in the newsmakers section, of course, all eyes are on the board meeting from Coforge. The stock is grinding lower at the lowest point of the day now, 4% lower for Coforge. It's down almost 11% in these last 3 trading sessions ever since the board meeting announcement was done. Panacea Biotech is now up 16%. NBCC, after the land parcel purchase in Dubai, is up 4.5%, and IEX, as Vivek just highlighted, still trading with losses of around 2%. Metal stocks, of course, continue to surge higher. Hindustan Copper is now up 22% this week. Nalco, Hindustan Zinc, GMDC is also at the highest point of the day, 9% higher on the stock now, nearing levels of 600. And the stocks that are doing well on the volumes front, Karur Vysya Bank finds its name among the list of private financiers who are surging today. At the highest point of the day now is Karur Vysya Bank, 7.5% higher on the stock. MMTC and, of course, GMDC on very strong volumes as well. And lastly, stocks that are not doing well in today's session, Stanley Lifestyles, another wealth destroying IPO. Braintree Solutions is at the lows of the day, and VIP Industries seeing some profit booking after that 15% surge that was seen in Wednesday's trading session. Back to you guys.
All right, some interesting names there. Thank you so much for joining us with that list, Hormuz. As always, let's now welcome Himen Kapadia from DR Choksi FinServ for a technical check on the market. Himen, good afternoon. Thank you so much for joining in. Do you think markets will continue to remain range-bound for the next week as well? Because we'll not see so much activity from FIIs and not so much back home as well.
A very good afternoon to you, Sonal. Thank you for having me on the show. It's always a pleasure. Frankly speaking, we need a week of Sonal. Markets going nowhere. Christmas year and we really need a week holiday. But seriously speaking, the VIX is at 9, Sonal. So I don't think one can expect anything much from the market. I mean, the fear index doesn't seem to show that any big moves are expected. Yeah, stock specific, yes. There was a gap on the daily chart, Sonal. As far as the Nifty is concerned, we've just partially covered it, not fully. I mean, a little bit is left. So, and we've been in this range between 25,700 and 26,300 for quite a few weeks now. Needless to say, we need a decisive push above the 26,277 earlier high. Also that, okay, round it off 26,300 for a breakthrough to come in. The setup is good. We are poised. There's a threshold, but we need that final move on the upside, which is somehow missing. Lack of activity, holiday mood, or the VIX low. So either way, nothing much is happening. Nifty Bank, which was sort of relatively strong, Sonal, and was, sort of at the helm of things, is now losing steam. So, like you said, IT is cooled off. Metal does not have that much of a great weightage on the Nifty. Scary thing is FMCG looking good. Scary, normally when FMCG goes up, everything else goes down. But that's how it is. It remained the 6-8 stock move, Sonal.
Right, Heyman, totally echo your sentiment in terms of the 1 week off that you asked us. But Heyman, your individual picks for the day and a view, if you have any, on Coforge ahead of the board meeting today. Stock has corrected quite a bit.
Okay. Firstly, Vivek, firstly, a buy call on Titan. It's a slightly interesting stock because we spent 24 months, Vivek. I kid you not, 24 months. And now we are breaking out. Needless to say, short term, medium term, long term, every time frame that you see, Titan is in an up move now. So 24 months is a long time. I believe the next 1 year should be good for Titan. All-time highs, and 3887 was one level, or maybe 3900, which it has not closed properly. And this is the month it's going to do that. So simply put, buy Titan at 39.90, stop loss 38.90, target 41.90. I believe not will is the wrong word. We would be crossing 4,500 sometime in the next calendar year. So buy call on Titan. Secondly, a buy call on Britannia Industries. We are in a short-term up move, medium-term base is being formed. I believe a further upside seems to be on the cards. So one can buy Britannia at 6060. Stop loss of 5960, target of 60 to 60 above the 55-day moving average, oscillators buy. Everything is beginning to improve even from a medium-term point of view. Coming back to Coforge that you mentioned, frankly speaking, I wouldn't say a triple top, but if you go back in time, we never sustained about 2000. Obviously, these are after the splits and whatever. So it's third time we've come back from the proximity of the 2000 area, and now it looks like falling under its own weight. Lower tops, lower bottoms, nothing positive on the charts. Everything looks as if Coforge is done for the day. Further downside, very much possible. Support comes in at 1600 and 1523.
Okay, all right. Thank you so much, Heyman, for joining us, and have a great weekend ahead. With that, we'll slip into a short break. When we come back, we'll get to more on the markets and stock-specific action on the other side. Stay tuned for that.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're still tuned into Mid-Cap Radar. A lot of stocks in the broader markets which are on our radar. Let's talk about Dilip Bilkon. Vivek, something brewing there?
Well, that's right. Year-end, calendar year-end, suddenly a whole host of power EPC companies, infra EPC companies have seen a slew of order wins. Dilip Bilkon today announced two separate order wins. First one, this is a transmission asset that we're talking about. The ordering authority was REC Power Development and Consultancy order. Dilip Bilkon will do the construction and commissioning for the next 24 months. So it's a 2-year project, and the total size of the order is a little over 1,850 crore. The second order is a larger one. This is a road order that is coming from Bihar, a 3,400 crore order from Adani Road Transport Limited. It's an EPC contract, so a little over 3,400 crore is what Dilip Bilkon's share in this particular project will remain. So it's a couple of large order wins, stock high by over 3%. Order book at the end of Q2 stood at over 18,600 crore. So pretty large order win coming as far as Dilip Bilkon is concerned now. But moving on, India's real estate investment trust segment has gained visibility after its 5th listing in 2025 and a slew of reforms that were announced. Sonal joined in to decode what is the next phase of growth. Sonal, over to you.
One of the notable trends in 2025 is the increased focus on REITs. This year, India saw its 5th REIT list on the stock exchanges, a small number globally, but a big milestone for a market that only began its REIT journey in 2014. Let's zoom out. The US launched REITs in 1960, Australia in 1971, Japan, Singapore and Hong Kong followed in the early 2000s. Today, while the US boasts 196 listed REITs and a market cap of $1.4 trillion, Japan has around 57. We have Singapore with 39 REITs. Australia has 32 REITs right now worth $126 billion and Hong Kong has 11. Where does India stand? India stands at 5 REITs with a market cap of about $18 billion. REITs are like mutual funds. Where the underlying is real estate, where they acquire, own, manage or finance income-generating real estate. In India, this real estate would be offices, malls, warehouses. 5 listed REITs in the country are Embassy Office Parks REIT, Mindspace Business Parks REIT, Brookfield India REIT, Nexus Select Trust REIT and Knowledge Trust REIT. Remember 2024? That's when the holding period for capital gains was cut from 36 months to 12 months, the first major nudge towards REITs. But in 2025, SEBI officially reclassified REITs as equities, aligning India with global practice. This will be applicable from Jan 2026. But why does that really matter? Because it has the potential to unlock institutional money. Mutual funds today have roughly 23,000 crore rupees in REITs, barely a drop in an 80 lakh crore industry. Funds can invest up to 10% of NAV in REITs, but the current allocation doesn't even touch 1%. Most exposure is still sitting inside debt and hybrid categories. Equity funds barely touch 2%. This reclassification is expected to reshape that in 2026 and beyond, improving liquidity and making REITs a mainstream asset class for Indian investors. In fact, there were tax sweeteners too for this asset class. Dividends and rental income from REITs remain exempt in the hands of investors, provided underlying SPVs pay corporate tax. And according to Anirok, if we talk about some more numbers for REITs, Indian REITs delivered distribution yields of 6 to 7%, comfortably above the global benchmark of 4 to 5%. Capital appreciation, because basically that is the rise in prices, stood at 3 to 5%, again higher than international peers. Although vacancy levels, they stayed elevated at 10 to 16%. On the ground, India continued to build. As of October 2025, over 23 million square feet of new Grade A office space was under construction, and Global Capability Centers, or the GCCs, drove 28 to 29% of gross leasing, reinforcing India's position as a global office hub. The market is now projected to cross $30 billion in the coming years, and also a lot of other impact that we'll see because of the regulations. And 2025 also saw early traction in small and medium REITs, introduced last year, allowing fractional ownership of real estate between 50 and 500 crore rupees. CBRE estimates that this space could surpass $75 billion with nearly 500 million square feet of eligible commercial assets across offices, retail and logistics. So now, maybe the question will be, how fast will this market grow, and not if we will see more traction in REITs in India.
Well, a very interesting piece put out by our colleague Sonal. Sonal, excellent work as far as the REITs is concerned, but an important development that you can see on the bottom of your screen, Stylum Industries. Remember, our colleague Yash Jain had done this particular story a while ago, and it's been confirmed Aika Kogyo is looking to buy a significant chunk of Stylum Industries. That is going to be done in two tranches from two separate sets of promoters. 40 to 53.12% stake will be bought in Stylum Industries, and given the change in management control, the open offer will be triggered as well. On the back of that, Stylum Industries, this particular stock has done quite well in the year gone by. Now, post the announcement of the deal, is up almost 1.5%. Sonal.
It is very important, and it also talks about how some of the promoters will be resigning and will be classified as public shareholders. We're trying to understand whether the company Aika Kogyo will get, there'll be more details on this one, but for now, 2,250 rupees a share. That is the price which is set for this acquisition, which is of course below the current market price that the stock is trading at. It will be between 1,530 to 2,038 crore rupees. That is the consideration, and that is for a 40 to 53% stake. We'll get in more analysis which will come in. We'll get in Mangalam as well. But for now, we'll slip into a short break. When we come back, we'll talk about more on the markets and stock-specific action. Stay tuned for that.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. A lot of action in the broader markets. The mid-cap index has come off from the highs with the advanced decline ratio in favor of declines. But something like a Hindustan Copper is surging at the day's high, 8% higher on that one. We do have Rain Industries as well, which is higher, 7% higher on that stock. Canara HSBC Life Insurance, that stock is up 6.5%. Bellrise Industries is the other one, which is surging up 6% as we speak. So there are pockets which are doing really well. Rail stocks, for instance, on the back of that fare hike are doing really well. So watch out for this space because some of them are bucking the trend as far as the benchmark is concerned. But let's focus on CNBC-TV18 exclusive. Shireen Bhan caught up with Karan Virwani, who is the MD and CEO of WeWork, on company's pivot from being a co-working space provider to infrastructure service provider. He also shares his plans on moving up the value chain by providing value-added services. Listen into that conversation.
WeWork India presents CNBC-TV18, The Titans.
The pivot that you're making from being not just a co-working space provider to, as you pointed out, a managed service space provider and then eventually perhaps an infrastructure service provider. As you make this pivot, what does it mean as far as ARPUs are concerned? What does it also mean in terms of your own capabilities? How much do you do in-house? How much do you outsource? How much do you partner? How much do you perhaps even acquire?
Yeah, I think it's an interesting point. An evolution that has sort of naturally been happening as the space and us as a company, you know, when we entered India about 8 years back, we were really trying to build just for startups and mid-sized companies, and we were just trying to build cool spaces that entrepreneurs would love coming to, that you could network with other entrepreneurs, and that would, you know, grow your business. That was really the original thought. And as soon as we opened enterprise, took off, and then we slowly started to see not just us but the entire market evolve to wanting to cater to these large customers. That required a different form of execution, different form of scale, and the expectations also have changed from what companies actually want us to do, the service levels and things like that. So we moved from co-working to now really what we're doing is, you know, workspace as a service. We, at least as WeWork, are a platform where any type of requirement you have, you're a freelancer who wants a desk for a day to, you know, large global corporate who needs a 2-3 lakh square foot office, we're able to do all of that. And I think as part of that, what we're starting to see is with that close relationship to a lot of these companies, with being really a partner as they grow and evolve as organizations, with really being at the forefront of seeing how a lot of these companies are starting to you know, adopt hybrid work, how they're changing in their way that the work styles are going. We think that there's opportunities above workspace that we can build, partner, or, you know, just sort of like position ourselves to be able to cater to these companies. If you're building tech, you know, managing transport, let's say, for your employees, or food for your employees, or employee experience for employees, those are still not core to what you do. You end up having to hire teams, build teams around it. Could you just outsource that, you know, to someone like us who's anyway managing your workspace and, you know, understands what you really require? So I think over time, we want to move up the value chain and try to do a bit more for these companies so that they can just focus on what they're doing.
So what will the addition of value-added services mean as far as the average revenue per user is concerned? And by when do you expect this transition to really kick in from a revenue perspective?
You'll see that we currently already, as a percentage of revenue, do a lot higher than other operators from a VAS perspective. So it's something that we've really been doing. And it works very well right now for all of our startups and mid-sized businesses. Today, enterprises have teams, you know, a lot of them have that, so they don't necessarily require us right now, but we're starting to see that if we can introduce and we can slowly do things, you know, they are becoming open to sort of outsourcing some of this stuff and not needing to have these teams or really, you know, spend money on it. So I think not to put maybe on like a number to it, but from roughly about 14-15% of our revenue, even if it moves up 1 or 2%, at this base of revenue that we have, it's really it almost all flows down to the bottom line. It's high margin type of revenues that we see, because it's really just manpower maybe that we have to add as a cost, or build certain teams, but we can provide this as a service, and I would say a few percentage points at the mid to near term is what we would at least focus on, but a lot of contribution to the margin of the business.
We Work India presents CNBC-TV18 The Titans.
Well, a very interesting conversation there with the management of WeWork India. Well, with the news that the mid-cap index is extremely flat today, it's all the time we have on this edition of Mid-Cap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Markets today, lackluster day coming in for the market. Third consecutive day of fall is what we're seeing for the Nifty 50. So yes, last few sessions it was down 1/10%, 2/10%, and now seems like today, as of now, it's down almost 0.3% in the trading session. Though it's managing to hold on to 26,000, the Nifty, but still almost in the day's lowest point. Around that mark is what the Nifty is trading at. So keep an eye out on that. The broader end of the market today, the Nifty mid-cap is also down almost 0.1% around that mark. Nifty mid-cap, it's moved to the green right now. So, okay, we'll keep an eye out on that. Nifty mid-cap is holding on to gains of 0.06%, 0.1% of gain there, while the small cap is also managing to hold on to gains of 0.2%. So, let's watch out for the gains there on the broader end of the market, though advance decline ratio a bit more in the favor of declines clearly today versus the advances. But let's get started with the show, which is where we solve all your stock-related queries. And to do just that, we have Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, to answer all the stock-related queries. Shaina as well as Vaishali, good afternoon. Thank you so much for joining us on the show. Let's get started with the queries for today. First query for today has come in from Suraj Reddy, who's writing to us from Chennai. It's an investment query. He's asking if he can invest in PNC Infratech, and this is a short-term query. What should they be doing with this? Shaina, let's start with you. Good afternoon.
Good afternoon, Vinny, and also Vaishali. See, basically, for short term, I would say it's slightly risky. But if you're looking at the medium to longer term, I think it's pretty safe in terms of valuations. Valuations are not very expensive. And if you look at the order book is also very strong. They're continuing to get orders, especially from Maharashtra in roads. Order book is just about 2.5 times their EV. So to that extent, I would say that, there is a potential for the stock to actually continue to perform. It's well capitalized in terms of, sufficiently, they have actually made some sale of some of their, projects where they have reduced their debt using that cash flow. So to an extent, the balance sheet is now better placed. So I would say you can buy, but buy only at dips. Short term is a little bit risky. Long term is okay.
Long term is okay. Short term, this is not something that China is saying that it is good. Long term, yes, you can watch out for it. Vaishali, good afternoon. What's your view for PNC Infratech? And this is specifically they're asking short term. So would you also suggest short term, or would you say avoid it?
Very good afternoon, Vinny and Shaina. So in my opinion, it is quite at a fair price, because technically when I'm looking at it, even on a shorter term time frame or a medium term, it's an attractive level, because we've seen the stock falling from 550 levels. And on technical levels, I would say 235 acts as a very good support. A number of times this support has been held on, and from there on, we are seeing a bounce. So according to me, the risk reward ratio is very favorable. Even for a shorter term perspective, 230 should be taken as a stop loss. And if we go right, we see a good bounce coming in, then we can see a bounce. Near term target also would come to around 280 to 300 levels to start with.
Okay, we'll keep an eye on those levels over there. Thanks so much for that, Vaishali. But let's move on to the next query. We have Sriram, who's writing to us from Chennai. He's holding 500 shares of Lloyd's Enterprise. Price is 7 rupees per share. Wants to know the long-term prospect of this one. Shaina, it's not something that we talk about regularly, but your word?
Yeah, so he seems to have bought it very, very, very long time ago. And he would have also probably subscribed to the recent rights issue, which was about at 38 or 40 rupees per share, very recent. And the company has raised good amount of funds through this rights. It's close to about 1,000 crores. And there's a lot of things happening in the company itself, which is why I would say that he can actually hold. And in fact, I would say even at dips, he can average. Basically, there's going to be a demerger of the real estate business into a separate entity. And also they have made investments in smaller stakes, not majority stakes, but smaller stakes in mining. They are actually expanding their real estate business. There's huge potential. The management has claimed in that real estate business going forward based on the acquisitions that they've recently made. So I would say, yes, hold. You can add it dips.
Okay. And Vaishali, what's your view for the long-term Lloyd's Enterprise?
Same and buoyant, because the long-term stock is in a good uptrend. We've seen a good consolidation right from 55 to 60, 70 line now. So I think this is a good level to start accumulating. Accumulate with a dip of 55 levels, and I think this stock very likely can go to retest the previous highs of 85 levels and perhaps even higher towards 100. So, well, I would call it a buy.
Okay, you would call it a buy and continue to hold long-term? positive view there. Next query for today is come from Mohammad Aslam, who's writing to us from Chennai. He's holding Pidilite Industries for the past year. He's asking whether to stay invested or sell at the current levels. So he's been invested for 1 year. What should he do now for Pidilite? Shaina?
So this is a difficult answer to give because yes, if you look at the medium term like FY26, the stock may continue to consolidate because the growth is not more than low double digits like 11-12%. Volumes also are a bit subdued in terms of growth. They are investing in new businesses like the paint business. Valuations also are expensive if you look at the shorter term. So if you look at shorter term on a EV by sales basis, it's about 6 times FY27, and even on the EV by EBITDA basis, slightly expensive. So shorter term, the stock may consolidate, but in my view, Pidilite is one stock which, if you're holding, keep part of it in your long-term portfolio and don't look at it, every quarter and all. Look at it couple of years down the line. And they're doing pretty well in some of their new businesses like the tile additive business, the ROF business. So I think some of their existing businesses, Fevicol also are doing pretty well. So continue to hold. But, if you're looking at shorter term, you may be slightly disappointed with the stock likely to consolidate.
Okay. In the short term, maybe you'll see some consolidation. Long term, it's fine. Vaishali, what's your view for Pidilite Industries? Given that when I'm looking at 1 year, it was around these levels only last 1 year back, 1,400 approximately there. And now also it's around 1,450. What should the viewer do? Sell or stay invested?
I agree with you, Vinny. It has lost its steam for quite some time. So, but now that if he's holding, keep a disciplined strategy, keep a stop loss of 1430. The strength and conviction only comes above 1500 levels to 1520. If we see this bounce coming towards those levels, then it makes sense to continue holding and look for a target of 1600 and so on. So, in my opinion, you can really switch for a shorter term perspective.
From a short-term perspective, you can look to switch. That's the word coming in for Pidilite. But next query for today, we have Rajendra, who's writing to us from Bangalore. He's holding 10,000 shares of IOC. Price is 169 rupees per share. Wants to know whether to hold or sell at current levels. 169, making a bit of a loss on this one. Shaina?
I would say book half the quantity loss and exit for half the quantity. Basically, it's like valuations are not expensive. It's just one-time price to book if you look at it 1 year forward. Last quarter numbers were very good. They were actually supported by very good GRMs that they did, especially on a comparative basis also. Now, if I look forward, actually, oil prices have come off and they are around that $58. And despite the global issues in terms of, we have certain issues with US, Venezuela, etc. But still, I think oil prices have remained low, which is a positive for IOC on one way. At the same time, I would believe that it is going to be a consolidation year for the company. So if I was an investor with this quantity, I would book half as the book half loss and hold the remaining.
Okay. Vaishali, your view for IOC?
I would agree with China because it is showing some profit booking right now. Probably re-enter at 140 levels. That would be a better way to do.
Okay, keeping an eye out on IOC over there. Similar views coming in on the fundamental and technical front. But on that note, we're actually going to slip into a very short break. We'll come back and we'll answer all the stock-related queries on the other side as well. Welcome back to Your Stocks on CNBC-TV18. We still have with us Shaina Mukaddam as well as Vaishali Parekh to answer all the stock-related queries that you all have sent us. Let's keep it going with those queries then, ladies. The next query is coming from Nagraj, who's writing to us from Bangalore. He's holding 20,000, not 2,000, 20,600 shares of Soam Distilleries. This is at a price of 104 rupees per share. So around right now also it's 108. So they're not making much of a profit. It's around their buy price. Now for the long term, should they continue to hold this? Or are there any other names maybe that one should watch out for? Shaina, your view?
I feel it is going to be on a path of recovery. After the huge correction we saw post June, when there were some issues regarding, some of the labor employed at the factory in Madhya Pradesh. I think things are looking better now. And in terms of valuation also, if you see, it's very attractive. If you compare it with peers, it's just about, if you look at the EV by sales, it's just about 1 time. So, and also they've got new products that they are planning to launch across categories in the near term. So I would say it's a hold.
It's a hold. Soam Distilleries for the long term. That's the view on the fundamentals. On the technicals, Vaishali, Soam Distilleries?
I think it's an attractive buy even for those who would want to consider, because good corrective move coming out of showing signs of reversal, making double bottom at 100 levels and now trying to get into a trend. So I think the near term, I mean, even as a positional trade, if one were to take, I would look at a target of 135 with a stop loss of 100. And the actual strength would be seen above 135.40. So if this question is for a long term, I think this can go towards 155, 162. So quite a good return that one could get from here.
Okay. Quite a good return that one could get from here on for the long term. Short term also, Vaishali has mentioned some of the stop losses as well as in terms of the target price. So keep an eye out on that. But next query for today then, that's from SK Datta, who's writing to us from Kolkata. He's holding 100 shares of Shalimar Paints. The price is 114 rupees per share. So they're making a significant loss on this one. Now wants to know, should they hold, sell? Is average an option? Shaina, what's your view?
I would say it could be averaged at current levels because he's acquired the original at much higher levels. There are a lot of changes happening. See, loss-making company, but the Jindal Group is actually reached into some agreement with SEBI for settling some of the issues that they had in the last couple of quarters. Now, that is one positive. Secondly, the Jindal Group is actually becoming very aggressive in the overall paint sector. As you know, they acquired the ExxonMobil paint, I would say, a huge stake in that company. So to that extent, the longer term looks attractive. This is a very small cap as of now. Shalimar Paints is just about some 450 crores, which is actually equivalent to their turnover, So it's a loss-making entity. So I wouldn't say it is risk-free, but at the same time, if you're a long-term holder, then there is potential good gains that you can make by averaging at current levels.
Okay, and what's your view on this one, Vaishali?
So currently, when I'm looking at the charts of all time period, it doesn't justify a buy. The trend is absolutely weak. So even a slight view to make it a positive buy, this stock needs to move above 63, 65 to call it a sign of reversal. But well, only justification would be that it's in deep oversold. So maybe if it bounces, then yes, but no trend for now.
Okay, that's a view there on the technical front for Shalimar Paints. Let's move on to the next query. We have K. Ramachandran, who's writing to us from Chennai. He's holding 40 shares of BASF, and this is at an average price of 4,450 rupees per share. Currently, the stock is at 3,895, so they're making a loss here. Shaina, he wants to know and he's asking if he can buy more shares and hold for another time period of 3 years.
Well, see, the balance sheet is very strong. And of course, the group is strong. They have actually, have had a bit of disappointment in terms of numbers. Like the chemical sector, they are into automotives, paints, etc., chemicals, agrochemicals. And they are facing some bit of slowdown, which is impacting their performance. At the same time, I think if you look at, since I said the balance sheet is strong, valuation is not expensive. If you compare their EV to their turnover sales, it's just about 1 time. Of course, it's 20 times their EV by EBITDA. So to that extent, I would say you can continue to hold. because automotive segment is picking up. So it is hopeful that, performance in the second half will be better. At the same time, I would not suggest averaging.
Okay, not suggesting average, but can hold is the word there from the fundamentals on from China. Vaishali, what's your view coming in for BASF?
Well, I would say that it's currently at a make or break level. 8,500 was the high. From there on, we have seen correcting so much, and it's at a support level even on a weekly chart. So I would say add more with a stop loss of 3,500, because once we see clarity of this stock bouncing back, you will get good returns and better your rate. So worth taking a chance, 3,500 stop loss. And if the view goes right, this can go towards 4,500, 5,000 to start with.
Okay. Keep an eye on those levels over there for BASF. Next query for today is coming on Vari Energies. This is from Soumya Pratim, who's writing to us from Kolkata, holding 30 shares of Vari Energy. Price is 2,735. Wants to know the time horizon. She's saying her time horizon is 2 years and is asking if you should buy more or sell at current levels. Vari Energies, what's your view on this, Shaina?
I would say continue to hold. Because the growth is very strong, and they have got a very good order book position which will support the growth. In terms of valuations, it is still expensive, if you look at it for the shorter term. So I would not be very comfortable adding at current levels. Maybe dips. They have got good facilities in the US. So I think to that extent, they're protected to some extent from tariffs, at least for the US market revenues. And with the rupee depreciating, it should be a positive for them to some extent. So I would say hold, but if you want to add, I would say better to add at dips.
Okay, better to add at dips, that's over there. And on the technicals, Vari Energies, what's your view?
I think it is a good uptrend, and it's again made a good base at 2,800 level. So to add, 2,800 would be the right price to get into the stock. And the stock is looking positive. So to those who want to hold, continue holding.
Okay, those who want to hold, continue holding. That's the word there from the technicals on Vari Energies. Next query for today, KS Rob is writing to us from Andhra Pradesh. He is asking if we can invest in Vedanta at current levels. Your view on this one, Shaina?
Vedanta is going to now split into 5 companies, 5 entities. 4 will be the demerged businesses of, the current verticals, aluminium, Hindustan Zinc, of course, is listed, which will be part of Vedanta, but the other businesses like oil and gas, and those will be demerged. Now, what I would suggest is instead of buying Vedanta, it is better to just buy Hindustan Zinc, because silver prices are actually driving not only Vedanta, but also Hindustan Zinc, and it is likely to remain strong. Now, the aluminium business also will be demerged into a separate vertical, which is another vertical which will do very well, in my view, if you look at the longer term. So let the demerger happen at a later stage. You can look to invest in the aluminium vertical. So I would say invest in Hindustan Zinc for the silver, and for the aluminium, invest at a later stage in the aluminium vertical.
Okay. And Vaishali, Vedanta at current levels, should one look to invest here?
No, I don't think so, because we've seen a one-way rally coming right from 440 to now 601. So too overbought. I would rather say book partial profit or wait for a dip. So as Shaina said, that logic applies. So I think follow that.
Okay. Thank you so much, ladies, for joining in this afternoon, giving us all those answers related to stock-related queries, as well as hope you'll have a great weekend as well. And viewers, thank you so much, as always, for sending us your queries. But remember, you can always email us your queries or send us the query on the phone number that is on the screens for you all as well. Last hour of trade is still left. You have Closing Bell up next to take you through that last hour.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A relatively positive picture on very thin trading, of course, in the Asian markets.
So maybe prepare ourselves for a bit of a range, low volatility, holiday thin trade.
Sources tell us that Coforge is in advanced talks to acquire a majority stake in Encora.
Nifty is open, there goes the opening bell, and it is a slightly reddish start.
So many headwinds in terms of valuations as well as fundamentals.
Because now there's an open offer which has come by from Motion JV Co, Stone Peak, CPP Investment Board.
Right, so the regulatory overhang as far as the IEX refuses to die down.
There's an anti-dumping duty which has been levied on R134A, which is a refrigerant.
Delay of nearly a year, Zepto is now set to confidentially file its draft IPO papers. Today, that's on December 26th.
So the market that we're keeping an eye on, a bit more of a decline that we've seen.
Well, it's a sparkling development that is taking place at Titan.
The headline remains that while the mid-cap index is doing well, we have far more declining stocks versus the advancing stocks.
That was the day so far. Hello and welcome to Closing Bell. It's the last full week of calendar year 2025. I am Rima. With me is Mangalam, and we're coming to you live from the CNBC-TV18 Motilal Oswal studio. And it's turning out to be a very quiet, expectedly low volatility consolidation kind of session. And again, volumes have thinned.
Volumes have thinned, but with thinning volumes, the problems have been that as we move into the holiday season, people have started to take their positions out. And as that happens, the impact has been a lot more. So the Nifty, which opened slightly flattish, mildly lower, has only seen gradual decline. So if you pull up the intraday chart of the Nifty, at any point in the day, if you entered into a short position, you'd be making money right now. We're at the low point of trade, very close to the 20-day moving average on the Nifty. Closing above that would be extremely crucial to track. For the first part of trade, major part of today's trade, the advanced declines were jostling between the number of gainers and the number of losers. They were largely in tandem, and now the lines are far and wide apart, with nearly 1,700 stocks which are declining versus 1,100 stocks which are advancing. Not too different from what we've seen over the last few trading sessions as well. But let's tell you what's lined up on the show today. Markets downbeat, investors hold back on fresh bets ahead of the upcoming earnings. Nifty well below that 26,100 mark. Broader markets lackluster. Resilient trade on metal counters. IT, pharma and autos under pressure. We'll take stock of January factor for railway stocks ahead of the budget buzz. Stocks like RVNL, IRFC, Railtel, Jupiter Wagons, Aidcon, all of them up anywhere between 8 to 12%. What's January going to be like? Details coming up in just a bit. And it's a news break confirmed. Japan's IKEA Kogyo will buy 40 to 53% stake in Stylem Industries. Details of that transaction coming up on Closing Bell as well. Sources tell us that Coforge is in talks to acquire Encora in a transaction pegged at nearly $2 billion. Lack of investor confidence and owner balance sheet flexibility is pulling the stock lower, down 4% ahead of the outcome of the board meeting.
All right, so how should you position yourself in the last hour of trade? Mitesh Thakkar now joins in. Mitesh, would you call it a disappointing session? Markets are gravitating lower and lower. And now just to put the levels on board, the 20-day moving average on the Nifty is 26,015. And below that is the 50-day moving average at 25,892. So we're holding on to these levels, but grinding down.
So, good afternoon. My understanding is that, basically it's a market which is still consolidating at high levels. We haven't got a sign of a breakdown, which could happen once the index starts getting below 25,800, 750 zones. And on the upside, the two pivots on the daily chart is about 26,200, 1020, and the intraday chart is about 26,300 odd. So I think till these levels are crossed, I think you might just expect the markets to be non-directional, in the sense that it will be a sideways consolidation. You will have to deploy range trading strategies, which is try to buy at lower levels, book profits around the upper end of the range, and even attempt a short in case you are prone to comfortable with trading on the short side at the upper end. So I think that's the way you will approach a ranging market. We have now a very clearly well-defined range, and we've said this for many days now. In case it breaks above, even then, you'll have some intraday pivot lines, which I explained a couple of days back, around 26,380, 400 zones. So I think for the time being, we believe that the market is still consolidating.
All right, you believe the market's still consolidating. But, some of the triggers that we're looking at for the market in terms of an up move, a large component would perhaps come in from either the banking space or the IT space, or the third one would be Reliance. As we speak right now, the Nifty Bank is unable to cross that 20-day moving average, below the 59,000 mark for that index, at the lower end of the range so far. The IT index too is putting some pressure, currently at the low point for that index as well. And if you look at Reliance too, that's been consolidating, grinding lower. So the intraday charts of both Reliance, IT index, as well as perhaps the Nifty Bank comes up, and that tells you that these big weights aren't moving yet, Mitesh.
See, that's right. I think Reliance, if you look at it, the Reliance stock had actually rallied from 1350 odd levels to about 1580. And Manglam, I made this point earlier also that there's an important weekly level. On the 12th of July 2024, we got a weekly closing of around 1586, 1587 on Reliance, and I think we are close to those levels. So we have not been able to decisively break above the earlier highs. Similarly, on the IT stocks also, most of them have rallied a good bit from the lower levels and are now showing signs of pullback. So I think for the time being, as the heavyweights also, don't give a signal of continuation on the upside, I think it's best assumed that we'll possibly consolidate a bit more.
Okay, so market's still very much in the range. IT is struggling today. The Nifty IT index is down 1%. And it's not just Coforge, which has slipped now to the day's low, 4.5% down on Coforge. But LTIMindtree is struggling. That's down 2%. LTTS has a cut of 1.5%. Zensar, Emphasis, all down 1.5%. And even frontline IT names are downbeat. Tech Mahindra, TCS, HCL Tech, all nursing losses in excess of close to about 1%. Mitesh, Coforge is, since the announcement that the company is holding a board meeting today where they will consider a fundraise, the stock has been grinding down. It's down 12-13% since then. Has it broken down?
It has. In fact, twice I considered, filing a sell call, but then got some other candidates. But the break below 1800 means that the stock in the short term has turned negative again. And while there can be a pullback, because last 3-4 days we have seen a good decline from, Monday's closing was around 1868, 1869, and today we are at about 1660. So about 200 points has been shaved off. You can get a pullback of about 70, 80 points. But broadly, it looks like the stock will head towards levels of 1580. And even, in case of some more bad news or some negative market event, I think it can even go to about 1510.
All right, that's the word on Coforge. But, Rachna spoke about Coforge. Additionally, there's a confirmed news break that has come in. Japanese surface solutions major Aika Kogyo has launched an open offer to pick up 40% or higher stake in Stylem Industries. Between 40 to 53% is what they can own. Rachna joins in with details on that one as well. A busy day, Rachna.
This is a CNBC-TV18 Newsbreak confirmed. Japan's Aika Kogyo will acquire a significant stake in Stylem Industries as a strategic partner. Now, this could be between 40 and 52%. This also marks yet another high-value Japanese FDI transaction in India, reinforcing the steady return of Japanese capital into Indian manufacturing. Importantly, this transaction has been in the works for some time. CNBC-TV18 had first reported it last year that Stylem was in advanced discussions with a Japanese strategic investor, with negotiations spanning valuation, control rights and long-term expansion plans. Pretty much what a deal is made of. Now, under the proposed transaction, Aika Kogyo will buy 40% to 53.12% of Stylem Industries. The deal size is pegged between 1,530 crore rupees and 2,038 crore rupees, with shares being acquired at 2,250 rupees per share. The acquisition will trigger a mandatory open offer at the same price of 2,250 rupees per share, providing public shareholders with an exit opportunity. Now, strategically, this partnership is expected to be mutually beneficial. For Stylem, the entry of a global chemical and a materials major brings access to advanced resin technologies, deeper product innovation, and access to international markets. For Aika Kogyo, India offers scale, cost-efficient manufacturing, and exposure to a fast-growing construction and interior designing market. In terms of control and governance, Aika Kogyo will have the right to nominate up to 8 directors on the board. The chairperson will be an independent director recommended by Aika Kogyo, while the existing promoter group will retain the right to nominate 2 directors. Aika Kogyo will also have the right, though not an obligation, to acquire additional shares in the company, indicating a potential path to deeper control over time. Overall, this deal adds a growing list of Japanese investments in Indian manufacturing and comes just a week after the Shriram Finance MUFG transaction, highlighting renewed Japan Inc. interest in India's long-term growth story.
All right, thanks a lot for that. 2250 is what the price is. Before that, the stock had seen a bigger rally and now down almost 129, 130 rupees. 2170 is where we are at Stylum. TR Choksi FinServe's Deven Choksi joins us now. Deven, good afternoon. Do you track Stylum? Do you have a view on this development on this counter?
Hi, Mangalam. Good afternoon. Well, we don't track Stylum directly, but I think overall building materials segment in which I think Stylum operates, a few companies therein I think we definitely look at. And I think we believe that I think this particular transaction, which is right now, I think one has seen the filing. I believe this particular transaction seems to be, I think, clearing a lot of the hurdles for the company as a whole. I think there have been, I think, the dispute among the promoters, and I think that gets cleared out. The Japanese major is basically buying, though it's a small company compared to sub 4,000 crore market cap. But Japanese major is buying out this particular majority stake in this company. They are into the premium laminates segment, and vis-a-vis the others in the industry, they have been relatively in a better category as far as the margin is concerned. So from a perspective of looking at this company, I think this is a good development. Whether the valuations are fully justified, I don't know. I feel that they are small companies putting at a relatively higher valuation. Not completely sure about, I think, if one wants to put more money behind it immediately at this point of time.
Got that. Stock is seeing a bit of profit booking. Deven, stay on. Railway stocks are on fire today. Most of them are doing well, whether it's IRFC, RVNL. Hormus has now joined in, and he's collated some interesting data to put into perspective the January seasonality factor for the railway companies. Hormus.
It's been a fabulous last 5 days for the railway companies, almost negating the fact that 2025 has been an extremely forgettable year for all of them. And you take a look at the moves that you have had in this month, predominantly, of course, the last 5 days. The RVNL is up nearly 17%, IRFC is up 12, RailTel up 15, IRCON up 15. And this is possibly turning out to be the best month that they have had all through the year in 2025, courtesy of this 5-day up move that all of these railway stocks have seen. Now, what I mean by January seasonality is that every year before the budget in the month of January, most of these railway stocks gain more often than not. You take a look at IRFC and RVNL. Now, RVNL listed in 2019. If you take a look at the last 5 years, the stock was up 70% in 2024. It was up, and most of the other years, barring 2022, it has delivered double-digit returns in the month of January. Now, if you take a look at a stock like IRFC as well, that listed in 2021. Now, if you take a look at the others, now it has been in the positive, not significantly higher, but positive nonetheless, barring that outsized year of 2024 when the stock was up 75% just in the month of January. Then the other stocks as well, IRCON, again, 4 out of the last 5 Januaries, it has had positive returns, and as has Jupiter Wagons, they double-digit returns in 4 out of the last 5 Januaries, barring that minor blip earlier this year in January. Now, if the recent developments are anything to go by, that could be one of the reasons why these stocks have moved higher, with the cabinet approving the expansion plan of the Delhi Metro, 12,000 crores of capex, 13 new stations, so railway lines, signalling lines. So all of these companies could be potential beneficiaries. The 3 of them are going to be underground stations as well. So as a result of which these railway stocks are moving higher, and of course the fare revision, which could also be a potential beneficiary for IRCTC. Now, railway stocks in general don't have a significant shareholding from the mutual funds of the country. They have a very large retail shareholder base, and most of the other stake lies with the government. The government owns anywhere between 65% to 85% in these companies. Now, if you take a look at the retail shareholder base, IRFC has over 50 lakh retail shareholders. RVNL has 22 lakh. IRCON has 11.5 3.5 lakh. RailTel has 5 lakhs. Now, this is the kind of retail investor base that's concentrated in these railway companies. But despite this up move, the stocks have been beaten down to an extent. Ever since they peaked in July and August of last year, these stocks are still down anywhere between 40 to 50% from their peak. The RVNR had reached levels of 650 before correcting. Same is the case with RailTel, and a lot of these names like IRCON, IRFC as well, still down anywhere between 30 to 40% from their record high levels.
All right. Almost interesting data point and trend that you've pointed out. Whether that holds true, or is this still an investable idea? Let's go back to Devin. Rail stocks, they've been doing well today and all of last month, as Hormaz pointed out, but they've taken a significant beating from the top. Do you think things are on the mend for the railway sector and it becomes investable once again?
Generally, Mangalam, the momentum is very, very strong ahead of budget. I think as it being pointed out. In my viewpoint, I think the fundamentals of this company, they remain unquestionably good, not an issue at all. However, the valuation at which I think these companies are trading, probably I think it is not leaving much of a scope for, even if the price correction has taken place, given the kind of underlying growth that they have in this business, I think it is not leaving much of a scope for somebody to make, I think, a very high amount of money once the budget announcement is completed. So till the budget announcement, I think the momentum will definitely favor the railway companies as we have been seeing all along. See, one of the challenge that I see in this particular business, government does allocate money. However, when it comes to, I think, completing the implementation part, generally seen that I think from year to year, I think there has been a gap between the allocated money versus I think the amount of money spent on buying out the products from some of these companies where they're beneficiaries. I believe that I think that is where the lag is. Unless I think that lag gets covered, I think probably the premium valuations don't get justified. So we only play momentum, if at all, I think, till the budget as far as the stocks are concerned.
Okay, stay on, Devin. Want to definitely get your views in on Coforge, because that is details on what she's picked up from her sources, where Coforge is in talks to acquire another IT company called Encora, and this could be a very large transaction. Rachna, give us all the details.
Well, sources have told us that Coforge is in advanced talks to acquire a stake in Encora in a transaction that's pegged, the value is pegged at about $2 billion. Now, the deal would mark a potential exit for private equity major Advent International, which currently holds a majority stake in Encora. Now, to put this in context, Advent entered Encora in 2021, acquiring the company from Warburg Pincus at a valuation of about $1.5 billion. Warburg had backed Encora during its earlier phase of expansion, helping build scale and offshore delivery and deepen its US enterprise client base before selling out to Advent. Now, as the company then transitioned into a more mature digital engineering platform. But Encora operates squarely in the digital engineering and product development space. Its core strengths lie in cloud-native application development, data engineering, platform modernization, and enterprise software services, with a strong concentration of clients in North America. Over the last few years, under Advent's ownership, Encora expanded both organically and through acquisitions, positioning itself as a high-growth engineering-led alternative to traditional IT outsourcing firms. But for Coforge, this could be an ambitious one, although transformational too, because the company has historically been a mid-sized IT services player with strength in BFSI and travel tech as we know it, but limited exposure to deep product engineering. And Encora would significantly shift that mix. As of March 2025, Coforge reported a net cash flow of around 474 crore rupees and cash and reserves of roughly about 600 crore rupees. Now, that balance sheet may provide flexibility, but it is definitely not enough to fund a $2 billion deal outright. As a result, Coforge's board is expected to consider a fundraise, potentially combining debt and equity to support this acquisition.
Thank you very much for that. I think the street's big fear is this acquisition too big for the company to digest? Coforge's market cap is $6.5 billion. The company they're looking to acquire is at a valuation of $2 billion. And generally, when you have such large transactions, there are integration-related risks. Plus, there is always a possibility that your existing talent leaves as you bring on board people from the other companies. So the street will watch this carefully. Even when the Cigniti acquisition was announced, initially the stock underperformed. The Coforge did a very good job in integrating Cigniti and getting getting cross-selling and getting the synergies out, particularly on cross-selling, but the return ratios did drop. I was seeing the ROCE in FY29 for Coforge was 29%. It dropped to 20% because of the funding-related issues of Cigniti. Now, again, you're going to go ahead and do a large size acquisition. So the street is concerned, which is why if you pull up a fortnight chart, you would see the stock has been struggling. But Devin, come in with your thoughts. I know this is source-based, but if Coforge announces a large acquisition, how would you read it?
Well, I think from the travel and the insurance space in which they specialize, I think they are moving into the product engineering, and I think particularly in the products in the healthcare space, I think where they are trying to move into through this acquisition. Of course, I think I do not know whether it will make a big difference. Getting the foothold in the North American market through this acquisition could be one of the possibility that one can see. And what kind of synergy it will build for Coforge, definitely I think not very sure about that aspect. So would wait for more details to come out before make any confident opinion on the subject.
They do have a lot of, if it's Encora, and again, that's a big if, they do have access to a lot of tech companies like, Microsoft, etc. Yeah. So it gives you access to those high-tech kind of clients.
All right, that's about a lot of tech, which I don't understand, but I understand jewelry, and that is something that we're going to talk about. Titan among the top Nifty gainers today, and it's an inflection point in the history of the company and also the industry at large, because over the last 2 or 3 years, everyone's been talking about the advent of lab-grown diamonds and whether the established players, etc., will look at entering the space at some point or not. Titan and the likes of Kalyan, etc., in the past, every time we've quizzed them about that, they've been fairly mum, or they've been tight-lipped about this. They said that they're monitoring this space, observing it very carefully. They won't reveal their plans, etc. And now it turns out that Titan's gone ahead and announced the foray into lab-grown diamond by this brand Beyond. What they'll basically do is launch their first store in Mumbai, and it is as recent as near as the 29th of December, where Beyond from the house of Titan will be launched, which will put out accessories, adornment accessories in the lab-grown space. The reason why it's Beyond, it's because it's accessorizing beyond eyewear, beyond watches, beyond ladies' bags, beyond saris. And they've been careful enough to not mention jewelry, value jewelry, because it's value fashion and not jewelry which is bought as investment, which is perhaps gold, etc. So that they want to keep sacrosanct with Tanishq, Zoya and Maya. They plan to add a couple of more stores in Mumbai and Delhi in the very near future as well. What it does to their overall growth prospects is something that we will visit 2, 3, 4 years from now. But what it definitely means is that large players are looking at lab-grown diamonds. That's now become a way of life and reality for the industry. And there will be segmentation now. Value fashion will come in from, lab-grown, Beyond, Carrot Lane, etc. In the case of Kalyan Jewelers, it will be Candier. So what we spoke about the other day, Zudioization of the overall industry. In Titan's case, it will be Beyondization, or in Indian Hotels' case, it will be Gingerization. So that value fashion market is something which is ballooning right now, and that's a big total addressable market, my sense is.
You remember Trent had also entered into lab-growns. I think there was something called POM, if I'm getting the pronunciation. What happens to that? Because both are ultimately Tata Group companies.
Well, I mean, there have been a lot of synergies in the Tata Group companies and a lot of different categories in the Tata Group companies as well. Titan had entered the apparel space where the Trent business has been there, etc. as well. And there have been a lot of LGDs in Carrot Lane itself. So the near term is more to do with Carrot Lane than, going to POM, etc. And that has been just one of the offerings that Trent does in their entire space. I don't think they've scaled it beyond the initial few stores out there. So we don't know the details on POM yet, but what we know is that if Titan's gone ahead and decided to enter this space with one store, companies like these, usually they're not going to stop. They're not going to stop. It won't be just a pilot project, because it's been 2.5 years. They've studied this market very carefully, and they've had investments in a couple of these lab-grown players in the US as well. So they've managed, to get that perspective from that level, from the international space. In the US also, anything sub 1 carat, all the smaller stones have, we've seen a lot of advent, at least in the adornment space as against the value fashion space, the value jewelry space.
Got that. So, and it's been very disruptive, lab-grown diamonds. And Titan has finally entered into it. And, you know, as Mangalam said, probably they're not going to stop with only one store. So every time we now quiz Titan, we'll ask them about how this lab-grown business for them scales up in terms of number of stores, in terms of revenues, the kind of margins they will make, and how will it compare with the gold jewelry margins. Devin, you want to comment on Titan?
Well, I think this was the missing piece probably, in their entire portfolio, as I always wanted them to have one. The lab-grown diamond business per se, I think, is basically, along with the jewelry, is gaining traction and gaining traction far more faster than the natural diamond jewelry business. And that's where probably I think you had to position yourself, which Titan has done this. I believe that it's a long play, of course, but at the same time, I think it is catering to a larger part of the lifestyle. The high-rising lifestyle, as we call it as, that's where probably this particular format would be. We'll not have the commercial subjects to talk about at this point of time, but do believe that the growth rate, both in the domestic market, including in the UAE market, where Titan has presence, is basically, growing much smarter. So it could be, a gateway to some of the other markets of the world for Titan. So let's wait and see, but it looks promising at this point of time.
All right, looks promising at this point in time. Just monitor the Nifty. It's flirting with that 20-day moving average as well. Went below that a couple of times during the day right now, but still holding around that 26,015, 26,019 mark. Take a short break, come back. On the other side, Amit Gupta of Motilal Oswal Private Wealth joins us for a quick conversation.
Welcome back. Still down about 0.5% on the benchmark indices. We've got about 30 minutes to go to call it a day and a week for our markets. The Nifty is holding on to 26,000 for now. The advanced decline ratio, though, the gap between the two continues to widen. We've got about one stock advancing for nearly two stocks declining. Amit Gupta, head of equities at PMS Motilal Oswal Private Wealth, is now joining in on the show. Amit, afternoon, and thank you very much for joining in. Season's greetings to you. So share your thoughts on the markets. You know, while the Nifty is pretty much at record levels, the broader markets have been struggling. More than half of the, NSE 500 stocks are well below their peak levels. So it's been a tough year for portfolios. As you look ahead into 2026, what would be the top 3 bets, the big calls that you're making?
Yeah. So I think you rightly said for the last 1 year, markets, the broader market has been struggling. There have been few themes which have come out actually of late, but indices have performed relatively better because we recovered from the lows of 24,000 back to 26,000. But the broader market is still seeing that particular correction. So, and it has happened, I think, primarily because if you look at the Japanese bond yields, so they are almost at 1.9%, the 10-year Japanese bond yield, the inflation is 3%. So their real interest rate is negative. And that's where I think eventually when the interest rates are going to be higher there, I think the money, the reversal of this carry trade, which has been there for the last many years before, I think that continues to be there. So previously we had 20% of FI holding in our equities, which has dropped down to 16.5 to 17% now. So this is the painful thing which market has to face. But I think as we are moving towards budget, and because the government is likely to meet 4.4% fiscal deficit target also, our sense is that now the market is realizing that what happened in 2023, that the government capex themes started performing when the private capex was little jittery because of the global scenario. I think the same trend is coming back.
All right, so government capex performing when the private capex is a little jittery. So the question is that when does private capex return, and as a result of which, when do corporate earnings return?
So if you look at the SBI results, when the results came out, the commentary was that 11% of credit growth can go to 13%. They said that the green shoots of some private capex looks like. Our sense is all the new age technologies, whether you talk about the renewable energy, you talk about the capital market also, you talk about the electronics manufacturing as a theme. So there are some new themes in the market which are seeing the capex. So it is not that the private capex is completely absent. All these areas are seeing the capex happening. And I think this is where the growth is also there. So yes, they will come with their own volatility. For example, digital companies also, you are seeing capex happening in the digital companies also, but you will have to face the volatility also because sometimes the valuations go higher and market is not going anywhere. In that case, you will see some pressure also. So yes, these themes are high growth themes. Even auto ancillary theme also, I think, is a high growth theme. And eventually, you will see that the private capex is happening there also. So we have seen some auto ancillary themes going actually and expanding. Previously, they were more into ICE, they expanded to EV. And I think they are further expanding now because new batteries are coming up now with higher range capacity. So it's a good progress in that area. And I think recently we have seen some mining companies finally in India, they are going to have a very good capex. So it may not be majorly from private, but yes, PSUs are coming forward for the capex in the mining segment also.
So just to recap, EMS companies, auto ancillary, mining companies. Am I missing anything else that you said?
Digital, renewable. I think both of them you need to include.
Digital and renewable. So these are the themes that you like because we're seeing a pickup in capex, signaling strong demand.
Absolutely. So I think it's happening across. You can see, yes, the stocks have declined recently. For example, the electronics manufacturing theme, right? They have declined. But we are seeing that they are acquiring, they are going for inorganic acquisitions also. So you take the case of Sirma SGS. This is hardly 14,000 crore market cap company. And they have done an acquisition recently. And they are moving more into industrial electronics where margins are better. So once they are out of this particular recent sell-off because of some company-specific news, our sense is that they will get good buying interest because ultimately 7.5% of margins can go into double digit as you are reducing 20% of consumer electronics and moving into industrial electronics. If you see the PAT in the last June and September quarter, last year it was 60 crores. And these 2 quarters, we have already seen 116 crores. Keynes Technology, which used to be 42,000 crore market cap, it used to give 290 crores of PAT. So in that case, our sense is if Sirma crosses 200 crore of PAT in this financial year, then market cap expansion is bound to happen.
So Sirma and Keynes are a part of your portfolio, Amit?
So Sirma definitely we are looking at and these declines. Keynes Technology promoters, they have given clarity from their front. Market is waiting for some more clarity to come in the numbers.
All right, market is waiting for some clarity to come on Keynes in the numbers front. Any of the metals or commodity-facing stocks that you like? Because there have been big movers there as well. Yes, cyclical, they usually move around the prices of the commodities, but have you seen any exposure or formidable investable idea here?
Yes, very interesting. See, our sense is sometimes the cyclical, stocks also needs to be considered. Yes. And this is the same time. So commodities, because the inflations outside also are going to be higher, people are moving into real assets. And we have observed that the metal and mining companies, they have done well, particularly the mining companies. In fact, the debt proposition is not there with them. And they are looking very aggressive. Government is looking quite aggressive for the critical minerals. When the world is getting, concentrated more towards their own, finally, the requirement of critical minerals has come out. And this is where you will see more expansion going forward. If you see the copper commodity, I think after aluminum and silver, we are seeing that copper as a theme is picking up now. There is a possibility of some deficiency happening. We saw the United Nations report also, where they are saying coming 10 years, more than 80 copper mines are required, and each copper mine takes 15-18 years to get operational. If you see all the newest technologies, whether it is EV, solar panels, wind turbines, or missiles, or now data centers. So big time copper requirement is there. Almost 65,000 ton of copper is required. When I look at the finally refined copper from Hindustan Copper, it is hardly 30,000 ton. So that means there is a demand-supply gap. And that is where our sense is they will see the move actually going forward. Along with this, I think if you look at beyond commodities, refining companies also, I think it's a good period for them, because the refining margins have expanded when the sanctions were imposed on Rosneft in Russia. It is one of the biggest energy company there. And we saw the diesel margins move to almost $25 to $30, and gasoline cracks also moved to $25-30 per barrel. And the crude oil prices have remained subdued, so marketing margins are stable. So I think it's a good scenario for them. And along with this, when we had a word with the management of HPCL, they were very gung-ho that they will try to reduce the debt as much as possible now. So from 65,000 crore of debt, they have already reduced to some extent, and they are looking forward along with the 30% of dividend payout that they give. Beyond that, whatever cash is generated, they will use it in the deleveraging of the balance sheet. So I think these are some good re-rating opportunities. Yes, some volatility will be part of the game as rupee is slowly depreciating, but eventually I think the winners will come from these spaces.
Amit, thank you very much for joining in. Wish you a very happy weekend. For now, we need to move on. Now, Hormus is waiting by, and he's going to put the spotlight on the big movers in the market right now.
Oh, what a day it's been for the railway stocks. Can't not talk about it, right? And moving on very, very significantly high volumes as well. You look at any railway stock, RVNL, IRFC, RailTel, RITES, all of them seeing gains of anywhere between 5% to 12% for RVNL, still holding on to those gains at higher levels. IRFC too nearing double-digit gains in today's session. And take a look at the volumes as well. Now, if you look at RVNL, close to 10 crore shares have been traded. For IRFC, almost 13 crore shares have been traded. For RailTel, 2 crore, RITES almost 60 lakh. And all of them significantly higher compared to their 20-day average, anywhere between 10x to 20x higher compared to their 20-day average. It will be interesting to see what kind of delivery volumes they throw up when we resume trading on Monday. So these are railway stocks that are doing well, of course. Hindustan Copper is one such name that's doing well. The 6th straight day of gains now for the stock. It's the last 6 sessions has resulted in the stock moving higher by 30%. And this week itself, the stock is up 22% in this truncated week. It is set for its best week since February of 2021. Volumes are the highest since December of 23. In today's session, we have had almost 9 crore shares that have been traded. The 20-day average is close to 2 crore shares. It is trading at the highest level since August of 2010 is Hindustan Copper. So it's at a 15-year high. There's the stock. And so far in 2025 itself, the stock is up over 90%, courtesy the surge it has seen in the month of December. And one name that has moved in the list of gainers among the smaller private financials is Karur Vysya Bank. They're slightly off the highs of the day. At one point was up 7.5%, but still holding on to gains of 5.5%. The biggest single day gain in 6 months for the stock. Volumes are the highest in the last 2 months. Over 1.5 crore shares that have been traded already. The 20-day average is just under 11 lakh shares. The stock has been above its key moving averages since October, and so far this year it's up almost 48%, straight set to be the 4th straight year of positive returns. And in this 4-year period, the stock has moved from as low as 40 rupees at the end of 2021 to as high as 265 rupees.
Right, Hormaz, thanks a lot for that. What we'll do is take a short break, come back on the other side, get you a check on what the dealing rooms are saying in our T-Street segment. Welcome back. There's been a bit of a pullback from the lows. The Nifty has managed to comfortably, defend the 20-day moving average as of now. So there's been a smidge higher from the lows, and that's been led by the Nifty Bank, which too has recovered a tad from the lows. But indices still have, been grinding lower ahead of the holiday and on thin volume. So good time to get in what the D Street chatter is from Nimesh. Nimesh, what's the insight today?
Today I can sense a bit of absence in the dealing rooms as well. Truncated week, next week is going to be even more challenging from a presence points of view. But clearly today the volume is on the lower side. But the good part is this week, there was a lot of traction in the broader market names, and so is the case today as well. So while the Nifty is on 100 points, that's not the case as far as the broader markets are concerned. A lot of outperformance could be seen in the broader market names, and that's the trend which is likely to continue till the year end. Might be a bit of NAV propping as well, but that's the case today. Technically, there is a resistance at 26,250 in the upside, and that's playing out for the last minute days on the Nifty. From a sector point of view, surprise, but the railway stocks continue to outperform and do really well. No specific triggers or no specific institutional buying as well, but there seems to be a bit of momentum in the railway names in the last couple of days. Other few sectors which stands out today is metals, which is again backed by some of the fundamentals because the underlying assets have been strong. And the PSU basket in general has done well, which includes the railway names as well. So that apart, it's a thin volume day and participation is lower compared to last minute days.
Okay, did you manage to get any stocks which are buzzing where there is some interest?
Yes, Rima. So you'll hear a couple of stocks. I mean, I'm going to highlight a few names which might get turned out in the days to come. So the first name is Timex. That's been buzzing in the last couple of days. In fact, remember in June, the promoter the parent did an OFS of 15%, and after that, you've seen a bit of an outperformance in that name. My sense is there could be another large block in Timex very soon. The parent entity now owns 51%, and there is a very high likelihood that they will bring it to 51%. So there could be a 7-8% block in Timex in the days to come. So that's the first name. The second name is GMDC. That's been buzzing and has actually recovered from the recent lows. After the kind of correction we saw in that name. Off late, you've seen a bit of volume also picking up, and my sense is that one large domestic mutual fund has been an active buyer in GMDC in the last couple of days. The third name is Nazara. It was part of my charter list a couple of days back as well. I do anticipate that there could be a few acquisitions on the card, but there could be a large block as well in Nazara very soon, and there could be a clean out trade from a leading domestic mutual fund. So that mutual fund could finally exit in Nazara very soon. And the last is Rain Industries. No specific news or a trigger, but off late you've seen a bit of outperformance in Rain Industries as well. At these levels, again, my sense is there is some bit of HNI interest back in that particular name, and hence a bit of outperformance in the last few days in Rain Industries on the back of HNI buying.
Interesting list as always. Thank you for scouting for these. Moving on now to the F&O trends. Mangalam is now joining in with the latest.
Well, if you look at the market, it's grinding lower. It's closer to the lower end of today's trading range so far. But the good part is that despite the Nifty Bank and the mid-cap index being in the red, we've managed to defend the 20-day moving average on the frontline index. So the Nifty 20-day moving average is 26,015. The Nifty is above 26,040 right now. So good 20-25 point bump up is what we've seen from those crucial technical support levels. But in the broader end of things, the advanced decline is still much in favor of declines. And it's been led lower by a couple of these IT-related names. So Coforge being one, ahead of fears of that large acquisition, the impact that could have on its balance sheet. HFCL is the other one. IEX concerns, reports of regulatory concerns coming in has that stock lower by almost 3%. And, the option writers are expecting some sort of resistance to stay above that 26,150 mark, even though there has been support at lower levels. So 26,100 call writers, fairly active, have completely eaten that premium 80 rupees of the 120 that there was yesterday, currently trading at around 50 rupees. So 26,150 to 26,200 still is an important resistance as we move into the expiry week next one. And at lower levels though, 25,950 to 26,000 is important support zone, because that's where the action is in the puts. 26,000 puts have been fairly active. The brief decline that happened in the market, moments ago was largely on account of panic selling by the 26,050 and 26,100 put writers as well. So let's see where that support comes in now that the markets navigated that panic and held on to the 20-day moving average.
Thank you very much for that. Mitesh is back with us for a few last 15-minute calls. Mitesh?
Yeah. So I think very clearly the market, as we discussed, isn't giving you a directional bias. So we'll take one BTSC and one STBT. On the BTSC side is Nestle. Keep a stop at about 1260 odd levels, and maybe 1290, 1295 could be the area which the stock can hit in the maybe tomorrow or day after, this Monday, Tuesday. And Oil India is on the negative side. Keep a stop at about 406. Look for targets of 396 to about 385.
Nestle sell Oil India. That's two trades by Mitesh. But moving on now to Castrol. Stock was higher by 4-5% in Wednesday's trade following Stonepeak acquiring at the parent level shares of Castrol from BP. Now they've launched an open offer for the Indian shareholders. So Sonal joins in with the details. Sonal.
Well, yes, the open offer for Castrol has been announced, and this time Motion JV Co, Stonepeak and CPP Investment Board, they'll be acquiring 26% stake via an open offer in Castrol India, the listed entity. And this comes in after British Petroleum or BP announced to sell 65% stake in the global entity to Stonepeak on Wednesday. The open offer price is at 194 rupees a share, which is at a 2.5% premium versus the Wednesday's closing price. Open offer will be key to track because there are big investors in the company, the Indian listed entity. We do have LIC, which holds around 10% stake in Castrol. There are FIIs as well. There's Government of Singapore, which holds around 1.5% stake. So all of them, what is the outcome of this open offer will be key to track. The other important point to track will be whether Castrol India will be delisted after this open offer. Because remember, Stonepeak has delisted all the acquisitions that the company has made in the past. 2020
2025, it was Air Transport Services. 2024, it was Acumen. 2022, it was TK LNG Ventures. Now, remember, this comes in after BP agreed to sell 65% stake in Castrol Limited, the global entity, and they say they have a lock-in of 2 years, after which they can actually sell the remaining 35% stake as well. Kotak has an ad rating on the stock. They expect the stock to be range-bound till the time the open offer the process is over. It will trigger only when the global transaction gets over, right? And it will take place at the promoter level, so they do not see any impact on the operational performance. So Castrol Limited, the India entity, will continue to be in focus till the time the open offer process gets over.
All right, no impact on the operational performance of the company, but this is an important technical development to monitor for the company. Amrish Balika joins us as well. Amrish, do you track Castrol, and what do you make of this special situation? The interesting part here is that X of the open offer, etc., the company which has acquired has a history of delisting the companies that it acquires. Do you think that's a possibility with Castrol?
That's a possibility. But then because of this open offer, at least one can be sure that at least the bottom is in place for Castrol. I mean, the stock has been underperforming for a while. So at least as of now, the stock really will not fall below these levels because it is very close to the open offer. I don't know how many shareholders will actually give in the open offer, because there's hardly any premium compared to the market price. But then in case there is delisting, which again is on, this will not be immediate. I think it will take a while, maybe in the next 12 months, maybe the next 15 months. But that in case there is delisting, I'm quite sure that would happen much beyond those 250 levels, which was the high which we have seen in the recent past. So it has to be beyond that, because wherever we have seen such delistings happening, they've happened at a decent premium to the average market price of the last few years.
So if someone has shares of Castrol India, don't tender in the open offer. Wait to see if this company gets delisted, because you could get a higher price. That's the advice?
Yeah, absolutely.
Okay. Nuvoco Vistas, that's a company that you like, a stock that you like. Tell us why.
The Nirma Group company, India's fifth largest cement company. Installed capacity is approximately 25 million tons. They have 55 ready-mix concrete plants, and 75% of the capacity is in East India, where the cement price rise has been better than the rest of India. If you look at the Q2 performance, revenue-wise, it was only 8% growth, but EBITDA per ton improved 64% Y-on-Y. And demand has been robust due to infra and real estate demand. So margins have been improving, which is clearly shown the EBITDA margins which are there. Q3 earnings, I think, would be a positive surprise. In FY27, we should see 10 million tons being added to the capacity. So till FY28, I see a revenue CAGR of about 30%. So based on that, my target price is about 480, based on a FY28 EPS of 24 rupees.
All right. So that's the word on Nuvoco Vistas. Hang in there, Amrish, because the stock that's also holding in the green, fairly in the green right now, is Lenskart. And the reason for that, today there has been a note, an initiating coverage coming in from the house of Avendis, and they are positive on the stock right now. Actually, the stock's just given up as we speak, down about 3 rupees, but still holding fairly above and resilient above its issue price of over 400 rupees. The listing price of over 400 rupees. So on Lenskart, what Avendis says is basically it's an important metric, the business moat that the company has, which is M2C, manufacturing to consumer. So that entire value chain has has an interesting strength where it actually solves for key business challenges. And that's not all. They have a playbook for India, which they now want to take it beyond India as well, and some of the other regional geographies. And the company has been making investments as recent as something that they bought in Korea. So this network expansion and taking this India playbook globally, along with a 550 basis points margin expansion, over 20% revenue CAGR over the next 2 to 3 years. What does that mean for Lenskart in terms of value offered or value left at the current price? Do you like this story? Do you think it's value accretive from here on as well?
No, it can be value accretive, but already the value which people are paying for it as of now I think is just too high. So there'll be a huge amount of catch-up which needs to happen. So at these valuations, I'm not bullish. Although there could be these research reports coming based on which we could see some sort of a bump up. But I really don't see a sustained rally from here. So, I mean, I would, in fact, stay out. And I would say that in case someone has got an allotment, I think you're getting a decent return, take some profits home.
All right, take some profits home. We'll take a short break on that note. More market talk on the other side.
Welcome back. About 5-6 minutes to go before we wrap up trade. VIP is now grinding to the day's low, 5.5% down on that. Ambrish, do you expect a turnaround with multiples PE in place as the promoter of the company, or would you go with Safari if someone has to play the luggage theme?
See, I mean, I would go in for those companies where the management is strong, management knows the business, and from that point of view, it would be Safari. Because whenever we have seen a PE supporting a strong promoter, then I think things work out very well. But where a PE takes over the management and wants to run the company, in such cases, I would be skeptical. So from that point of view, I would stay out of VIP or prefer Safari.
Example in which where the PE took complete control as a promoter, but the business struggled. What comes to your mind?
No, in fact, investors are supposed to be investors. They could be guiding, but it's a completely different ballgame, investing and running a business. I think you ask any businessman or any investor who's trying to become a businessman, I think you'll get the answer.
All right. There's an interesting one out there. But, do you think Safari itself counts as an investable idea? Because the revenue growth has been over 21-22% over the last 5 years on a compounded basis. The EPS growth has been 35%. The stock price growth itself has been close to around 54-55%. So a lot of the multiple re-rating after an earnings growth has taken place. incremental share do you think accrues to Safari or some of the large D2C players?
No, see, I mean, the like this overall market is expanding hugely, and Safari, like you rightly said, because of all that, we have seen a consolidation in the last 2 years. If you see the price, I mean, you've not seen a huge price rise in the last 2 years for Safari. It's been in a range. So after this consolidation, I mean, I would assume that it will take part in the next growth story for the sector.
Stop for close. Do you have a view on Titan? Because important, decision that the company has taken to actually enter the lab-grown space. Yes, it's under a different brand, but it rallies back to the trust that Titan has by calling it Beyond from the house of Tatas or from the house of Titan. So making lab-grown diamonds a little more trustworthy, somewhere in the middle of regular lab-grown and natural diamonds.
I mean, if you look at the demand which is there from the millennials, for the lab-grown diamonds vis-a-vis the natural diamonds, it's the lab-grown diamonds where we see the demand really shooting up. And with Titan getting into that, I think will be decently be positive for this sector. And at the same time, looking at the sort of valuations which Lenskart is getting, I think that will also get rubbed off against Titan as far as their eyewear is concerned. So from both these points of view, I think Titan would be a better bet.
Ambarish, if Coforge does announce that acquisition of Encora for $2 billion, would you read it positively or negatively?
So in fact, Coforge, I don't track it very closely, so it's a bit difficult for me to really comment on this.
Is there any mid-cap or small-cap or large-cap IT stock that you like at this level?
As of now, I would say may not be like directly IT, but something like a Root Mobile is something which I've been recommending. Basically, the stock has also corrected well, consolidated at lower levels. But now, if you look at the cash generation, I think that's the core strength of the company. Operating cash flow conversion is about 82% of EBITDA. And if you look at the new generation products, that's been contributing more to the revenue, and the margin improvement is actually coming from the new generation products. So I think after this correction and consolidation, I think it's just right for the next move up. Expecting a 15 rupees EPS for FY27, and for something like Root Mobile, I've got a target of 885.
Remember in the past you used to like a couple of these rail names. They're buzzing again today after some correction in the first 11 months of this year. December's been decent for them. Is there anything that you like now?
In fact, I think most of these stocks are moving up because with the budget coming within about a month or so, I think the focus again would be on railway spend. And from that point of view, I would go in for some of these railway stocks like Titagarh would be one of my picks, where I still see an upside of another 20-25%.
All right, Ambarish. Thank you so much for joining in. See you next week, hopefully next year as well. Wish you a very, very happy new year and season's greetings to you and your family. With that, let's start wrapping this holiday shortened week for our viewers. The Nifty down about 100 points, defended the 26,000 mark, defended the 20-day moving average, but the bulls did pull back ahead of the holiday shortened week and ahead of the weekend, ahead of Nifty expiry. We did see the advanced decline move firmly in favor of declines towards the end of trade. Metal stock did well, but the market was buoyed lower by a couple of these IT names, large cap and mid cap IT names, which ended lower by and large. Railway stocks continued to do well, so we had double-digit gains for a lot of the railway stocks, including the likes of RVNL, IRFC and Titagarh Rail Systems. Record run for Hindustan Copper and Hind Zinc continued.
All right, let's just quickly wrap up the week and how it's been. It was a truncated week and the Nifty has ended with a minor gain of close to about 0.3%. The mid-cap index is absolutely flat. Sectorally, there was weakness seen in the IT pack. The Nifty IT index ended the week lower. PSU Bank struggled. Pharma too, down nearly about 0.5%. On the way up, defense stocks were excited. The Nifty Defense Index up 3.5% for the week. Metals continue to see buying. The Nifty Metal Index up nearly about 2.5%. Some individual mid-caps which catch your attention today. VIP on the way down. Coforge also struggling. IEX lower by 2.5%. And on the way up, Castrol, Vikran Engineering and KNR Construction saw healthy buying. Well, that brings us to a close in this edition of Closing Bell. Thank you very much for watching. Don't go anywhere. On the other side is Editor's Roundtable. The Nifty and the Sensex managed to break its 3-week losing streak to end mildly in the green. The broader markets continue to underperform. The Nifty Bank ends lower for the third consecutive week. Defense, metal stocks bat for the bulls, while IT, realty drag. Over the next 30 minutes, we'll decode the week and the year on Dalal Street, and we prepare you for the new trading year. Well, this is the last Editors Roundtable for 2025. I am Reema Tendulkar. With me are Nimesh Shah and Mangalam. And joining us on Zoom today is Devina Mehra, founder, chairperson, and MD of First Global. Hi, guys. Just 3 days to go, and then we say the year is over.
Yes, we do that.
And eventful year, right? I mean, a lot of events to discuss and talk. The big rally in the commodities, which was unexpected. Large FDI deals, which was unexpected. So much of IPOs, which were unexpected. So I think what Street was expecting, that didn't turn out to be in 25. We were all expecting a lot of momentum to continue. And that was not the case. And a lot of things which we didn't expect. The entire commodity rally was a big surprise. I think a lot of investors just missed out and that entire commodity rally.
And everyone thought at the start of the year that the India-US trade deal would be struck, and that didn't happen, right?
Exactly. You know, so many things happened. I was just trying to recap whatever happened in 2025 to look at how things would happen. The Nifty has actually managed to gain about 10% this year so far, but it's the least performing or the worst performing, among the worst performing indices in the world.
That's because of the US deal.
Exactly. And if you account for the currency weakness, we're up just around 5.5%. There are only 2 or 3 global markets which have done a lot worse than the Nifty has done. But then if you put things into perspective, we climbed so many walls of worry. There was the Operation Sindhu, there was the Iran-Israel war, then there was the US Trump tariffs tantrums that came by, the weakness in currency, record FPI outflows, so much money directed towards IPOs, which a large part of which were OFS. And then you had the GST 2.0 transition, so many things. So,
exactly.
10th straight year of,
no doubt about it.
Despite all of that, 10th straight year of positive returns is what we've seen on the Nifty.
Well, indeed. So let's begin the conversation and get Devina Mehra. Devina, what stood out for you as you look back at 2025, and what would be the top 2-3 big ideas, big bets for you, expectations?
Always, I mean, markets will always frustrate you. That's the thing to remember, that they will never do what you expect them to do. And risk is always something that you do not expect. That is always the theme. And that is the reason why I never give an index projection either in the new Samvat or in December, January. I haven't done it for 3 years. And because that's something you don't know. Yeah, I'll just give you an example. In 2022, January, The Economist, which is supposed to have all this data of over a century of what happened geopolitically, had given a list of 10 geopolitical hotspots. And they did not mention Russia, Ukraine, where the war broke out the very next month. So that's how off even so-called experts can be. And of course, you know, we are talking about the currency depreciation in India. I mean, just to give you another example, versus the US dollar, but that actually understates how much the Indian currency is depreciated. So because the US dollar has not been a well-performing currency against other currencies. So for instance, against the euro, the rupee has gone down 20%. So I say that nowadays people say that if one has to educate the children abroad, US is not so welcoming, so let's go to Europe. So I mean, the news is that your college bill went up by 20% in just this 1 year. Of course, the flip side to currency depreciation is the commodity rally in rupees. So off late, the last kicker you saw in metal prices has really come out of the currency. So, you know, that is the thing. And of course, I mean, always in every year, there are many news-driven shifts that happen. And this time it was the Trump tariffs and GST. I think those were the 2 overall kind of industry-wide.
You know, Devina, we'll come to you for your 2026 call, not on the index, but the themes that appear attractive. But for that, let's just recap the week that went by, the last week of 2025. The market ended the holiday truncated week flattish. We obviously broke the 3-week losing streak, but it was not much in terms of a gain. The Nifty was up, what, close to about 1/3%. Trade on thin volumes. The good part was, from a bull's perspective, the Nifty managed to hold on to 26,000 and the 26,015 mark, which is the 20-day moving average, an important technical support. The Nifty Bank marginally lower. The mid-cap index was lower by about 0.1%. So if you call it an underperformance, so be it. But, you know, this week was absolutely flat. Metals did well, the public sector enterprises did well, and rail stocks, they continued to do well this week. In fact, this month they've been good gainers. But on the way down, we had the IT, realty and pharma stocks, which were key underperformers. Gold, silver and metals continued to rally. Among the top stocks of this week, from the Nifty standpoint, Shriram, that continued its up move after the deal was announced, so 7% higher on that. Trent continued to do well. It was one of the worst performing stocks on the Nifty this year, but the last week seen a 7% up move. Coal India as well, on the back of value unlocking news out there, was up around 6%. But in the broader markets, that's where the action was. Hind Copper up around 22%. Coforge, ahead of a possible big acquisition, was down 9% this week. And Dixon also down about 7% this week. But the cake was definitely with all the rail stocks, up anywhere between 15 to 21% gains for Titagarh, IRFC, RVNL. And now the next week as we move on, all eyes will be on one, the monthly expiry. The second thing we'll be watching out for, year-end trade. Will NAV propping continue as we move towards 2026?
Mangala, we spoke about cake, and I must remind you that you have to give cake to everyone else, right? I mean,
I do.
Your daughter's first birthday, so congratulations. But
it's cake and a lot
we are waiting for the cake to come, but anyway. So, Devina, two-part questions to you. One, for the year gone by in 25, what is one thing that worked out for you in terms of portfolio positions, and one which didn't work out, and which you expect can turn out and work out for you in 26? So, in two parts, if you can explain those two things.
Okay, so the two industries we've been overweight now for almost 2 years. So one had a good run this year, which was auto components and autos, and pharma took a bit of a pause. So pharma and healthcare was the other area. So pharma has been kind of more of a pause this year. So now we see it again doing well. So those would be the kind of two sides of what we took a bet on and what worked out and what didn't.
Okay. Anything on metals, Devina? I mean, did you expect such a big move in the hard commodities, and eventually it meant for stocks as well? Are you still bullish on the metal names?
Yeah, I mean, we had a reasonable number of metals, but we weren't overweight metals. So that's it's a kind of a risky thing to play. And as I said, the last bit really was the rupee slide, because even if you are not a big exporting nation, the benchmarking of metal prices is always off the international metal prices. And then, of course, there's also been a protection put in place for Indian metal companies, which is the anti-dumping duties from China. So, those have been the two additional kind of buffers for the metals in India.
You know, the chatter around US-India trade truce is increasing, and maybe what didn't take place in 2025 is expected to take place sooner rather than later in 2026. With the rupee depreciation that we've seen this year, and if there is a possible trade deal, do you believe some of the exporters would benefit in 2026? And in that, it could make for an investing case?
Well, I mean, if the trade deal does come through, yes, it is a positive, though I think a large part of it is probably already in the price, in the sense that the market has been expecting it for a while. So it's not as if that it is an unknown positive that will come suddenly. And if you look at the listed space, other than, again, some engineering and some pharma, there isn't that much of an export exposure in the listed space. Again, I mean, the IT services is not goods export, but it is services export. But among the major sectors, that would be it. I mean, we have been losing share with our traditional exports like textile, garments, jewelry, etc. So that has last few years, we have not done well in those traditional exports.
Devina, any one turnaround sector that you're betting on?
I generally don't bet on turnaround. I mean, because those are high risk plays, and our whole philosophy is that you must manage the risk. If you talk of, if in terms of just sectors which have, in terms of stock performance, not done very well, I would think, IT services is one you can bet on, where I mean, we are not hugely overweight. We would be slightly overweight IT services. And over time, I think we moved a little more from the large caps to the mid caps. But as a sector, I think that's a sector which has underperformed for long and might have a better 2026, something like what banking did this year, especially the PSU banks, that after 5 years from 2020 to 2024, the sector underperformed every year except 2022. So after that, they had a good year this year. So maybe something like that might happen to IT services in 2026. But I generally don't like making one-year bets.
Sure, sure. Devina, you briefly spoke about banking, but this year was a surprise in terms of FDI investments in the financial space, right from Shriram to RBL Bank to Yes Bank to Samman Capital. A lot of FDI money has come into the financial sector. Of all the deals that you've seen so far, anything that strikes out for you, and maybe you're betting on any of those NBFCs or financial names?
Not particularly. This year, what we would have mostly added, especially in the first half of the year, was PSU banks.
Okay.
After that, of course, we've done a bit more of a reshuffle, but not so much on necessarily the stocks that have got the FDI.
Sure, but anything that stands out for you? Shriram getting $4.5 billion, RBL Bank getting very large 60% FDI holder now. It's like an MNC bank now. So anything that excites you, or you've looked at adding?
We're tracking from here on how these things work out, RBL in particular. But we haven't made any significant bets there.
I'm curious to know, where are you deploying incremental capital then? What is it that you're buying? Is it the same stocks which you hold exposure to, or is there anything new that you're looking at as an interesting bet?
We haven't made very big changes in our last rebalance. One area where we did add was oil marketing companies. FMCG, we've been adding through the year. As I said, banks, particularly PSU banks, we've been adding through the year. So not necessarily only in the October rebalance. But FMCG also, we would be overweight now. And that's really the consumption story. Again, consumption coming off the very low of the real low was in 2023-24 when the market was still booming. I mean, people kind of woke up to it after the market started going down, but that was the real low, and it has moved up since then, the consumption story. Of course, the flip side to the consumption story is that a lot of the inflation coming down has been food prices coming down. So for the rural consumer, that's their income. So it's kind of a little bit of a tightrope balance, that something which is good for the urban consumer is not so good for the rural consumer, for whom the food is actually an income source and not an expenditure source for the most part.
Devina, I request you to hold that thought, but don't go anywhere. To all our viewers, we will continue to decode the week on Dalal Street and continue our chat with Devina. Stay tuned.
You're watching us here on Editor's Roundtable on CNBC-TV18 as we look back at 2025, look ahead at 2026. With us still is Devina Mehra. But, before we go back to Devina, Nimesh, Rima, let's discuss what 2026 looks like from the space that we track individually. So, Nimesh, you are all encompassing when it comes to the market. So what is it that you're tracking?
So look, from a market point of view, Mangalam, while we spoke about indices, Nifty 10% higher, 5% in dollar terms or whatever, the fact is 25 was a very difficult and a challenging year to make money. And people have lost a bit of momentum and they've lost money as well because the broader markets have not done well. I put out a piece 2-3 weeks back as to how much you've seen the correction in the broader market names, stocks at on 40, 50, 60%. So that pain is something to watch out for. If that doesn't come back, the biggest risk for this market in 26 would be few things. And the biggest of that all would be the domestic money.
Yeah.
We all have rallied on the back of DI, the local money, the SIP money, right? The feedback is if the 3-year returns turn negative at a mutual fund level, then the SIPs turn negative. And that could be a big impact on the markets as well. So this is something to watch out for. Second, there is a lot of hope that 26 would be a turnaround year in terms of earnings. But again, there is a macro view as well that at least the macros are not supportive for a big earnings upside. Yeah. If there is no big earnings upside, then again, that's going to be a bit of a risk to this market. The third and the most important would be the FI money. When will FIs come back? For that, I guess the biggest trigger would be the India-US deal. If that takes place, then India comes back to some extent in a sweet spot and the FI money comes in. So again, that is something to watch out for. And the last would be the IPO, the rush of IPOs, the kind of liquidity which is getting sucked out. That is again a bit of a question mark on the secondary market. So these are the few elements to watch out for. My sense is 26, there is a lot of hope that we'll have a big rebound. That may not be the case because there are few elements which needs to work out in India's favor for India to do well. So that's the market setup. But Mangalam, if I want to ask you for 26, which are the triggers to watch out for within the sectors that you track, FMCG? And more so from an M&A perspective, because there is a lot of buzz about RBA, Sapphire and the Devyani merger. A lot of things are happening, right? BBL is getting into non-alcohol and alcohol as well. What is that you'll be watching out for?
So from a consumer space standpoint, there are 3 major triggers that I'll be tracking in 2026. The most important one is the kind of thrust that the government has given to reviving consumption in the last 9 months or so, be it the income tax cut that has come in, the RBI rate cut that has come in, etc. And alongside that, we've had more of the GST rationalization that has happened as well. So will all of that now fructify and the long expected demand recovery come by? We've seen green shoots of that. Does that sustain and accelerate into 2026? If that happens, then these companies sustain their valuations, or else there will be time correction. The second trigger will be a lot of these companies over the last year. If 2025 had to be summed up in one word for FMCG, would be leadership changes. Sure. So you had a new leader for HUL, you've had a new leader for Birla Opus, you've had a new leader for Nestle. You name it. Every large FMCG company has had a new leader. So now they've had their time in settling in the company. Any new leadership change in the FMCG space and the existing strategies of the new leaders, whether that comes to fruition or not, is something that I'll be tracking. And from a category standpoint, the one thing that I will be looking at in particular is this value premiumization or mass premiumization, because we've seen Zudio work very well for Trent. Does that happen with Indian hotels? Do we see Ginger drive a lot of volumes for Trent as well? Obviously, the revenue contribution will not be as much. And Titan itself has announced its foray into lab-grown diamonds. So value fashion would be a big thing that I'll be watching out for. Devina has been buying a lot of these FMCG stocks all through 2025. Devina, what are your triggers that you're looking at in the consumption space in particular?
As I mentioned, see, consumption, one thing is overall, if you look at, one is inflation coming down. In fact, there have been products where there's been a negative inflation, where prices have come down, which is what I was talking about in food products. And also, as I said, that from that bottom of 23-24, consumption has begun to tick up, which should help FMCG companies. And also other inflation factors, also the components have come down, which is basically petrochemicals, the downstream from crude, which is an input for a lot of companies, including FMCG companies. So there's some beneficial tailwinds on revenue as well as on the margin front. But of course, the other thing I would like to say that we are talking about all the things to be cautious about and what are the risks. Let me remind your viewers that sentiment is always a contraindicator. you should be careful in markets when you are feeling too good, when you are feeling too buoyant, which was, let us say, the first half of 2024, when people thought, 35% compounding was there for the taking. And so that's when you should pause and think that, am I doing the right thing? When actually you're feeling that there are a lot of risks, that am I feeling anxious? Should I stop my SIP? Should I get out of the market? That's almost always the worst time to get out of the market. So that's why you had this one whole samvat where even the index gave no returns. And as was mentioned, the index doesn't even capture the pain in the markets, which is why the indexes may be hovering around the highs. The median stock is still down significantly. So it's something like 70% of the stocks are down more than 10%, something like 30% are down more than 20%. So that's the broader thing that the viewers should keep in mind, that when you are enumerating the risks, actually, usually that's the better time to be in the markets than when you are feeling great that everything is going very well. But don't remain in the same stocks where you are. The market has no interest that you bought the stock at 100 and today it is 60 and you are waiting for it to go back to 100. That particular stock may never go back to 100. So remember that. So look at your portfolio from scratch today. Where should I be invested? But remain invested to the extent of your equity allocation.
Sure. Devina, I want to have your thoughts on the IPOs as well. But before that, I want to ask Rima about the IT sector. Rima, what are the few things that one should watch out in 26?
Well, top down, actually the IT sector has seen a re-rating or a recovery since October. From that level, it's gone up 15%. Top down, the strong US GDP growth help, expectation that Fed rate cuts continue, and sentimentally, whenever the India-US trade deal gets struck, that will be a positive. Sure. But what we've seen this year is that IT companies sort of realize that organic growth is not coming through and they're making acquisitions. Even a company like TCS, which has historically been very conservative on acquisition, they focused on organic growth, internal hires, they never hired laterally. TCS made 2 acquisitions. Coastal Cloud was a large one, $700 million, a smaller one, Listingage. Infosys made a couple of tuck-in acquisitions like MRE Consulting, etc. Coforge will, do one. So large cap IT companies made acquisitions. Next year, will we see mid-cap IT companies also go ahead and make acquisitions? And the third one is on AI. Because maybe, the street realizes, or maybe companies realize that if you want to get some sort of an AI-related multiple, you need to start quantifying your AI revenue. TCS did that. They said we're getting 1.5. TCS, HCL gave it in Q2 where they spoke about the quarterly revenue from advanced AI. TCS did it at the investor day. So if you want, now you'll start scaling up the contribution that you get from AI, and maybe that helps with overall multiples, etc. So these are a couple of things I think we'll watch.
Any large AI play which will come up from an
Fractal Analytics, I think, is the only one, which is expected to come in December.
Anybody else?
Nothing that's
nothing else?
At least in the
Devina, your thoughts on any of the India AI play, if there is any that you've looked at, and B, from the IPO perspective of all the listings that we've seen in 25, anything that stood out for you?
IPOs, my whole worldview is that when there is an IPO frenzy, it almost never makes sense for an investor to apply for an IPO because most IPOs are crazily priced, and if they are not, this is a good business at a good price, you are unlikely to get a allocation. So that's the thing. Also this year, as you briefly mentioned, the other issue has been that the quantum of offer for sale in the IPOs, so which never used to be the case. So earlier it used to be that most of the money should go into the company unless the company doesn't need money. But now you have a situation where the company needs money, but still it is the promoters and the early stage investors who are cashing out. And then they, like in the case of Swiggy, you saw the major 60% of the IPO was OFS. And then, within a year, they are back asking for more money. That sort of thing is dangerous. I see that as a danger sign that you as an individual investor or the IPO investor are buying at a price where the promoters are selling at scale. Normally in the secondary market, we take it as a red flag if the promoter is selling. Here you are doing that in bulk. So those things, never end very well. IPO frenzies have come and gone in all exchanges over the centuries, literally. You had an IPO frenzy in the 19th century on the Paris bourse with some few hundred listings in a year, and the next year it went bust. So So be very, very careful on the
Right.
IPO side.
Be very careful of the IPO frenzy. That's the word coming in from Devina as she speaks about, the sectors that she likes. Devina, wish you a very happy 2026. May it be financially, personally, and from a health standpoint, one of the best years for you. And as we close on 2025 on Editors Roundtable, just a quick one word, your resolution for 2026.
Be present.
Be present. Wow, that's deep. Yours?
For me, it's been for the last many years, fitness, fitness, and fitness. I still have to come to your levels, but that could be my maybe a wish to do next year. To be as fit as what you are.
What about last word, Mangalam?
Richer, smarter, fitter.
Okay.
All right, let's all-encompassing. With that, we wrap up on this edition of Editors Roundtable, the 2025 edition of Editors Roundtable. You stay tuned to CNBC TV18. More news and updates continue, and we'll see you in 2026.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty snap a 3-week losing streak despite declining on Friday. The rupee weakens against the dollar as it moves towards the 90 mark once again. Quick commerce company Zepto to file its draft IPO papers confidentially today. Sources say a listing is likely by September quarter next fiscal. Hopes to raise around 11,000 crore rupees. IT firm Coforge in talks to acquire digital engineering company Encora for an enterprise value of $2 billion. Sources say the deal could mark the exit of private equity firm Advent from Encora. Coforge's board meets today to discuss a fundraise proposal. The union government opposes a petition before the Delhi High Court seeking GST reduction on air purifiers. The government calls the petition motivated and bypassing the GST Council would open a Pandora's box. The court seeks a detailed government response in the next 10 days. Tata Steel faces a compensation claim worth $1.6 billion in Netherlands. A Dutch NGO is seeking damages alleging health impact from harmful emissions. Company says the claim is speculative and without any basis. Titan enters the lab-grown diamond segment with a new brand called Beyond. The first retail store will open in Mumbai next week. The government's top auditor finds lapses in the rural electrification drive. The CAG report says only 66% of households have received power supply, contrary to the government's claims of 100% success. Also finds several gaps, including financial mismanagement.
I have a plan for the people of my country, for my country.
BNP leader Tariq Rahman returns to Bangladesh after a self-imposed exile of 17 years, receives a massive reception in Dhaka. The Bangladesh government quashes allegations of a communal angle after a Hindu man was lynched in Rajbari, says the deceased was a history cheater who had entered the area with the intent of collecting extortion money. The US launches deadly airstrikes against the Islamic State militants in Nigeria for allegedly targeting Christians. US Defense Secretary Pete Hegseth thanks the Nigerian government for cooperation, but the Nigerian government rejects the US assertions as militants target both Muslims and Christians. Well, let's begin with the market action for the day. The Christmas hangover on Dalal Street. The Sensex down by over 360 points and the Nifty lost nearly 100 points in what turned out to be a fairly tepid session of trade today. So finally closing at 85,041. That's the Sensex. The Nifty down 100 points. The Nifty mid-cap down 130 points and 170 point cut there for the Nifty Bank. The Nifty is now below its 20-day moving average. But if you look at the picture for the week, the Nifty has managed to gain 0.5%, snapping a 3-week losing streak. And metal stocks were among the top performers this week. The Nifty Metal Index up 3% and a flat close there for the Nifty Bank. That's underperformed and closing in the red for the third straight week. But from the stock markets, the money market action, the rupee weakened marginally against the dollar. The rupee is now within striking distance of the 90 mark against the greenback, and the 10-year bonds declining in trade today and the yields hardened. This comes after bond prices rallied for the last few days after the RBI announced a 2 lakh crore rupee bond buying program and a $10 billion forex swap. In the commodity market, oil prices spiked after the U.S. stepped up pressure on Venezuelan oil shipments and carried out airstrikes against the Islamic State militants in northwest Nigeria in coordination with authorities. President Trump called the operation in Nigeria a defensive response to vicious attacks on innocent Christians in the African country. Both Venezuela and Nigeria are major oil producers, and America's offensive has raised concerns over potential supply disruptions. Meanwhile, there's no stopping the gold rush. The yellow metal, along with silver, scaling new records. Silver prices have surged by 158% so far this year, significantly outperforming even gold. Well, let's talk about the big corporate stories of the day. Quick commerce startup Zepto is all set to file its draft red herring prospectus via the confidential route. We learn from sources the company is aiming for a public listing in the second quarter of the next financial year. Zepto plans to raise about 11,000 crore rupees through a mix of fresh equity and an offer for sale. Rachna is standing by. Rachna, give us a sense of how Zepto's financials stack up and the valuations it is looking at.
Well, after a delay of nearly a year, Zepto is now set to confidentially file its draft IPO papers. Now, this is according to people familiar with the matter. The company is targeting a public listing in the July-September quarter of 2026 and plans to raise around 11,000 crore rupees or about $1.3 billion. This will be through a mix of fresh equity and an offer for sale. The timing is significant both for Zepto and for India's fast-maturing quick commerce sector. But let's start with the numbers. Zepto's revenue growth has been sharp. FY25 revenue more than doubled to 11,109 crore rupees from 4,498 crore rupees in FY24. But losses have also widened alongside expansion. Net losses rose to 3,367 crore rupees in FY26 from 1,249 crore rupees a year earlier. Now, the company was last valued at $7 billion in a private round in October 2025. A public listing would place Zepto alongside rivals such as Blinkit and Swiggy at a time when investors are far more focused on profitability and execution than growth alone. Ahead of the IPO, a key strategic shift has been the effort to Indianize the cap table. In January 2025, Zepto completed a reverse flip, moving its domicile from Singapore back to India, which is a pretty standard move. But since then, it has worked towards raising domestic ownership, largely through secondary share sales. That's how Motilal Oswal and its founders buy shares about $50 million and then one more of about $50 million in their personal capacity. But that may not have been enough because Zepto did continue to attract global capital, including a $450 million round led by US-based pension fund CalPERS in October 2025. So clearly the plan to Indianize did not materialize well. But Zepto's origins trace back to Y Combinator when the accelerator invested in 2021. That, and with later investors, the company scaled rapidly and became India's first unicorn of 2023, ending a prolonged funding slowdown, if you remember then. But scale also brought scrutiny. In late 2025, the Central Consumer Protection Authority fined Zepto for using dark patterns such as drip pricing and basket sneaking. Earlier in 2025, a Maharashtra FDA inspection led to a temporary suspension of a warehouse in Mumbai's Dharavi, but that was an isolated case. Now, as per the reports, the company also laid off over 500 employees last year as a part of cost control measures. Despite all of this, user momentum remains strong. According to data from CLSA, Zepto added 1.2 million weekly active users in the week of December 15, the highest among quick commerce players. That said, Blinkit still continues to lead on downloads. So how public market investors weigh growth, losses, governance and competition will ultimately determine how this IPO plays out, and we will keep a close eye.
Okay, that's Zepto heading to the Lal Street. But Rachna, hang in there. I'm going to come back to you. Let's talk about the other story that you're tracking, which is Coforge. It is in talks to acquire digital engineering firm Encora for an enterprise value of $2 billion. What could this deal mean, Ratna, for Coforge's growth strategy?
Right. Sources have told us that Coforge is in advanced talks to acquire a stake in Encora in a transaction that could go up to $2 billion. Now, the deal would mark a potential exit for private equity major Advent International, which currently holds a majority stake in the company. But to put this in context, Advent entered Encora in 2021, acquiring the company from Warburg Pincus at a valuation of about $1.5 billion. Warburg had backed Encora during its earlier phase of expansion, helping build scale in offshore delivery and deepen its US enterprise client base before selling out to Advent as the company transitioned into a more mature digital engineering platform. Now, Encora operates squarely in the digital engineering and product development space. Its core strengths lie in cloud-native application development, data engineering, platform modernization, and enterprise software services with a strong clientele in North America. Over the last few years, under Advent's ownership, Encora expanded both organically and through acquisitions, positioning itself as a high-growth engineering-led alternative to traditional IT outsourcing firms. For Coforge, though, it would definitely be a transformational transaction, but an ambitious one, because the company has historically been a mid-sized IT services player with strength in BFSI and travel tech as we know it, but limited exposure to deep product engineering. And that's where Encora would significantly shift that mix for Coforge. But as of March 2025, Coforge reported a net cash flow of around 474 crore rupees, cash and reserves of roughly 600 crore rupees. That balance sheet may provide flexibility, but it's not enough to fund a $2 billion deal outright. And as a result, Coforge's board is expected to consider a fundraise, potentially combining debt and equity to support this acquisition, is what we're learning from our sources. The call with the investors is scheduled for 5:30 p.m. So we will be looking out for management commentary.
Yes, we certainly will. Rachna, many thanks for joining us. Let's look at the other headlines we're tracking this evening. As CNBC-TV18 Newsbreak confirmed, Japanese building materials giant Aika Koyo will acquire at least 40% stake in laminate sheet manufacturer Stylum Industries for about 1,500 crore rupees. This deal marks another high-value Japanese FDI in India, following investments in Yes Bank and Shriram Finance this year. Shares of Castrol India gained after a consortium led by Stonepeak announced an open offer to acquire additional 26% stake in the lubricant maker. The offer price is set at 194 rupees a share, which is at a 2% premium to Wednesday's closing price. Earlier this week, BP agreed to sell 65% stake in the parent company Castrol to Stonepeak at an enterprise value of $10 billion. Colgate-Palmolive is facing a tax demand of about 270 crore rupees for financial year 2022 from the IT department. The company said the order pertains to adjustments around intercompany pricing and disallowance of certain expenses. Colgate added that the demand does not impact its operations and financials. However, it will appeal against the order before the tax tribunal. A Dutch organization is seeking compensation of $1.6 billion from Tata Steel's Netherlands subsidiary. The NGO alleges potential health impact from harmful emissions at Tata Steel's plant and claims that property values have underperformed compared to other regions. Tata Steel described the claims as speculative and without basis. The company also highlighted its investments to improve environmental standards and community health in the region. WeWork CEO Karan Virwani says that service expectations are evolving as companies increasingly adopt hybrid work models. In an interview with me, Virwani highlighted opportunities beyond workspace, noting that a 1% increase in revenue on account of value-added services can significantly boost the bottom line. Take a look.
We think that there's opportunities above workspace that we can build, partner, or position ourselves to be able to cater to these companies. If you're building tech, managing transport, let's say for your employees, or food for your employees, or employee experience for employees, those are still not core to what you do. You end up having to hire teams, build teams around it. Could you just outsource that, to someone like us who's anyway managing your workspace? From roughly about 15% of our revenue, even if it moves up 1 or 2%, at this base of revenue that we have, it's really it almost all flows down to the bottom line. It's high margin type of revenues that we see.
Well, that's Karan Virwani of WeWork India. Now, Indigo has started issuing vouchers worth 10,000 rupees to passengers who were affected by flight disruptions between the 3rd of December and the 5th of December when those massive disruptions took place. According to the airline, these vouchers can be redeemed on any Indigo flight booked within the next 12 months. If all passengers avail of the vouchers, the airline could face an estimated cost of over 500 crore rupees. Indigo is yet to disburse cash compensation mandated under the DGCA guidelines for impacted travellers. Titan hit a fresh 52-week high after the firm announced its foray into the lab-grown diamond space. Mangalam is standing by with the details on what this means for the company and the industry. Lab-grown diamonds, Mangalam, we saw that big inflection point in 2025, and now Titan on that bandwagon as well.
Well, it's a sparkling development that has taken place at Titan, and by sparkling I mean they have announced for the first time their foray into lab-grown diamonds. Yes, the management has been speaking about in the past, saying that they've been observing this trend, whether they want to get into it or not, they won't announce their plans publicly, etc. Then there were a few murmurs that they've gone ahead and trademarked the brand Beyond for their lab-grown foray, and then the analysts were worried whether trademarking the brand immediately means a launch or not, etc. The company's gone ahead and now set the record straight. Titan will enter the lab-grown jewelry space, and the first store opens as recently or as in the near future as 29th December. So Beyond, from the house of Titan, which is their lab-grown foray, will have their first exclusive retail store in Mumbai on the 29th of December. It will offer a curated range of lab-grown diamond jewelry, will cater to the adornment needs of women in lifestyle categories. And this understandably is one of those repurposed stores from Carrot Lane. So looking at adornment jewelry, a lot more affordable than natural diamonds. So they do not want to, cannibalize the demand that they get for natural diamond jewelry itself. They also plan to add a couple of more stores in Mumbai and Delhi in the immediate near future. Again, this is a seminal moment from the jewelry industry standpoint, because the first time a large-scale, organization has announced its formal foray into the lab-grown diamond space. So the impact of this is something we will monitor over the next few years, not immediately, but this is just an important inflection point.
All right, Mangala, many thanks for joining us. That's Titan moving into the lab-grown diamond space. Air pollution continues to choke large parts of North India. In Delhi, the AQI improved marginally but remains in the very poor category. Air quality in cities like Gorakhpur, Panipat and Amritsar in the hazardous category, with pollution more than 30 times the standard levels. In Mumbai, work has been halted at the bullet train project site in BKC after the Bombay High Court flagged widespread violation of pollution control measures. Air quality in Mumbai at unhealthy levels. Now, the centre has opposed a plea in the Delhi High Court that called for classifying air purifiers as medical devices amidst the deteriorating air quality in Delhi. Ashmit joins us now with more. Ashmit, the court saying, give us your rationale for opposing this move, and the centre essentially saying that this is up to the GST Council, and moving on this front could, in fact, in the words of the centre, open up the Pandora's box. Explain this to us.
Well, indeed, the centre is not one bit happy as far as this PIL is concerned. In fact, questioning why this question of reducing the GST on air purifiers was not raised before the government and is coming by way of a PIL, in fact, hinting that this could perhaps be even motivated. But the broad heart of what the centre's opposition essentially is that, look, it's not happy with the fact that GST Council is being asked through this PIL for cutting the rates. What the government essentially argued is that there is a mechanism in place. There is a constitutional mechanism in place. The GST Council is the only and the final authority which has the say as far as deciding on the rates is concerned, that the parliamentary committee has made a recommendation to that end of cutting the rate on air purifiers from 18% GST to 5%, and that is an issue that will be laid before the GST Council meeting, that there is no urgent meeting that is being called, but in due course when the meeting does come up, this is an issue that will be taken up for consideration. The centre saying that, look, we're not saying one way or the other whether or not the rates will be cut, but only saying that there is a formal process to be followed, which is the GST Council, and that should be respected. But to that end, the Delhi High Court taking note of this submission being made by the centre, but nonetheless nudging the centre to come back with a formal response on what the stance is of the central government as far as slashing the GST rates from 18 to 5% on air purifiers. Around 10 days have been given to the centre. The next hearing in this case, we understand, will be on January 9th.
All right, Ashmit, many thanks for joining us. The Indian Medical Association has opposed the Andhra Pradesh government's move to allow postgraduate Ayurveda doctors to perform certain surgical procedures. IMA's president, Dr. Dilip Bhanushali, has called the move a huge blunder and said it will create many problems for patients. Dr. Bhanushali also questioned why Ayurveda should be mixed with modern medicine. The association will be submitting a memorandum to raise its objections in this case. Up next, government's top auditor finds lapses in the rural electrification drive. The CAG reports as only 66% of households have received power supply, contrary to the government's claims of 100% success. Details when we return. Well, here's the latest in Bangladesh. Former Prime Minister Khalida Zia's son Tariq Rahman has returned to the country after spending 17 years in self-imposed exile. Rahman was living in London since he fled Bangladesh in 2008 over what he called politically motivated persecution. His return comes as his mother remains unwell. Rahman, along with his wife and daughter, received a rousing welcome with thousands of Bangladesh National Party supporters flocking the roads leading to the Dhaka airport. Upon landing, Rahman thanked the interim government head Mohammad Yunus in a phone call for ensuring adequate security arrangements. The 60-year-old also addressed a public rally with senior BNP leaders present on stage. He invoked Martin Luther King, saying he has a plan for the people of his country. Rahman is widely seen as the prime ministerial frontrunner in the general elections set to take place in February of 2026. Meanwhile, the Bangladesh government has quashed allegations of a communal angle after a Hindu man was lynched in Rajbari. It said the deceased was a history cheater who had entered the area with the intent of collecting extortion money. This is the second such reported incident. Days after Deepu Das, a Hindu man, was lynched over alleged blasphemy, India's Ministry of External Affairs has said that over 2,900 incidents of violence against minorities, including cases of killings, arson, land grab, have been documented by independent sources during the tenure of the interim government of Bangladesh, which started in August last year. The Indian ambassador to the US, Vinay Quatra, met US ambassador-designate to India, Sergio Gore, at President Trump's residence Mar-a-Lago in Florida amidst uncertainty over the conclusion of a trade deal. Quatra revealed that extensive discussions were held on strengthening trade ties and priorities for the bilateral partnership. Gore expected to arrive in New Delhi in middle of January. He will be assisted by non-Korea diplomats at the US Embassy. Indian origin US official Ricky Gill has received the Distinguished Action Award for his role in coordinating efforts during the India-Pakistan ceasefire this year. US Secretary of State Marco Rubio presented the award to him despite India denying any third-party mediation. Gill serves as Special Assistant to President Trump and Senior Director for South and Central Asia at the National Security Council. India's External Affairs Ministry has responded to issues faced by H-1B visa holders. The US government has tightened the visa conditions, and the holiday season is turning out to be a nightmare for many after visa appointments were delayed for several months. The MEA spokesperson says the issues have been flagged with the US. It's hopeful that disruptions will be addressed shortly.
While we do understand, as you also understand, that visa-related issues pertain to the sovereign domain of any country, we have flagged these issues and our concerns of our nationals to the US side, both here in New Delhi and in Washington, D.C. And we hope that these delays and these disruptions will be addressed.
Well, that's the MEA on the H-1B visa delay. Now, the government's top auditor has found significant gaps in the government's rural electrification program. A CAG report also questions the government's claim of 100% rural electrification and finds several shortcomings, including financial mismanagement. Santhya is here with more from what the CAG has had to say. Santhya.
So yes, Shireen, the CAG audit report has raised serious questions about the government's claim of 100% rural electrification under two flagship schemes, Deen Dayal Upadhyay Gram Jyoti Yojana and Pradhan Mantri Sahaj Bijli Har Ghar Yojana, also known as Saubhagya. While official dashboards declared full completion by March 2019, the audit shows that the ground reality was very different. Under Saubhagya, about 300 lakh unelectrified households were to be covered. But by the deadline, only around 152 lakh households had actually been electrified, just over half the target. Even by March 2022, the figure rose only to about 174 lakh households, which amounts to over 66% of households. The report also highlights that 25 states claimed 100% achievement, even as 7 states still reported over 19 lakh unelectrified households at the same time. In rural India, more than 4 crore households were to be electrified by 2019, along with an additional 19 lakh households. However, only about 2.9 crore households were actually electrified by the deadline. The CAG report points out that despite spending tens of thousands of crores, problems of inadequate and unreliable power supply continue in rural areas due to weak distribution networks. The audit also flags serious financial irregularities. Shireen, in 2 states, over 16,000 households received connections under both Deen Dayal and Saubhagya scheme, leading to duplicate claims by contractors. In other cases, payments were released without ensuring completion of work, resulting in double payments amounting to over 2 crore rupees. State-wise discrepancies have also been flagged. In Uttar Pradesh, for instance, full electrification was declared in 2019, but the audit found that less than half of the identified households were actually electrified. The CAG report further notes that delays were widespread. More than 80% of projects under Deen Dayal scheme were awarded late and over 90% were completed with delays, many running more than 2 years behind schedule. The bottom line from the audit is, Shireen, that despite ambitious targets and claims of success, rural electrification under Deen Dayal and Saubhagya schemes remain incomplete with gaps in execution and monitoring.
Santya, many thanks for joining us. That's the latest there from the CAG on those two schemes. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. We've got plenty more lined up for you, so stay tuned. We're back in a minute with more. Hello and welcome to Rewind 2025. I'm Shireen Bhan. The year has turned out to be a landmark for India's financial regulatory landscape. Under Governor Sanjay Malhotra, the Reserve Bank of India has rolled out one of the most far-reaching reform agendas in over a decade. Ritu explains what changed, why it matters, and how the RBI's regulatory philosophy itself has evolved.
2025 is going to be remembered as the year the Reserve Bank of India fundamentally rewired how Indian banks operate. Under Governor Sanjay Malhotra, the RBI did not just tweak rules, it dismantled and rewrote them, merging many and simplifying more. In all, we saw more than 80 regulatory changes in a single year, all aimed at the single objective to free up bank balance sheets, to revive credit growth and prepare the system for India's next investment cycle. At the heart of these reforms lies a clear shift in regulatory thinking. Governor Sanjay Malhotra has argued that Indian banks today are far stronger than they were a decade ago, better capitalized, better governed and more resilient to shocks.
We have taken measures very balanced, calibrated, thought out, considered, and we'll continue to take more measures, as and when required. Always the aim will be to promote the stability while at the same time improving competitiveness, encouraging and enhancing growth of the economy.
One of the most consequential changes came in M&A financing. For years, banks had faced tight restrictions on funding acquisitions and promoter buyouts, which was a hangover from the excesses of the last credit cycle. In 2025, the RBI recalibrated those limits and opened the doors for acquisition financing by banks. The signal was clear. Consolidation and capital reallocation are now seen as part of economic efficiency, not excess.
So there was a period of time when we thought acquisition by one company of another company typically is a hostile route, and that the bank should not be an instrument in doing this. So this was long back. So I think that has now been set right in current context where everything is the market and everything goes through the marketplace. And now in a completely different context, I believe the Reserve Bank has done the right thing to open it up because it's an excellent avenue of business for banks.
Linked to this was a broader easing of rules governing bank loans against shares, IPO financing and structured credit.
These announcements are, I call them as banking reforms 3.0.
Yeah.
And these reforms are, for a long-standing demand from the banking industry.
Yeah.
And very proactively addressed by the RBI.
Yeah.
I believe that they're absolutely credit accretive.
Prudentially, the RBI chose sequencing over shock therapy. The expected credit loss framework was deferred, allowing banks 4 years' time to adapt systems and capital planning. Older project finance norms were withdrawn and merged into a simple, unified credit framework.
Circumstances change, times change, requirements change, and so nothing should be frozen in time. And so that's why we had earlier also said that we will be continuously reviewing our regulations. It's very important that we continuously revise, review, improve our whole regulatory ecosystem.
Another major cleanup came through the removal of overlapping and legacy frameworks. The RBI consolidated a total of 3,809 circulars into updated master directions and scrapped another 5,673 obsolete circulars to ease compliance. Liquidity coverage ratio norms were relaxed and external commercial borrowing norms were liberalized, giving firms greater access to offshore capital while retaining safeguards on maturity, currency risk and end use.
The global discourse has been to move towards a principle-based regulation for reasons of simplicity over exhaustive specification, which may not even be possible. Not only is it not possible, but it can also lead to a very creative way of complying with the regulations, adopting a tick box kind of an approach that, yes, we have complied with these, and these provisions of the various regulations, and not serve really, the outcome.
These reforms extended beyond large banks. Risk weights on lending to NBFCs and MFIs were restored, co-lending norms expanded, and priority sector rules eased for small finance banks. Parallelly, the RBI addressed the cost of credit. Through 2025, it delivered 4 rate cuts, taking the repo rate from 6.5% to 5.25%. Loan reset norms were reviewed to ensure faster transmission to borrowers. The governor exuded confidence.
Since the October policy, the Indian economy has witnessed rapid disinflation, with inflation coming down to an unprecedentedly low level. Inflation at a benign 2.2% and growth at 8% for the first half of this year presents a rare Goldilocks period.
But the clearest signal of confidence showed through in bank licensing. After a long hiatus, the RBI granted a full-fledged banking license to AU Small Finance Bank and also approved Fino Payments Bank's transition into a small finance bank. The other significant shift came when RBI signaled greater openness to foreign capital, paving the way for Japan's SMBC to invest in Yes Bank and Emirates NBD buying a stake in RBL Bank. Taken together, the RBI's actions in 2025 mark a decisive shift from crisis-era regulation to growth-era regulation. Now, this is not deregulation without discipline, but the tone has changed. The RBI is no longer regulating for the last crisis, it is regulating for the next investment cycle. In Bengaluru, Ritu Singh.
Well, a significant year, 2025 for the RBI, many regulatory changes being ushered in. Now, 2025 has also been a landmark year for the goods and services tax in India, characterized by sweeping reforms, simplified slabs, strong collections and a major shake-up in how tobacco and sin goods are taxed. Timsy Jaipuri has the details on what changed. Timsy, the government finally gave the consumers and the industry something that they'd spent years asking for.
Well, let me take you back to Independence Day 2025. Since Prime Minister Modi took charge, he has reserved his 15th August speech for some big bang announcement. And this year was no different.
मेरे प्यारे देशवासियों, हम नेक्स्ट जनरेशन जीएसटी रिफॉर्म्स लेकर के आ रहे हैं. ये दिवाली के अंदर आपके लिए तोहफा बन जाएंगे.
The Finance Ministry went into hyperdrive after this, and Finance Minister Nirmala Sitharaman was able to deliver on what industry had been demanding for years: a simpler, cleaner rate structure, much ahead of schedule. She announced the changes on the 3rd September and set the 22nd of September for the biggest GST rate rationalization since the tax was launched in 2017. The old 4-slab structure of 5%, 12%, 18% and 28% was the first to go. In its place, we have a simplified 2-rate structure, a merit rate of 5% and a standard rate of 18%. We also have a special rate of 40% applicable only on sin goods. Of course, this meant a ton of goods had to be moved to new rates. So many key commodities like butter, ghee, biscuits, pasta, namkeen, etc., especially those categorized as basic and essential goods, were brought under the 5% slab. Remember, many of these were earlier taxed at either 12% or 18%. Goods like cement and paints, which were classified as standard goods, were moved to the 18% bracket. Most services remained to this rate slab. A major category here is basic 4-wheelers and 2-wheelers. These have been brought down from the 28% plus cess bracket to 18%, making them more affordable. Similarly, a bunch of consumer durables like TVs, refrigerators and washing machines have been moved down to the 18% slab from the earlier 28% slab. The council also cleaned up the list of items in the luxury, sin and demerit goods category. Now this list is limited to a few items like aerated drinks and luxury cars. So in the case of aerated beverages, the tax incidence has been kept the same but made simpler. Instead of 28% plus cess of 12%, these attract a flat 40%. Similarly, luxury cars also attract a flat 40% GST instead of the earlier 28% plus cess. Medicines were the other big impact area of this exercise. A host of drugs were brought down from 12% to either nil or were zero rated. This made these drugs cheaper. GST on essential services like health and life insurance premia has also been brought down from 18% to nil. So that's the much needed relief for these insurance customers and a long-standing demand from both the populace and industry. The government's confidence in pushing through and implementing this major reform came from two sources. One is the fact that there was a need to re-energize the consumption cycle. The other was a trend of strong GST collections, which were averaging at nearly 2 lakh rupees a month for most of the financial year. As you can see on this chart, there is a slight dip in the number announced at the beginning of December to 1.7 lakh crore rupees. This is the first collection where the full impact of GST 2.0 was felt, and the government is of the opinion that it is still indicating overall GST revenues as remaining robust. And so that's a strong sign that the simplified slabs, a rise in consumption due to cheaper goods, and improved compliance under GST 2.0 are helping sustain tax buoyancy. But there's one area that's yet to see a change in slabs, and that's the levy on cigarettes, tobacco products and pan masala. The GST Council had held off making any changes to these products as the compensation cess these brought in was still being used to pay off the loans taken to compensate states for the losses due to COVID-19 pandemic. Currently, these goods attract 28% GST plus cess. But we do have some clarity on how these will change once the loans are repaid. According to two bills introduced by the government, the Health Securities and National Security Cess Bill 2025 and Central Excise Amendment Bill 2025, the government plans to replace the quantum of compensation cess levy on cigarettes, cigars, gutka and other tobacco products and pan masala. Under GST 2.0, these products are expected to fall under the new demerit slab of 40%, and the gap in the tax incidence will be made up by the new taxes. On pan masala, for instance, tax will be 40% GST plus Health Securities and National Security cess. On cigarettes and other tobacco products, we are looking at 40% GST plus a higher rate of central excise duty. Effectively, this will retain the overall tax incidence on these products, preventing any sharp drop in government revenues while keeping prices steady. So, for the Goods and Services Tax 2025 has not been just a year of routine tweaks. It's been a year of evolution into a leaner tax with simpler slabs, stronger collections and sharper enforcement, while keeping consumer prices in check and setting the consumption cycle rolling again. In New Delhi, Timsi Jaipuria.
Well, 2025, the year that we saw that big GST rate rationalization. Up next on Rewind 2025, a year of top-level churn across the FMCG industry in India and around the world. That and more when we return. You're watching Rewind. Well, this is Rewind 2025. It's been a sluggish year for steel makers across the world. Weak demand, high energy costs, tariff tensions and persistent overcapacity proved to be a heady cocktail for companies world over. However, the new year is bringing fresh hope for the industry. Nigel explains why steel makers are pinning their hopes on a turnaround in 2026.
Well, that's right. The big question is what's in store for steel in 2026? Well, in the near term, steel prices, they have weakened, and that's likely to weigh on margins for steel companies just in the near term. In India, the hot rolled coil prices, they're down by roughly around 8% from the September quarter. That's driven by lower Asian prices as well as the expiry of the interim 12% safeguard duty, which happened in early November. But that's where things start to get a little bit more interesting. Now, there are growing hopes that steel prices may be close to the bottom. And they say this because Asian steel spreads, well, they are at near 15-year lows, almost 40% below their long-term averages. At these prices, these levels, spreads, well, they look unsustainable. And part of the street is optimistic of a recovery, especially if China's anti-involution policy leads to production or supply cuts. Now, let's turn our attention to the largest steel producer, which is China. China's steel production is down by close to 3 to around 4% year to date. But exports, they're up by around 6.5 to around 7%, and they remain elevated because Chinese demand has been weak. In fact, Chinese exports have crossed 100 million tons in the first 11 months of 2025 itself. And that continues to put pressure on steel prices. Turning to India, well, India's steel consumption has grown by around 11 to around 12% CAGR over the last 4 years. And growth of around 7 to 8% is expected in the times to come. At the same time, Indian steel companies, well, they are adding capacity, which means demand needs to keep pace to avoid oversupply. And that brings us to a key policy trigger. With Chinese exports high and export options limited, well, steel companies are hoping for the reintroduction of safeguard duty that expired in November 2025. Earlier in 2025, remember, the interim 12% safeguard duty helped domestic HRC prices trade at roughly around 9% premium to landed imports. But once that duty expired in November, prices, well, they have quickly converged with import levels. If safeguard duty returns, well, they could provide the much needed support to domestic steel prices. So heading into 2026, steel, well, it faces near-term pressure, but the setup could hopefully slowly improve with spreads near the bottom. Policy support will be in focus, and demand growth, as always, will be the key swing factor.
Well, thanks very much, Nigel. Will it be a turnaround year for steel? One will have to wait to see. But it was a year of change for consumer companies world over. Unilever, PepsiCo, Diageo, L'Oreal all saw changes in the corner office. In India, HUL, Nestle, Britannia saw leadership changes as the FMCG industry transformed into a high-stakes battleground. Shilpa reports the message to FMCG CEOs from the boardroom is simple: perform or perish.
The corner offices at many FMCG firms saw new occupants through 2025. From Hindustan Unilever and Britannia in India to Nestle, Unilever to PepsiCo globally, 2025 had some of the biggest consumer giants seeing one of the most dramatic waves of C-suite churn in over a decade. Let's start at home. HUL, India's largest FMCG company, saw CEO Rohit Java step down barely 2 years in the top job. His exit came after muted sales, flat volumes and investor pushback on the revival pace. Priya Nair, who served as the president of beauty and well-being at Unilever globally and has over 30 years of experience, has since taken charge and set HUL on a path that focuses on volumes to rekindle growth. Then there's Britannia. CEO Rajneet Kohli resigned in March and moved to HUL. He was replaced at Britannia by Rakshit Hargave, who was the CEO of Birla Opus. But then came the real shocker. Long-time MD Varun Berry abruptly announced his exit in November, with even his notice period being waived off. Markets reacted instantly, the stock slid over 5%, and all eyes are now on incoming chief Rakshit Hargave to steady the ship. There were also planned changes at Nestle India. That was a planned retirement. Manish Tiwari, who was heading Amazon India, has stepped in to replace Suresh Narayanan, who has been at the helm for a decade. Narayanan successfully steered Nestle through its biggest crisis, the Maggi ban, and then he focused on innovation and diversified Nestle's portfolio with expansion into categories like breakfast cereals, pet food, and more. Tiwari is now banking on digital growth, innovation, and a consumer-centric strategy to get the FMCG giant accelerating on the next leg of growth. L'Oreal India and Diageo India also saw leadership changes. Overall, 2025 have been a tough year for the FMCG industry in India, which struggled with rising inflation, muted performance, slowing urban demand. While income tax cuts, GST rates changes, and cooling inflation towards the end of the year, providing some relief, signs of recovery have begun to show. But the challenge is to keep the ship steady at the time of choppy waters on the global geopolitical and trade front as well. Now, while leadership changes in India were due to a mix of muted performance and planned transitions, the churn in the global FMCG landscape has been a lot more dramatic. Let's start with Nestle Global. Now, the company saw 3 CEOs change in less than 14 months. In August 2024, Mark Schneider was replaced with Laurent Freshy as Nestle CEO to rev up the company's performance. But Freshy was ousted less than a year later over an undisclosed personal relationship, and Philippe Navratil was then appointed CEO. Nestle's then chairman, Paul Bulke, too, first announced that he would retire in 2026, a year earlier than his scheduled retirement. But then he exited even earlier in September this year, and Pablo Ayala has taken over from the 1st of October. All against the backdrop of the company's worst growth in 2 decades, with volumes being flat or even declining and sales shrinking as well, and the boardroom losing patience quickly. Unilever also threw a curveball. CEO Heinz Schumacher was out in less than 2 years, and the company was looking to turn around, but the board wanted faster change, and they handed over the reins to CFO Fernando Fernandez, who has now taken over as the CEO. Diageo also has multiple faces that have occupied the corner office through 2025. In the middle of a multi-year cost-cutting reset, it saw CEO Deborah Crew step down. Nick Jangiani took over as interim chief, and now the firm is looking forward to welcoming Sir Dave Lewis as its new CEO in 2026, tasked with turning around the maker of Johnnie Walker, which has been plagued with declining sales and high debt. Even Coke and PepsiCo are both pivoting as they struggle to swallow weak beverage demand worldwide. Henry K. Brown, who worked at Coke in various leadership roles for 30 years, is now set to take over as the next CEO from March. Rival Pepsi is also in the throes of reorganization. It has elevated its North America CEO to a newly created EVP and vice chairman role, and it has appointed new CEOs, one for North America and one for Latin America Foods, and it soon also unveiled a new plan to accelerate sales and also improve margins. Now, in the global FMCG space, there's a clear pattern to the cause of this churn. Sluggish volumes, discretionary slowdown, rising competition, rising input costs, and geopolitical uncertainty. But most of it all, investor impatience. Boards and investors no longer want 5-year or 10-year plans. They want visible action, and they want it fast. 2025 has seen the FMCG world transform from slow, steady, and predictable to high-stakes, high-pressure battleground where even industry veterans can be shown the door if numbers don't impress. In today's FMCG boardrooms, the message is brutally simple: deliver growth or move aside.
Well, 2025 turning out to be a year of churn for the FMCG sector. Will 2026 beckon better days? With that, it is time for us to wrap up this edition of Rewind 2025. Here's wishing all of our viewers a very Merry Christmas and a very Happy New Year. Keep watching CNBC TV18. We promise to keep you updated on everything that matters to you. Stay with us. We're back after this break.
Welcome to News Centre. I'm Parikshat Luthra. Today on the show, we turn the spotlight on the intensifying debate around the Aravali Hills. Amid growing public outcry, the Indian government has moved to take control of the narrative. On Wednesday, it ordered a ban on any new general mining leases in and around the Aravali Hills, a range that stretches across Gujarat, Rajasthan, Haryana and Delhi. However, existing mining leases will continue unhindered. The government says the move is aimed at protecting the integrity of the Aravalis, but there's a catch. A narrowly tailored exception allows new mining for atomic, critical and strategic minerals. In addition, renewals too will be possible, subject to clearance by a multi-agency expert team. Environmentalists are not convinced. They warn that these exceptions could eventually open the floodgates for general mining, especially as the region may hold lithium, nickel, graphite and rare earth elements. What is particularly alarming is that the government's own committee has raised red flags. In October, the Ministry of Environment, Forest and Climate Change proposed a new 100-meter definition for the Aravali Hills before the Supreme Court. But the very next day, the Apex Court's panel on environmental concerns, Central Empowered Committee, comprising senior government officials, wrote to the court saying it had neither examined nor approved the proposal. The committee warned that if the 100-meter definition were accepted, all hills below that height would be opened up for mining, destroying the continuity and integrity of the Aravali range. The opposition has also stepped up attacks against the government on this matter. All right, to take this discussion forward, we're now joined by former Principal Secretary with the Government of Haryana, M.D. Sinha. We'll also be joined by independent forest policy analyst Chetan Agrawal. Thank you very much for joining us. Mr. Sinha, this is an issue we have been seeing, and this issue, in fact, Mr. Sinha, has been rejected by different committees. If we look at the centrally empowered committee itself, it wrote to the amicus saying that they never examined or approved this recommendation. The Geological Survey of India opposed this 100-meter rule as early as 2003. The Supreme Court also in 2010 had rejected this 100-meter definition. So how do you think the government went ahead and said there should be this 100-meter definition, and how did the Supreme Court go against its own orders?
See, the attempts to define the Aravalis have not been nothing new. In fact, what really happened 92 onwards, the policy and the legal framework orders by the Supreme Court of India and even orders by the government of India made non-ecological activities more and more difficult and stringent. That led to a lot of the mining and the real estate lobbies to examine how to get around the orders of the Supreme Court. The present definition, that 100 meters definition, was first put forward by Government of Rajasthan in 2006 and firmly rejected by the Apex Court in 2010. For 15 years, no judge touched it. And out of a sudden, out of the bolt, out of the sky, suddenly the government revives it, and a 100-meter definition is accepted in the court, in spite of the fact that no technical committee really supported it. The CEC, which is the advisory body of the Supreme Court, did not agree with it. The amicus did not agree with it. The committee appointed to look into it and come with a uniform decision was told to the court's words are that we need to save the precious Aravalis. Now, the report that the committee submitted is a mining report. It's not a conservation report.
That's an important point. Let me also get in Mr. Chetan at this point. Mr. Chetan, what is the danger with accepting this definition? Just 2 to 3 days back, the Ministry of Environment and Forest put out a clarification saying that Centre would protect entire Aravalis. No mining leases will be allowed. The protected zones to be expanded. But this was literally a reiteration of the Supreme Court's own order. The Supreme Court, while accepting the 100-meter definition, has said that no new mining leases will be allowed till a new sustainable mining development plan is developed and approved. What is the loophole that will be exploited in the years to come, especially with regard to critical mining?
So it's quite simple. Like Mr. Sinha said, from 2010 to 2025, the entire Aravali range, whether they're small hills or large hills, were all called Aravlis. They were legal Aravlis legally. So all the Supreme Court judgments, there are about 10 or 15 of them, which mention the word Aravali and say no mining in this part of the Aravali, no mining within 5 km buffer around Delhi, restrictions on mining in Gurgaon and Faridabad. The master plans, the Delhi master plan mentions, it restricts construction in the Aravlis, the Gurgaon, and for these plans and orders and laws basically hinge on the word Aravali. They're applicable on the Aravlis. However, yeah, are you still there?
Yes, sir. Please go ahead.
Yeah. However, with the new definition, you have a first class kind of Aravali hills which are more than 100 meters, and then you have a second class of non-Aravali hills which are less than 100 meters high, and so all the laws and the judgments will basically now be applicable only on the class 1 Aravalis, and the class 2 non-Aravalis will not apply that. And then if you look at the base contour and the whole hill, so there are no...
Mr. Agarwal, I'll just come to you. We're somehow losing your link. I'll get my team to make you join again. But let me go back to Mr. Sinha. Mr. Sinha, the government, when we heard the minister speak...
Let me just add to what you had said, that the government order banning Aravlis a few days ago, banning mining in Aravlis. See, governments don't, having been in the government for 35 years, I can tell you governments don't function on press notes. You have to back your order with a formal OM or an order. No such order has been issued. Minor minerals, which are the
And more importantly, it'll have to be in court. If you want to make something which has a legal bearing, it has to be made in court.
No, if the government is serious about it, they can issue a order under the EPA like they issued it in 1992, saying that there'll be no mining in the Aravlis. But minor minerals are state subject. So the order issued or the press note issue is meaningless. Issued by the government is actually meaningless.
I would ask you about the Richard Murphy rule that is being quoted by the Environment Minister. Now, this was a definition given in 1968. Landform classification under which hills are classified as a geomorphic class with local relief of more than 100 meters. The CEC, now this is when Rajasthan government had proposed the 100-meter definition. The centrally empowered committee had said at that time, while this works for broad classification, experts say it cannot be relied upon for a micro level and site-specific planning as required in the ecologically sensitive Aravali hills and ranges. What is the danger with accepting such a definition?
See, Richard Murphy in 1968 in his work, Landforms of the World, in fact, gave 3 kinds of classification. He classified structure as per 3. Topographical basis, which is the basis on which 100 meters has come out, then structural basis and formational basis. So I can very well classify the Aravlis using his classification into 3 types only. So in my view, it is a very perverse and selfish use of the classification system. In any case, the fundamental question you must ask, we all must ask, is why do you need to define the Aravlis? Have we defined, I keep saying this, are we going to define the Ganges? Are we going to define the Himalayas? Are we going to define the Nilgiris and the Eastern Ghats and the Western Ghats tomorrow? No, we are not going to do that. There is already a system very clear in vogue for the last 400 years. You go to any village, the villager will tell you, Gair Mumkin Pahad wo hai, Aravali hai. So the system of Gair Mumkin Pahad is well entered in the revenue records. The 1992 notification of the government itself recognizes it. There is no need to define the Aravlis, just as there is no need to define the Himalayas and all. It is very well recognized.
Right.
The ministry's committee itself says that there is complete conventional understanding on what constitutes the Aravlis within these 4 states. There is no need.
Okay.
It is just... Yeah.
Right. Let me get in a final question from Mr. Chetan Agarwal. He's now joining us on the phone. Mr. Agarwal, Could you give us a sense as to how in the last 20 years, how many committees would have rejected this 100-meter definition, so to say? And should the government actually make this centrally empowered committee's note, which the CEC had written to the amicus, saying that it did not approve or examine this recommendation of 100-meter definition, should the government make this note public?
So on the first question, basically there was no committee because the Supreme Court didn't accept the assertion of the Mining Department of Rajasthan and the government of Rajasthan in 2010. In their order of 19 February 2010, they noted the assertion of Rajasthan, that 100-meter definition, and then they said, but we want FSI to map the entire Aravallis, so it was rejected. And Rajasthan may have been sulking for 15 years till they got an opportunity again, but no one raised this issue again, except Rajasthan would keep saying that in our mining department view, this is not Aravalli, and when the FSI would be asked in the Supreme Court, any mining lease when they were doing this, FSI would say it's in the Aravallis, in the geological Aravallis, and that was it. So basically it's like, Mohammad Ghori attacking the Delhi, 70, trying again and again and again in the hope that it'll succeed. And so it seems like the mining and reality people think that, eventually they'll succeed and we hope that.
Okay. Mr. Agarwal, thank you so much for joining us, and I'd like to thank Mr. M.D. Sinha also for some very important views. So the Supreme Court in 2010 had rejected this definition. There have been at least 2 or 3 committees over the years which have rejected this 100-meter definition as well, including the centrally empowered committee of the government itself. Let's see what happens in this story in the days to come, whether the government makes a clarification in court, files another plea. There will definitely be people who will be petitioning the Supreme Court for action. Let's see what happens. Time for a short break here, but don't go anywhere. We put the spotlight on the India-US ties as envoys of both countries meet at Trump's Mar-a-Lago residence. Welcome back to News Center. Indian ambassador to the US, Vinay Quatra, met US ambassador designate to India, Sergio Gore, at President Donald Trump's Mar-a-Lago residence in Florida amid uncertainty over the conclusion of a trade deal. This was Quatra's first visit to Mar-a-Lago. Quatra revealed that he held extensive discussions with Gore on strengthening trade ties and priorities for the bilateral partnership. The meeting also comes as India continues to face 50% tariffs from the US. Gore is expected to arrive in New Delhi in mid-January. He will be assisted by North Korea diplomats at the US Embassy. Ministry of External Affairs spokesperson Randeep Jaiswal said that both governments continue to remain engaged with a view to conclude a fair, balanced and mutually beneficial trade agreement. US Deputy Ambassador for Trade Rick Schweitzer recently visited New Delhi. In a separate development, Indian origin US official Ricky Gill has received the Distinguished Action Award for his role in coordinating efforts during the India-Pakistan ceasefire this year. US Secretary of State Marco Rubio presented the award to him. Gill serves as Special Assistant to the US President and Senior Director for South and Central Asia at the National Security Council, overseeing India, Pakistan, Afghanistan and the broader South and Central Asia portfolio. The honour has been given to Gill even as India has maintained that no third party, including the United States, was involved in the ceasefire understanding. Gill previously served in the first Trump administration as Director for Russia and European Energy Security at the NSC and as Senior Advisor at the US State Department's Bureau of Overseas Building Operations. Joining me now to decode these developments is Ashok Malik, Senior Journalist and expert on Indo-US issues. He's also the head of the India operations for a leading US think tank, the Asia Group. Thank you very much, Mr. Malik. Let me begin by asking you about this meeting that took place at Mar-a-Lago. Do you think the fact that it took place at President Trump's residence in Florida is of some significance and may indicate that there may be some good news soon?
Thank you. Thank you for having me, Parikshit. I must clarify the Asia Group is a business consultancy, not a think tank. Having said that, look, obviously the significance of a meeting in Mar-a-Lago, the likelihood of maybe the president being around at some point is important. It's also the first visit of Ambassador Quatra there. It's also more important, one of the last occasions for the two men to talk about the relationship before Ambassador Gore comes to India. He's expected to land in India in the second week of January, which is not too long from now. And the hope here is that he will come with some good news, some indication as to what the US is thinking on both the sanction tariffs vis-a-vis Russia, which frankly need to be lifted. Nobody quite understands why they're there, and on what President Trump's thinking is on the trade deal. Now, no trade deal is done till it's done, and trade deals can always be negotiated and always be made better. But the point is a large amount of conversation, discussion, and negotiation has gone into the trade deal already. Much has been agreed upon. Both sides have placed their cards on the table. The working level negotiators are reasonably satisfied that they have enough to go ahead. The clearance needs to come from President Trump, as does clarity on what he plans to do with the sanction tariffs, the Russia-specific tariffs, which single out India. Hopefully there will be some clarity on that, and we'll know the way forward, because quite honestly, in India, the mood is beginning to get a little sour now. We waited long enough. If something doesn't happen quickly, I think India will just start diversifying and take the pain.
Right. Do you some way now believe that the deal might happen after Sergio Gore comes to India in January?
Well, Sergio Gore has to come to India with some news, some advance. He can't come to India, I'm presuming, he can't come to India or can't be sent to India with no good news or no advance. So is that good news on the trade deal? Is that good news on the Russia-specific tariffs, which India has been singled out for? Is that good news on both? That remains a guess, and that remains a subject to speculation. But quite honestly, there is no earthly reason for President Trump not to move positively on both the Russia tariffs, the Russia-specific tariffs, and the trade deal.
Mr. Malik, do you believe that This is the biggest olive branch we've extended so far in the form of the Shanti Bill, whereby the nuclear liability has been capped, 49% FDI has been opened up, private companies can now invest. This was something that India and US were engaging for almost the last 20 years. Liability was a big issue. So do you think that this was like the final thing that India could offer to the US?
No, look, there's no such thing as a final offer. The fact is we needed to do this, the Shanti Act and the overhaul of our nuclear liability law for our own reasons, because the law that was put in place in 2010 by Parliament was unviable. It made nuclear commerce with not just the US, but with any other country as well, with, for example, Canada or maybe Australia or any other country. It made it unviable.
Right.
So we needed to do this for ourselves, and everyone recognized that. Okay. I think the government recognized it, the opposition recognized it, the opposition, when in government, recognized it, everybody recognized it. So this needed to be done for India's sake, and as kudos to the Prime Minister and the government for finding the political capital to just go ahead and do it. Now,
right.
Is the US happy with this new act? Yes, it is. But quite honestly, this also points to the opportunity that awaits US companies in India should we go ahead with reasonable economic engagement and with the trade deal. Why just the nuclear act? I mean, if you look at, we've signed a trade deal with the UK. They will be selling scotch in India. But bourbon will face higher tariffs unless there is a trade deal. I'm just giving another example, completely unrelated to nuclear. But the fact is, these are opportunities awaiting any partner who signs a deal with India. And the US is missing out as well.
Absolutely. And as you said, that the mood in New Delhi is turning sour, and it will become worse if we don't get a deal by end January. I would also like to ask you about the award for Ricky Gill. The US State Department has recognized his contribution in the India-Pakistan ceasefire. How do you see this? This is almost one, Donald Trump had taken credit for it, but now you're actually awarding an official in the Trump administration for this.
Look, a few things here. Ricky Gill works in the National Security Council. As far as I know, Secretary of State Rubio, along with the foreign ministers of Saudi Arabia and the UAE, was in touch with the Indian foreign minister. Vice President Vance also spoke to Prime Minister Modi in that period. I don't think the NSC as an institution was that engaged. And I don't think a peace initiative would have been worked out at that level, to be honest. So I think India's position remains valid. Second, I looked at the details of the citation. I believe the award has been given for internal coordination, which is something within the US system. It's maybe Ricky Gill contributed to smoothing the communication within the US system, for which, of course, he much deserves the award in that case. But to suggest that he was in any way responsible, or the US system was in any way responsible for effecting a ceasefire and trying to bring about a cessation of hostilities during Operation Sindoor would be a bit much.
All right. Thank you very much, Mr. Malik, for joining us on the program, giving us your views on the important meeting between Ambassador Vinay Quatra and Ambassador Sergio Gore in Mar-a-Lago. Let's hope we have a trade deal soon and there is good news for Indian exporters. That's all we have time for here on News Center. Goodbye and thanks for watching.
Hello and welcome to Rewind 2025. I'm Shireen Bhan. Now, this has been a productive year for the government. In all, 28 bills were introduced in Parliament, ranging from a new employment guarantee scheme for rural India to tweaking the rules for foreign direct investment in insurance to laws revising the duties applicable on tobacco. Sapna Das looks back at some of the key laws that were aimed at keeping the reform agenda going and reports that 2026 is likely to see this exercise being taken forward. Take a look.
2025's winter session of Parliament has probably been one of the most productive in recent history. Lok Sabha saw productivity at 111% and Rajya Sabha 121%. In just 19 days of the session, 5 new bills became law, while 1 more bill was referred to a parliamentary panel. Of these 6, at least 3 are reform-oriented: the Nuclear Energy Bill, the Bill to amend insurance laws, and the Securities Markets Code. The laws supporting the overhaul of the Goods and Services Tax were also passed in this session. And then there was a new Rural Employment Guarantee Scheme, which caused quite a stir in the House. The bill goes beyond amending the 20-year-old UPA-era flagship Manrega of 2005. The new bill increases the guarantee of employment to rural households from 100 days to 125 days in a year. However, it shifts a portion of the cost onto state governments, 40% against the earlier 0%. Cosmetically, the government has changed the name of the scheme by dropping Mahatma Gandhi's name from it. None of this sat well with the opposition or experts.
हर योजना का नाम बदलने की जो सनक है ये समझ में नहीं आती है सर जब ये किया जाता है तो सरकार केंद्र को पैसे खर्चने पड़ते हैं बिना इस सदन की सलाह लिए इस तरह से जल्दी में विधेयक को पास नहीं होना चाहिए सर ये विधेयक वापस लिया जाना चाहिए
The G bill, which says that 60% for most of the country, barring northeastern states and hill states and union territories, the new bill says that 40% of the money will have to come, even for labor component, from the states. Now, there is no reason that the states may want to do this. And in fact, in trying to bring the 60 and 40 together, most parts of the country, the sufferer will be the worker who during every time of economic distress, and those distressed workers who find themselves looking for alternative employment will be unable to get any kind of guarantee. As it is, it's been very difficult because of lack of allocation.
But the government stood firm.
महात्मा गांधी स्वयं राम राज्य की स्थापना की बात करते थे और उनके अंतिम शब्द भी हे राम थे
And the bill was pushed through with just 5 hours notice.
जो सदस्य जिसके पक्ष में आ गए जो सदस्य विरोध में ना गए मेरे विचार में निर्णय हाँ वालों के पक्षवा विधेयक पर विचार करने के प्रस्ताव को स्वीकृत किया.
The other big-ticket change came in the foreign direct investment rules. This was driven by 2 bills. The Sabka Bima, Sabki Raksha Amendment of Insurance Laws Bill 2025 and the Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India Bill 2025. The Shanti Bill allows up to 49% FDI in the nuclear energy sector. It also allows private players through joint ventures to build, own and operate nuclear plants while the government retains control over core functions. The amendments to the insurance law now permit 100% direct investment by insurance majors. Now, realistically, while only 4 of the 74 players in the insurance space are at 74% FDI, the government views allowing 100% FDI as an enabler for global majors to set up shop without shopping for an Indian partner.
We have heard a lot of these FDI people who want to come into this country searching for a partner, joint venture partner. It's a mammoth effort. Now, by doing this, we are able to bring them to the country directly, of course, with all the Indian laws which are passed by this parliament.
Market regulators Committee on Finance. But the surprise this year came for India's growing workforce, including gig workers. The centre rolled out the 4 labour codes effective the 21st of November. Key features include mandatory issuance of appointment letters for all workers, making minimum wages a statutory right, cutting the period for eligibility for gratuity for fixed-term employees to 1 year, and double wages for overtime. The frenetic activity in the winter session has made 2025 a highly productive year for the government. But the government's reforms agenda is far from complete. 2026 will see it not only taking up pending bills that have been sent to select and standing committees, but pushing to implement the laws passed in 2025, like the new Rural Employment Guarantee Law. In New Delhi, Sapna Das.
And of course, 2026 will start with the budget session and the presentation of the budget, courtesy Finance Minister Nirmala Sitharaman. Well, the year 2025 marked a defining moment in India's fight against terrorism. After a horrific terror attack in Kashmir's Pahalgam, India responded with resolve, precision and restraint. On Rewind 2025, Santiagora reports how India made clear its zero-tolerance policy towards terrorism through one of its most decisive operations, Operation Sindoor.
On the 22nd of April, 4 men the Indian authorities later identified as Pakistan-backed terrorists killed 26 tourists in Kashmir's Pahalgam. The massacre shocked the nation. On the 7th of May, India retaliated with Operation Sindoor, a precise, restrained and non-escalatory strike on terror infrastructure in Pakistan and Pakistan-occupied Kashmir.
इस कार्रवाई में 9 टेररिस्ट कैंप्स को टारगेट किया गया और पूरी तरह से इसे बर्बाद किया गया।
The terror bases were identified as belonging to Lashkar-e-Taiba and Jaish-e-Mohammed. 5 of these were in Pak-occupied Kashmir and 4 were in Pakistan, including base camps located in Muridke and Bahawalpur. Among them was Markaz Taiba in Muridke, where intelligence said all the terrorists involved in the 26/11 Mumbai attacks were trained. The government says the exercise resulted in the death of around 100 terrorists. Despite India's restraint, Pakistan escalated the situation. It targeted civilian and military installations along India's border with drones and shelling. Amritsar, the Poonch sector, and border areas in Rajasthan were a few of the regions that came under attack. India struck back.
Following these relentless attacks on our air bases, on our forward positions, and on our civilian targets, this was time to convey some message to our adversaries. And therefore, a decision was taken to strike where it would hurt.
India's counter-offensive struck 11 Pakistani military establishments, including Noor Khan, Sargodha, Bhulari and Skardu, destroying ammunition depots and crippling key air bases. The Indian government claims the strikes destroyed nearly 20% of the Pakistani Air Force's infrastructure. The Indian Navy also remained fully prepared. Less than 3 days later, on the 10th of May, Pakistan sought a ceasefire.
The offensive deployment and posturing of the Navy also included a series of successful weapon firings in April and forced the Pakistani Navy to remain close to its own coast. In fact, the threat of offensive action by the Indian Navy could be considered one of the important factors in Pakistan requesting for a ceasefire.
But reports of ceasefire violations by Pakistan's ground troops kept coming in. India made it clear that any further breach would invite fierce retaliation. Parallelly, India also took diplomatic steps to get Pakistan to cease and desist. The Indus Water Treaty was terminated, the Atari-Wagha border was shut, and bilateral trade was suspended. While the Director Generals of Military Operations of India and Pakistan spoke to each other on firming up the terms of the ceasefire, US President Donald Trump claimed he had stopped the war, something he has repeated multiple times since.
The Prime Minister of Pakistan called me, thank you very much. He actually said, President Trump saved millions and millions of lives. And I got a call from Prime Minister Modi saying, we're done. I said, you're done with what? We're not going to go to war. I said, thank you very much. Let's make a deal.
This is a claim India has categorically denied multiple times. It also maintains that the ceasefire decision was a bilateral one driven solely by military and strategic considerations and that Pakistan called for it. India has also countered Pakistan's misinformation campaign, debunking false narratives in real time. For instance, Pakistan claimed victory in the standoff, saying it shot down 6 aircraft of the Indian Air Force. India has refuted both these claims. To reinforce its zero-tolerance policy towards terrorism, India sent 7 all-party delegations worldwide to convey a unified message against terrorism. The trading of fire may be in abeyance, but tensions are not. Pakistani airspace, which was close to Indian aircraft when Operation Sindoor was carried out, remains shut to this day. So too, Indian airspace to Pakistani aircraft. The Indus Water Treaty remains suspended despite Pakistan protesting the move in international fora.
Well, one of the most significant moments of 2025, Operation Sindoor. Up next on the show, real estate investment trusts are ready for takeoff after a landmark year. More on REITs in 2025 when we return. Well, 2025 was a pivotal year for the cement industry, which saw significant consolidation, but growth in demand could not keep pace with the expansion in capacity. Will 2026 bring good tidings for the cement industry? Nigel is here to find out. Nigel.
2026 could be a crucial year for the cement sector. The big question is whether the early green shoots in demand will strengthen or they'll fade away. Well, cement demand remained weak during October and November 2025, and growth during these 2 months was roughly around 6 to around 6.5% on a year-on-year basis. This compares with around 5.5 to around 6% growth that we saw in the first half of the fiscal. The slowdown was driven by three big factors. First, the sluggish government capital expenditure. Second, labour migration linked to the Bihar elections. And third, there were curbs on construction activity, particularly in the NCR region, due to the pollution-related restrictions. Birla Corp spoke to us here on CNBC-TV18, and they said that while demand was sluggish in October and November, early signs of improvement have started to emerge in December. The street is hopeful that demand will see an uptick in the fourth quarter of this fiscal that could be supported by higher government spending. Well, there was some pricing discipline and prices remained resilient between April to August 2025. However, the average pan-India prices declined by around 2 to around 2.5% in October as well as November. That compares with the average pricing that we saw in the second quarter of the fiscal. The impact was sharper in the non-trade segment, with prices falling by roughly around 15 to around 20 rupees per bag across regions, while trade pricing was softer by close to around 5 rupees per bag. The question now is whether a meaningful price hike can only be absorbed post the quarter 4 FY26. Well, consolidation in the sector appears to be largely behind us. The top 5 players account for around 62% of the industry, up from around 51% in 2020, and the share could rise to around 65% by 2028. However, the challenge is that the recently acquired assets are getting ramped up, which could lead to additional supply. In fact, the supply risk continues as capacity additions are expected to grow at a CAGR of around 7.5 to around 8%. While demand growth could be in the vicinity of around 6.5 to around 7%. This suggests that utilization levels will stay sub 70% for a prolonged period. And as large players continue to chase market share, mid-cap regional players may face greater pressure on pricing as well as on profitability. According to DAM Capital, large cement players are better positioned due to their diversified regional presence, the ability to gain market share without significantly affecting their profitability, and capacity to sustain capex momentum. They expect competitive intensity to remain elevated, benefiting large players over the medium term. Well, let's wind this down with a valuation snapshot of all our listed players. So 2026 is shaping up to be yet another important year for cement stocks. Whether green shoots on the demand front they blossom or they wither away, that will depend on the pace of the government spending, pricing discipline, and how supply additions are absorbed.
Well, the outlook for India's cement sector, and let's now talk about India's real estate sector. India's real estate investment trust segment has gained visibility after its 5th listing in 2025 and a slew of reforms that were announced. Sonal is here to decode what is the next phase of growth for REITs in India. Sonal.
One of the notable trends in 2025 is the increased focus on REITs. This year, India saw its 5th REIT list on the stock exchanges, a small number globally, but a big milestone for a market that only began its REIT journey in 2014. Let's zoom out. The US launched REITs in 1960, Australia in 1971, Japan, Singapore and Hong Kong followed in the early 2000s. Today, while the US boasts 196 listed REITs and a market cap of $1.4 trillion, Japan has around 57. We have Singapore with 39 REITs. Australia has 32 REITs right now worth $126 billion and Hong Kong has 11. Where does India stand? India stands at 5 REITs with a market cap of about $18 billion. REITs are like mutual funds, where the underlying is real estate where they acquire, own, manage or finance income-generating real estate. In India, this real estate would be offices, malls, warehouses. 5 listed REITs in the country are Embassy Office Parks REIT, Mindspace Business Parks REIT, Brookfield India REIT, Nexus Select Trust REIT and Knowledge Trust REIT. Remember 2024? That's when the holding period for capital gains was cut from 36 months to 12 months, the first major nudge towards REITs. But in 2025, SEBI officially reclassified REITs as equities, aligning India with global practice. This will be applicable from Jan 2026. But why does that really matter? Because it has the potential to unlock institutional money. Mutual funds today have roughly 23,000 crore rupees in REITs, barely a drop in an 80 lakh crore industry. Funds can invest up to 10% of NAV in REITs, but the current allocation doesn't even touch 1%. Most exposure is still sitting inside debt and hybrid categories. Equity funds barely touch 2%. This reclassification is expected to reshape that in 2026 and beyond, improving liquidity and making REITs a mainstream asset class for Indian investors. In fact, there were tax sweeteners too for this asset class. Dividends and rental income from REITs remain exempt in the hands of investors, provided underlying SPVs pay corporate tax. And according to Anirok, if we talk about some more numbers for REITs, Indian REITs delivered distribution yields of 6 to 7%, comfortably above the global benchmark of 4 to 5%. Capital appreciation, because basically that is the rise in prices, stood at 3 to 5%, again higher than international peers. Although vacancy levels, they stayed elevated at 10 to 16%. On the ground, India continued to build. As of October 2025, over 23 million square feet of new Grade A office space was under construction, and Global Capability Centers, or the GCCs, drove 28 to 29% of gross leasing, reinforcing India's position as a global office hub. The market is now projected to cross $30 billion in the coming years, and also a lot of other impact that we'll see because of the regulations. And 2025 also saw early traction in small and medium REITs, introduced last year, allowing fractional ownership of real estate between 50 and 500 crore rupees. CBRE estimates that this space could surpass $75 billion with nearly 500 million square feet of eligible commercial assets across offices, retail and logistics. So now, maybe the question will be, how fast will this market grow? And not if we will see more traction in REITs in India.
Well, 2025, a big year for REITs. But with that, it is time for us to wrap up this edition of Rewind. Of course, do stay tuned to CNBC-TV18 as we bring you all the latest on what the new year holds for the capital markets and, of course, for a whole bunch of sectors. For now, from all of us here, thanks very much for watching. Here's wishing all our viewers a very happy new year. Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty snap a 3-week losing streak despite declining on Friday. The rupee weakens against the dollar as it moves towards the 90 mark once again. Quick commerce company Zepto to file its draft IPO papers confidentially today. Sources say a listing is likely by September quarter next fiscal. Hopes to raise around 11,000 crore rupees. IT firm Coforge in talks to acquire digital engineering company Encora for an enterprise value of $2 billion. Sources say the deal could mark the exit of private equity firm Advent from Encora. Coforge's board meets today to discuss a fundraise proposal. The union government opposes a petition before the Delhi High Court seeking GST reduction on air purifiers. The government calls the petition motivated, and bypassing the GST Council would open a Pandora's box. The court seeks a detailed government response in the next 10 days. Tata Steel faces a compensation claim worth $1.6 billion in Netherlands. A Dutch NGO is seeking damages alleging health impact from harmful emissions. Company says the claim is speculative and without any basis. Titan enters the lab-grown diamond segment with a new brand called Beyond. The first retail store will open in Mumbai next week. The government's top auditor finds lapses in the rural electrification drive. The CAG report says only 66% of households have received power supply, contrary to the government's claims of 100% success. Also finds several gaps, including financial mismanagement.
I have a plan for the people of my country, for my country.
BNP leader Tariq Rahman returns to Bangladesh after a self-imposed exile of 17 years, receives a massive reception in Dhaka. The Bangladesh government quashes allegations of a communal angle after a Hindu man was lynched in Rajbari, says the deceased was a history cheater who had entered the area with the intent of collecting extortion money. The US launches deadly airstrikes against the Islamic State militants in Nigeria for allegedly targeting Christians. US Defense Secretary Pete Hegseth thanks the Nigerian government for cooperation, but the Nigerian government rejects the US assertions as militants target both Muslims and Christians. Well, let's begin with the market action for the day. The Christmas hangover on Dalal Street. The Sensex down by over 360 points and the Nifty lost nearly 100 points in what turned out to be a fairly tepid session of trade today. So finally closing at 85,041. That's the Sensex. The Nifty down 100 points. The Nifty mid-cap down 130 points and 170-point cut there for the Nifty Bank. The Nifty is now below its 20-day move-ring average. But if you look at the picture for the week, the Nifty has managed to gain 0.5%, snapping a 3-week losing streak. And metal stocks were among the top performers this week. The Nifty Metal Index up 3% and a flat close there for the Nifty Bank. That's underperformed and closing in the red for the third straight week. But from the stock markets, the money market action, the rupee weakened marginally against the dollar. The rupee is now within striking distance of the 90 mark against the greenback, and the 10-year bonds declining in trade today and the yields hardened. This comes after bond prices rallied for the last few days after the RBI announced a 2 lakh crore rupee bond buying program and a $10 billion forex swap. In the commodity market, oil prices spiked after the U.S. stepped up pressure on Venezuelan oil shipments and carried out airstrikes against the Islamic State militants in northwest Nigeria in coordination with authorities. President Trump called the operation in Nigeria a defensive response to vicious attacks on innocent Christians in the African country. Both Venezuela and Nigeria are major oil producers, and America's offensive has raised concerns over potential supply disruptions. Meanwhile, there's no stopping the gold rush. The yellow metal, along with silver, scaling new records. Silver prices have surged by 158% so far this year, significantly outperforming even gold. Well, let's talk about the big corporate stories of the day. Quick commerce startup Zepto is all set to file its draft red herring prospectus via the confidential route. We learn from sources the company is aiming for a public listing in the second quarter of the next financial year. Zepto plans to raise about 11,000 crore rupees through a mix of fresh equity and an offer for sale. Rachna is standing by. Rachna, give us a sense of how Zepto's financials stack up and the valuations it is looking at.
Well, after a delay of nearly a year, Zepto is now set to confidentially file its draft IPO papers. Now, this is according to people familiar with the matter. The company is targeting a public listing in the July-September quarter of 2026 and plans to raise around 11,000 crore rupees or about $1.3 billion. This will be through a mix of fresh equity and an offer for sale. The timing is significant both for Zepto and for India's fast-maturing quick commerce sector. But let's start with the numbers. Zepto's revenue growth has been sharp. FY25 revenue revenue more than doubled to 11,109 crore rupees from 4,498 crore rupees in FY24. But losses have also widened alongside expansion. Net losses rose to 3,367 crore rupees in FY26 from 1,249 crore rupees from a year earlier. Now, the company was last valued at $7 billion in a private round in October 2025. A public listing would place Zepto alongside rivals such as Blinkit and Swiggy at a time when investors are far more focused on profitability and execution than growth alone. Ahead of the IPO, a key strategic shift has been the effort to Indianize the cap table. In January 2025, Zepto completed a reverse flip, moving its domicile from Singapore back to India, which is a pretty standard move. But since then, it has worked towards raising domestic ownership, largely through secondary share sales. That's how Motilal Oswal and its founders buy shares about $50 million and then one more of about $50 million in their personal capacity. But that may not have been enough because Zepto did continue to attract global capital, including a $450 million round led by US-based pension fund CalPERS in October 2025. So clearly the plan to Indianize did not materialize well. But Zepto's origins trace back to Y Combinator when the accelerator invested in 2021. That, and with later investors, the company scaled rapidly and became India's first unicorn of 2023, ending a prolonged funding slowdown, if you remember then. But scale also brought scrutiny. In late 2025, the Central Consumer Protection Authority fined Zepto for using dark patterns such as drip pricing and basket sneaking. Earlier in 2025, a Maharashtra FDA inspection led to a temporary suspension of a warehouse in Mumbai's Dharavi, but that was an isolated case. Now, as per the reports, the company also laid off over 500 employees last year as a part of cost control measures. Despite all of this, user momentum remains strong. According to data from CLSA, Zepto added 1.2 million weekly active users in the week of December 15, the highest among quick commerce players. That said, Blinkit still continues to lead on downloads. So how public market investors weigh growth, losses, governance and competition will ultimately determine how this IPO plays out, and we will keep a close eye.
Okay, that's Zepto heading to Dalal Street. But Rachna, hang in there. I'm going to come back to you. Let's talk about the other story that you're tracking, which is Coforge. It is in talks to acquire digital engineering firm Encora for an enterprise value of $2 billion. What could this deal mean, Rachna, for Coforge's growth strategy?
Right. Sources have told us that Coforge is in advanced talks to acquire a stake in Encora in a transaction that could go up to $2 billion. Now, the deal would mark a potential exit for private equity major Advent International, which currently holds a majority stake in the company. But to put this in context, Advent entered Encora in 2021, acquiring the company from Warburg Pincus at a valuation of about $1.5 billion. Warburg had backed Encora during its earlier phase of expansion, helping build scale in offshore delivery and deepen its US enterprise client base before selling out to Advent as the company transitioned into a more mature digital engineering platform. Now, Encora operates squarely in the digital engineering and product development space. Its core strengths lie in cloud-native application development, data engineering, platform modernization, and enterprise software services with a strong clientele in North America. Over the last few years, under Advent's ownership, Encora expanded both organically and through acquisitions, positioning itself as a high-growth engineering-led alternative to traditional IT outsourcing firms. For Coforge, though, it would definitely be a transformational transaction, but an ambitious one, because the company has historically been a mid-sized IT services player with strength in BFSI and travel tech as we know it, but limited exposure to deep product engineering. And that's where Encora would significantly shift that mix for Coforge. But as of March 2025, Coforge reported a net cash flow of around 474 crore rupees, cash and reserves of roughly 600 crore rupees. That balance sheet may provide flexibility, but it's not enough to fund a $2 billion deal outright. And as a result, Coforge's board is expected to consider a fundraise, potentially combining debt and equity to support this acquisition, is what we're learning from our sources. The call with the investors is scheduled for 5:30 p.m. So we will be looking out for management commentary.
Yes, we certainly will. Rachna, many thanks for joining us. Let's look at the other headlines we're tracking this evening. A CNBC-TV18 News break confirmed Japanese building materials giant Aika Koyo will acquire at least 40% stake in laminate sheet manufacturer Stylum Industries for about 1,500 crore rupees. This deal marks another high-value Japanese FDI in India, following investments in Yes Bank and Shriram Finance this year. Shares of Castrol India gained after a consortium led by Stone Peak announced an open offer to acquire additional 26% stake in the lubricant maker. The offer price is set at 194 rupees a share, which is at a 2% premium to Wednesday's closing price. Earlier this week, BP agreed to sell 65% stake in the parent company Castrol to Stone Peak at an enterprise value of $10 billion. Colgate-Palmolive is facing a tax demand of about 270 crore rupees for financial year 2022 from the IT department. The company said the order pertains to adjustments around intercompany pricing and disallowance of certain expenses. Colgate added that the demand does not impact its operations and financials. However, it will appeal against the order before the tax tribunal. A Dutch organization is seeking compensation of $1.6 billion from Tata Steel's Netherlands subsidiary. The NGO alleges potential health impact from harmful emissions at Tata Steel's plant and claims that property values have underperformed compared to other regions. Tata Steel described the claims as speculative and without basis. The company also highlighted its investments to improve environmental standards and community health in the region. WeWork CEO Karan Virwani says that service expectations are evolving as companies increasingly adopt hybrid work models. In an interview with me, Virwani highlighted opportunities beyond workspace, noting that a 1% increase in revenue on account of value-added services can significantly boost the bottom line. Take a look.
We think that there's opportunities above workspace that we can build, partner, or position ourselves to be able to cater to these companies. If you're building tech, managing transport, let's say for your employees, or food for your employees, or employee experience for employees, those are still not core to what you do. You end up having to hire teams, build teams around it. Could you just outsource that to someone like us who's anyway managing your workspace? From roughly about 14-15% of our revenue, even if it moves up 1 or 2%, at this base of revenue that we have, it's really it almost all flows down to the bottom line. It's high margin type of revenues that we see.
Well, that's Karan Virwani of WeWork India. Now, Indigo has started issuing vouchers worth 10,000 rupees to passengers who were affected by flight disruptions between the 3rd of December and the 5th of December when those massive disruptions took place. According to the airline, these vouchers can be redeemed on any Indigo flight booked within the next 12 months. If all passengers avail of the vouchers, the airline could face an estimated cost of over 500 crore rupees. Indigo is yet to disburse cash compensation mandated under the DGCA guidelines for impacted travellers. Titan hit a fresh 52-week high after the firm announced its foray into the lab-grown diamond space. Mangalam is standing by with the details on what this means for the company and the industry. Lab-grown diamonds, Mangalam, we saw that big inflection point in 2025, and now Titan on that bandwagon as well.
Well, it's a sparkling development that is taking place at Titan, and by sparkling I mean they have announced for the first time their foray into lab-grown diamonds. Yes, the management has been speaking about it in the past, saying that they've been observing this trend, whether they want to get into it or not, they won't announce their plans publicly, etc. Then there were a few murmurs that they've gone ahead and trademarked the brand Beyond for their lab-grown foray, and then the analysts were worried whether trademarking the brand immediately means a launch or not, etc. The company's gone ahead and now set the record straight. Titan will enter the lab-grown jewelry space, and the first store opens as recently or as in the near future as 29th December. So Beyond, from the house of Titan, which is their lab-grown foray, will have their first exclusive retail store in Mumbai on the 29th of December. It will offer a curated range of lab-grown diamond jewelry, will cater to the adornment needs of women in lifestyle categories. And this understandably is one of those repurposed stores from Carrot Lane. So looking at adornment jewelry, a lot more affordable than natural diamonds. So they do not want to, cannibalize the demand that they get for natural diamond jewelry itself. They also plan to add a couple of more stores in Mumbai and Delhi in the immediate near future. Again, this is a seminal moment from the jewelry industry standpoint, because the first time a large-scale, organization has announced its formal foray into the lab-grown diamond space. So the impact of this is something we will monitor over the next few years, not immediately, but this is just an important inflection point.
All right, Mangala, many thanks for joining us. That's Titan moving into the lab-grown diamond space. Air pollution continues to choke large parts of North India. In Delhi, the AQI improved marginally but remains in the very poor category. Air quality in cities like Gorakhpur, Panipat and Amritsar in the hazardous category with pollution more than 30 times the standard levels. In Mumbai, work has been halted at the bullet train project site in BKC after the Bombay High Court flagged widespread violation of pollution control measures. Air quality in Mumbai at unhealthy levels. Now, the centre has opposed a plea in the Delhi High Court that called for classifying air purifiers as medical devices amidst the deteriorating air quality in Delhi. Ashmit joins us now with more. Ashmit, the court saying, give us your rationale for opposing this move, and the centre essentially saying that this is up to the GST Council, and moving on this front could, in fact, in the words of the centre, open up the Pandora's box. Explain this to us.
Well, indeed, the centre is not one bit happy as far as this PIL is concerned. In fact, questioning why this question of reducing the GST on air purifiers was not raised before the government and is coming by way of a PIL, in fact, hinting that this could perhaps be even motivated. But the broad heart of what the centre's opposition essentially is that, look, it's not happy with the fact that GST Council is being asked through this PIL for cutting the rates. What the government essentially argued is that there is a mechanism in place. There is a constitutional mechanism in place. The GST Council is the only and the final authority which has the say as far as deciding on the rates is concerned. That the parliamentary committee has made a recommendation to that end of cutting the rate on air purifiers from 18% GST to 5%, and that is an issue that will be laid before the GST Council meeting. That there is no urgent meeting that is being called, but in due course, when the meeting does come up, this is an issue that will be taken up for consideration. The centre saying that, look, we're not saying one way or the other whether or not the rates will be cut, but only saying that there is a formal process to be followed, which is the GST Council, and that should be respected. But to that end, the Delhi High Court taking note of this submission being made by the centre, but nonetheless nudging the centre to come back with a formal response on what the stance is of the central government as far as slashing the GST rates from 18 to 5% on air purifiers. Around 10 days have been given to the centre. The next hearing in this case, we understand, will be on January 9th.
All right, Ashmit, many thanks for joining us. The Indian Medical Association has opposed the Andhra Pradesh government's move to allow postgraduate Ayurveda doctors to perform certain surgical procedures. IMA's president, Dr. Dilip Bhanushali, has called the move a huge blunder and said it will create many problems for patients. Dr. Bhanushali also questioned why Ayurveda should be mixed with modern medicine. The association will be submitting a memorandum to raise its objections in this case. Up next, government's top auditor finds lapses in the rural electrification drive. The CAG reports as only 66% of households have received power supply, contrary to the government's claims of 100% success. Details when we return. Well, here's the latest in Bangladesh. Former Prime Minister Khaleda Zia's son Tariq Rahman has returned to the country after spending 17 years in self-imposed exile. Rahman was living in London since he fled Bangladesh in 2008 over what he called politically motivated persecution. His return comes as his mother remains unwell. Rahman, along with his wife and daughter, received a rousing welcome with thousands of Bangladesh National Party supporters flocking the roads leading to the Dhaka airport. Upon landing, Rahman thanked the interim government head Mohammad Yunus in a phone call for ensuring adequate security arrangements. The 60-year-old also addressed a public rally with senior BNP leaders present on stage. He invoked Martin Luther King, saying he has a plan for the people of his country. Rahman is widely seen as the prime ministerial frontrunner in the general elections set to take place in February of 2026. Meanwhile, the Bangladesh government has quashed allegations of a communal angle after a Hindu man was lynched in Rajbari. It said the deceased was a history cheater who had entered the area with the intent of collecting extortion money. This is the second such reported incident. Days after Deepu Das, a Hindu man, was lynched over alleged blasphemy, India's Ministry of External Affairs has said that over 2,900 incidents of violence against minorities, including cases of killings, arson, land grab, have been documented by independent sources during the tenure of the interim government of Bangladesh, which started in August last year. The Indian ambassador to the US, Vinay Quatra, met US ambassador-designate to India, Sergio Gore, at President Trump's residence Mar-a-Lago in Florida amidst uncertainty over the conclusion of a trade deal. Quatra revealed that extensive discussions were held on strengthening trade ties and priorities for the bilateral partnership. Gore expected to arrive in New Delhi in middle of January. He will be assisted by non-Korea diplomats at the US Embassy. Indian origin US official Ricky Gill has received the Distinguished Action Award for his role in coordinating efforts during the India-Pakistan ceasefire this year. US Secretary of State Marco Rubio presented the award to him despite India denying any third-party mediation. Gill serves as Special Assistant to President Trump and Senior Director for South and Central Asia at the National Security Council. India's External Affairs Ministry has responded to issues faced by H-1B visa holders. The US government has tightened the visa conditions, and the holiday season is turning out to be a nightmare for many after visa appointments were delayed for several months. The MEA spokesperson says the issues have been flagged with the US. It's hopeful that disruptions will be addressed shortly.
While we do understand, as you also understand, that visa-related issues pertain to the sovereign domain of any country, we have flagged these issues and our concerns of our nationals to the US side, both here in New Delhi and in Washington, D.C. And we hope that these delays and these disruptions will be addressed.
Well, that's the MEA on the H-1B visa delay. Now, the government's top auditor has found significant gaps in the government's rural electrification program. A CAG report also questions the government's claim of 100% rural electrification and finds several shortcomings, including financial mismanagement. Santya is here with more from what the CAG has had to say. Santya.
So yes, Shireen, the CAG audit report has raised serious questions about the government's claim of 100% rural electrification under two flagship schemes, Deen Dayal Upadhyay Gram Jyoti Yojana and Pradhan Mantri Sehaj Bijli Har Ghar Yojana, also known as Saubhagya. While official dashboards declared full completion by March 2019, the audit shows that the ground reality was very different. Under Saubhagya, about 300 lakh unelectrified households were to be covered. But by the deadline, only around 152 lakh households had actually been electrified, just over half the target. Even by March 2022, the figure rose only to about 174 lakh households, which amounts to over 66% of households. The report also highlights that 25 states claimed 100% achievement, even as 7 states still reported over 19 lakh unelectrified households at the same time. In rural India, more than 4 crore households were to be electrified by 2019, along with an additional 19 lakh households. However, only about 2.9 crore households were actually electrified by the deadline. The CAG report points out that despite spending tens of thousands of crores, problems of inadequate and unreliable power supply continue in rural areas due to weak distribution networks. The audit also flags serious financial irregularities. Shireen, in 2 states, over 16,000 households received connections under both Deen Dayal and Saubhagya scheme, leading to duplicate claims by contractors. In other cases, payments were released without ensuring completion of work, resulting in double payments amounting to over 2 crore rupees. State-wise discrepancies have also been flagged. In Uttar Pradesh, for instance, full electrification was declared in 2019, but the audit found that less than half of the identified households were actually electrified. The CAG report further notes that delays were widespread. More than 80% of projects under Deen Dayal scheme were awarded late and over 90% were completed with delays, many running more than 2 years behind schedule. The bottom line from the audit is, Shireen, that despite ambitious targets and claims of success, rural electrification under Deen Dayal and Saubhagya schemes remain incomplete, with gaps in execution and monitoring.
Santya, many thanks for joining us. That's the latest there from the CAG on those two schemes. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. We've got plenty more lined up for you, so stay tuned. We're back in a minute with more. Hello and welcome to Startup Street. I'm Arundhati Ramanan and these are the top headlines from the startup world. Quick commerce company Zepto likely to file its draft IPO papers confidentially today. Sources say a listing is likely by September quarter next fiscal, hopes to raise around 11,000 crore rupees. Temasek-backed consumer appliances maker Atomberg, which is chalking out plans for a $200 million IPO, reported a 20% increase in its operating revenue while significantly narrowing its costs. The company reported EBITDA loss of 21 crore rupees in FY25 versus 132 crore rupees a year ago. Agritech firm Ninja Kart reported operating revenue of 1,634 crore rupees in FY25 compared to 2,007 crore rupees in FY24. Losses remained largely stable at 256 crore rupees versus 260 crore rupees last year, reflecting strong cost discipline.
NVIDIA has agreed to a non-exclusive license to Grok's technology. The latter, in a blog post, said its founder Jonathan Ross, who helped Google start its AI chip program, as well as Grok president Sunny Madra and other members of its engineering team will join NVIDIA. China has launched 3 venture capital funds to invest in hard technology areas. State broadcaster CCTV reported the capital contribution plans for the funds have been finalized, each with more than 50 billion yuan. The funds will primarily invest in early-stage startups, and the target should be valued at less than 500 million yuan. Those were the headlines that we're tracking for you this evening, but on what's brewing today, quick commerce startup Zepto likely to file its draft red herring prospectus via the confidential route today. We learned from sources that the company is aiming for a public listing in the second quarter of the next financial year. The company is planning to raise around 11,000 crore rupees through a mix of both fresh equity and an offer for sale. Rachna Dhanrajani joins us now with the details. Rachna, give us a sense of how Zepto's financials and the valuation it is targeting.
After a delay of nearly a year, Zepto is now set to confidentially file its draft IPO papers. Now, this is according to people familiar with the matter. The company is targeting a public listing in the July-September quarter of 2026 and plans to raise around 11,000 crore rupees or about $1.3 billion through a mix of fresh equity and an offer for sale. The timing is significant, though, both for Zepto and for India's fast-maturing quick commerce sector. But let's start with Zepto's numbers. Zepto's revenue growth has been sharp. FY25 revenue more than doubled to 11,109 crore rupees from 4,498 crore rupees in FY24. Losses, however, widened alongside expansion. Net losses rose to 3,367 crore rupees in FY25 from 1,249 crore rupees from a year earlier. The company was last valued at $7 billion in a private round in October 2025. A public listing would place Zepto alongside rivals such as Swiggy and Blinkit at a time when investors are far more focused on profitability and execution than growth alone. Ahead of the IPO, a key strategic shift has been the effort to Indianize Zepto's cap table. In January 2025, when Zepto completed a reverse flip, moving its domicile from Singapore back to India, a pretty standard move, since then, it has worked to raise domestic ownership, largely through secondary share sales. And that saw Motilal Oswal and its founders participating in that round. But that may not have been enough, because Zepto continued to attract global capital, including a $450 million round led by US-based pension fund CalPERS in October 2025. Now, Zepto's origins trace back to Y Combinator, when the accelerator invested in 2021. That, and with later investors, the company scaled rapidly and became India's first unicorn of 2023, ending a prolonged funding slowdown, if you remember that time. But scale also brought scrutiny. In late 2025, the Central Consumer Protection Authority fined Zepto for using dark patterns such as drip pricing and basket sneaking. Earlier in 2025, a Maharashtra FDA inspection led to a temporary suspension of a warehouse in Mumbai's Dharavi. But that was an isolated case, though. As per reports, the company also laid off over 500 employees last year as a part of cost control measures. Despite all this, user momentum remains strong. According to data from CLSA, Zepto added over 1.2 million weekly active users in the week of December 15, the highest among quick commerce players. That said, Blinkit continues to lead on downloads. Now, how public market investors weigh growth, losses, governance, and competition will ultimately determine how this IPO plays out. We will definitely keep an eye out for it.
All right, Rachna, many thanks for those details. Now, India's healthcare system is hungry for skilled professionals, and the gap between education and employment remains a critical challenge. Virohan, a leader in healthcare education, is working to bridge that divide through industry-aligned degree programs and stronger employer partnerships. The company has raised 65 crore rupees in its ongoing Series B round, led by Japan's Mainavi Corporation, with participation from Bloom Ventures and existing investors. With over 13,000 learners trained, partnerships across universities and healthcare employers, and a clear path to profitability, we speak to Virohan's Kunal Dureja about its growth story, impact, and what lies ahead. Kunal, thank you so much for taking time out and being here with us on Startup Street. You know, as I pointed out, Virohan has raised the 65 crore rupees in its ongoing Series B round. How does this funding sort of strengthen your mission to make healthcare education more accessible and outcome-driven? Take us through your key offerings.
Right. Thank you, Arundhati. Pleasure to be here. Just to give you a background before I even take you through the offering is, just for everyone to know, healthcare is the largest employment generating sector globally. And just to let you know, there's an 18 million people shortage globally as per the WHO. In India, there's a shortage of about 6 million allied health professionals and 1.9 million nurses. Now, with the capital that we've raised, we actually want to make the education for healthcare degrees accessible across India. We want to partner with universities across the length and breadth of the country and essentially make sure that they have access to these degrees available so that we can bridge the gap for the Indian healthcare worker shortage and also be the largest supplier to the global market for healthcare workers.
Sure. And, you work with over 20 universities and about 2,000 healthcare employers, right? So how does this strong ecosystem help ensure students are truly job ready from day one?
Right. So we work as an industry partner to the existing universities, and there are about 1,100 universities in India, right? Now, what do I mean by industry partner? A, we want to make sure that whatever is being taught is industry aligned. And what does that mean? A, job readiness, making sure that the students have soft skills, behavioral skills, have enough practical knowledge to be job ready on day one. B, deeper industry partnerships. For example, we have contracts with companies like Lenskart. It's called a Sure Start program, where we have companies like Lenskart, Orange Health, Redcliffe, etc., where on the day of enrollment, the student actually gets a conditional offer letter for an internship and a job, and essentially a guaranteed internship to work with these players. All of this essentially makes sure that the student is job ready and has access to the network that we work with the universities and the industry partners.
All right. And you've got 13,000 healthcare professionals already trained. What's the impact that you're seeing on employability and workforce gaps across allied healthcare roles?
The impact is massive. I mean, we're now working with over 2,000 employers. When we started, we were working with less than 100. In 7 years, we're working with over 2,000 employers. And employers are coming back to us with these sort of Sure Start programs where they're saying, we're only going to take interns from you. We're going to give them a conditional offer letter on day one. And we're going to, give them a job if they successfully complete the internship. And if you talk about impact, there's a huge international market where there's a massive shortage globally of these workers. We're looking to start sending people to Japan and even Europe, essentially, which will give India, dollar income back and also globally make us the market leader for filling the gap.
Sure. So you're looking at this global expansion as well. Now, the fresh capital is going to help accelerate your path to profitability, right? So where will the focus lie? Technology, operational efficiencies, or expanding institutional partnerships? Can you tell us where your revenue is currently at and, by how much you want to grow it by next year?
So we've been growing 2x year on year for the last 7 years. Every year, the company has doubled its revenue for the last 7 years. Over the next few years, we were looking at over a few thousand crores of revenues in the next few years. We're looking at being a profitable company in FY 27-28. The proceeds from the funding is essentially going to be looked at for two things. One is, making healthcare education accessible to all the students across India. The second is opening the international pathway for these students to go to Europe, Japan, Australia, etc. Right? That's what we're going to be looking at. We're not going to use the funding for profitability, primarily because we are unit economics profitable already. And with scale, essentially, we anyways are moving towards profitability.
Sure. So you're looking to also place all of these healthcare workers in countries abroad. So what's the biggest challenge when it comes to that? Because every country has its own rules and regulations, right? And which are the countries you're targeting right now? And are you looking to expand beyond that as well? And what about, expansion within India itself?
So internationally, we're running a pilot for two countries. We are working with sending some students to Japan and sending some students to Germany. Over the next few years, we're actually going to open this corridor for Europe and Australia and Japan, right? And within India, we actually are more North India dominated as of now. We're also going to look at expanding into South India, East India, and also cover those geographies.
So big expansion plans across India as well as the world. But what are the key milestones we should watch out for from Virohan over the next 12 to 18 months as the new year starts?
12 to 18 months. I think 18 months, you're looking at a profitable company altogether. and hopefully, a public listing maybe in a few years. So yes, and international students leaving India, in the next 18 months for sure.
All right. So profitability by FY27, you're looking at even building your IPO plans and students leaving India to work in markets abroad. All right, Kunal, thank you so much for joining us here on Startup Street, and we wish you all the best on this journey going forward.
Thank you, Arundhati. Pleasure.
And from healthcare to FMCG, India's convenience food market is heating up, driven by changing tastes, busier lifestyles, and a strong appetite for flavor-forward brands. Alimento Agro Foods, the company behind Mom Meal of the Moment and Gimme Gimme, has raised 52 crore rupees in a Series A round led by Ivy Cap Ventures. The fresh capital will be used to scale manufacturing, strengthen nationwide distribution, and accelerate product innovation across both brands. From flavor-rich instant meals to Korean-inspired noodles, Alimento looks to build a new generation of consumer-loved Indian food brands. Joining me now to discuss this further is Pratik Bhagchandak, the founder and CEO of Alimento Agro. Pratik, thank you so much for joining us here on Startup Street. Alimento Agro Foods has now raised 52 crore rupees in a Series A led by Ivy Cap Ventures. What does this funding milestone sort of mean for the company at this stage of growth? And can you take us through what's on offer in a very crowded FMCG market, right?
Sure. First of all, thanks for having me, Arundhati. Pleasure to be here. Yes, we have recently raised 52 crores led by Ivy Cap Ventures. And so to give you a little bit of context, we've been around for about 8 years. We've been growing about at 60% CAGR while being fully bootstrapped. And we've been profitable for the last 3 or 4 years. So we've taken this funding primarily because we felt we were ready to really accelerate, our growth speed and the targets we were going after. Our distribution is very omni-channel. Many of our consumers have, first interacted with the brand on board a lot of the airlines in India, moving to 50,000 odd Kirana stores, as well as, quick com and modern trade now. So the raise was really a testament to the acceptability of the brand, of the flavors, and where we want to go from here. So yeah, that's what it's about.
Absolutely. And what's interesting is that you're building two very distinct brands, right? With Meal of the Moment and Gimme Gimme. How do these brands sort of complement each other within Alimento's broader portfolio strategy?
Yeah, that's a great question. So primarily the brands complement each other from a distribution point of view, as well as a sort of practical operational point of view, in the sense that they're both attuned to general trade. The shelf life is sort of similar. The kind of premium stores that MOM is available at is the same store that Gimme Gimme customers are frequenting. So and additionally, also our expertise has been on flavor creation, and we've honed that skill for the last 8 years, and we believe we've really cracked getting the right flavor delivered at the right moment to our consumer, which is what Korean food is all about. So we've even gone to Korea and done, taste trials throughout the whole country. And yeah.
Yeah, so you're building a flavorful brand and flavor being key to what you're doing. But before we get into that further, how will this fresh capital sort of be deployed across, manufacturing expansion, distribution, and product innovation over the next 12 to 18 months?
Sure. So we're looking to double our capacity at a manufacturing level. We are looking to strengthen our leadership team. We already have a great team in place that's got us here. We're looking to strengthen that. We're looking to expand our reach to about 2 lakh stores over the next 3 or 4 years. And the last bit is on the awareness piece. So while we're a fairly well-known brand in the circles, there's a lot more room to become ubiquitous and top of mind.
Sure. You want to double your manufacturing capacity, as you pointed out, right? So what's the kind of demand that you're seeing for both the brands, and where is there more demand? What is right? What does your audience currently want more and love more?
So the brand love is strong for both the brands. MOM has been around a lot longer, about 8 years. So there's a lot more consumers attached to it. A lot of people have very heartfelt stories about how it got them through their travels, how it's the best favorite thing on board. So there's a lot more brand love currently towards MOM, if you had to ask me. But the the new brand love coming up for Gimme Gimme is very strong as well.
Sure, and apart from manufacturing, distribution is critical in the FMCG space, right? What are your plans to sort of strengthen nationwide reach, and which channels will drive the next phase of growth? And take us through your presence right now and where we'll see that growth coming from going forward.
Sure. So as I said, we are very omni-channel. We believe that FMCG in India today, you need to be where your customer is. You can't pick and choose. And if you're not available at an arm's length, today's consumer has a lot more choices. So we believe distribution is king. So we have 4 primary channels, which is general trade, as I mentioned, modern trade, quick commerce, which is obviously exploding, which you just covered earlier in your segment, as well as airlines and institutions. So we cover all of these, and we see growth potential across the board in all of them. We're fairly small as a brand, in the FMCG world, so there's a lot more room to grow across all these channels. So yeah, sure. We are very omni-channel.
Sure. So a big omni-channel presence there. Otherwise, it's very difficult to have your customers use your products. But how have revenues sort of scaled for Alimento Agro Foods so far? I know you mentioned that you were profitable, but what kind of growth trajectory are you targeting over the next year following the Series A raise, and where are you at currently?
So as I mentioned, we are growing at 60% CAGR over the last 3 years while being bootstrapped and profitable. So obviously the aim is a lot higher than that. We'll be looking at between 90 and 110% for the next 2 years, and then maybe moderating that to about 80% on an annual basis. To give you a number, we're looking to do around 600 crores in 4 to 5 years as top line.
Looking to do 600 crores in 4 to 5 years, and plans to launch any other brands, or will you be focusing on these 2 for now?
I think our team's got its hands full for now, but you never know.
Your team has its hand full, but we'll never know, so we'll have to wait and see. All right, Prateek, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best for your journey going forward.
Thank you for having me.
On that note, it is time for us to head into a short break. But coming up next, a former India cricketer has turned deep tech entrepreneur to develop technology that generates drinking water directly from air. Details when we come back. Stay tuned. Welcome back. You're still with us on Startup Street. Water scarcity is no longer just a rural problem, it's a growing urban risk, even in coastal cities. As climate stress and infrastructure gaps widen, new technology-led solutions are beginning to draw attention. One such deep tech startup is AeroNero, founded by former India cricketer Durga Das, which is working on decentralized water generation by extracting drinking water directly from air. CNBC-TV18's Aishwarya Anand brings you this report on how atmospheric water technology could reshape access to potable water. Take a look.
She once represented India on the cricket field. Today, she's taking on one of the world's biggest off-field battles, water scarcity. Durga Das grew up in Chennai, a city that swings between floods and droughts, and it was this contradiction, abundance on one side, shortage on the other, that pushed a former athlete to think beyond sport and into science, technology and water.
When I got into water, it was about solving a problem for my home city, Chennai, which is where I was born and brought up. And though we have the second longest beach, we have a perennial problem with water, deluge and drought every year. It just stared me in the face with Cape Town running out of water when I was playing cricket there, and then Chennai, my own hometown, having a day zero. That's what I wanted to solve, and before I knew it, it became a global problem.
Water scarcity today affects more than 2 billion people worldwide. Climate change, over-extraction and fragile infrastructure are making reliable access to clean drinking water increasingly uncertain, even in major cities. For Durga Das, the question became simple. What if water didn't have to come from the ground at all? That idea became Aeronero, a Chennai-based deep tech startup building atmospheric water generators, machines that extract potable water from humidity in the air. The goal? Decentralized water, much like rooftop solar decentralized power. Can you break down what this dual method capability mean in terms of reliability, cost and quality of generated water?
Now with desiccation, the pros and cons are that pros are, of course, you don't need power, you have sunlight that you can use, and desiccation can work in low humid conditions. But the con is that you can't produce sufficient because it is reliant on the ability of the desiccant itself to be able to generate the water that it does. So you need more and more desiccant to produce more water. And therefore you have to have large adsorbers or desorbers. On the condensation side, which is mimicking the nature's cycle, like the rain, you can produce larger amounts of water, but there's always a dependency on energy, which is the compressors and things like that. So the combination of the two, which is which we are the only company in the world which has patents in both, has led us to hybridization. How can we benefit from learning from low desiccation, from the desiccant method for low humidity, and work with condensation and generate enough water? And I think we're able to put that together, and we're able to now work in adverse and diverse conditions. For example, in Leh Ladakh, in colder regions. We can work now in Rajasthan, where humidity is low, or in desert conditions. So I think that's the combination that makes us unique.
You have over 300 installations in India providing drinking water to 1.5 million people. So what have been some of the biggest learnings in deploying AWG in the real world, especially in high demand environments?
Yeah, so this 300 deployments that we have done were basically the early test beds, if you will, to understand what our customers need and how to plan for scale up and growth. We expect to do in 200,000 homes in the next 12 to 18 months. We're working on something very unique for the defense, which is a water on the go mobile pack for a soldier.
Now, what began as a Chennai-focused solution is now drawing global validation, with the startup being selected into international innovation cohorts such as the Reckitt Catalyst program.
Pleasing to be part of this year's Reckitt cohort because of Serena Williams supporting it. I think this will help us accelerate, internationally. We are going to Latin America, we're going to Singapore and Far East, we're looking in the Middle East and African region.
You've also created WADO, which was your UK-based charity working in refugee camps and on water inequality. So how do your philanthropic efforts tie back to Aeronero's commercial vision of water for all, always?
Working in this space means that we have to make sure we get solution to everyone. With AWG and machines like the bubble that we have here, not everyone's going to be able to afford it. So we also have to create a pool from our own profits, if we can, and by bringing other partners in. And that's how I set up Water in the UK, to see if we could pool monies together through philanthropy to also get it to people who don't have the ability to afford it.
Energy consumption and cost per litre are often raised as concerns with AWG. So what have you done to make that technology more efficient, affordable and climate resilient?
We are going to cut energy costs by more than half, and we will work in even sub-zero temperatures, both of which are now not possible for AWG companies. And I think this breakthrough will truly make air water generation the future of water.
It is Friday and it's time to check out the top startup deals this week. According to Venture Intelligence, 6 deals worth $36 million were signed this week, bringing the total for the year so far to 923 deals valued at $9.1 billion. Some of the big deals this week include Wint Wealth, a debt investment platform, which raised nearly $13 million, while mutual fund platform Power Up Money secured $12 million in its Series A round. Tax management startup Prosper.io landed $4 million, while beauty tech platform Dazzle and electric motors maker Nakshatra Labs raised $3 million each. That's your weekly startup deal roundup. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Once you bought a land with the house of Abhinandan Lodha, you could know owner next to you, what price he has bought at, when he registered his document, whom he bought through, etc. etc.
Trust is very important when you're buying real estate.
92% of the people don't take a loan. They are quite clear that the investment in land is a long-term asset, whether it be Alibag, whether it be Ayodhya ji. The typical buyer is below the age of 50.
Land that you sold digitally, in 4 weeks you were able to sell it. Is it NRIs, is it Gen Zs, millennials? Did you see any trend there?
The people who bought were largely in the age of 30 to 40. Business owners owners, and almost nobody took a loan. The important thing is not whether you buy land or not. You should buy land. The important thing is whom you buy land through and where you buy the land. I was reading a book yesterday, I'll have a copy sent to you, which is talking about how land has actually played a disruptive growth in the human economic cycle for the last 2000 years.
Title, as you said, that becomes a big question mark when NRI buys it. They're not sure whether they will have that land when they come to India.
Using technology, I think the Maharashtra government is doing a great initiative on that. Government supports in creating the title online. I think that will take away a lot of the grey areas. When I'm an NRI sitting out of New York and I can understand the title flow on the state government website and then see the flow to me, I think that will completely transform participation in land. We recently launched what was India's first agentic AI-based launch.
Agentic AI?
Yeah.
Okay.
So the entire launch, Sonal, was done. There was no site office, there was no sample flat, there was no site visit, and in the entire launch, there was not a single salesperson. If you're buying land in Nagpur, you're buying land in Vrindavan, you're buying land in Alibag. There are some 47, 48 locations across the country we've identified where state government and central government is building infrastructure together. Jobs are getting created. Buying land in any of these areas, I think 20 years onwards, you'll make a tremendous return.
One mistake every retail land buyer must avoid.
Buying land without knowing what he's buying.
One hotspot nobody's talking about yet.
Chitrakoot.
Buying a land without any site visit or the home as well. Few years back, that would have felt impossible, right? But the house of Abhinandan Lodha seems to have cracked the code to understand how it happens, how you can go ahead, buy a land or a home without actually visiting the site. Let's get in the man behind all of this, Mr. Abhinandan Lodha, who is the chairperson of the house of Abhinandan Lodha. Mr. Lodha, thank you so much for joining in today. And you have basically cracked the code to sell homes and land digitally. Tell us what made you think like that, and what are some of the challenges you faced it at the start, and how has it become so smooth now, and are people really coming up for this?
Good morning, Sonal. Thanks. I think it was more unplanned than planned. We started our real estate business in the middle of COVID in 2021. And at that time, there was a large enablement of the world to move towards what I would call the digital technology part of life. Fortunately, otherwise, the land parcel which we owned was a 6.5-hour drive away from Mumbai. So there was no way we could have sold it physically. So it was confluence of events coming together. But I think what that also made us realize, and then give you a background, we were running a private equity firm called Tomorrow Capital, where we were interacting with a lot of the new age entrepreneurs who were using technology in very, very varied manners. So we largely took a call saying that the young Indian wants to invest in land, has some issues around the worry on title, possession, approvals and liquidity. If we can solve for these and effectively create what I would call theoretically dematted land, then there should be a large participation. And when we started off with the thought process, we also very, very clear to build scale, we have to make this business non-physical, because otherwise land was being bought in India largely for consumption. So we turned this thing around. We said, let's launch. It was more of an experiment when we started off. We said, if we can sell this in 6 months, we should be doing quite well. It sold off in less than 4 weeks. 100-acre parcel sold off in less than 4 weeks. And we realized that we hit the core somewhere, right? We expanded quite rapidly. And I think we've been, people have been very, very supportive. Of course, the base of this comes from a large focus on transparency and the ability to constantly keep updating the consumer on whatever is happening in and around the area and in the development.
So is there an age group, a type of customer which lapped up on that land that you sold digitally? In 4 weeks, you were able to sell it. Is it NRIs? Is it Gen Zs, millennials? Did you see any trend there?
So we started off a theory that the people who would be buying land actually would be in the age group of 40 plus. And would largely be salaried PR, would largely not be salaried people, and they would be wanting to take a loan. Their theory was entirely wrong. The people who bought were largely in the age of 30 to 40, business owners, and almost nobody took a loan. So I think, and we've seen this trend moving alongside, whether it be Alibag, whether it be Ayodhya ji, the typical buyer is below the age of 50. Whether he's salaried or self-employed is almost split 50-50. But 92% of the people don't take a loan. They are quite clear that the investment in land is a long-term asset. They don't want to match it with any short-term liability. So it's a 15 to 20-year asset in their mind, and that's how they are investing.
So what are some of the features that you showed them, technology, that made them believe that, okay, whatever we are buying, is something which is kosher, which is something that actually exists? Because trust is very important when you're buying real estate.
So I split that into two portions. I think one on the pure trust side, what we did is we ensured every land we bought is certified by two of India's largest law firms. We ensured that the kind of consultants who work with us are best in class. More importantly, we made everything available on our app. So theoretically, once you bought a land with the House of Abhinandan Lodha, you could know the owner next to you, what price he has bought at, when he registered his document, whom he bought through, etc., etc. So that's what we did on the side of building trust. On the use of technology, it was quite differentiated, because typically if you go to a 100-acre parcel of land, you see raw land. And it's very, very difficult for you to imagine what this is actually going to end up becoming. And our idea was, if we can bring 3 years of development cycle, which is now real in our mind, into the consumer's house, then his ability to create a transaction is very, very high. So, using technology, visualization tools, Oculus, etc., we managed to ensure that whatever is our vision on the land and what it is going to look like when it's delivered is made alive in the consumer's mind today. And what I would really request you to do, Sonal, it's very, very easy. It can be done on your phone. When you're traveling back to studio from here today, you can probably set up a sales call with one of our sales team and go through the sales experience. And you'll probably be able to connect to what the consumer gets to see.
Okay, so if I actually like land and I want to buy it, tell me, do you think land is an asset which will continue to appreciate from here on? Because if somebody is buying from an investment perspective and you have finance background, right? So a lot of it is from investment purpose as well. Where are we in that cycle right now when it comes to land buying?
My answer to that, actually, if you look at India since independence and you look at any area which was not fully urban but became urban later, the land return has been a 20% plus CAGR for the last 50 years put together. So the important thing is not whether you buy land or not. You should buy land. The important thing is whom you buy land through and where you buy the land. Whether you're buying it in areas which have already appreciated a lot, they may appreciate further again, or you're buying in areas which are just at the cusp. And I think even today, if you're buying land in Nagpur, you're buying land in Vrindavan, you're buying land in Alibag, there are some 47, 48 locations across the country we've identified where state government and central government is building infrastructure together, jobs are getting created, and economic growth is ahead of the national average. Buying land in any of these areas, I think 20 years onwards, you'll make a tremendous return.
So from a retail investor perspective, these are certain things they should keep in mind before they're investing in land, the economic growth of that area. Are there any other factors that one should look out for?
So a couple of things. One, it's more important to do detailed diligence. Whether you're buying from a developer or you're buying on your own, it's very, very important to make sure the title is very, very clear and possession is taken care of. And in terms of research, you need to make sure that the area norms are quite well understood by you, what the planning norms are. I think if you're done with that, you're quite good.
Okay, but are people still hesitant to buy land in India versus buying a ready-made home or an under construction building? Not from an investment perspective, but because they want to build a home. Do you see that as well?
Absolutely. I think right now the quantum of land buyers in India versus the people who buy in apartments, I think land will be less than 5% of the overall pie. And interestingly, Sonal, I was reading a book yesterday, I'll have a copy sent to you, which is talking about how land has actually paid a disruptive growth in the human economic cycle for the last 2000 years. So I think land as an investment class has always been something which is very well, desired. It is just that the availability of quality land with clean title has been quite low, and it's become almost a grey sector. If we can all work towards making the grey into black and white, it should be far more participants.
So that's exactly what you're trying to, that is the gap you're trying to fill in here. So which are some of the locations you mentioned? Vrindavan, you're in Goa, Ayodhya is one of the locations. Are these the places where you'll expand further? What are the other locations that look good to you at the current moment?
So I think Nagpur is a great location today. The entire Konkan belt with the Mumbai-Goa expressway getting built is quite fantabulous. I would say Uttar Pradesh in general, there are undiscovered gems in Uttar Pradesh like Chitrakoot. Now we all know Chitrakoot, from the Ramayana era, but the fact is, it's getting an airport now. It is probably today what Ayodhya ji was 6-7 years ago. And I think there are many such hidden gems in our country What's happening is, so if you look at the way the urban India is changing, there was a time where people used to believe that wealth creation is happening only in the major metros. And that story is completely changed. You can go to a Jaipur today and see tremendous amount of wealth getting created. And you can go to an Amritsar today and see tremendous amount of wealth getting created. Now, what I would call the non-metro India is becoming as wealthy as the metro India, with a huge desire to also make sure the lifestyle matches. So this entire change is also going to redraw the economic map of India.
Okay. So the non-metro part of India is also seeing the price increases that metro saw. And do you think that will continue as well?
I think it's seeing a larger increase than metro saw. And you will see report after report after report talking today on how Surat is outperforming probably Delhi, and how Vrindavan is doing better than Mumbai, and how so many other locations are doing better than the metro areas, because the base is very different. These are locations where even today you can buy a quality apartment at 5,000, 6,000, 10,000 rupees a square foot, right? You would believe in Mumbai at 10,000 rupees a square foot, you really need to go very, very far away. So at 10,000 rupees a square foot in an area where you're being able to buy a prime apartments, the cost of construction is probably 20-30% different. There will be re-rating. There is huge scope for upswing there. And I think a prime example has been Jaipur. I think Jaipur pricing and Surat pricing has moved up by almost 2 times to 3 times in the last 5 years. And there's further scope to move ahead.
Further scope to move ahead. So people buying house or land in Surat and Jaipur should be very aware of that as well. Then what is the plan for the house of Abhinandan Lodha going forward? What is the current portfolio you have? What is the pipeline that you want to add? And what is the capex planned overall?
So the house of Abhinandan Lodha is now split into 3 verticals. Primarily, including this year, 75% plus of our revenues come from our land business. Roughly 15 to 20% of the revenue is coming from the vertical business this year, but that will substantially change over the next 3 years' time. We have a very, very small division in the hospitality space as well. We are doing our first hotel with Brookfield at Ayodhya Ji. It's a Leela hotel, and we'll be expanding to 7 hotels in the near future. So I think we'll largely play between these 3 divisions. Currently, the gross development value of our assets, which are under construction or about to start in the next 12 months' time, is in excess of 20,000 crores. We expect this number to double over the next 3 years. And we also expect that by March 28, roughly 40% of our top line will come from the plotted business versus 75% today. 45% of the top line will probably be coming from the vertical business, and 15% will be spread between commercial and hospitality.
Okay. So you will be looking at the hospitality or the commercial business. Will it be in partnerships? The one that you said you have with Brookfield, you had some funding from HDFC as well. So are you looking at such strategic partnerships or financial partnerships?
On an ongoing basis, I think the Indian developer today is far luckier. I sort of have been through a long cycle. I've seen that the access to capital today is much more than it was probably 15-20 years ago. More importantly, the belief in the Indian story today is phenomenal. I think every major hospitality chain in the world now wants to come to India. They are understanding the spend potential of our countries, and in general, House of Abhinandan Lodha will continuously look at financial partnerships and also strategic partnerships. The partnership with Brookfield is both financial and strategic, because they also own the Leela. So I think we'll on an ongoing basis look at both of these.
Okay, all right. So, there's so much more to ask, but we are surrounded by such beautiful views. So I have to take you to one of those views and take this conversation forward. look at that view, coastal road. We've seen a massive infrastructural transformation in the city. And this is something which is expected to continue, right? There are more projects which are announced. Do you think this is something which will keep the growth for Mumbai real estate market running, or we have plateaued a little bit because last 5 years were incredible?
No, I think this is going to be a completely new lease of life for the Mumbai real estate market. And you see different areas becoming more and more valuable. If you look at the plans now, there is going to be a connector from BKC to Alibag, which is going to cut the travel time from here to Alibag to less than 45 minutes. Eventually, when the connector to Warsaw is made, it's going to cut down travel time by almost 60%. So newer and newer hotspots are going to emerge in the city of Mumbai. Maybe the price rise in certain pockets like South Mumbai may slow down, but definitely parts of Mumbai will see escalating sky prices because the infrastructure there is already quite well built. It was the connectivity which was a problem, which is changing with these amazing projects the government is now executing.
Oh, absolutely. So, you know, while we talk about Mumbai market, there is the MMR region, the metropolitan region, and you do have some projects there. Tell us, is that an area which you are more bullish on versus the core Mumbai market?
No, I don't think we have a preference to one versus the other. We definitely see that both in the super luxury segment and in the affordable housing space, there is tremendous amount of potential for differentiated product, and a new approach can be seen. And we saw this with our development in Naigaon, where we recently launched what was India's first agentic AI-based launch.
Agentic AI?
Yeah,
okay.
So the entire launch, Sonal, was done. There was no site office, there was no sample flat, there was no site visit. And in the entire launch, there was not a single salesperson.
Okay.
So we built our agentic AI. We called her Priya. Priya went through 40,000 consumer conversations. We had almost 8,800 people apply for 1,500 apartments.
All of them sold?
All of them sold. And most importantly, what we realized is that the use of technology and the capturing of data and then the analytics you can run on that is not applicable any lesser to real estate as compared to maybe financial services or any other technology firm.
You know, I'm still a little taken aback by the fact that people bought so many homes without actually visiting the place, because if we compare it to financial services, you cannot see, touch, feel the product, but here you can. So tell us, because now buyers are vocal, there are a lot of things happening around buyers' rights. Are there any complaints that you have tried to solve? People have come to you that, okay, 1, 2, 3, this is what we want, and this is and these are the things around which you have tried to build the model.
No, I think absolutely not. This is a constant learning process, and there's a lot to learn from the consumer feedback. I've always maintained that the Indian consumer is the most giving consumer in the entire world, especially in the real estate segment. They are the reason why developers exist. The kind of support they give, they effectively finance through developer cycles. And consumers have constant feedback. We've gotten a lot of feedback. At times, our refund processes were not fully aligned with what the consumers were expecting. At times, the kind of documentation they wanted to see was not fully available. And I think all of this feedback, the only good thing we do is we take feedback very, very quickly and make sure we are able to bring about change. In this process, so far, I don't think we've gotten any negative feedback from the consumer. But probably as they see the cycle of execution playing out, they'll probably require data at a different level compared to what we have thought today. And that'll be one more change which we need to make.
Okay. So what are the top 3 things that you think a first-time buyer should know before buying a land or an apartment?
Most thing is the background, the title of the place you're buying, understanding in detail about the construction cycle and practical timelines around delivery, and third, the kind of people who are buying around you. I think you pack these in this order and you get this right, you should make a very, very good return on your investment wherever you go.
Okay. So you think in next 5 to 7 years, we'll continue to see the 20% CAGR that land appreciation or land pricing has seen? That is a trend which will continue?
Absolutely. But the only thing is you should not buy land with anything less than a 20-year horizon. While you will make extraordinary return in the short term, I think people have made a far more than 20% in the last 4 years. But if you hold land and you let it compound for you for 10 to 20 years, the returns which you will make will be phenomenal. But yes, I think 20-22% return is quite par for the course in the near future.
So, when people are coming to you buying land digitally or buying homes digitally, what are certain features that you saw? I know I asked you earlier as well, but again, because viewers who are seeing it and who have not bought any house digitally, it is just a way of telling them these are also the ways to buy house. Even if you are sitting in Bombay, you can buy a land in Ayodhya without having to visit Ayodhya. So what are some of the features or some of the characteristics they need to keep in mind when they go on your app, or generally which markets they should watch out for? Is there any infrastructural development or other things to keep in mind?
I think generally buyers will need to do a bit of the research on their own first, which is the more third-party research to understand which are the areas they are looking at. You know, whether a person sitting in Chicago is looking at Nagpur, or a person in Jharkhand is wanting to look at Vrindavan. That is going to come from his understanding either emotionally or economically of the area they want to participate in. Once that is done, then once you go, your understanding of the firm, if you're dealing with us, the title certificates and the approval process, that is very, very important. Once you're done with that, then then it's quite okay. But these two things you should always keep a lookout for. And I'll give you a corollary that while in India we find this quite extraordinary, let's look at the Dubai real estate market. People from all over the world make up their mind that they want to participate in Dubai. Then it is more about picking the developer, picking the location. And I think the kind of turnaround time you're seeing in the Dubai market today is quite unprecedented anywhere else in the world. I think it's quite similar for land in India. Once you make up your mind that I want to participate in Ayodhya Ji, or I want to go to Vrindavan, or I want to buy in Alibag, once that is made, then it is about narrowing down the search to the kind of developer you want to participate with, who's able to give transparency and technological fields across the screen.
So, you know, to be honest, our feedback on that as well is how Dubai and Indian markets are different is how laws are applicable as well. Title, as you said, that becomes a big question mark when NRI buys it. They're not sure whether they will have that land when they come to India. So do you think there are some places or areas which you need more government support on? And there are some reasons why which somebody is not very keen on buying land the way they're buying real estate right now?
I think couple of things which I answer this slightly differently. I think what can accelerate the growth of land participation in India is, I think government has been very proactive in now allowing fractional ownership in certain asset classes. I think if you create the ability for fractional ownership in land using technology, I think the Maharashtra government is doing a great initiative on that. If you come to a stage where you can effectively buy dematted land, the government supports in creating the title online, I think that will take away a lot of the grey areas. If I'm an NRI sitting out of New York and I can understand the title flow on the state government website and then see the flow to me, I think that will completely transform participation in land.
So now that we've spoken about the land part, which is a bigger part, you're in vertical development as well. Is it going to be a mix of affordable, ultra luxury, which is growing very well? Because we did see that K-shaped recovery post-COVID. Do you think that is a trend which is continued, or all the segments are doing well?
I think all segments are doing well, but there is disproportionate space available in ultra luxury and affordable housing. I think there are two ends of the market. But both these ends of the market have enough space for a new product led brand to come in. And if you have large focus on execution, then the kind of returns you'll make in these two ends of the market will be much more than anywhere else.
And the kind of pricing growth that we saw so far, do you think that is something that will continue in both these segments?
I think the last 4 years have been an aberration. I think the ultra luxury segment has probably grown at more than 20% over the last 4 years. I don't see that kind of price growth happening in the near future again. A 20% compounding return from here will be quite difficult in my mind. But I think it's still a great value buy. And people who are buying these apartments are largely buying for short-term consumption, long-term investment. In the long term, these apartments are going to become more and more rare, and hence participation should be good.
Okay, all right. So, before we end on this very, very insightful conversation, I have a rapid fire for you. So you have to be very quick and short with that answer. So let's start with that. One mistake every retail land buyer must avoid.
Buying land without knowing what he's buying.
Okay. One hotspot nobody's talking about yet.
Chitrakoot.
Oh, okay. One policy change that will change Indian land investing.
Fractional ownership in land and demat land.
Okay. And one misconception about buying land.
You need a lot of money to buy land. That's not true.
Thank you so much for inviting us here and giving us these views to take this conversation ahead. It was a pleasure.
Thank you so much, Sarah.
Okay, all right. With that, we'll take your leave on this edition of Beyond the Brick. But stay tuned for more such conversations ahead.
$35 billion to 2030. This is on top of the $40 billion that Amazon's already invested in India from 2010 to 2025.
We view India as a massive opportunity. We found innovations that have worked for India, but those same innovations are actually coming and solving problems all around the world. We launched this program in India called I Have Space. That same idea, was picked up by a team in Spain. It worked really well. It expanded to other parts of Europe. We now have 1 million robots globally.
And what are they doing exactly?
You've got robots that move goods to people. You've got robots that actually physically pick up products. You have robots that will actually pack products for you.
Do you believe you could be in an era of zero defects on account of agentic AI?
I think defects can become far more of an exception than the norm.
2 years in Hyderabad Public School, which is home to Satya Nadella, Ajay Banga, Shantanu Narayan. What is it about HPS that has this strange connection with the valley?
I wish somebody could answer that question. Maybe it's luck. Maybe it is something that there's something in the water there. I don't know.
Today, we bring you an inside look at the engine that keeps the everything store moving. Amazon moves millions of packages a day through a global network powered by advanced AI, next-generation robotics, and more than 1 million associates. And steering this massive system is one of the youngest members of Amazon's S-Team and engineer-turned-operations chief. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. From leading Amazon's COVID response to rolling out the largest commercial EV delivery fleet in the US, to now building a smarter, more resilient global network. His fingerprints are on some of Amazon's most ambitious bets. And India, where his journey began, is central to the next chapter. From infrastructure and safety investments to a new era of AI-powered logistics. But what does it take to lead over 1 million employees, thousands of facilities, a global fleet of planes, trucks, and one of the world's largest robotic networks, all at just 38. Well, joining me now is the man at the helm of Amazon's worldwide operations, Udit Madan. Udit, great to have you join us here in India. And thanks very much for joining us on Young Turks.
Thank you so much for having me. It's a pleasure, and I look forward to the conversation.
We're here at Amazon Sambhav. This is your event where you put together all of Amazon's might on display and showcase your commitment to India. So let's start with that big number, $35 billion to 2030. That's the big announcement that's coming from Amazon. This is on top of the $40 billion that Amazon's already invested in India from 2010 to 2025. Now, take me through why $35 billion and what it's going to be used for.
We're really excited about the $35 billion investment announcement today. It makes us the largest foreign direct investor in the country. And, we view India as a massive opportunity. It is a country of 1 billion people. There is a ton of innovation that's happening here. And we think it's a place where we are going to have a very large business that's going to appeal to consumers and sellers alike. And so that $35 billion is really focused on advancing our infrastructure, creating a larger business and a larger set of opportunities for sellers, investments in AI, in technology, investments in upskilling, and every aspect of business that we have across Amazon is really inclusive in that number. And we expect that it's going to help us digitize and support and empower small businesses. It will help us educate more people on AI and make AI more accessible to both sellers. We expect 15 million sellers to have access to AI-based training and skills and tools, as well as fund investments that we get to make across educating students. We expect this to have 4 million students, government students across the country, to understand, learn, and experience what AI can do. And so it's a wide range of investments all put together.
Speaking of the use of that 35 billion, one, of course, is also going to be accelerating your exports from India to the world. You've crossed the $20 billion milestone, but you're targeting 80 billion by 2030. Now, that's going to put a lot of pressure on you to be able to get the supply chain in order as well to be able to fulfill that aspiration. Take me through that export opportunity and how you see India fulfilling that number.
Yeah, we have been so excited and encouraged by what's happened just in the last several years. We crossed $20 billion of exports from India and did it in a very short amount of time. We made the announcement in 2020. We've already crossed that today in 2025. And we see that really accelerating. For us, the scale and the opportunity really is not just a challenge, but it's actually really exciting to be able to create a global marketplace where we can connect Indian sellers, Indian producers to every customer around the world. And so it's actually a mission that we're super excited about.
One of the other interesting things that we've seen happen in India, and that was not something that Amazon actually led, was quick commerce and the way that that's exploded. Did that take you by surprise?
Look, for us, speed's been part of our DNA and passion for the company for a very long time. Ever since we launched the Prime program for the first time in the States, really was helping customers experience a level of convenience that drove changes in shopping behavior. And we've seen that ring true every time we've invested in making speeds faster. There's this really interesting phenomena that happens when speed intersects with the customer need. And every time we've increased speeds, we've seen customers consider us for more and more purchases. Not only do they come back and buy more things, the things they were buying, they actually also come back and consider us for things that they were not coming to our store for. And so it's been part of our DNA. And what we've seen is that over the years, we've gone from 2 days as a Prime program and offering to 1 day delivery to overnight deliveries to same day deliveries. So Amazon now, which is what we call our quick commerce offering, is really just an extension of that. And it represents, I think, that next phase and in the continuum of speeds that we offer to customers.
From same day now to 10-minute deliveries, and Amazon is now getting into that game as well with Amazon Now. What is the big takeaway from that? What's the big learning from the India experience? Is this exportable to the rest of the world?
Yeah, I think there's a couple of takeaways. One, as the country's gotten more digitized, as more people have gotten used to e-commerce, I think this behavior that was always there, right? When I was living in India, going down to your store and grabbing something in 10 minutes was a thing. We did it all the time. Calling up the store and having...
you walked to the store,
Or you called somebody up and somebody at the store would come and drop it off at your doorstep 10 or 15 minutes later. And so it's just how we lived our lives. And I think as e-commerce took root, I think that behavior has now translated and made the jump into your app. And so to me, I think that parallel, that sort of idea that there is a set of urgent needs and a set of things that customers would rather not have to plan for, I think is very exportable. And in fact, we've seen the success that we're having in India actually already start to translate to other parts of the world. We've launched Amazon Now in the Middle East, where we're offering 15 or 20-minute deliveries. And just a few days ago, we announced that we're launching a 30-minute quick commerce offering in the United States. In both Seattle and Philadelphia, customers can now order something and get it delivered in 30 minutes. And we see very consistent behavior patterns from consumers across the board.
Do you believe that we're likely to see a shift, maybe, I don't know, the next few years, the next 5 years of moving away from same day or next day deliveries to, 10 and 20 and 15-minute deliveries?
It's hard to say what the future is going to hold, but I would say my belief is that it's going to be a continuum. I think customers have always valued low prices, vast selection, high levels of convenience. I think there's going to be still a strong desire to have access to millions or tens of millions of products that may not be able to get to you in 10 minutes, but could get to you overnight or the same day. You will have a corpus of products that are your everyday essential needs, perishable, ambient groceries, could be, personal care items that you want in a much shorter amount of time, whether it's 10 minutes or an hour or some combination of the two across sort of, hundreds of thousands of products. I think that, that's how most consumers, I suspect, around the world will experience this. I don't think the end, the end outcome here is going to be that consumers will, settle for lower amount of selection. I think they will likely want what they get today, which is tens of millions of products from around the world.
So how do you reconfigure then the supply chain to be able to cater to these changing fulfillment expectations and fulfillment demands?
Yeah. I think our philosophy has always been to build a network that's agile and flexible. And I'll use an example from the US that, we've gone through in just the last 2 years. Coming out of the pandemic, we had more than doubled our network. Network prior to the pandemic in the US was still a very sizable network. Coming out, which more than doubled it. And we realized that the speed expectations were changing. They'd gone from 2 day to 1 day as people had gotten more used to online shopping. And that scale afforded us an opportunity to offer not just that 1 day delivery, but also same day deliveries. And so using the same large network we had, the same fulfillment centers, the same sortation and delivery network we had, we just reconfigured it in ways that could offer consumers a lot more of what they were looking for, which is faster deliveries. And we did that effectively by regionalizing the network in the US, compartmentalizing into 8 different regions. It's now 9 regions, getting products much closer to customers, really investing in the supply chain to get vendors and sellers to get the right products for a geography, do the sites that are the closest to them, and then shipping from those sites. And what we found in that experience was that it wasn't just that the network was getting faster. We'd found a way to get the network faster at a lower cost. And that then allowed us...
How did you manage that?
Yeah, it's a great question. There's 2 things that we've learned over the last 15 years at Amazon, that in supply chains, your costs are very tightly correlated to how far a product has to move between a manufacturer's location to a customer's doorstep, and then how many times you have to handle it. And if you can reduce the number of times something has to get handled, or you can get products much more directly from the manufacturing location to where a customer actually is, you can actually reduce those costs. And it has the added benefit that it's also providing a much faster level of service. So today, in most countries, our fastest speeds, sort of put maybe quick commerce aside, our fastest speeds are our most inexpensive speeds. They have the lowest cost to serve. And as a business that is built on driving consumer behavior that is indexed on an increasing appetite for convenience, it's a very powerful place to be.
Mm-hmm. So, what's changed then? More micro fulfillment centers? I mean, how do you keep costs down but accelerate speed at the same time?
So we've invested in 2 areas to do that. One, in the context of quick commerce, we built these micro fulfillment centers. They're tech-enabled, but very small formats that hold tens of thousands of products, not hundreds or millions of thousands of products. And then we've invested a lot in the distribution to get the right products in the right quantities that are pertinent to customers in that geography at the right time. And so that allows us to handle products much more efficiently until it gets to that final resting spot, that micro fulfillment center. And then from there, you're delivering to the customer. If you think about it, if the customer gets a promise in 10 minutes, you have 5 to 7 minutes to deliver it, which means they're very close to where that micro FC is. And so the final distance is actually getting a lot shorter to the customer, and that keeps costs down.
the big bet on technology, and you just gave us some examples of what you're being able to do with that. But now in the context of Gen AI, and especially in the context of robotics, you talked about the million associates that you work with. How is the workforce likely to be reimagined as we look 5-10 years on?
You know, it's hard to know exactly how things will shape and change. I think if you look at our history, though, it kind of is a good example of what's happening and how things have evolved. We've been on the journey of automation or robotics for quite some time. Really, our first set of advanced robots came into our network probably 12, 13 years ago. We now have 1 million robots globally that operate every day to fulfill customer orders.
And what are they doing exactly?
They vary. We have a suite of robots, but you've got robots that move goods to people so that people don't have to walk around warehouses and grab products. You've got robots that actually physically pick up products. You have robots that will actually pack products for you. So it's a huge range. But across the gamut, what we've seen over the last 12 years is that the amount of jobs, the amount of people we've had in the network has continued to grow. Just the nature of their work has shifted. It's gone from repetitive work to less repetitive, more knowledge-oriented work. We've seen a large increase in the number of technician staff we hire. And so my belief is that, again, well, it's impossible to predict the future. My belief is that that's really the pattern we're going to see around the world. Amazon and outside of Amazon is that as robotics are more and more prevalent in our lives, we're going to start to see the work shift. And as businesses continue to grow, I think the orientation of people being hired for repetitive, low sort of value work, or not low value rather, but repetitive, I'd say work that has to be done that could be automated versus work that actually here requires training and skilled labor, I think will start to shift. And I think a lot of companies are seeing that trend. For us, what we've learned is the best thing we can do in these transformative years where we're seeing technology come in to invest in upskilling our teams. And that's really why you hear us talk a lot about investments we're making in programs that are teaching people about AI, helping them get exposed to tools, and become capable and ready for that technology shift as it
but if I were to take forward this next generation of robotics that is sort of being debated and discussed at this point in time, and what it could mean as far as the workforce is concerned, one of the shifts especially on the last mile delivery side, I mean, do you believe that we could see a significant disruption maybe in the next 5 years on that front? I mean, we're talking about drone deliveries, etc. But will any of that be at scale, you think, in the next 5 years?
I think so. I think there will be robots and there's going to be automation at scale. Now, you could argue about what that scale looks like, but I think it'll be, I think there will be hundreds of thousands, if not millions of robots that are going to be across the industry doing things that today have not felt possible. What I think is harder to predict is what shape or form they'll take. For example, I think it's very easy to conceive that a delivery driver will have a robot assistant that can help carry packages, help sort of take something from the vehicle to the customer door. But I think it's a lot harder to imagine the entire process being automated, being done in an automated way. And so I think you're going to find that a lot of the creativity in robotics is going to shift from building the robots and the technology behind it to actually seeing how to integrate it into the real world, how to actually have it face real world challenges and be able to navigate it. And I have both from the history that we've been through, and I think just my experience, I think it's going to take people longer to get to that last stage, but integrating collaborative robots where you have a person and you have a robot that's sort of assisting that person, I think it's going to be a lot faster to come.
I want to do some trend spotting with you now. Udit, 5-10 years on, what are the big shifts that you see? We talked about speed and what quick commerce has done. We talked about the shift to more robotics, whether on the line or offline. We're also talking about electrification. You led that big ambitious project, at least as far as the US is concerned. What are some of the big shifts that you're working towards bracing yourself for?
I think for us, what's going on right now is actually very exciting. The the technology transformation, the focus on supply chains, resilience, the focus on automation, it really creates an opportunity to rethink how traditional supply chains have operated for hundreds of years. And so it's actually quite energizing because I do think that we could transform the way things are getting done, have gotten done traditionally. I see, a few areas. You already touched on a couple of them. I see speed and what customer expectations are continue to evolve. I think it's going to be a mix of really quick deliveries, deliveries that maybe come next day or same day, but end up operating with a supply chain that powers that looks very different from the supply chain that's powered e-commerce for the last 20 years. I think there's going to be a
How
lot.
so?
I think there's going to be a lot more focus on distribution and how to get the right products closer to customers. Much more so, and it's much more important now than it used to be, given that you really are no longer talking about a large network of 100 fulfillment centers. You're talking about a network potentially of thousands of micro fulfillment centers and hundreds of fulfillment centers. And so it's a lot more important to have a distribution network that can power that can get both an understanding of what customers want, how much they want, and what products to get there, and are able to get there fast enough and in a way that is resilient to spikes in customer demand or volatility from vendors or any other disruption that might come to it. The second, I think, is what AI is going to do, both to what the bar is for an efficient supply chain. I think if you look at supply chains over the last 2 or 3 decades, everybody's accepted a little bit of inefficiency or slop. They've affected some level of defects. And that's because that you practically couldn't throw people at these problems in an efficient way. Getting an address wrong happens. Getting a delivery wrong happens. And you can't really prevent that without a new construct. And I think AI is that new construct. And as you see agentic AI and physical AI evolving, I think a lot of what both businesses expect and what consumers expect of what the bar is for what their physical experience of supply chain ends up being, I think that's going to ratchet up. And I think that, again, both represents an opportunity for companies to invest early in it and are thinking about how to build the right amount of integration of these products to make these experiences more defect-free, more efficient. And I think it presents a opportunity to really maybe not dramatically, but significantly increase the experience that we offer customers.
Are you already starting to see that happen at Amazon today?
We're seeing it happening all across operations. I don't think there's one operations team today that does not have at least some work going on AI and several that have had success stories already. One of the early investments we made was in an area where we see probably the most contribution of delivery defects where customers don't get their package on time or they may not get it at all. And that's in our sort of mapping and geospatial systems. So these are the systems that try to represent the physical world. They can tell you exactly where a customer's home is, whether they like their delivery on the front door or the side door, whether to leave it with the receptionist downstairs or something else. And we found that using agentic AI and combining sort of the world data that's available with the Amazon data has allowed us to very rapidly close a number of gaps that for years didn't feel like we had a path to close. And I think it's early. And so seeing that level of success this early.
Has it brought down the defect rate?
It has.
By how much?
I don't have a precise number to share, but significant double-digit percentages.
Really? And so do you believe you could be in an era of zero defects on account of agentic AI?
I don't know about zero defects, but I think defects can become far more of an exception than norm.
Well, let me end then by asking you, we talked about what India has taught you, but what is the big surprise from the India experience so far? And you said that quick commerce is probably something that is exportable and you're seeing that experiment play out across several markets. But what's the one thing that really has surprised you about the way that India has managed to run on Amazon?
I wish there was one thing. There's so many things that have surprised me, but I think I bucket them all under the guise of the kind of innovations that are coming out, both driven by just the scale of the consumer here and some of the constraints that, if you will, that exist. Yeah, the surprise has been that we found innovations that have worked for India, but those same innovations are actually coming and solving problems all around the world.
Give me examples.
We talked about we talked about Amazon now as a business opportunity. Another one that I think is quite relevant is we launched this program in India called I Have Space. It's now called Amazon Hub Points. The program was trying to find partners with Kirana stores to deliver and both pick up and deliver packages for us. Came out of the need in India where we saw that building a large delivery network really quickly that could also handle the peaks that you get from the number of festivals and events that we have here was very challenging. And so partnering with these Kirana stores offered an opportunity for us to rapidly expand that network, scale up and down a lot faster, and offered significant incremental income to these stores. And so it was a great great program. We now have 28,000 of these Amazon Hub Points around the country. And we could have stopped there. You could have said, look, this makes sense. India has a lot of Kirana stores. But that same idea, was picked up by a team in Spain who was facing a challenge in the rural parts of Spain where they could not find the right amount of delivery capacity. It was also very volatile. So they started partnering with a store there. It worked really well. It expanded to other parts of Europe. We started looking at it in parts of the US where, you have very similar challenges with rural populations where you might have a house, that's 10 miles away from the next one. And that, surprisingly just took root in a very similar construct. Now you've got those stores in Mumbai, and we also have similar partnerships in Manhattan where you have deliveries from stores that help add the supplemental capacity as and when we need them. And so again, it's just one example of an innovation that was very started with India. We kind of call it an India first innovation, but took root all around the world.
So what's the next big idea that you're working on?
I wish I could share it, but we'll have to save that for the next conversation.
Next time. Udit, a pleasure. Thanks so much. Wish you the very best of luck. It's wonderful to have you join us here on Young Turks Reloaded. And thanks very much for spending time with us here at Amazon Sambhav.
Of course. Thank you for having me.
With that, it is time for us to wrap up this CNBC-TV18 special. Do send us your feedback. We always like to hear from you. But for now, from the team, goodbye and thanks very much for watching.